it's the large caps, it's a bit of a mixed kind of a day, at least mixed kind of a start. But otherwise, in the broader space, it's not bad, at least as far as the starting is concerned. And then we'll pick up on individual names, etc. If we have the heat map, I think that'll give you a quick sense of things. And then we'll get down to stocks, as we always do. So that's the heat map. It's, again, mixed. So about 30 names are higher. The rest of the stocks are lower, starting lower at this point in time. And I think, of course, we'd want to check out what's happening on IndusInd Bank. Surabhi.
Absolutely. IndusInd is not too bad. IndusInd is down just about 2%. And a part of that reason would be the stock already has fallen. I mean, was there something in the market? The stock has been falling consistently this week. This week, the Nifty is up 4%. The Bank Nifty is up 3%. IndusInd is already down 6% this week. And then you add today's decline as well. So perhaps the market kind of had a sense of this. For what it's worth, the stock is down 1.5% at this juncture. Bharti Airtel lower by 2.5%. Of course, it's that block trade that we're speaking of, which is the focus point here. The other weak names include SBI, Infosys, HCL Tech. These are the names. Then Reddy, Sun Pharma, also on the lower side. So IT is lower, Pharma is lower. Bank Nifty is absolutely flat, which brings me to the top side of the tally. Eicher Motors up about 1.5%. Coal India, Ultratech Cement, Adani Enterprises, Grasim. These are some of the names on the upside, but then the list just dwindles from that point onwards. Some of the auto stocks are still continuing their good form from yesterday. Hero Moto Maruti, for instance, are up and about. Eicher is not the only one. So auto is doing quite okay. Banks are flat. And IT and Pharma is weak to begin with. Just very quickly talking about the mid-cap market, because there is some outperformance there. The mid-cap index is up about 0.4% at this juncture. Talk about the gainers. Abbott, after numbers, 3.5% higher. Keynes Tech, like we were discussing, good set of numbers, strong margin expansion, so 5% up on Keynes. Endurance, after numbers, is 3.5% higher. IKS, SKF, all of these are result reactions. SKF is doing particularly well, 7% up, remember? So told us that it's been a really good quarter for the company. And that stock is up and about. Some of the defense names like Zentech, they're still running about 5% up on Zentech as well. So that's pretty much how it's opened out for the time being. Datamatics reported numbers negative, 7% lower. PN Guardkill after numbers down 5%. NCC, JSW Infra, these are also stocks on the lower side. So pretty much reacting to individual news flow and earnings. The Nifty is okay, about 45 lower. Prashant, let's see. I mean, yesterday also we had a very quiet start. And then the momentum picked up during the course of the day. So let's wait for that. By the way, those are the large trades. JSW Infra, the large trade that Vivek was alerting us on, that seems to have just happened. Yeah, absolutely. So, just a few other names here. Cochin Shipyard is the #1 volume-led gainer right now. It's up about 2.5% at this stage. I mean, this week, it's up 25%. I mean, that's basically from last Friday to Friday morning now. That's a 25% pop. Keynes is up about 5% this morning. Keynes Technologies is up 17% this week. There is Crompton, which is coming up with a 5% pop this morning. So stocks at about 343. Policy Bazaar, I think Surabhi mentioned, 2.5% higher. Stocks at about 1828 on Policy Bazaar. Zentech is, of course, I mean, the big winner this week. Even within defense, which has done so well, it's up 30% from last Friday's close. Zentech, largely in the anti-drone space. Vari Energy is up 3%. It's, again, I'm just sort of looking at this from a big volume-led perspective. SKF, of course, we mentioned. Data Patterns, another defense name. There's a company called Wanbury. Wanbury is up 15%. That's WANBURY. 320. It's coming up with significant volumes. I've not seen this with volumes like this. 500,000 shares. Right at the word go, but there is action. What else? PG Electroplast, of course, has been doing well. IK has reported numbers, margin expansion, and Surabhi mentioned that earlier. So that's, I mean, 2:1 in the broader market space at this point in time. So it's not a bad-looking screen. Newland is the only large cut. Newland is down 8%, which is coming up with a cut. And Sonorous is down about 7% as well. 504 on Sonorous. The other one is Allied Blenders on the other side. Oh boy. Allied Blenders will come up on your screen. It's pretty sharp moves. It was at it went up to 430. 429 was the high, and it's basically flattened out now. The intraday will tell you the story in terms of what has happened here. As I was saying,
There's been a big 30%, 35% pop over the last 4 odd sessions or so. More stocks in a bit. Rana Gupta is with our Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. Thank you very much for your time. You know, I just wanted you to talk about the Indocent situation, not Indocent and what to do with the stock. But as a long-term sort of money manager, how do you kind of sort of look at things like this, which happens occasionally in finance companies more often than elsewhere? Do you think, you know, a credible private sector person at the helm is what it'll take to bring confidence back, and that's essentially the only thing from here?
The lending business where you get tech deposits and they lend money, the importance of the management team is extremely important. And yes, I think a credible person with a considerable private or public sector experience will help restore the credibility. And basically, I'll make 2 points. The lenders who has a higher cost of funds, they, in order to generate a certain target ROA, ROE, invariably go and lend to the higher riskier segments. And these riskier segments in tough times, there's a little bad asset quality. It's important to recognize the pain and clean it off rather than pushing it away through any restructuring or any accounting methods. I think that has now come to the surface. So I think that's a very important point. And secondly, in recognizing and letting investors know about what's going on and raise capital if necessary. Those are all prudent steps, which I think will restore credibility of any financial institutions. Because after all, there is a big opportunity in lending to, let's say, rural India, lending to SME. But I think over-aggression on certain banks' front, chasing yields on certain, in cases, will result into this kind of troubles. But this can be fixed.
It can be fixed. Well, investors are hoping it gets fixed, and we don't have to, keep looking at sudden pieces of news of this nature from the bank. But anyway, good to have you on the show. Thank you so much for joining in. I just want to get your sense, Rana, on financials overall. I mean, what are you buying here? Because even with large cap banks, this quarter has told us that growth could be a challenge, though asset quality is okay, credit cost is coming down. But it's all about growth. So do you like banks? Are you looking at insurance companies? Are you looking at capital market institutions? What do you like in BFSI?
So the financials, we like the entire space. Okay. I think given the way even the global setup is, whereby we are seeing dollar declining, emerging market currencies, and the rest of the world catching a bid, it is good for the liquidity environment. It's good for the central bank like RBI, who has maintained prudent policy so far, also to inject more liquidity and cut rates. So I think the credit growth, it is weak right now. It will probably remain weak for the first quarter or so. But we expect a good pickup in H2 of the current financial year. And I think that growth, because of that, we like most of the lending institutions, including top class private banks, as well as the large non-banks. Non-banks, although I think in the result they said that not much scope for margin expansion, but I do think there will be some margin expansion playing out in the non-banking segment as well. The credit quality, I think, is still quite okay. Of course, microfinance and certain unsecured small tickets are a bit of a problem. But again, it's a pretty localized problem. We do not expect it to be a generalized problem. We also like the financial services segment, particularly insurance and capital markets. And the way the sectors that we like there, if you basically the aggregators, the distributors, I think companies like who are aggregating and selling insurances, the companies like who are offering wealth management services, they are, I think, a very good and clean play on the rising domestic savings and investment into insurance and capital markets. And this is going to be a pretty long-term structural play.
Hi, Mr. Gupta. Good to see you. And in fact, look at the way BSE has rallied. That's one of the financialization listed themes as well. Valuations going out of whack, but the street believes there's a long runway. So let's see how that goes. But Mr. Gupta, let's talk about this China plus one theme. Let's talk about some of these fancied sectors, the EMS plays. Everyone's building in that India can take some part of that share from China. Do you believe so? EMS, chemicals possibly, or would you play this theme?
In terms of China plus one, I think the long-term theme of multinational corporates diversifying out of China remains intact. And this theme started not now, this theme started some time back and will continue to last for a very long time. Progress will, of course, be gradual because relocating supply chain or developing new supply chain takes a lot of time. So in that context, I think the sectors that we still like for the longer term in this segment will be the electronics, EMS, electronic manufacturing services sector. I will also additionally add pharma, CDMO. That is one sector that we like. I will also add textiles, particularly in the context of the new FTA signing that has happened. I think textile is also one sector which can look very, very interesting from a medium to long-term perspective.
Got that. CDMO, EMS, textiles, these are all areas that you are bullish on. On the EMS thing, I mean, would you play any heed at all to these comments from President Trump yesterday about, I mean, not that the EMS industry is largely dependent on Apple. I mean, Apple, for example, the largest player, Dixon, has no exposure. It's all Android. But would you pay any heed at all to these comments?
Well, I think, the EMS industry, Apple is selling all their US, the iPhone they're selling in the US, they're sourcing it from India. And it took them quite a while, I think 5, 7, 10 years to do so. Although Apple has promised, significant investments within US, but, start producing Apple phone from day one is not easy. There is a huge component and huge supply chain that is required. Setting up that takes a long time. That is why I think it is only fair for these larger companies to have diversified supply chains. I think over a period of time, they will develop something in US also. That could happen, but that does not mean that India will not get its share. For example, I mean, we talk about Apple shifting production out of China, but that's probably 20-25%. Their mass scale, their production in supply chain in China still remains, and they continue to produce and sell to the rest of the world. This supply chain removing and establishing cannot really happen overnight. It takes 5, 7, 10 years. So while that comment is important and maybe a guide, maybe to Apple, but it will take a long time for them to set up something in US.
Talk is cheap, as they say, right? but that is what it is. In textiles, you're talking about apparels, or could you? Is there a subset here, or you own a bunch of them, Rana?
Yeah, textile is it's an emerging theme in the sense, the stocks are not very large and liquid in that space. But typically, we are looking out apparel exports out of India. And given the advantage that India might have in terms of tariff differentials, India has a good chance to gain market share in that segment. And also, as we are aware that the other main apparel and garment exporters, those countries face certain challenges. So I think both all put together, it is quite possible that India can gain market share in this industry.
Okay, so that's apparel. It's another area in focus. Markets down about 0.25%, so it's a bit of a cautious morning, 60 points lower at this juncture. But mid-caps continue to fly away. I mean, 0.5% up on the mid-cap index. Cochin Shipyard, by the way, reported numbers yesterday. That stock's continuing to find more traction. Though I think on the margin, it was a bit of a miss. But anyway, the market's mood is very different on defense stocks of late. So this is what we have going. Crumpton, like Prashant mentioned, still looking good. Kalpataru projects, 6% higher. Data patterns, Zentech. So, defense is still a very, very strong theme. Rana, speaking of defense, I mean, it's really been the theme of this week, right? I mean, the index is up some 9%, the Nifty Defense Index. And the stocks all of them are just literally touching the sky. I don't know, do you already have some exposure here? Or if you don't, for those who don't have exposure, is it too late to now jump on the bus? What's your advice?
I think within industrial space, there are two sub-themes that we like. One is, of course, we just discussed the electronic manufacturing, and second is defense. Defense is more because of import substitution, and defense we would prefer some broad-based plays. If one is buying a particular company targeting a particular segment, that will go through its own ebbs and flows and huge amount of volatility. For us, it's very important to get the returns, but also manage the risk. So that's why I think it's we would think someone who is diversified has exposure to a number of segments where the investments are happening, because let's be very pretty clear. I think rising defense expenditure and more localization, it's not just in India, but it's a global theme. So I think we would continue to see that going on. And our take would be that buy the one who is more diversified, or rather look at the one which is more diversified and has exposure to multiple segments. That is to reduce the volatility, but also get the long-term uptrend.
Okay. All right. Got that. Ran, thanks very much for joining in and giving us a perspective on the market. You have a good day and a good weekend as well. Thank you very much for joining in. Moving on now to the big story of the hour, actually, a story that came out last evening. More disclosures from IndusInd Bank that raise more questions. The bank has spoken about two specific accounting issues now, in addition to what was, in early April, the derivative discrepancy. We have Abhisar Divanji, founder at Neostrat Advisors, joining in. Abhisar, good morning. Thanks for joining in. So, for the benefit of our viewers, I'm just recapping what are these two new issues at IndusInd Bank. One is that the internal accounts department. Let's put up the graphics as well if we can, so viewers are aware of specifically what we're talking about. There is a 674 crore rupee entry which was incorrectly recorded as interest over 3 quarters. The bank has said all of this will be reversed in the 4th quarter. And remember, IndusInd Bank has not declared numbers just yet. So the 674, they're saying they've reversed it in January. So net, no P&L impact. That's number one. The second issue that the bank disclosed yesterday was that there was a whistleblower complaint. And on behalf of that complaint, again, the internal accounts department went in to check transactions recorded in other assets and liabilities. Now, they're saying that there were unsubstantiated balances aggregating to 595 crores in other assets account of the bank, and these were offset against corresponding balances appearing in other liabilities. Let's ask Abhisar what all of this means. Abhisar, I think the market's view is clear, and IndusInd Bank is a big underperformer this week.
Yep.
The Bank Nifty are up 3-4%. IndusInd is down 6-7%. So the market's view is very clear that there are way too many mistakes happening, and mistakes that are involving large amounts. Let's take the second part first. What does this mean? Unsubstantiated balances aggregating to 594 crores in other assets, but they've been now offset against other liabilities. And they've not clarified whether this means a P&L hit or not. Can you help us understand this?
Yeah. So, in banks' balance sheets, sometimes they have unreconciled suspense accounts. They have normal suspense accounts where entries bounce in and out. Like the derivatives transaction, for example, was also sitting in other assets and other liabilities. So what happens is that sometimes the way the accounting works is that an entry is made in income, for example, bounced off the other asset and then bounces out back when it gets reversed out, when the interest is collected or whatever. And that's how the other assets, other liabilities pan out in a bank. Now, it's important to note that even suspense accounts, which is accounts where unreconciled or unexplained balances also sit in other assets and other liabilities. So technically, unless one goes to the root cause of what these other assets and other liabilities were, which I'm sure IndusInd has done but not disclosed, at least to the in publicly declared forums, then one would not get an appreciation of exactly what was this. Having set off could have been the right option. But one needs to explain what these entries were, what the root causes of these unreconciled numbers or unsubstantiated numbers were, and how have now they been substantiated by netting off the other assets and other liabilities. Needs to be explained.
Okay, so you're saying that it's not something that is unheard of. It is done, but we don't know the rationale or the reason, and maybe we'll have more ideas. Now let's talk about the one that's causing the P&L hit. This 675 crores. I mean, how do you incorrectly recognize an amount as interest income for 3 quarters, and now that you're reversing the entire amount? What's going on here?
Incorrect is a harsh word, especially for the auditors as well as the internal auditors. Because we normally, don't certify balance sheets as correct or incorrect. So incorrect is a bad word to use, in my opinion. However, what would have happened here is that normally interest income in banks is computed through the system. And many things could have happened, and there's only a guess here because, again, there is no explanation. Is that, normally interest income is calculated by the system basis the loan and the input data. It could have been one that the input data was incorrectly entered in and hence the interest income was recognized. Could also have been that an NPA account, especially in MFIs, may not have been tagged as an NPA and the interest income would have continued to have accrued. These things are possible. But unless there is an explanation as to how this income was recorded, it's obviously not an accounting entry that's manually passed, in my opinion.
Okay.
These are systemic entries. But the root cause, the Surabhi of everything is that why don't we disclose comprehensively what the problem is? You're dealing with a bank which has lost confidence because of the derivatives issue. Thereafter, successively issues are coming out. And the issues are coming out as in they're dripping out of the balance sheets. And when they're getting dripped out, also we get reasons like incorrectly recorded or offsetted, unsubstantiated balances. I think there needs to be a far more clear and explanation of the root cause and the remedial measure done, so that people know that these things are not systemic. Otherwise, by default, people would think that there are many more things that can come out of this batch.
Abhizar, hi, morning, Prashant here. What happens to existing auditors? You think we will see more heads rolling?
Well, the auditors will have to do a lot of explanation here clearly as to how they established what they call internal controls on financial reporting. There's a norm in auditing called internal controls on financial reporting. It basically means what are the controls to make sure that the numbers are substantially true and fair. So they will obviously have to explain whether there were glitches in there, whether those controls had failed, and if so, why did they not detect it? I think that, but they are the last line of defense. There is internal audit, there is the company's accounting itself. So I think there are many lines of defense that need to explain this.
Abhizar, now let me ask you slightly. Markets are always hopeful creatures, right? They're already looking at where the stock is and saying, well, it trades at 0.7 times price to book. The book, though, is a little, we're not very sure about what the book is, but with what we have for now. The next, let's talk about next steps. I mean, I think they've hired an executive search committee to send, they're looking for a leader. Do you think that is essentially what markets will wait and watch? And I'm just looking at the stock reaction now. It's corrected a little bit this week, but markets are clearly focused ahead. What's your sense?
I'm no market expert, but I can tell you how turnarounds would possibly work.
Yeah.
And what will happen is that, yes, there will be a new CEO. There will be a period of stabilization where the CEO will take stock of everything because he really doesn't want dripping information to come in later on. So there'll be a taking stock situation. Then there will obviously be a remedial time where growth will take a backseat, but governance and regulation will take a front seat. And then I think a growth strategy will start. So I think we're looking at a 3 to 4 year turnaround period over which obviously growth will be the least important.
And it's possible that whoever comes in, I mean, if so required, you have one of those, I mean, famously SBI, I think when there was that big kitchen sink exercise, right? Many years ago. No, I'm not suggesting one needs to happen, but it's possible, right? I mean,
I think they will want to clean up, the balance sheet to make sure that the start is cleaner. I mean, we saw Yes Bank happen as a successful turnaround after so many years. So yes, something like that would happen.
3-4 years, Abhizar. So then 3-4 years. So what started as a 1,900 crore rupee, and I remember we had a conversation when the original derivative issue was disclosed. Now, obviously, Mr. Katpalia is on his way out. Do you expect more heads to roll? Do you expect the RBI to step in a clearer way in any measure? Because we thought that it's over and done with that derivative issue, but then they keep coming up with something new or the other.
Yeah, but I think there's a good structure being put in place at IndusInd Bank, to run this whole process. I don't think RBI will interfere too much in it. Should not, in my opinion. But what will work is that let the structure decide on a good stable CEO and give it its time to recover.
Are these, how would you, Abhizar, finally, I mean, how would, we don't hear of so many such issues with other banks. Why is this becoming a bit of a, repeat phenomena with IndusInd? I mean, no one's alleging that there's some malified intention here, at least none of that till now. Why is this happening? We don't see this with other banks.
So I think, what's happened is generally if you look at mid-sized banks, they've all been through a level of crisis over time. And any crisis manifests more on them, on their balance sheets. Like the MFI crisis would have hit, the mid-sized banks more. And they got impacted, in terms of valuations, in terms of perceptions. And when these kind of things happen, sometimes desperate times calls for desperate measures. So people take these measures over a period of time. And then in the the quest to grow significantly other parts of the business which are doing well, to make sure that the parts which are not doing well are covered well. Sometimes errors do happen. So I think it's part of running business, in my opinion. So I think the way to deal with it is, if there is adequately capitalized banks, we will have not much of an issue.
Okay. All right, Abhisar, we'll leave it there on that note. Thank you very much for joining us and giving us perspective in these two fresh developments, the whistleblower complaint and the 675 crore rupee interest income accounting that needs to be reversed. Let's actually move on. Markets are still down about 0.25%, so not much changing. That's where things have settled. Bank Nifty and Nifty both are down 0.25%. So let's move on to some more earnings and some of these conversations. JSW Energy is the next company on our radar. Now, the company reported an operationally weak set of numbers for the quarter gone by. To talk about this, we have with us Sharad Mahindra, Joint MD and CEO of JSW Energy. Mr. Mahindra, great to have you on. Thank you for joining in. So let's just talk about your own assessment of FY25, the way the year played out for you. You had some acquisitions and you obviously, are also scaling up. So tell us, what is FY26 looking like? Can you start with some targets?
Yes, FY25 has been a phenomenal year for us at JSW Energy. In terms of when we started the year at 7.2 gigawatt and we have ended the year at close to 10.9 gigawatt. It has been through both inorganic and organic routes, the capacities which we have added. And these are highly attractive, return accretive capacities which we have increased. We have been able to commission greenfield wind capacity of 1.3 gigawatt of our ongoing project, which is 1/3 of the country's wind capacity which has been added during the year. So all these things gives us a very strong foot entering in FY26, and we are absolutely certain that FY26 will be a significant year for us, both in terms of further capacity additions and in terms of the returns.
Well, so power demand trends for the summer have been muted. How are merchant tariff rates sort of panning out right now?
If we see last year, the average merchant tariff for the year was 4 rupees 47 paisa. And Q4 showed some increase, but in Q1 till now, in first 45 days, we have seen further increase in the merchant tariff. But here I'll just like to inform that for us, now the open capacity has reduced significantly to almost our operating capacity of 10,875 megawatt. When we started the year, only about 975 megawatt is open. And out of that, only close to about 9% of the capacity is now on imported coal. Rest all is like our Utkal unit in Odisha and the KSK acquired capacity, out of which 100 megawatt is open. All are based on domestic coal. So our fuel cost gives us a significant advantage being close to the coal mines. So even with the tariffs which are prevailing, these appear to be a very, very good opportunity for us to sell in the merchant.
Okay, got that point, sir. You recently converted short-term capacity with the long-term PPAs. Can you tell us what's the percentage of this conversion and what is it that you're still selling out there in the open market?
See, one is that, of course, the acquired portfolio of KSK with operating capacity of 1800 megawatt, 95% of the capacity is tied up with complete 100% of the fuel linkage. So that has increased our tied up capacity in long term. And also our Vijayanagar plant, which has been an imported coal-based landlocked plant where the fuel cost has been higher, has been totally converted into the long-term PPA, medium-term PPA with our group company, JSW Steel, with their increasing capacity. So that reduces our dependence on the imported coal, which by nature is volatile in nature in terms of pricing, in terms of currency movements. So that insulates us from those uncertainties.
No, got that. What is the timeline for the O2 acquisition? What's the sort of operationalization timeline and then its contribution to financials?
O2 contribution we have executed on 9th of April. So it is a part of our JSW Energy under JSW Neo. So it is fully is part of JSW Energy effective 9th of April. So, and with an operating capacity of 1.34 gigawatt when we acquired, and during Q1, we are certain that another 500 megawatt of capacity will get added, taking it close to about 1.9 gigawatt by end of Q1. And during Q2, another capacity addition of 300 to 500 megawatt, which will happen. So it will be a 2.2, 2.4 operating portfolio and by end of H1.
Okay, got that point. You've also announced a pretty large fundraising program. So what is the likely mode? I mean, are you using the equity route, debt? What will be the mix? And what will you use the money for?
We have said, which I will be talking about, that earlier when we announced strategy 2.0 of reaching 20 gigawatt of operational capacity and 40 gigawatt hour of storage by 2030, with the first timeline which we announced that end of FY25 to reach 10 gigawatt, as we have achieved the first milestone by reaching 10,875 megawatt of operational capacity, we are announcing today our strategy 3.0 of 30 by 30, means reaching 30 gigawatt of operational capacity by FY30. So this is one on which we have already have the orders in pipeline, the PPAs executed, under construction projects. So for all these things, the capital which is required, we plan to have a capex of close to 1,30,000 crores from FY26 to FY30. So this all with this significant capacity additions which we are doing will help us going forward from next year more of a generation of free cash. But yes, if required, we have taken the enabling approval for this 10,000 crores as and when required, because our growth has always been prudent. Our benchmark ratios to be what we have been talking of, what the rating agencies look for, we will definitely be below that. Whether we raise this equity as and when, we'll decide on which instrument we will go for at the appropriate time. And also whether in one or two tranches, that will depend on the capex requirement, what we are going to have and the timing.
Got that. So are you open to buying assets in the thermal space, especially in the stressed assets? Lots of assets are stressed and available at decent valuations. Are you looking at them?
Presently, if you see in thermal space, like we have signed a greenfield power purchase agreement to set up a 1.6 gigawatt of ultra supercritical thermal plant. When we have signed the PPA with the state of West Bengal, we will be now focusing on that, for which the work at ground has already started. And the KSK asset which we have acquired gives us a very unique advantage with 1.8 gigawatt operational and balance of plant ready for 3,600 megawatt. The fourth unit of 600 megawatt, 40% of the work completed. So we are certain that we will be focusing on this 1.8 gigawatt capacity expansion, which will be at a much, much lesser cost as compared to the benchmark cost of setting up any thermal plant. So we will be focusing more on this and our pipelines, organic pipelines, what we have. So our main focus will be on execution of the entire order portfolio which we have, order pipeline of more than 30 gigawatt.
Okay, got that. Also, can you give us a quick update on the renewable side? I mean, whether it's wind turbine generation or the green hydrogen plans that you have, where have you reached and what can we expect this year?
See, I'll start with green hydrogen. Green hydrogen work is at the final stage of completion, and we expect the commissioning of this plant between June or July of 25. So it's just few months from now when we will be commissioning this plant. It is at final stages of readiness. And regarding wind turbine manufacturing, as we had earlier said, is also informed that we have signed technology license agreement with SANY. So I'm happy to tell that SANY manufacturing unit for WTG supplies to us in India has already started, which is in the state of Maharashtra near Pune. And also to further optimize our cost and to ensure de-risking, we ourselves are setting up 2 plants of wind blade manufacturing in India to take care of our requirements. Both these plants will be commissioned in the current financial year only.
All right, so we'll leave it on that note. Thank you very much for joining in and giving us some perspective on your business. That is JSW Energy at the end of the fourth quarter. Need to take a very quick break. We come back to markets. It's a little bit of a cautious morning here in India. We'll have with us Daniel Morris of BNP Paribas Asset Management in our studio to give us some perspective on everything that we've seen over the last few weeks. Welcome back. Still continues to be a steady morning of trade. The bias is slightly negative on the large cap screen today, about 0.25% lower on the Nifty, and the bank Nifty is also down by the same amount. Mid caps are having a better morning. Well, as promised, let's get that conversation going with Daniel Morris, Chief Market Strategist and co-head of the Investment Insight Center at BNP Paribas Asset Management. Daniel, thank you so much for being here with us. It's great to have you in person. The world has been a very interesting place, to say the least, over the last month and a half. So let's start by understanding, I mean, at your level, when you talk about asset class calls and markets around the world, there was the love everything America move, then there was let's go away from America move, then whether you want to go to India or China. So just give us a top-down view of, the investment call and the framework that you're working with right now.
Yeah, well, the contrast between the very much everything in U.S. equities that you felt after the election. And, imagine if someone had come to you then on this show and said, no, forget America, you should buy China or you should buy Europe. You probably would have escorted them quickly out of the studio. But that's turned out to be the right call. I think what's perhaps a bit healthier today is it is much more balanced. So we're modestly overweight equities, so we do think it's a positive outlook. But honestly, no geographic call today. It's not obvious any particular region or country that you'd have a high level of confidence that that's likely to outperform or for whatever period. So we're pretty neutral geographically right now. As always, wait to see what develops to see if there's something that looks more appealing.
You said you're only moderately overweight on equities.
Yeah.
So you're cautious overall. So just run us through that.
Well, there's still, you hate to say it, but plenty of uncertainty. So to have a view where you really would want to be very overweight equities, we wouldn't think would be prudent. I mean, we're really still, and will be, honestly, for probably a couple months yet, assessing what the macroeconomic impact on growth is going to be of the tariffs. Many scenarios we can discuss, but since we don't really know which one's going to play out, having a high conviction call we think right now is not appropriate.
Any anti-consensus views, Daniel?
And well, to be honest, even be modestly overweight equities could arguably be anti-consensus. There's still plenty of people that think you're going to have, or certainly the risk that you're going to have a much more significant slowdown. At least in the U.S., people do still talk of a recession, even if hopefully the odds of that have fallen. We have to see what the actual impact on inflation is. And the other thing to keep in mind here, without question, the tariffs are going to be negative for growth in the short term. But that's happening in a context where growth in the U.S., at least, was already slowing for other reasons. Remember, we talked about a soft landing as a scenario for the U.S. before the election, which meant that consumer demand was going to slow and growth would fall. That's actually probably happening anyway. And then you add the tariff shock. It's a bit unsettling when you try to forecast what's going to happen with growth.
With China, the view is that maybe we've seen they have some sort of a handshake deal for now, and then we'll get probably like a MOU and then probably a deal later. But even back in 2018, China actually started slowing down when those first set of tariffs, etc., were imposed. I'm asking this in the context of India, because generally, if you read the press, if you read, the view is China has come out on top. with regards to negotiations with, I mean, they've not given in very much and they've been able to reduce tariffs to 30%. Is that, I mean, would you agree with that, Daniel? Or you think we will see another leg of slowdown in the, look at what happened in 2018 and this is much bigger.
Yeah, I probably have a slightly different view of what's occurred in terms of the reductions we've had. I think the initially very high tariffs, the objective was to get to the negotiations. The idea was not to leave them there permanently. So the fact that they've been reduced, well, is because we're negotiating. So from that point of view, I don't know that I see that's the case. But ultimately, it's going to come down to what the agreement is. And I don't think anyone assumes it's going to be an easy discussion. I think, you know, not only with the negotiations with China, but essentially with all the U.S. trading partners. What the U.S. wants to see is a reduction in tariff levels vis-a-vis the U.S. And, you know, ultimately we have to see how successful that is, and then we can assess whether or not it turned out to be worth all the turmoil that we've gone through or not.
You know, on tariffs, yesterday President Trump made a very interesting statement. It was picked up widely by everyone in India. I know you know what I'm talking about, right? He's calling up Tim Cook and saying, don't make phones in India for the US. How do you think, this is an example I'm picking up, how do you think this is going to play out in terms of corporate America sentiment? And again, I go back to the main question that I think this is why you're not too optimistic on equities. But what are you pricing in, I mean, for the rest of the year, say, in the US market or any of the other regional markets that you may like?
Well, I think, you know, when you think about, you know, people discuss what are the risks to growth, and one of the points that people highlight is uncertainty. So supposedly we're also uncertain about exactly what's going to happen, and therefore you're worried about the impact of that on growth. But I think one thing is pretty certain, which is you are going to have tariffs in the U.S. And the point then is it's a clear message to businesses that if you want to avoid those tariffs, you want to produce in the U.S. So regardless of whatever statements you might hear from the administration, you know, any company is going to be evaluating, I can produce or attempt to produce more in the U.S. And therefore avoid the tariffs. And if I produce elsewhere and import, there is going to be a cost. So it's going to be ultimately a financial assessment that every company is going to make as they should.
So as investors, what is your overall portfolio architecture? I mean, you're saying moderately positive on equities. So what else? I mean, do you like treasuries? Are you advocating a bigger shift towards gold? So what's the portfolio call at this point, given the environment?
I guess two key positions to mention outside of equity. So within fixed income, the view is a relative preference for European fixed income versus the U.S. I mean, to be honest, it's relative. I would say simple. But in Europe, it's a bit more clear in that you are certainly going to have lower growth because of the tariffs. Tariffs are going to likely to reduce inflation in the Eurozone. You worry about an increase of Chinese exports to Europe to offset the U.S. All of that negative for inflation, or at least bringing inflation down. And then, of course, the ECB is cutting rates and the Fed is not. So it all suggests that on a relative basis, you would have a preference for European fixed income, which we do. And then we still have a modest preference for gold. We had a much bigger one previously, but needless to say, gold has moved a lot. So not quite so optimistic about the future, but nonetheless, the two key drivers of the performance of gold over the last 18 months, number one, central bank reallocation of portfolios from treasuries to gold. That's likely to continue. And if you can call it the Trump premium in gold prices, that's probably going to stay, even if, all the volatility that we expect around it, but not likely to disappear either.
A great conversation, Daniel. Thank you very much for dropping by. It's a pleasure having you here.
Thank you.
Well, what we're going to do is take a quick commercial break here. We're down, 65 points, 24,900. Actually, we're at about 25,000 as things stand right now. Let's actually welcome in the next management who's joining us. I'm talking about Arvind, which reported numbers. And here, of course, as you heard from Rana Gupta of Manulife earlier, a fair bit of excitement. We have Kulin Lalbhai, Vice Chairman at Arvind, now joining us. Kulin, good morning. Great to have you with us here. Appreciate it. Just a quick run through of what you've seen. I think we're speaking for the first time after that India-UK FTA. So I just wanted to start with that before we drill down to numbers for the quarter, etc. What is your assessment, Kulin, in terms of what this can do for Indian textile exports?
I think the UK FTA is a seminal event. I think it's an extremely strong positive for all the high labor-intensive sectors in the country. And the UK is a large trading partner as far as apparel is concerned. And currently, India's share is quite small. We export $3 to $4 billion dollars worth to that economy, and we can easily double it as a country in a shortish period of time. So I think this will be a big positive. I think you will see the scale up play out over the next couple of years because it takes a certain amount of time to build more capacities in garmenting and for brands to start reallocating supplies here, because we had a huge disadvantage with the UK. All our competing countries, Bangladesh, Vietnam, etc., had a 10% advantage, which has now got nullified. So it's a very strong positive for the sector.
Kulin, hi, great to have you on. So it's all about trade, right? Just give us a sense of your exposure to Europe, to the UK specifically, where we've already done that trade deal, and the US. In terms of exports for Arvind, which are the key markets and in which order? And within that, UK specifically, if you could tell us that if you stand to benefit because of this FTA.
So our current exposure to the UK is not very large. It's around 5%, but we see that as a very large opportunity. I think this is our chance to look at that market very differently. And we are already thinking through how we will scale up our exposure to the UK. Our US exposure is much larger. That's around 30% of our overall revenues. And even there, we are seeing that after all of these trade uncertainties, I think generally brands are looking to using India as a strategic future sourcing destination. So over the last month and a half, we're seeing a lot of US brands also talking about being more strategic with Indian vendors and thinking of ramping up capacities.
Okay, so UK could be an opportunity. Got that point. So let's talk about the domestic market outlook as well. And then I want to come to the overall picture for FY26 because there's so many moving parts. Domestic market, when you're looking at volumes that you have visibility on this year, maybe pricing, give us a sense on pricing as well, on both counts for the local market.
So last year, the consumer sentiments in India have not been at the best. But the first quarter of the year, at least as far as our textile business is concerned, we are seeing reasonably good demand from the Indian brands. So currently, we are cautiously optimistic that as the year progresses, the demand scenario should be better than that which we saw in FY25. And possibly as we move towards Diwali, as the inflation reduction kind of plays out, as the tax cuts kind of play out, we do expect an uptick in the consumer demand in the quarters to come.
Okay, so you're expecting some improvement in the local markets. Like you mentioned, you're looking at opportunities in Europe as well. What about the US? Are you worried about that 30% exposure given this, unending almost protectionist talk? And we don't know what's the shape and form of the deal with the US. Those details aren't out yet. But could there be a concern there?
You're very right that there is uncertainty. I think the way to look at this is to look at it from a window of relative attractiveness. And even with whatever trade talks have happened with China, China still stands 20% higher than India on tariffs. That's not a trivial number. And the US highest exposure still remains with China. US imports around $100 billion of apparel. 22% of that comes from China, whilst India is just 4%. So relatively, we still remain better placed. And we are seeing, as I mentioned, the body language of global brands to look at India differently and to scale up capacities here. I think in the short term, this does lead to uncertainty. There will be some tariff-related potential impacts on margins in the very short term. But we are seeing volume compensate for that. So brands are saying we would want to give you much more volume. Just help us out a bit with the very short-term impact on the tariff side.
Yeah, one just hopes that the US president doesn't start calling up the Gaps of the world or the other textile or apparel majors in the US, like he called up Tim Cook yesterday, saying, please don't take from India. One can only hope. But Kulin, all things put together, now I'm going to the bigger picture. I mean, FY25, your top line was up about 8%. Margins, were around 15%. Now, since you're optimistic on the India business, at least Indian demand picking up, UK you're saying could be a big opportunity. What should we expect? How much growth? I mean, can you do at least double digits? And what's the outlook on margins?
Yeah, I think last year actually we had an impact of an industrial unrest in the first quarter of the year, and that impacted FY25 for us. So if you remove that impact and looking at whatever business plan we have, where we are focusing on a ramp up of our garments business and significant growth even in our advanced materials business, I think if we add both of those growth drivers, we do expect our growth to go, into the double digits, and we do expect, and a lift in margins as well. I mean, we want our EBITDAs to grow faster than our sales, so we do expect a mid double digit growth in EBITDA.
Okay. And so the margin would then work out to how much better than 15%? Or
We
is
don't
15%?
exactly give margin guidance, but I think generally what I can share is we do expect operating leverage to also kick in into our business next year.
Got it. So that'll be good news for your shareholders. Quick update on the capex. I think this year you're talking about 450 to 475 crores of capex. Is that all through the internal accruals? And where will the money be used? Also, just tell us about the additional capacities across your businesses that would be coming on stream this year.
We spent around 470 crores in capex. It was spread one-third across our garments, advanced materials, and textiles businesses. And we'll have a similar amount of capex the following year as well. We have seen no increase in our debt levels, so all of this is coming from our internal accruals. And broadly, we've been guiding that our garmenting capacities will see a lift of around 15 to 20%. And we hope to continue to grow our advanced materials business at close to 20%. So these are the two growth drivers which are kind of being pushed with this capex plan.
Garmenting and advanced materials. Got it. So they get another leg up with the additional capex. Kulin, thank you very much for joining in and giving us pretty well-rounded view of course, local operations here and what all these shifting trade winds mean for the business at Arvind. We'll take a break on that note, come back on the other side. We'll wrap up the market action once again and, of course, talk commodities. Manisha will join in. All right, welcome back. So as we've been telling you, equity markets are taking a little easy this morning. Nothing too bad. It's just around the flat line, frankly, for the Nifty and the Bank Nifty. Midcaps are actually doing quite okay. But let's now shift the focus to commodities. Manisha is here with us in the studios. Manisha, so what's your big headline this Friday morning?
Well, I'm absolutely looking at the gold prices because after being very, very strong and making all those headlines for most part of 2025, we're finally looking at some profit taking coming in. Well, the gold is trading at a 5-week lows. It's headed for a weekly decline of 3%. And this, by the way, is the worst weekly decline that we are looking at in last 6 months coming in for the gold prices. Also, when you look at the prices, the way they have come off, remember $3,500 an ounce was an all-time high. And from those kind of levels, we have seen the gold prices come off by nearly 9 to 10%. The low that the gold market saw yesterday was to the tune of $31.25. It's just about holding $3,200 an ounce in the Asian markets right now. Well, there are various reasons for the gold prices to come off. One, of course, is the tariff de-escalation, which seems to be weighing on to the safe haven buying there. It also is about the Fed rate cut expectations, which seems to be scaling back in sense of time and quantum both. And then it also is about rising U.S. Treasury yields, which is weighing on to the markets right now. The gold is also off highs because we're looking at CFTC data showcasing that many of the net long speculative positions seem to be now winding down. There actually are more shorts being created as well. And why not? Because you've seen the gold prices on a one-way rally from $1,800 an ounce since October 2023 to almost $3,500 on the higher side. So people have been holding those net longs and we are finally looking at some profit taking there. And speculators cutting their net longs has been on for 5 weeks now since the gold prices hit an all-time high there. They're down by nearly 30% from in the month of April on a month-on-month basis. And from where the net longs stand right now, this is the lowest since Feb 2024. So clearly, a lot of profit taking, a lot of money being pulled back from there. But it's interesting to see on how we've seen trading volumes for the month of April. They have been at a record $181 billion a day there. And also when you look at the ETF buying, well, we've seen 67% of a jump up in the month of April on a month-on-month basis. Well, markets do feel that going forward from here, it's not going to be a very sharp correction. Nobody's talking about 2,500 or 2,000 or going back to those kind of levels. That is because the U.S. chaotic tariff policies perhaps would just about continue. It also is about central bank buying. Every time you see the gold prices coming off, you will see those central bank buyings. And then portfolio diversification, inflation concerns, especially because of tariff and especially in US will support gold prices there. The global ETFs is something that you should be keeping an eye on. As I told you, the ETF buying for the month of April jumped up by 67% on a month-on-month basis. For the month of April, it has been the highest since March 2022 at around $11 billion. This is a global number there. But when you look at the Asian markets, and this is where the maximum ETF buying came in at around nearly $7.3 billion, which is the strongest on record. So while the speculators are taking money off, it is the retailers, investors, HNIs and ETF buying which seems to be supporting gold.
Okay, all right, got that. Manisha, thank you very much. So gold in sharp focus. We need to take a very quick break, but do stay on because on the other side, we're getting you a special segment of Indianomics. Lata speaks with Mitul Kotecha of Barclays and Louis Kugis of S&P Global Ratings on the impact of the US-China deal.
Welcome back to Indianomics. Well, we have been discussing whether the US-China deal has completely erased the worst possibilities of tariff wars and whether it can actually lead to some growth upgrades, at least for Asia, for China in particular, Also, what happens to yields and currencies in Asia now that the overhang is gone? Joining me are Louis Squeeze, the Asia economist of S&P, and Mithul Kotecha, head foreign exchange FX at Barclays Bank for EM Macro Strategy. Gentlemen, thank you very much indeed for your time. Well, Louis, let me start with you on the first growth picture. Any changes to S&P's growth forecasts for the global economy or for China because of the US-China deal?
Well, that's definitely the lowering and suspension of tariffs between these two large economies is a plus for the global economy and for these economies themselves. It matters a lot for China. We will be looking at that again. These things take time, changing one's forecast, so we don't do that overnight. But definitely, this is a positive for the economy. It will also, of course, probably mean a bit less stimulus necessary in China, but that's all a good thing. So this by itself is a piece of good news, even though, of course, there remain quite a few areas of uncertainty, both with regard to the US-China dimension and also more generally. There's still a lot of uncertainty hanging over that global trade arrangement.
Oh, yes, let's not forget that this is a 90-day truce. But Mithul, what is the sense about, first, the Chinese yuan? We saw that rapid appreciation, almost 7.18, even 1.7 on a day, on an hour. Do you expect that there will be an appreciation of the yuan that we should be prepared for? What are the ranges you're looking at?
I think at the moment, you're right. We had an initial positive reaction in the yuan on the back of the trade truce. But the reality is, I think it would be hurting China's economy if we do see continued appreciation of the currency. Now, obviously, the dollar has been very restrained. But our view at the moment is that the pressure on the dollar, the headwinds to the dollar have been fading, and we don't see much more downside from here. And so in that sense, currently, if you look at the fixings that we see on a daily basis, the PBOC sets these fixings, and they've been generally around this 720 mark. So there's no real sense here that China's looking for an aggressive appreciation of the currency in this environment. If anything, with a weaker dollar or a weak dollar backdrop, China's benefiting from some trade-weighted improvement of the yuan, actually much like the rupee has done in recent months. So in that sense, they don't necessarily have to see a stronger currency versus a dollar. But our view is still that we will see some depreciation of the yuan in the months ahead. We think that the currency is still one of the release valves of economic pressure, along with more fiscal stimulus and more monetary stimulus. Now, admittedly, the pressure on the economy is less than it would have been given the tariffs truce, but there is still economic pressure, and growth is still coming under that downward momentum without further stimulus, whether it's monetary, fiscal, or via the exchange rate.
Okay. Actually, things are pretty clear when it comes to equities because everyone's reading growth after the US-China deal, but it's very confusing on the currency and yields front. Louis, what are your thoughts on Asian currencies? Not just the Taiwan dollar, which I'll discuss separately, but the rupee itself has zigzagged a lot. What is the longer-term view on Asian currencies?
Yeah, I think we've seen a quite remarkable, very interesting, but also unexpected shift in currency markets in the last 6 months or so, because 6 months ago everybody, all the experts were saying that if the US is going to engage in trade wars with everybody else, that will strengthen the dollar and will weaken other currencies. In fact, the opposite happened, and the opposite happened in large part, I think, because financial markets started to reprice US assets compared to the assets of other economies. We've seen there have been capital flows, into Europe, into Asia. I'm not sure that this is completely over, but I'm also not sure that we can extrapolate from this. I would still expect there to be some at least, risk and uncertainty hanging over those Asian currency markets as that that situation on tariffs and what will the US eventually roll out, I think that will still weigh over those currency markets. Having said that, our forecast has for a long time been that if you look at, say, a 3-year period, we expect most Asian currencies to strengthen against the US dollar from a position. In the current situation, most Asian currencies are still quite weak vis-a-vis the dollar on fundamentals. So there is some room still for further strengthening of Asian currencies.
Strengthening of Asian currencies. Actually, a previous speaker also said that, Neeraj Seth. Mitul, what are your thoughts? Is the rupee going to get stronger? First, Asian currencies, but more specifically the rupee.
Sure. Look, I think I have some sympathy with the view because we wrote a piece recently highlighting the massive net international investment positions that Asia has, countries like Korea and China and obviously economies such as Hong Kong, Taiwan. And we've seen the upward pressure more recently on these currencies. You mentioned Taiwan dollar, very, very rapid move in that currency. So I think if you could see a big repatriation of this money coming back into Asia, yes, there could be some severe strength, significant strength in Asian currencies. But again, it's not our base case. We still see the dollar picking up some ground in the next several months. Even though structurally there is some shift out of US assets and shift of repatriation, which is a longer term path, we will see cyclical and large moves cyclically in that environment. And we still think the bias will still be for dollar Asian currencies to move, or dollar versus Asian currencies to move higher. And I would say similarly for the rupee. I think we're finding a sort of base around this sort of 85 level for dollar rupee. We have seen some improvement in competitiveness more in the last few months. But again, I think the RBI would probably want to avoid any real richening of the currency from these sort of levels. At the same time, I think there will be continued focus on what the CNY is doing. And I think India will focus on that. And I would doubt that we want to see a move out of that sort of range that we've been in. Potentially, you could see CNH INR cross also moving, back towards sort of the 12 level where it was some time back. So look, I think that I think the downside risk on the rupee will pick up in the next several months. Not a massive depreciation, but perhaps a gradual depreciation of the rupee.
Okay. Well, actually, the market is quite deeply divided. You just heard Lewis saying that, he expects a rupee appreciation, or rather Asian currency appreciation. A lot of this confusion is coming because of the dollar. Why are you expecting a dollar appreciation at all? Trump himself wants a dollar depreciation. Is the appreciation likely because he may announce tax cuts as you get into the middle of the year?
I think, again, any appreciation is probably a lot milder than had previously been expected, for sure. I mean, I agree with the comments that, everyone had expected the dollar to strengthen on tariffs, and it just didn't happen. And now we're probably seeing better news on the US and less tariffs and less economic impact, less policy gyrations. And that actually, perversely, could bode well for the dollar. So, our view is that sentiment and positioning is really stretched negatively on the dollar, that we might start to see some better news coming through from a point of view of less extreme negativity. And that could help the dollar to pick up some momentum as we go through the next several months after being in this very oversold territory that we're in presently.
Okay. Well, let me just finish the India growth story with Lewis. Lewis, what are your growth forecasts for India? And interest rate as well. The Reserve Bank's policy is up next month.
I think when we look at our forecast for the different economies in Asia, the Indian one, the forecast for India has been among the more stable. We still we nudged down our forecast for the fiscal year, for current fiscal year, to 6.3%, but we expect growth to recover to about 6.5% and then move up to close to 7%, in 2-3 years' time again. So we've factored in our Indian forecast the impact of that, of really that all that trade turmoil. But our medium-term view on India remains pretty positive, with growth of around 6.5-7%. On the RBI, we do think that the RBI will consider there to be room for them to lower rates later in the year. We actually expect 75 basis points of cuts this fiscal year.
Okay, 75, actually, the market is moving to the view that the end repo rate could be 5/4. But Mitul, the other big question I wanted to ask you is this Taiwan dollar appreciation and the latent fear that the US may impose non-tariff barriers like asking people to buy 100-year US treasuries or, in some way forcing a depreciation, an appreciation of Asian currencies. Does that threat still remain?
Well, that threat definitely remains. And for example, just yesterday, or last couple of days, sorry, we had these comments out of Korea where there had been some statement and reports that the currency, the Korean won, had been discussed on May the 5th between discussions between US and Korean officials. And we saw quite a sharp rally in the Korean won. Similarly, Taiwan dollar, there is, and I would argue the yen as well, that there is some focus on whether currencies will play a part in these trade discussions. And as you highlighted earlier, some in the US administration do want to see a weaker dollar. They do believe that Asian currencies are vastly undervalued and that they should be strengthening somewhat more going forward. And that is a big risk. And I think that is one of the reasons why currencies in Asia have been doing so well lately and catching up with the moves in the broader dollar sell-off that we saw against major currencies.
A quick last one, Mitul. Why is it that the US bond yields are not coming down at all? They're remaining at around the 4.5 mark even after yesterday's fall. And if they remain at that point, what is the impact for Asia?
Well, it's a good point. And I think the the risk premium, the term premium has been something that's been increasingly priced into the US bond market. The worries that the fiscal expansion in the US is going to get out of hand from a deficit that's already around 6.5%, 7% of GDP. There's still lingering worries about inflation risks. And the Fed perhaps not moving as quickly to counter that. So, and also one other factor remains foreign selling. We go back to the same theme, concerns about foreign selling of US treasuries. Now, we think some of these concerns are overdone. Our US rate strategists have just put out a piece highlighting that they still remain quite constructive on treasuries going out further. So, we don't think this pressure is going to be sustained. But of course, if US rates continue to remain high, that would bode quite badly for Asia rates markets and Asia overall because of the fact that we'll see continued funding sucked towards the US. We'll continue to see perhaps some latent pressure on Asian markets because of that.
Okay, well, that remains the big question mark in terms of, how smart money will move. Thank you very much, Louis and Mitul, for joining me and explaining what is still a picture with too many moving parts. But that's it on this edition of Indianomics. Thanks for watching Chartbusters after the break.
Bharti Airtel slips following a large trade where nearly 1.3% equity gets exchanged. Sources say Singtel is the likely seller. Another large trade today pushes JSW Infra lower as well. 4.5 crore shares worth nearly 1250 crore rupees change hands. Sources say it's the Sajan Jindal family which is the likely seller.
IndusInd Bank trades under pressure after the bank discloses more irregularities. The Internal Audit Department's report finds 674 crore rupees was incorrectly recorded as interest over 3 quarters of FY25. CLSA downgrades the stock.
Crompton climbs more than 4% after posting good numbers, now up 6%. Revenue comes in line while profit and EBITDA beat analysts' expectations.
Newland Labs slides more than 6% after showing a weak performance for the fourth quarter. Revenue declines 18% sequentially. However, the management says growth will resume in FY26.
In other results reaction, we do have IKS Health and SKF India trading higher on the back of their numbers. In fact, we have the management of both these companies joining us shortly to discuss the quarter gone by. So don't go anywhere. Good morning. You're watching us here on Chartbusters on CNBC-TV18. I'm Mangalam Malu. With me, Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. And it's been a decent day so far. No real worries. Yes, there has been some decline from the highs, but Nifty is managing to hold on to the 25,000 mark, which it captured yesterday. And the Midcap Index, that's doing a lot better, up nearly 0.8%. And almost 1,800 stocks advancing for 800 stocks which are declining, telling you that your portfolios are looking a lot better. No real problems. After a big rally in the second half of trade yesterday, we are seeing some bit of give back. Again, nothing really to worry ahead of the weekend, Winnie.
Absolutely nothing to worry ahead of the weekend is what we're watching out for. But two sectors that I want to highlight, IT and pharma. Both these yesterday also were subdued in trading session. Today, also a bit of a red is coming in on the screen for both these sectors. We have the Nifty Realty, which is managing to hold on to good gains among the top sectoral gainer today. So keep an eye out on that. And a whole host of other stocks like GE Shipping that continues to be in focus, as well as BEML also in focus as well.
All right, let's get cracking on the numbers. We had promised to you while we were reading headlines that the management of SKF will be with us, and that's exactly what we have. Up 6% in today's trading session, that stock, because Q4 has historically been a strong quarter for the company. In that as well, they've shown margin expansion. Mukund Vasudevan, who is the managing director of the company, joins us now. Thanks a lot, Mr. Vasudevan, for joining in. Congratulations on a good set of operational performance that has come by. I'd just like your thoughts on a couple of things before we, move ahead with what the outlook for the next year looks like. If you could give us a split of the performance in the fourth quarter for both your industrial and automotive segments, and where was the margin expansion more? What was the operational performance of both these verticals like in the fourth quarter?
Great to be here, Mangalam and Vinny. A good performance overall. We expanded our margin by almost 20% this quarter overall, and we grew the top line by 1%. The top line growth hasn't been as strong, but you can't look at one quarter. If you look at the full year, it's 8% growth, and that's pretty consistent with what we have done year on year for the last 5 to 10 years. So in terms of automotive and industrial, the margin expansion has come from both. Both have done very well, and on the back of operational improvements on the manufacturing side, cost controls across the board, and some intercompany benefits we've got, which is from all the imports we're doing from other SKF global factories.
So if you could quantify that, the growth that we saw in the revenue for both auto and industrial, and the kind of margins that we saw year on year?
Yeah, so industrial grew by around 2%, and automotive grew around a little less, so averaging out around 1% top line growth. On margin, industrial grew by almost 25%, whereas automotive grew a bit less, but it's a smaller portion of our business overall, 40% or so. Right. So, and then what was your second question? Sorry, Mangalam.
No, that was all about it.
Yeah. Okay.
Okay, Mr. Vasudevan, good morning. Thank you so much for joining in with us. What I want to also know is in terms of your two-wheeler and three-wheelers, what is the share of premium over here and the outlook that you have on EV adoption for yourself?
EV adoption is growing. It's still slow, meaning it's still small in terms of volume in India, but it is growing. And SKF is very well positioned to satisfy this market because Two-wheelers, as you can imagine, are all about lighter weights. It's all about energy efficiency, and that's the strength of SKF. So our business in EVs is absolutely booming. Two-wheeler market tends to go a little bit to answer your first part of your question, two-wheeler market tends to move up and down a little bit with economy, especially rural. This quarter in particular, our expansion has been primarily in actually passenger vehicles, where SUVs are continuing to boom, and also in smaller commercial vehicles. This is the last mile delivery vehicles, where we see that with the boom of e-commerce and quick delivery, there's more and more demand for smaller commercial vehicles, and that's the two areas we have grown. Two-wheelers have been steady, but it's still it's not the strongest quarter for this year.
All right, and what about the year ahead? You know, you've grown about 8% on top line this year, but operationally it's been absolutely flat. You've actually lost margins by about 100 basis points. From 15.7%, it's gone down to 14.7%. And there has been a marginal growth in the profitability as well, just about 2.6%. Notwithstanding the fourth quarter, which was strong, the entire year wasn't so. What's your outlook for FY26 as we look at it from the start?
No, I think we'll continue to deliver strong profit before tax, right? We typically maintain in the range of around 15 to 18, and we will continue to do that. It's been a record year in terms of absolute profit, but you're right, the margin could have been better, but it's we can't base it on 1 year. Overall, our trend in profit has been growing at around 13% year-on-year CAGR for the last 5 years. I think we'll continue this trend. We see, barring any kind of major macroeconomic issues, we see this 25, 26 continue to grow in the high single digits or low double-digit numbers, as well as top line, as well as the profit before tax should continue to be in the 16 to 19% range. You know, one major thing which is happening is this year is the separation of a demerger of the automotive and industrial business, which we believe will build two world-class fit-for-purpose companies. I think you'll see margin expansions coming from 27 onwards in these. But this is going to be a major year where we'll see this demerger happen. There will be some headwinds because of that, but irrespective, I think 27 onwards, you'll see margin expansion on both sides.
When will this demerger, actually take place in FY26, first half, second half? When are we expecting that by?
So that is expected in around November timeframe, but obviously it depends on SEBI and NCLT approvals.
All right. I just wanted a couple of things on the demerger itself. If you could now give us a sense on the pro forma gross block of both these verticals, the kind of balance sheet that both of them will have in terms of debt or, capex that will be deployed from either of these verticals. And basis that, the compounded growth rate that we can expect on both these verticals over the next 3 to 5 years post demerger.
A lot of this is being worked out as we speak, Mangalam, so you're kind of jumping the gun here. But I'll tell you that the basic idea is the two businesses are very different, automotive and industrial. Automotive is a lot about, if you take manufacturing, for example, it's large volumes, series production. Industrial tends to be smaller batches and a lot of resetting, which happens in these. Industrial is a lot more varied in terms of different industries we serve. Automotive is a little more linear that way in terms of the two-wheelers, the commercial vehicles, passenger vehicles, etc., right? And EVs. Even the trends which are emerging in both are slightly different. And that's the reason we're doing this demerger, because we believe we can then create an entire value chain from manufacturing to innovation to sales, which is catered specifically to both these entities. Both, we would see a margin expansion because we believe that it will become more efficient and not have one business drive the other or vice versa, right? I think both will become more efficient. So we see margin expansion happening on both. We also see better capital allocation because today, if there was a capital allocation choice, typically because as you see, profit before tax for industrial tends to be a little higher, the capital allocation tended to go to industrial. So if you had a choice, now capital allocation will be a little more efficient in this when you have a demerger. And then on the growth front, I think we would expect to see similar growth on both. I would say if we can continue the 10% plus double-digit growth which we have delivered consistently for the last 5 years, it'll be good. I think we can actually see expansion because we can do more innovation specific to industrial and automotive. So I don't have specific numbers as of yet, but I'd say that this is how the trend is going to be.
Okay, Mr. Vasudevan, thank you so much for joining with us on the show this morning, explaining us what to expect from the company going forward. High single-digit to low double-digit revenue growth in FY26 and maintain margins at around 16 to 19% on the PAT level. But on that note, we're going to step into a very short break, viewers. On the other side, we'll be joined by Sachin K. Gupta, who is the founder and CEO of IKS Health, as well as Nithya Balasubramanian, who is the Chief Financial Officer at the company, to discuss the quarter gone by. Welcome back to Chartbusters on CNBC-TV18. Now let's focus and put the spotlight on IKS Health. They reported their numbers, a 17% revenue growth on a year-on-year basis, driven by ramp-up in client additions as well as good margin improvement is what they've seen. Now talk to us about the numbers as well as the outlook of the company going forward. We have Sachin K. Gupta, who is the founder and CEO of the company, as well as Nithya Balasubramanian, the CFO of the company, joining you to talk to us about all of that. Sachin as well as Nithya, thank you so much and good morning to both of y'all. Before we dive into the numbers, just yesterday we had, more updates coming in on United Health, the issue on that front as well. I just want to understand what would be the impact of this on the company, any concerns that we're watching out for in FY26 on this front?
Good morning. First of all, thank you for having us today. Pleasure to be here. So yes, United Healthcare, look, I think obviously it's a company that's going through certain headwinds that are significant. As you know, they've been hit with three pretty dramatic events over the last 12 to 18 months. One of their biggest subsidiaries, Change Healthcare, had a big cybersecurity attack that almost destroyed them. The CEO of their insurance business was assassinated, and then a big part of their business, which is a Medicare Advantage business, is going through headwinds due to what is called HCC version 28. I will say that most other companies, if hit by such perfect storms, one after the other, would have collapsed. Now, keep in mind, United Healthcare is the largest health insurer in the world, certainly in the US, but in the world. They have nearly 50 million plus lives under insurance. So is the company under pressure? Yes. But is the company losing money? No. Is the company, does it need to transform certain things? Yes. Now, our relationship with United Healthcare is orchestrated through one of this $110 billion revenue company subsidiary called Optum Health, which employs 50,000 plus physicians. It's the largest employer of physicians in the world. And as you know, our business model is all built around driving operating efficiency in the non-discretionary spend for these physician businesses in the US. So in fact, what happens is when our customers come under pressure, we actually become often the relief valve that they need to get their performance where it needs to be. A testament to that has been that our relationship with United Healthcare has really grown at least 20 to 30% over the last 12 to 18 months. So actually, as much as it is unfortunate what United Healthcare is going through, I think there is no existential crisis to the business. And as they try to do things to get the financial performance of the business where it has been historically, we actually will be one of those contributors, we believe, and hence, without trying to get too speculative, I think we should be okay from a United Healthcare perspective, and I think United Healthcare as a business should be okay in the medium to long term.
should be okay in the medium to long term, but how much of our revenue or any sort of impact that you could give us, how much revenue comes in from United Healthcare side right now?
Yeah, so we don't tend to reveal that, but suffice to say they are one of our largest customers. And again, really important to note that our revenue with them has been growing through this period of crisis. And actually, when we look at our opportunity set with them, it continues to reflect continued growth, because it's very important to draw the distinction that a lot of what traditional IT services companies do with them is on the discretionary spend side. And in such crisis, discretionary spend gets cut. Whereas what we do with them is all non-discretionary operating spend, which we actually improve the cost on. And hence, our relationship with them in a tough situation is likely to experience growth versus de-acceleration.
What I'm trying to understand is that, United Healthcare, which you're not revealing how much it contributes to your overall revenue. I see top 5 clients contributing about 22% to your revenue. Would suffice to say they're part of your top 5?
Absolutely.
All right. Nitya, Sachin did mention that regulation in healthcare will be your friend. Now that some regulatory announcements are beginning to come through, do you still hold that belief? What exactly is happening here? Because, day in, day out, you get headlines on social media, the President of the United States just putting out posts, changing, flipping, flopping. How do you navigate through that?
Specifics are still emerging, but I think if you look at it more from a fundamental perspective, what they're trying to achieve is reduction in healthcare costs. You'll actually note that healthcare spend in the US is $4.8 trillion, growing faster than GDP. So clearly they have to do something about making it a lot more sustainable in the future. So we believe that we are actually part of the solution. What we bring to the table are efficiencies and a platform through which these healthcare provider organizations can actually run their operations a lot more efficiently. So we genuinely believe that whatever be the specifics of the initiatives that the administration takes, given that the fundamental intent here is to make healthcare a lot more efficient, we continue to believe that this will be a tailwind given how our business model is structured.
So in light of that, with the kind of year that you've had, earlier it was alluded to as a perfect storm of sorts. You've still managed to grow 17% this quarter. For the entire year, it's been a much larger growth. As your base increases, what do you think would be a steady state growth that one should estimate for a company like yours over the next, say, 1 year, 3 years, and 5 years? Nitya.
I think we have always maintained, and I will continue to maintain our guidance that we will, in the long run, be able to grow faster than the market. If you look at our addressable market, that's about $225 billion, expanding at 12%. And if you look at the underlying healthcare market, that's about $4.8 trillion, expanding at 5 to 6%. So we continue to believe that we will be able to grow faster than the market. Out of the TAM of $225 billion, only $34 billion is outsourced today. So there is clearly a lot of growth runway left. And given our business model, given our investments in technology, we will continue to grow faster than the 12%.
Okay, you will grow faster than the 12%. I just want to check in terms of the margins as well, right? Previously, we had spoken about the 30% range in terms of EBITDA margins. In Q4 FY25, we're clearly above that mark. The full year FY25, it's 29% approximately. I want to know the outlook for margins in FY26. Are we going to be doing better than 30%? Would you increase your guidance for FY26?
I don't give guidance deliberately given the relative maturity, but we have been vocal in saying that we believe our margins will eventually stabilize somewhere in the early to mid 30s. And our 31.2% EBITDA that was delivered in Q4 FY25 is a fine reflection of our confidence in our ability to get there. So I feel like we have every reason to believe that we will get to that early to mid 30s range over the next 12 to 18 months. And without giving formal guidance, we continue to believe that that seems imminent.
And what kind of client wins are you expecting this year? You had 2 big ones last year. You didn't quantify the size, but if you could give us a sense of, the client wins that you're targeting this year, maybe potential size, because it's an interesting influx of both pharma and IT. Typically, IT companies give us these details.
Yeah, so Mangalam, it's there is a deliberate reason why we haven't been giving the specifics, because the way our business works is often clients commit to a large contract, but the ramp up of the contract happens over a period of time. And different clients have different ramp up periods depending on which features of our platform they're implementing. And so what we tend to do is we announce clients that are full platform commitments. For example, this quarter, we have 3 customers that are full platform commitments. Skylakes is a big health system. That's a full platform commitment. Platinum Derm is a full platinum commitment, which is one of the world's largest dermatology platforms. And a Western Washington Medical Group, a multi-specialty group, is a full platform commitment. Now, those tend to be larger in size because we are naturally committed to getting the full share of their wallet for those tasks. And then there are other customers that might be even larger in size, but they're committing to certain features of the platform. So suffice to say that, given where the buying behavior is and where it is still dynamic and not mature, it's hard for us to hazard exactly what the client revenue will be in 3, 6, 9, 12 months from now, which is why we continue to say, Mangalam, my simple thinking is, if the outsourced TAM is growing at 12%, if we grow faster than 12%, we are gaining market share. If we grow slower than 12%, we are losing market share. We feel confident based on our leadership that we will continue to gain market share, hence that faster than 12%. If the outsourced TAM starts growing at 15%, my suspicion is we'll grow faster than 15% as well. But how much faster than 12% becomes a little hard to predict in this currently dynamic buying deal.
Okay, Sachin, as well as Nithya, thank you so much for joining in with us on the show and giving us your time, explaining us what to watch out for on FY26 from the company. It's a pleasure having you both here. But on that note, we're going to shift focus now to a special segment where we will get you a few ideas of profit from Money Control Pro. Bharat Jayanani is joining in with us of moneycontrol.com to give us and talk to us about a stock that he's been tracking closely. Bharat?
This area has been trending bit. The company posted better than expected margin performance in Q4. Despite slow level like-for-like growth moderating to single digits, the company was able to improve its margins. Better store operating matrices as well as operating leverage led the company post better margins. We expect the company to continue rapid store expansion for both Westside and Rudy. In metro and tier 1 cities and towns, the strategy is to deepen presence, whereas the company would enter new locations in tier 2 and 3 cities and towns. Emerging categories of innerwear, beauty and personal care, footwear are driving store level sales. Recent foray into lab-grown diamonds is expected to drive the store level sales further. The company's loyal customer base is increasing, with Westside Club members reaching 16 million in FY25. Increased Westside.com sales as well as the parent support in the form of Tata Neo app is enabling the company to scale up its digital business. At the current market price, the stock is trading at a PE of 64 times FY27 core fashion business earnings. Investors with a long-term view can add this stock to the book.
Right, Bharat, thanks a lot for that. A bunch of stocks moving around. Titagarh Rail Systems, that's the one on fire, up nearly 8%. We did see some traction in rail-related stocks over the last couple of trading sessions. This one comes back as well. The weekly gains on this stock would mirror any of the defense names as well, up 27% on Titagarh Rail Systems. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us. Welcome back. We're talking about T-Toggle Rate Systems. Look at IRFC. That's the one which is surging as well. Hindustan Aeronautics up 13% this week. Angel One is the other one which is up around 13% as well. But the one which is taking the cake is about 5% higher. That's Apollo Tyres. Sudarshan joins in with the key takeaways of what the management had to say in the conference call for the fourth quarter of the company. Despite a minor miss on the numbers, the stock actually is surging. Sudarshan.
So the stock is today one of the top mid-cap gainers, and company in Q4 FY25 had underperformed peers, and as far as on the results, it had missed. It was a minor miss to the estimates. But now the commentary is coming from the analyst call, and those commentaries looking very positive. For Q1, company is saying that two segments where it had seen a decline, those segments are OEM and exports. Both these segments will see a growth in Q1, and going forward, it believes that growth will be in double digit, and also the situation has been improving as far as the Europe is concerned. Also, question was asked related to the tariff impact, and company believes that even if there would be any impact, it would be very marginal. So overall, it's looking positive from the con call of Apollo Tyres.
Okay, thank you so much for that, Sudarshan. But with that, we're going to wind down this edition of Chartbusters on CNBC-TV18. Thank you so much for tuning in. But here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or the Google Play Store, or you can just scan the QR code on the screen. Good morning. Welcome to Friday's edition of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Hormuz Fatakia. And after yesterday's mega rally, there is a bit of a cool-off in the markets. The Nifty is exactly at the 25,000 mark, a cut of close to about 0.25%, 0.33% lower for the Sensex. Midcaps faring much better. The midcap index is up close to about 0.8, 0.9%. Advanced decline ratio also positive. Innocent Bank, Bharti Airtel in the large cap space are the two casualties of the day on the way down, and BEL is on fire. BEL has a gain of, I think, 3%. The last time I checked, it was the top gainer. It still is the top gainer, and now it's advanced nearly 4%. And its week to date tally, or rally, should I say, is now at 15%.
Defense, railways,
I think
all of them are
defense
on
is
fire.
the new defensive. That's the way these stocks have been, acting.
It's almost reminding me of that mid-2023, late 2023 period where every single day these railway stocks, these defense stocks were moving 7, 8, 10%
Railways also higher
in a
today?
single day. All of the railway names are higher today, be it RITES, be it RVNL, be it Titagarh, and it's not just a 1, 2, 3% gain, it's an 8 to 9% gain with all of them that you are witnessing currently. So the railway names, the defense names, look at RVNL, 9% higher. It just announced 100 crore or 150 crore order win
115,
yesterday. Yeah, 150 crores. And Titagarh is up 8.5%. And even if you take a look at IRFC, Jupiter Wagons, Ircon, all of them are trading with gains of anywhere between 5% to 8% in today's session. So it is railways, it is defense. They are the ones that are ruling the roost currently in the broader markets. And Cochin Shipyard is it's an interesting bit. 11.5% higher is the top gainer on the Nifty 500. And today, Kotak has come out with a note on Cochin Shipyard. The stock is at 2,000 rupees. They have a price target of 850 on the stock. So they're projecting a 60% downside on Cochin Shipyard. And they are now saying that the stock might fall to levels of 850 because they have not won any major orders in the last 2 years. That's the warning that Kotak has given. But the Cochin Shipyard moving in a league of its own right now, 11% higher on the stock.
They said the target price is what?
850, yeah. The other one, of course, it's the block deals, right? The couple of them that took place in today, earlier this morning, be it Bharti and JSW Infra. Let's go across to Vivek for more details on that, Vivek.
Well, that's right. Earlier today we told you pre-market that a couple of large block deals were expected to take place along expected lines. The first large block deal actually has taken place in Bharti Airtel. So Singtel sold close to 7.1 crore shares, and the total value of the shares sold was at $1.5 billion. Now, the rate at which this particular deal was done was at 1814, which is where the stock seems to have settled at least for now. Now, as per the term sheet that we managed to access, there is a lockup on 60 days on further sale of shares as far as Singtel is concerned. So let's have a look at the shareholding of Singtel. Singtel pre-block held close to 29%, of which a little over 9% was through the entity known as Pastel. So 9.17% stake was the direct stake that it held through Pastel. Now the effective stake post-block deal now drops down to 28%. But what is it that we need to watch out for? Remember, the Mittal Group's stake in Bharti Airtel is at close to 23%. And what Singtel has said in today's press release is that they've been working with Bharti Enterprises to equalize an effective stake as far as Airtel in the medium term is concerned. So maybe there could be further paring down of stake, once this particular lockup period ends from Singtel on Bharti Airtel. The other stock, again, that we had mentioned to you earlier today was JSW Infra. 2% of total equity. Now remember, as far as the shareholding of JSW Infra is concerned, the Sajjan Jindal Family Trust actually held close to 80.7% stake. And the company on May 11th had intimated the exchanges that they would go in for a stake sale, mainly to go ahead and ensure that they meet minimum public shareholding norms. Remember, SEBI rules indicate that the promoter holding cannot exceed more than 75% after a certain period as far as any listed entity is concerned. So a little over 1,200 crore worth of shares have exchanged hands in JSW Infra as well, and that particular stock too under a bit of pressure. Both Bharti as well as JSW Infra post the blocks under a bit of pressure today.
And under pressure indeed, with JSW Infra, of course, comfortably above its IPO price is JSW Infra. So interesting two block deals there coming in earlier in the day. But on to earnings conversations then. LIC Housing Finance is the first management that we are going to be talking about. But just before we go to that, continuing with some of the other movers on the street today, Shipping Corporation is one of them, 7.5% higher on that stock as well. CCL Products, that too after its earnings has seen a bit of an up move recently, is now up 7% as well. But if you look at the list of gainers, all you can see is defense names and railway names. It's very difficult to find other names in this list. But of course, as we just mentioned, onto earnings interactions then, LIC Housing after their fourth quarter results, asset quality saw an improvement. The dispersals were up 24% sequentially. AUMs also grew 3% during the same period. We are now being joined by Tribhuvan Adhikari, who is the MD and CEO of LIC Housing Finance, to discuss the road ahead for the company. Mr. Adhikari, good morning. Thank you for joining in. I'd like to first start off with your loan growth bit, right? A single quarter or a couple of quarters of single digit growth, you would say, okay, it's a one-off, but it's been 9 quarters now that your loan growth has been in single digits. What would you attribute that to, one? And two, in FY26, are you aiming for a double-digit loan growth as well?
Well, yes, honestly speaking, 9 quarters in a row, single-digit loan growth has been disappointing. Yes, it has been disappointing.
Last 2 years, there were some issues within the company, change of the loan management software and all that. But I think that is all behind us. That is all behind us. The last quarter, the growth has been good, 24% overall. Some segments showing as high as 45% growth in the project loan book, etc. So I think that is all behind us. And this year should definitely we should be aiming for a more than double-digit growth, both in the loan book as well as the disbursement book.
Low double digit, high double digit?
10 to 12% is the guidance right now.
Okay. Could you can you break that up in terms of home loans and the developer loan book? Because I believe in the prior quarter, your developer loan book declined by 13%. First, what's the reason for that, the developer loan book? And then break up your guidance of next year of 10 to 12% in these two segments.
Yeah, the developer loan book did decrease, as you said, and it was partly because of big I would say, the rate of interest at which we were willing to underwrite the big loans. Many of the loans which had been granted 2 years, 3 years earlier at higher rates of interest, they were demanding rates of interest which we felt were not tenable for us. And so we had to take the painful decision of letting them go. But as far as the disbursement book is concerned, in the last fiscal, the project loan book has grown by almost 47%. So we are looking to grow this book. Last year, we had done 4,200 crores of disbursement through the project loan book. This year, we're aiming for 10,000 crores of disbursement through this book. Again, at the same time, we are cautious in growing this book. Our past legacy, our history has not been very good as far as this book is concerned. 50% NPAs at one point of time. Right now, we're down to 21. So it's going to be a cautious approach, but we feel there is definitely a market for this, and there are good quality builders with pedigree who can be taken up and who can be pursued for growing this book.
Mr. Adhikari, I was just checking your disbursements were up almost 24% on a sequential basis, but that has not translated into very meaningful AUM growth. It's just only 3% on a sequential basis when you compare that to the December quarter. What has led to that, and do you see that improving as we go into the new financial year?
Yes, definitely. I do see improvement going into the new financial year. In the last quarter, the book transfers have been slightly high. So retention was a cause of concern in quarter four for us. But then this year we would be setting up a separate retention team to look into how we can hold on to these existing loans and at the same time grow the new loan book. So definitely this year I'm optimistic that there will be a good book growth as well as disbursement growth for the company. 12%. Yeah.
Got that. What about net interest margins? Considering that we are currently in a declining interest rate environment, what is the NIM range that you're targeting, or the outlook on net interest margins? And even the asset quality has been improving for you. Your credit costs have been fairly benign. What is the outlook for FY26, or the first half of the year where you have visibility?
Well, as far as the NIMs are concerned, we ended the year at 2.72, and that was the guidance we had given between 2.7 to 2.9. Yes, the margins are the net interest margins are going to be volatile. RBI has already done a 50 basis point rate cut. I'm expecting another in the June MPC. Going forward, I believe the trend would be towards lowering of the repo rate. So on one hand is the repo rate. As far as my borrowings book is concerned, 55% is fixed cost borrowing, where I do not see any, there is no scope for any improvement in the borrowing cost. 45% is linked to the repo rate. So there is where we will be seeing a downward impact on our borrowing cost. So I think this year we need to balance between, we have to be very cautious about the borrowings we do and ensure that we are very aggressive, or we pursue lenders to give us excellent rates. Very recently, a new channel has opened up, RDBMS, company set up by NHB. PTCs, the first PTC deal was done and listed on the exchange very recently. We'd be looking at that also. So borrowing costs would be important. And as far as the repo rate cuts are there, they would be there. The cost of lending would have to come down. We are operating in a competitive scenario. My loan book is comprised of 85% of individual home loans, a very competitive segment in which all the banks are present, and where the margins are really very small for the companies. But at the same time, since 85% of my book is there, I cannot afford to price them higher than my competition, because then in that case I would lose business. So it's going to be a very tightrope walk for maintaining margins. But I believe we should be able to maintain the margins between 2.6 and 2.8 this year.
Okay, but there will be a downward bias from where you ended, considering that 55% of your borrowing cost is still fixed. And when it comes to loans, given the competition, you will have to price it down as and when the interest rates come through. So, bias could be...
Yeah, of course. The trends point to a downward bias.
But 2.6 is the base.
Yeah, but we need to diversify. We need to diversify our business without losing sight of our individual home loan book, which is our mainstay. We need to diversify into other margin accretive segments like project and the LRD and the lab space.
Mr. Adhikari, what are you expecting in terms of your asset quality, sir? Your gross NPAs and your net NPAs, what are you expecting them to be? Have you set any targets for the year?
Well, right now, my gross NPA is at 2.46. We are targeting 2.2 in the current financial year. The asset quality has been improving every quarter, and we expect that trend to continue. So my target for the year is about a GNPA ratio of 2.2, down from 2.46 as of now.
All right, Mr. Adhikari, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year, as well as the management of LIC Housing Finance. Expecting the NIMs to remain volatile in FY26, but is hopeful that the asset quality will continue to improve in this financial year as well. The stock had nearly moved into the green, but has recovered significantly from the lows of the day after the management commentary. So LIC Housing Finance still 0.5% lower at 621. By the way, some other negative earnings reactions, since we spoke a lot about the gainers, Newland Laboratories is one of them, and although it's off the lows of the day, at one point was down almost 11.5%, still down 7% as we speak, still the top loser on the Nifty 500. So 7% lower on Newland Laboratories. Godfrey Phillips is down 5%. Global Health is down 4%, and of course IndusInd Bank is down around 2.75% after some new accounting issues have come to light. We'll take a short break here on Trading Hour. Up next to discuss what's buzzing in the commodity space, Manisha Gupta joins in. Welcome back, and shifting focus now to the commodity space. Manisha Gupta is now joining in, and today we are focusing on metals. Manisha, good morning. Are there some metals that are shining?
Well, not too many really, because we've seen a percentage point of decline for most of these industrial metals as well, which is inclusive of aluminum, copper and zinc. Some support, though, has come in for the ferrous metals like steel and iron ore. They seem to be doing quite well. But as you can see on your screens, well, no, we haven't done so well when it comes to industrial metals. There has been some support in the recent few sessions, and that is after US and China. We've seen some temporary tariff deferral there, and that would mean perhaps more demand in China and US when it comes to manufacturing and encourage trade as well. But that doesn't really seem to be supporting now. There was a knee-jerk reaction, but not anymore. That is because the markets are looking at weak data coming in from China. easing on of inflation from US as well, and the European numbers have not been supportive either. And then their markets also are looking at easing supplies, especially for copper in Congo, Indonesia and Myanmar. For aluminum as well, there are increasing supplies, especially in LME and in the US markets there. There also are more bauxite and alumina inventories now being reported, and that is the reason you are looking at prices declining. An interesting report from Citi also says that they are downgrading their price forecast for the third quarter for many of these metals. For copper, they're anticipating the prices to go down to 8,800, which is trading at $9,500 a ton right now. And zinc prices at 2,500, that's whereabout zinc is trading. So some more correction on the lower side is anticipated. For this year, for the metal prices, when you look at the overall sector, it's only copper which is trading in the positive and by a large 17%. But aluminum is down 2% and zinc is down 9% in this year until now.
Thank you, Manisha, for that. Moving on now to Patanjali Foods. They reported their Q4 numbers. The company's revenue surged by nearly 18%. EBITDA was up 13% and profits have gone up by nearly 76%. To discuss this, we have Sanjeev Asthana, CEO of Patanjali Foods, joining us on the show now. Thank you very much, Mr. Asthana, for joining in. This is Reema Tendulkar. So the first question is, we've seen a decline in edible oil prices from the highs. So to what extent have the prices declined? And therefore, what will be your margins that we could expect, at least in Q1, Q2, first half of the year, in the edible oil business?
So edible oil prices have declined, just tapered off. And I think there was a high inflation that we noticed in the edible oil prices. So that this decline, whether in terms of revenue or margin, would not have a large impact. As we've always maintained that our margin profile is between 2 and 4% on the edible oils. And that this year we did higher than 4%, we did about 4.65%. So we're pretty confident of meeting the same objectives of keeping at a ballpark range of 4% and hopefully better than that.
Okay. So edible oil margins, 4+ percentage points, right?
That's right.
Mr. Asthana, good morning. Thank you for joining in. After what FY25 has been when it comes to margins and your revenue growth, what are the targets that you have set for FY26?
So our targets are, what we've often said, and there's no change in that we'd like the HPC business that we acquired, nearly 5 months now for 1st November. We'd like that to grow by 15% year on year. The food FMCG businesses, which is the portfolio of all the food, 4 major categories, we'd target for 8 to 10% growth in that. And in the edible oil segment, between 2 and 4%. So that pretty much is clearly the growth in the revenue terms and the volume terms as well. And we are pretty much on course to achieve that. This year, we did more than 6% of EBITDA on the overall basis. And the target is that we should do better than this next year.
And what about the revenue growth? You've outlined the margin aspirations, and they're pretty much unchanged from compared to what they were. You're maintaining the margin guidance. But for edible oils, food and FMCG, home and personal care, on the top line?
So top line, as I mentioned, on a blend of 15% for HPC, 10% for the food, and about between 2 and 3% for the edible oil. That's pretty much. So that should take overall business closer to compared to 35,000 crores. We should be somewhere close to 40,000 crores in top line this year, more than 40,000 crores.
Now, what about the foods business, Mr. Asthana? Are you expecting any improvement there? Because staples continue to struggle as a segment. And the foods revenue also in the fourth quarter was down almost, 16%. EBITDA was down around 7%. Do you see that trend improving? What is the current situation that you're witnessing on ground? We are almost a quarter, halfway through the first quarter already.
So 2 things happened. Just to explain a bit about last fiscal, that the challenge that the food business faced overall, multiple food companies have gone through that. So the high commodity price inflation had a big impact. So for example, the edible oil prices were very high. The price on the side of the wheat prices, we typically witnessed between 5 to 8% growth that we had. Likewise on the rice prices and similarly sugar, etc. So that impacted both the margins as well as the consumer demand was a bit muted, especially in the urban centers. So this quarter we are seeing largely, food inflation has tapered off. It's closer to 3.2% odd. We feel pretty confident of, the sort of both the sales and the margins to pick up. So as we are already witnessing that. So I think pretty much things are normalizing. So this year we should come back pretty much on the food business on the same track.
By when do you think you will get to the non-oil revenue contribution up to 50%? You had earlier spoken it'll take about 3 to 4 years.
So right now, this year, as you can see that, because of the high edible oil prices, the percentage of the non-oil revenues came down to 25%. Broadly, the target is pretty much that in next 3 years, we'd like this to be 50-50. HPC, we will see a first full year of operation. The food business, the lost sales that we had last year, we should pick up this year. Our biscuits and the Nutella category continues to grow. So we are pretty much on course that stated objective that of 50-50 revenue. We should pretty much reach that objective in next 3 to 4 years, that we pretty much stand committed to that. And 10% EBITDA margin on a consolidated basis for the entire company.
What about your market share for the edible oil business, Mr. Asthana? You earlier mentioned that it stood at around 10%. And does it still remain?
So edible oil margin business that we pretty much, in terms of the market share, as we had stated, that margin it has not gone down. We had a marginal dip in the palm oil volume this year, but that was owing to the high prices of the commodity side. That part is more or less sorted out as the prices have tapered off. So our market share of 10% that we currently have, we will continue to grow, but at a pace which is about 2 to 3% growth rate in volume that we see. That is not going to be diminished in any way. In fact, if at all, we should consolidate that further and should grow faster.
Is it possible to split your revenue growth in the oils business into volume and pricing? Just to get a sense?
Okay, so 70% business that we do is in palm oil.
Yes.
So out of the 25 lakh odd tons that we do, typically nearly 15 lakh tons would be palm oil. About 5.5 lakh tons is soya. Rest is sunflower is about 100,000 tons, and balance would be split between mustard, sesame, and whole range of pressed oils that we have at the premium end. So typically that would be the broad split in the edible oil side.
So any expansion plans for the palm oil business, Mr. Asthana, this year? Because you had mentioned that margins will continue to expand for that, and around about 45% of your planted area is under the prime high yielding range. Have you planned any expansions for this business this year?
So big plans. I mean, we did 89,000 hectares as we speak. We've done the plantation already. This year we should do more than 40,000 hectares of additional plantation. So it's a huge pickup that we're expecting that we will have. And subsequent to that, our target is that we should be able to, build up further. So all the plantation that we've accelerated in last 2 years should start to fruit in next 2 years' time. So then we should see a big uptick in the growth plans that the company has on the oil palm plantation side. So both on the margin as well as on the revenue side, the domestic oil palm plantation business should start showing a substantial uptick.
So for this 40,000 hectares that you are planning, is everything already in place, or have you earmarked any capex or something of that sort?
So everything is, of course, in place. I mean, seedlings, nurseries, preparation at the farmer end, the work that we've done progressively over the years, all that is in place. And year after, we should do 100,000 hectares plus. On the capex side, as I've repeatedly mentioned, that we don't have any great need of capex other than the maintenance capex that we have. So pretty much about 150 odd crores that we spend. Give or take additional 25% either side. I don't expect this to go further. But 4 years down the line, when all this new plantation that we're doing, I think we will need a capex of about 800 to 1,000 crores. So that the free cash flows that what the company has, the cash that sits on our balance sheet that we currently have. So we are pretty confident of not going for any kind of borrowing for funding our capex.
All right, Mr. Asthana, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Patanjali Foods, 3 to 4 years later, looking for some capex, but confident that the cash flows and the balance sheet will be able to fund it by itself. We'll take a short break. The Nifty has just slipped below the mark of 25,000. Nothing alarming, of course. It's still just down by around 90 points. The Sensex is down 300. We discuss charts with Apurva Sheth of Samco Securities and some trading ideas on the other side. Stay tuned.
Welcome back. Lots of mid-caps reacting to numbers. So on the way down, we spoke about Newland Labs, but Datamatics has taken a crack today. That's down nearly 7%. MediAssist is another one reacting adversely to disappointing set of numbers. Garware Tech, Tega Industries, PN Guardgale, these stocks are down close to about 3 to 4%. But on the way up, there is one stock that deserves mention, and that's Crompton. Numbers are good. Upasana joins in with the highlights.
The company has reported good set of numbers. The revenue was largely in line, but PAT and EBITDA margin beats the poll estimates. Now, EBITDA margin beat was mainly led by the positive margin surprise in the company's lighting segment and healthy performance in its Butterfly. Now, coming to the numbers now, the revenue saw an uptick of 5%, EBITDA saw an uptick of 30%, EBITDA margin saw an uptick of 240 basis points at 12.8% versus the poll of 11.5. Now, this margin expansion was supported by 700 basis points margin uptick in company's lighting segment at 15.9%. Butterfly stood at 6.7% and ECD reported a steady margin of 16.7%. PAT reported a growth of 29% on a YoY basis, and company's key segment, that is ECD, saw a steady growth of 6% in line with estimates. Now, this ECD growth was mainly led by pumps and appliances, especially mixer grinders, coolers and solar pumps, which saw a 20% YoY growth. Now, company held its conference call, and here are some of the important takeaways. Company has indicated that it is actively exploring a greenfield manufacturing project with an investment of 350 crore, and the phase 1 of this will focus on fan manufacturing. Company is also entering into high growth solar rooftop segment with a TAM of nearly about 20,000 crores is what the company is estimating. Now, coming to the categories, company has indicated that the pipes continue to perform very well. Appliances delivered a high teen growth, and despite delayed summers, air cooler stood out with a growth of 50% on a YoY basis. Now, coming to the Butterfly, which was under pressure, and the company has revived it. The Butterfly performance was supported by their double-digit growth in mixer grinder and cooker category. And lastly, company says that despite the consumer demand continue to remain subdued, it remains optimistic about FY26 growth outlook. So all in all, strong set of numbers from Crompton.
One of the positive earnings reactions today. Upasana, thanks a lot for that on Crompton. But Apurva Seth from Samco Securities is joining in for a quick chart check. Apurva, good morning. Thank you for joining in. The minor pullback that you're seeing on the charts, of course, that's only par for the course considering the move that you have seen this week. But how important is that 25,000 mark to sustain on the Nifty for a further move higher? And what are your recommendations in terms of stocks for the morning?
Me on the show. So 25,000 mark is a good enough resistance for the Nifty. I believe that Nifty for a short term, medium term perspective will face resistance around the 25,000 mark. So for me, the range for Nifty has shifted slightly higher from 24,500 to 25,500. So this is a 1,000-point broad range that the Nifty will trade. Now on the small cap and mid cap front, we have seen that even though Nifty has moved up and crossed the 25,000 mark after 7 months, the mid cap and small cap indices have still stayed behind. Nearly 75% of the top 750 stocks are still trading with negative returns, and only about 190 stocks have delivered positive returns in the last 7 months. So there's still a lot of catch up to do for the mid cap and small cap stocks, and that's where the action will be in the next 1 or 2 months. And on the stocks front, we have KEC International Limited. So the stock is currently trading around 790, and the stop loss for the stock will be 740 with a target of 900. So it is forming a good base with a lot of volume action happening yesterday. So that's first stock, and another is NFL. Now NFL has seen a very good volume accumulation yesterday. So the stop loss for NFL will be 90 and target will be 110. It is again forming a double bottom formation and breaking out. So NFL will also be one of the top picks.
Thank you very much for that. We will slip into a break on that note. On the other side, the management of Welspun Enterprises will join in to discuss their Q4 numbers and more.
Welcome back. Continuing with corporate conversations, the other one on our radar today is Wellspun Enterprises. Fourth quarter saw revenue growth of 24%, EBITDA growth of 35%, margins also expanded. Now, to discuss more on this, we're being joined by Sandeep Garg, who's the managing director of the company. Mr. Garg, good morning. Thank you for joining in. Now, before I get to the fourth quarter, let me just ask you about the full year as well. You'd indicated that you would do close to 4,000 crores of top line in terms of FY25. You've managed to do 35,880. What led to this marginal miss, and what is the target that you are projecting for FY26?
Good morning, Amar. So thanks for taking me on the show. To put the issue in perspective, the guidance for the revenue growth has been in the ranges of 15 to 20% at the console level. And we have returned year-on-year revenue growth of approximately 5%. Now, in terms of your anticipation of 4,000 crores as a revenue versus the 3,500 odd crores, the rationale was a couple of projects which we ever opened, L1 did not get awarded, and a few projects that got awarded because of the approvals from the statutory authorities or not coming in play could not chug in the revenue. However, the important point was that the EBITDA guidance that we had given was around 700 crores, and we have been able to bring in 730 crores. That means the mix of the segments in terms of the revenue of water and tunneling, which are more value accretive, has been higher than the other segments. So we are very happy that we have been able to return better than the guidance EBITDA growth, as well as better than the guidance of 15 to 20% on the revenue.
So now, keeping this as a base, so 23% revenue growth in FY25 and 730 crore of an EBITDA, what can you do in FY26, top line and margins?
So the guidance would once again, Rima, be in the ranges of 15 to 20% growth on the revenue. However, on the EBITDA side, we see that the skew on the order book at this point in time is in favor of water, and we are trying to be a one-stop shop for all water solutions. In line of that, and if you see the segmental reporting that we have done, water has given EBITDA returns of almost 21%. And tunneling is also another thing which we are focusing on. So we expect the EBITDA margins to be not only in line with what the revenue growth will be, but a lot better than that.
Okay.
Now, Mr. Garg, you had earlier in your previous answer, you mentioned that there were some delays with the projects that you were declared L1 were not awarded at that point of time. Have they been awarded, or do they spill over into the new financial year? And since we are on the subject of orders, what did you end FY25 with in terms of order inflow, and what are you projecting for FY26?
So we had at a console level about the order inflow of about 3,200 odd crores. We are expecting the order inflow, substantive orders, which we did not get last year, to overflow into this year. So our expected order inflows and our execution all put together, we expect the FY26 to close somewhere above 20,000 crores as an order book of unexecuted orders. So the orders will be in the north of about 10,000, 11,000 crores in this year. Across all visibility? Across all segments.
How much visibility does that lend to you, Mr. Garg, with a 20,000 crore order book that you're projecting?
So given that we expect 15 to 20% plus revenue growth, it will give us a visibility of about 4 years of orders. I think the company is on a threshold of growth. So our attempt to become a water and a niche area tunneling company are now yielding results. We expect that the revenue will grow from these segments much faster than the road, which is the historical company that we were. So my views on the growth, as well as my view on the company, is that we will be kind of breaking into the exponential growth within a year or two, is my forecast at this point in time.
Okay, so just some more color on water, because when we chatted with, say, KEC International, they did flag off some concerns, particularly on the collection front. Are you facing any such impediments?
So there are temporary, one of the project is seeing temporary delay in payments. I would not say a lot of challenge there. There is a temporary slowdown there in the revenue being or the cash being paid out. All of the projects that we have on water are, continuing to pay on time. In fact, before time as well. So as a vertical, we are okay, barring one project.
Okay, I know you said that the water segment margins are higher at 21%, and therefore that will lend a positive bias to your your overall margins in FY26. But the water segment margins in Q4 declined 21% versus 34% year on year. What was the reason for that, and what percentage of your order book and revenue is now water and tunneling?
So the order book is now almost like out of the 14,000 odd crores revenue being the outstanding order book at the year end. About 12,000 crores plus is coming from the water and tunneling. This includes the O&M of about 4,000 odd crores. The road order book is outstanding at this point in time is close to about 1,600 odd crores. So that is why we are very confident of our EBITDA margins being a lot better than in past.
One final question, Mr. Garg. Are you how many projects are you L1 in currently, and how many are you anticipating in the current quarter itself in terms of order inflow?
So I am right now there are no open bids at this point in time where we are L1. However, we are expecting at least one order in this quarter. That is what our plan is. We hope to conclude that order within this quarter or early of the next quarter is what we are targeting.
All right, Mr. Garg, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Wellspun Enterprises targeting an order book of around 20,000 crores revenue visibility of over 4 years as that progresses. We take a short break. On the other side, we get to excerpts of our conversation with the management of BLS International. Stay tuned.
Investing.
Welcome back. It's lots of corporate interactions lined up on the show today. So BLS International is the next one, reported the Q4 numbers. Strong growth momentum seen in the quarter gone by. Shikhar Agarwal, Joint Managing Director, the company is now with us. Shikhar, well, currently there's been a lot of global uncertainty. People are cancelling their, travel plans. There's hesitation to go even to the United States. How are the demand trends and the client confidence looking like, and what could be the growth that you will clock in the coming year?
Basically, see, if you see the global scenario right now, we as a company operate in 70 plus countries, and we work with more than 40 client governments. So essentially, we have seen since we've been in operation in 2009, every year there is some policy changes in different parts of the globe, but it has not, has any effect on our industry till now. We have always seen a growth in visa volume, people traveling to multiple countries, the tourism, business, student, etc. increasing. And as you see, because of the scenario in the world, actually more regulations have coming, more visa requirements have come in different parts of the world. So we are, in fact, not seen an impact on, only a positive impact on our business till now. If you see our numbers this year, we've done a increase of EBITDA of 82% compared to last year, and our revenue has also gone up by 30%. So I feel we have not seen any impact on our business. We are working with multiple governments across different parts of the world. But being an Indian company, we are very proud of that.
You know, Shikhar, your visa revenue growth was around 19% this time around, and your net revenue per application also grew by 26% from last year. What pulled the revenue to 19% when realizations were up 26%?
So if you see, as I said, if you see the overall numbers of the company, our EBITDA has grown 82%. It's 629 crores now compared to 345 crores last year. And if you talk specifically of visa business, our volumes have grown to 9.83 lakh, which is a 38% increase compared to last year. And the margins in visa business have grown from 20% to 34%. There has been a good increase in visa volumes, visa business, etc. There are a variety of factors to that. We also did a lot of things like changing from a partner-led model to our own operations last year. We got increase in prices of a service fee. Our economies of scale kicked in. There were increased adoption of different services like mobile biometric, etc. Also, the acquisitions that we did, we synergized some of those countries. That is why we see an uptick in the visa business.
Okay, uptick in the visa business. So just to put it all together, what's the growth expected in FY26 for the visa business?
Growth has been, if you see on EBITDA level, we have grown 82% compared to last year. So this 90% of the revenue comes from visa business. And, year before that, we were at 200 crores. So we've already, last 5 years, we've had more than 90% CAGR growth in terms of our profit, from our visa business itself. Going forward this year, there are multiple things, in the pipeline. We are looking at multiple tenders that we are bidding for across the world. As we mature as a company, governments have more acceptance of us as an Indian company. There are multiple contracts that are coming up. Governments want more players to deliver services. So we feel that we want to maintain the trajectory that we are at. We've done few acquisitions in the last 1 year. We've done 1,000 crore plus acquisitions. And if you see, we again have around the same amount of money in our books, as of 31st March. So we feel going forward, our immediate priority is to maintain whatever we have achieved first, maintain the EBITDA margins, maintain the PAT, etc., and then build on top of that. So if you see, there are multiple contracts that are coming out, the companies that we have acquired, some of the operations have been synergized, some still need to synergize with us. So there is multiple things that are being worked on. On top of that, we are always open to more inorganic opportunities in the future as well.
But Shikhar, since we are on the subject of acquisitions, what have these acquisitions contributed to you in FY25, be it iData, Citizenship Invest, and Adifidelis? What kind of growth are you expecting from them in FY26 now?
So if you see, one important factor to note in our results is that, our EBITDA that has grown 82%. 60% of the growth has just come from the organic business because we acquired these companies at different timelines in the year. So full year revenues have not come from these acquisitions itself. Last year also. So only 20% of our growth came from, the profitability of the acquisition. 60% was all organic. So we feel that this year and years, the future years, we want to maintain the growth trajectory. There are multiple opportunities in the world, billions of dollars of contracts that we are bidding for. As we grow as a company, as more cash develops, we are always looking for opportunities where we can buy more, integrate to our existing system. So, we will maintain healthy growth momentum in the next few years as well.
Margins too have come off in Q4 to about 25% versus about 30% plus in the prior 2 quarters. What impacted margins in Q4 and in FY26 do you think can revert back to 30% plus margins?
See, if you see the margins in the visa business have grown to around 34% compared to 20% last year, which has been a growth of 14%. If you see the consolidated margin, they are now at 28% compared to 20% that we did last year. There has been a little dip in the consolidated, overall basis because the digital service business, the margins are a little lesser. But our target is to maintain the margins that we have achieved of 28%, but going forward, that is the immediate target.
Shikhar, while the digital business saw strong growth, but the margins have come down to about 15.8%, so the 120 bips contraction compared to last year. What's the outlook on your margins in this segment?
If you see the digital business, which is BSE Services, the company that we listed last year is performing superbly well. If you see the revenue has grown 71% compared to last year, which is 540 crore this year. The EBITDA is now 60 crores, which was 45 crores last year. So there has been a 32% growth in the digital service EBITDA and 70% growth in the revenue. We've added a lot of new banks. We've added a lot of touch points across India. So we feel that the EBITDA margin in digital business is a little lesser than the visa business because of the factor that we are operating in India. There is, per user, we get less money, but there is a lot of volumes. So our immediate objective as we grow as a company, as we add more services to the existing customers like insurances, etc., more value-added kind of services, then the margins will definitely go up. But as a whole, the revenue has grown up 70%. The EBITDA has grown 32% in digital business. So we expect to maintain the momentum even in this business.
Okay, and what about more acquisitions? You did a few last year, but you still have about 928 crore of cash on your books. More to go? More on the anvil?
If you see, last year we acquired a company called iData, which is into visa services in multiple countries. Citizenship Invest, which is a long-term resident visa company based out of Dubai. Then RD Phyllis Loan Solution, which is a big loan distribution company in India. So we did thousands of crore of acquisition that, we are just synergizing these companies with our existing operations, making sure that, the multiple that we paid, we earn the money, earn the cash much before. So that is our target. But as this business is a negative working capital business, the cash keeps on generating. So we are, even if you see the dividend, we have declared 100% dividend this year in spite of 1,000 crore of acquisition. So going forward, we are looking at different opportunities, in the field where we operate in synergistic fields across the world, in service industries, which is a user pay model, negative working capital, healthy multiple, adjacency to us, where we can build on and value add. That is what we're looking at.
All right, Shikhar, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of BLS International. On the other side, we'll discuss the hot theme of the last 2 weeks, that is defense. Jyoti Gupta from Nirmal Bang Institutional Equities Research joins in. Stay tuned, back after the short break. Welcome back. Now, defense stocks have been on the rise in the wake of Operation Sindoor, and a lot of these moves have come in a very, very quick time. Now, Jyoti Gupta, the research analyst at Nirmal Bang Institutional Equities Research, joins in to discuss more on this. Jyoti, good morning. Thank you for joining in. Defense has suddenly now again become the flavor. It was the flavor until mid of last year, and then we saw a very sharp correction, and now suddenly all of these stocks have moved up 20-30% in a span of 2 weeks. What do you do in a time like this? Because you know that after an incident like this, the importance of defense and more particularly homegrown defense companies is only going to rise.
Thank you so much for having me on the show. At the outset, I would like to thank our Indian Armed Forces and their families for protecting us. Their strength is the foundation of safety of our country. Now, to answer your question, Yes, given the current situation and, post Pakistan, our India-Pakistan conflict, yes, the country has actually moved to a very different level where, one, we have showcased our superiority across land, air, and sea. And there's a clear urgency to replenish inventories and strengthen capabilities. So obviously this positions India as a key beneficiary, both as a defense exporter, because even if you look at European spending, which has grown by almost 17% over last year to somewhere around 326 billion, we believe it's going to be somewhere in the CAGR of 10 to 12% going forward. And that's basically driven by increased global security concerns and focus on self-reliance. So this will eventually not only benefit the Indian defense PSUs, but the overall, which are the primes, but the overall suppliers, which are the ancillary industries, which is private companies. So yes, and it's also what we have understood and sensed from the market is that the companies have already stepped up their production levels, and scale. They've transitioned into an accelerated execution phase where they are working 3 shifts. So this proactive scaling signals that there's a potential. One is early achievement of our targets, which is something like 3 trillion by 2029. Possibly it could be achieved earlier than 2029.
You're saying companies are now working in 3 shifts and production is now being accelerated proactively?
Yes, we have. I mean, that's what I understand from some companies, that yes, they were earlier working 1 shift, but I think that has been, some are working in 2 shifts. Some have increased to 2.5 shifts.
We chatted with Bharat Forge last week, and they said, we asked them, this was right in the midst of, when the tensions between India and Pakistan were high, and we asked them, have you heard from New Delhi? And to which Baba Kalyani said that, our teams have been called to New Delhi. Do you know anything that came out of the meeting? What has been the directive from the government? Because the word you used was proactively. The companies seem to be stepping up production on their own. Has there been a government mandate?
So if you see, in all my interviews, I've been saying we are replete with order books. What we need is step up of execution. Now, in the current scenario where we have post the war, we obviously need to replenish our inventories, and strengthen capabilities. So in that case, what we have consumed in the current war, we need to replenish. And of course, we've had deficit in inventories of X days, which has to be done. As far as what was discussed in the ministry, I think no comments. As far as my understanding goes, that there is a huge unfinished order book which needs to be completed in a certain time frame.
Jyoti, since you brought up Europe as well, the defense spending, and before all of this happened, these defense stocks had started to move higher based on hopes that exports will increase. Now, over the last decade, exports have gone up by almost, 30 times. Now, but with the current scenario in place, with the need to replenish our own inventories and our own capabilities first, do you think that exports might slightly take a back seat, if not priority, and focus more on domestics first up?
Possibly. I think that is totally at the discretion of the companies and the whatever the direction they get from the government of India. So maybe, yeah. But I'm sure the companies already have scaled their capacities, which we are seeing. The capex spend which is being done by private companies. I think they should be able to support both the domestic and international demand. And anyways, this international demand has not come recently. It's been there for some time. So obviously you cannot suddenly step back or not honor your obligation. So you will be doing it.
Now, a question that everybody on the street wants to know, Jyoti, after stocks have gone up 30-40% over the last couple of weeks, your top picks, and what should one do now if you are holding them and if you want to have new positions as well?
Let me give a little background. So everybody must be thinking that the current valuations may appear stretched. And I feel that they're expected to be justified once you get, earnings growth visibility. As order execution accelerates and operating leverage, kicks in, investor confidence in current valuation should strengthen, making them reasonable. And that on that basis, I would say HAL is my top pick, followed by, again, BTL. And BML, which has been quite a laggard for many years. These are three companies. MDL, which has done its peak revenue growth, I think going forward, maybe with a lag, MDL will also start because there's a complete demand not only from the there's an overall demand from all the three fronts: land, army, and sea. So obviously you have to scale production not only at the air fleet level, but also in sea levels. So all of them require 1x number of inventory levels to be maintained, and we are still at there are still lingering tensions between India and Pakistan. So on that basis, and companies like Data Patterns, Solar, they will also benefit because they are the key suppliers to these big companies for electronic warfare, for explosives. So they remain my top pick.
All right, Jyoti, thank you so much for sparing time and joining us today to talk about a very important theme that has been the focus of the market over the last 2 weeks. With that, we call time on this edition of Trading Hour. From Reemami and the team that put this show together, thank you so much for watching. We leave you with the Nifty still down around 90 points. Halftime report on the other side.
Stocks trade range following a mixed session in the US and rising geopolitical uncertainties. Industrials and realty are the big gainers, even as IT and healthcare drag. Mid-caps, the clear outperformers.
IndusInd Bank reveals it wrongly recorded interest income of around 675 crores over 3 quarters and identified unsubstantiated assets of 595 crores. While the accounts have been corrected in January, the instances spark fears of a deeper malaise.
Bharti Airtel co-promoter and Singapore's telecom operator Singtel sends under 1% of its stake in the company via block deals with a floor price of 1,800 rupees a share. The stock slips.
JSW Energy gains despite missing income and operating profit estimates on the company's bold aim of tripling capacity to 30 gigawatts by 2030, coinciding with a similar growth in EBITDA. A very good afternoon. You're watching Halftime Reporter on CNBC-TV18. I'm Ekta Batra, and with me is Mangalam Malu. Well, it's turning out to be a session where we are seeing the frontline indices in the red and you'd say a mixed picture because we have the mid caps in the green at this point in time. Nonetheless, we do have an advanced decline ratio, which is still in positive terrain. So let's see whether that continues or not. Lot of specific stocks in focus in today's trading session on the back of news and result reactions. So on the back of news is the likes of Bharti Airtel as well as IndusInd Bank. From the broader markets, we do have stocks such as Newland, Global Health, which are under pressure at this point in time. Overall, it is definitely a lively market for stocks, considering that it is still earnings season. But besides that, definitely pressure on the markets.
Indeed, pressure on the markets, but we do have a bunch of stocks which are doing a lot better, portfolios feeling a lot better. So if you look at, the Nifty Next 50, you look at the Nifty Midcap Index, you look at the Nifty Small Cap Index, all of them doing well. The FMCG pack, actually, all the domestic facing stocks doing extremely well as well. We have HUL, which is at the high point of trade. We have Bajaj Auto, which is doing well too. And alongside that, we have a lot of these PSUs which continue to surge. So BEL, case in point, is among the top gainers that we have. But we also have the management of a company, MediAssist, that joins in after their fourth quarter numbers. Satish Giruku, who's the Chief Executive Officer, joins in. Satish, thanks a lot for joining in. The first obvious question, right? What's the growth prospect that you have for the next year, given the business that you're in, given the environment that you're in right now as well? There's a fair amount of global uncertainty, perhaps for some of your clients as well. So in light of all of this, what's the target that you've set yourself for?
Good afternoon, Mangala. Always a pleasure to be here. Thank you for having me here. So I think we continue to grow in all the key segments that we operate in, right? Group, we've grown faster than the market from a premium perspective, and so has in retail. And we've also done well in the government and the international segment. So all in all, given the growth situation in the Indian insurance industry, we're happy that we've done better than the industry in all respects. So we've just received the regulatory approval for concluding the acquisition of Paramount TPA, which should approximately add from their last year's reported numbers about a 20% further growth on a pro forma basis. And of course, the real value is subject to the timing of the acquisition. And we continue to hold to what we've always said, that we will grow at par or faster than the insurance market growth rates in India. And that continues to be our focus.
Okay. Satish, hi, welcome to the show. Well, I was just looking at your EBITDA margins, 21.6% as per your presentation. And you have indicated that, the dilution from all of the acquisitions is in fact fully absorbed by the company. So give us a sense in terms of what this trajectory could be, considering that this is probably a multi-quarter high. I mean, just by a few basis points, but nonetheless, it's one of the highest margins that you've reported.
Thank you, Ekta. Historically, prior to these, the 3-4 acquisitions that we concluded in the last 2 years, we were traditionally at 23-24% margin. That was our steady state margin. And our efforts continue to sort of get back to the steady state margin, of course, in a much larger and a consolidated book. Clearly, we're on track. And of course, there's, that will be adjusted in the short term by any impact coming in from the Paramount acquisition. But otherwise, that's the focus.
I'll have to ask you this question. Health insurance have been seeing higher underwriting losses. Does that mean that you're going to increase rates for some of the group insurances? That's point number one. And secondly, on the margins itself, how do you see margins for both your retail and group business shaping up going forward, given the sort of higher underwriting losses that you're seeing?
Fortunately, we're not in the business of pricing insurance or underwriting. So, however, if you look at the group business, while the headcounts may not necessarily have gone up as much, there's a significant expansion in benefits. So the premium growth is not just from an inflation or a price correction perspective. There's a significant number of new benefits that are actually coming into the group benefits today. And the covers are widening and expanding. So there's a fair bit of healthy growth from that perspective. So we're not very impacted by the underlying growth in the unit rates of insurance because we are very focused on the service provisioning side of it. And from a margins perspective, one of the reasons why we don't split our group and retail revenues is we've been able to, using technology and our scale, get to almost a homogeneous backend that actually runs in just the same way for group and retail businesses. So to that extent, that's how we're able to build economies of scale.
So what is your guidance on both group premium under management as well as retail?
Our guidance is whatever is the industry growth rate, we will grow at par or faster than that, and we've done that for the last 4 or 5 years on both group and retail. In fact, retail, our own retail has grown at about a 29% compared to a very low in the market. Group also we've grown at over 14%, and that will further get strengthened with Paramount coming in, and because Paramount is the second largest portfolio in the group book in the country.
So you're exceeding 12% and 29% respectively in FY26.
Hoping that the industry will in fact grow even faster, and then the growth will come back to the industry itself.
Curious to know the kind of cost savings that are likely going forward as well, because I'm looking at some of the data that you've put out. 41% of your inbound queries now managed by your self-service channels, which is the IVR chatbot and WhatsApp, which does not entail a lot of costs, and also through your fraud detection engine, AI ML based technology that you've done. There's nearly 400 crore worth savings for insurers as well. So from your own tech stack at the back end, what's the kind of further margin improvement that we can see here?
I'll split that answer into 2 parts. One, like I said, our steady state margin we believe is between like 23-24%. So that's what we aim to sort of get back to, subject to any temporary adjustments to acquire Paramount and integrate. But from a very interesting point that you brought up there, Mangalam, I think the investments that we've made in fraud detection, etc., the savings actually go back to the insurance companies, right? As a service provider, today we do not have the equivalent of a gain share on some of the savings that we deliver. But having said that, this is our North Star metric that we improve policyholder experience, but at the same time improve the profitability of the insurers by weeding out fraud, waste, and abuse. And that's actually one of the reasons why we are now sort of decoupling or unbundling some of these capabilities, like the fraud detection AI models or the customer support AI models, and allowing insurers who don't traditionally work with the TPM model to also benefit from some of the capabilities we have built. Today, if you look at technology-led revenues outside the TPA business are probably about 1.5 to 2% at the consolidated level. And we seeing fair bit of interest from the insurance companies to actually leverage just the technology components too, and not just the fully baked in TPA services.
Right. So could that provide a funnel to the insurance companies for client acquisition as well? I'm just trying to understand, because you are trying to improve the experience for your users while improving the profitability of your insurers. So could then at some point you look at it as a front end, say a marketplace for insurance? Could that be on the horizon? Is there a possibility here?
No.
Or you monetize all the services that you are offering?
We will not distribute or sell insurance because as our wholly owned subsidiary is a licensed TPA, so broking or distribution of insurance is out of the question from an insurance perspective. But our belief today is that, one of the things that we've done, right, the things that people routinely talk about is the cashless and the discharge experience and why it takes time with insurance. Today, in the last year, about 100,000 patients walked out of the hospitals even before the bills got generated, because our AI technology was able to predict their out-of-pocket just on the day of admission itself. And they were able to just pay that amount and walk out of the hospital the moment the doctor said you're fine to go home. So our policyholder experience improvement and our insurance companies' profitability improvement are largely predicated on how much of the insurance business in the whole country we're able to impact directly or indirectly. Today, we have about a 20% market share, and I think there's a fair bit of headroom for us to deliver this impact to the rest of the cohorts.
I will concur with what you say here, because I have had a personal experience here too with the MediAssist. What happened was we'd gone to the hospital for our daughter's birth, and before we were discharged, part of the insurance claim was done by MediAssist.
Okay, well, that's wonderful. But Satish,
thank you so much for saying that live, but I appreciate that. Thank you.
Satish, before we wrap up this conversation, I just wanted your view considering what is taking place with United Health in the US. It's one of the largest insurers in the world, and the kind of fraud that they're being investigated for now. Any learnings and thoughts considering that you're from the same space?
It's a tough business that we run. right? And it's also very emotionally charged moments where people actually experience insurance. And there are 2 or 3 fundamental issues that we have as a country. One, we don't understand how to buy the right kind of insurance, right? We think like 4 lakhs or 5 lakhs of sum insured is a lot of money. And then obviously that sort of fails to protect in the moment of truth. And secondly, you have to also choose the right kind of a product, right? From a membership perspective, because you could have a 5 lakh sum insured, but maybe there is just a capping of 50,000 rupees for a particular procedure. So I think what we would like to see is all of the work that we are doing in terms of understanding, digitizing data and creating patterns that eventually we're able to help insurers and the membership right size their products, understand what is the right kind of cover. And of course, hopefully that what we're doing as Raksha Prime and allowing people to walk out of the hospitals without waiting even for a minute, really driving people to adopt cashless 100% of the time so that the experience also improves. Lastly, I think fraud, waste, and abuse is a general problem in across the globe. While I can't put numbers, I mean, you've seen the work that we've done with AI, about 400 crores of savings last year just for the portfolio that we manage. And I think a lot more work can be done in a concerted fashion by the whole industry. And our objective is to take this to the entire industry.
All right, Satish, thank you so much for joining in. Wish you good luck for the remainder of this year as well. The growth that you're targeting above and beyond the industry with steady state margins between 23 to 24%, net improving the experience for everyone. Take a short break, come back on the other side. We'll talk about the pharmaceutical space. The management of JB Pharma joins in to talk about their fourth quarter numbers.
Welcome back. Well, for the markets, it's the same as we spoke about earlier. So we have a couple of stocks which are under pressure, especially from the pharmaceutical space. A lot of numbers from there. Let's in fact address one particular company that came out with numbers. That is JB Pharma, which reported an inline Q4 earnings with a profit growth of around 19%. Nikhil Chopra is joining in. He's the CEO and the whole-time director at JB Pharma to talk about the numbers. Nikhil, hi, welcome to the show. Good to see you in. Domestic growth has been extremely strong for you this quarter, 20% growth for the entire fiscal, and you're also outperforming IPM. Give us a sense in terms of how the key brands did, the likes of Metrogyl and the others, such as Razil as well as Silacar. What were the franchises like this quarter, and what are you guiding for going into FY26? Do you expect this growth to continue?
First of all, good afternoon, Ekta, and good to be back on CNBC. And Ekta, welcome back. After a long time, we are meeting.
Thank you.
It was a good year in terms of what we performed. If you look at our domestic growth, which has demonstrated 20% for the current year. But if you look at ex-Opthal, which is a franchise what we acquired, the growth is 12%. Still, the growth is much better than the Indian pharma market growth. We continue to beat Indian pharma market by 300 to 400 bips. And you at CNBC and your team have been tracking our journey for last now 4 years in terms of what we have committed, we have been able to deliver. This journey, according to me, will continue for next 3 to 5 years in terms of the portfolio that we have built over a period of time. What you were talking, whether it's a heart failure pill, Azmada, whether we are talking of lipid pill, Razel, whether we are talking of number one anti-hypertensive brand today in the country, Cilacar and Cilacar T, all are demonstrating good volume growth. When I talk of volume growth, it all tells about the better penetration and better prescriptive in nature. So that is where we stand. We continue to be now number 8. We are now number 8th company in the world of cardiology in the country, with all what I've spoken in the world of cardiology, what we have done, hypertension, heart failure, lipids, equally backed up by, there was a good demand for Metrogyl this year, which grew at around 10-11% for the year, the progressive portfolio of metronidazole franchisee. And last but not the least, we are also happy to share now that Sporolac, our probiotic brand, is now among the top 300 brands in the country. So today now we have 6 brands in top 300, that is Cilacar, Nicardia, Cilacar T, Rantac, Metrogyl, and now Sporolac. That is how we are placed. And the fundamentals of the business looks very strong.
Right.
Not only that tomorrow we want to grow better than the market, but also we want to inch up our ranking in the prescription ranking overall as a company.
So that brings us to two-part questions. Nikhil, a couple of things that have happened under your leadership. One is the surge that we've seen in the domestic part of the business as against just, selling to the US and other markets. And the second part is that you're saying that you are increasing your, looking to increase your prescription drugs as well. So to that extent, what would be your ANSP going forward? That's point number one. And secondly, at what rate do you expect your domestic business to go and the other businesses to grow over the next 1 year or 2 years, if you must?
Short to medium term, Mangalam, is what we see company growing at nearly around 12% overall as a company, but 2 parts of the business. India should grow at 12 to 14%, and equally outside India, CDMO should also grow at around 12 to 14%. If you look at historically, in my past interviews, what we have been talking for the world of CDMO, it has been a very progressive category for us outside India, particularly what we do in the world of lozenges with our players, consumer partners outside India. Our CDMO run rate, though the business has not grown this year, is average 110 crores this year every quarter. So we have done around 430, 440 crores. There are some good progressive marquee projects which will be additive to this entire business. So by end of this year, those projects, be it our lozenges which will be going to Europe and US market, we are getting into newer way of drug delivery, that is throat spray. We are getting into the entire world of iodine-based formulations for gargles, for creams and ointments. Those all projects are on. So FY27, our average run rate every quarter, which is 110 crore for the FY25, FY27 will be 150 crores. So we see the CDMO business also next 3 years CAGR growing at around 15%, India growing at around 12%, and anything if we buy in India, which we continue to evaluate assets, will be additive in nature. And last but not the least, also I would like to talk about that in last 3 years, we have been raising our EBITDA margin guidance. So if you look at what we scored in terms of EBITDA for the year FY25 was 26.3%. Our guidance was 25 to 27%. This year yesterday in our investor call, we have raised our EBITDA guidance to now 27 to 29%, which was 25 to 27% up till now. So a lot of improvement that we are trying to see in the mix of business. We are trying to look at how do you drive organization which is more efficient. And also our productivity per medical rep now, including the ophthalmology business, for the current year stands now at 8 lakh rupees, which was 4 years ago, 4.6 lakh rupees. So productivity also has gone up, and we would like to challenge ourselves that how do we take this productivity and grow it around 12 to 14% in next 3 years.
Okay. All right. Well, Nikhil, while the CDMO business seems to be firing on all cylinders, just wanted to touch upon the US business for you.
The US is a very small business for us. We are doing around $30 million, and we have got 15 ANDAs approved, which JP as a company holds. Also happy to share we had a US FDA audit in the month of March, which happens every year for our formulation as well as API business. Not only no 483s, but no observations. That is how we run our manufacturing plants. We continue to file 3 to 4 ANDAs every year, looking at more opportunity, low volume, high value, opportunistic. But we don't expect this business to become big. Our major focus continues to be India, CDMO, and in some parts of ROW market, because there we see a lot of opportunities. We have been filing every year 10 products in the ROW market, and those products will start commercializing FY27. So from there, the entire run rate for our business will be, which the business today is $50 million. We do around $12 million every quarter. That business today is growing at high single digit. We expect when these new products, which we have registered for last 3 years, 10 products, 30 products in last 3 years, when they start commercializing in FY27, this business should also grow at mid-teens with better EBITDA margins.
What about
CDMO growing at 12 to 14%, and US high single digit. Yeah.
Okay.
What about the cash on your books? I just wanted to know, 700 crores of cash on your books. You said that you are looking at some sort of M&A. You mentioned that briefly. What categories are you looking at? How close to a deal closure are you?
Not that we are closer to any deal closing, but Mangalam, we continue to evaluate assets. And in last 4 years, we have done 5 deals. More opportunistic that we would like to do, more we would like to see in the space and the areas where we are present, more in the area of cardiology, probiotics, pediatrics, or women health. Given a choice, we would like to buy something in that space. It all depends upon what value the asset is available, and if we are able to do justice with that asset, and also we are able to do justice with the existing portfolio that we have to grow better than the market.
Okay. Well, Nikhil, we can't end this conversation by not asking you about KKR's plans. They've sold around 5% stake. Give us what the plan is with regards to KKR and JB Pharma.
KKR being a responsible private equity player in the country, and they diluted 7% stake. They continue to be the promoter, and they continue to hold 47% stake in the company. Business Ekta is as usual. Also, I would like to share with you that we have now got a new chairman, Mr. Arun Duggal, who is an ex-Bank of America. He now is a chairman of the company. In last board meeting, we have got now Mr. Ashwini Puri, who also have joined our board. He is also on the board of Titan. Business continues to be as usual. We have 3 folks from KKR on the board. We continue to discuss our ongoing progression in terms of what business we want to do in next 3 to 5 years. We already have made a plan that how do we grow this business at around 12 to 14% CAGR for next 3 to 5 years. KKR will take its own call at the right time in terms of right values, what they think. Very less that as a management team that I would be in a position to comment.
So they're still, they're still considering their options at this point in time. They're looking for buyers.
See, it's very difficult for me to talk about this because we being the management team, we are responsible for running the business. It's at the day call from KKR that what do they think is the right time in terms of when they want to exit.
All right, fine. Fair enough, Nikhil. I'm sure we're going to hear probably a little more about that in weeks and months to come. Thanks very much for joining in and speaking with us and talking to us about the guidance. We need to take a short break now, but up next, technical Sameet Chavan of Angel One will be joining in.
Welcome back. We were talking about domestic-facing stocks doing well. Look at the FMCG pack. We have Britannia, which has moved to the high point of trade. Tata Consumer for the last 2 trading sessions has been doing well. We spoke with the management. They are looking to double down on their growth going forward. And we have HUL, which too has moved to the high point of trade as well. But by and large, if you look at the frontline indices, after a big rally yesterday, in the second half in particular, both the Nifty as well as the Nifty Bank are consolidating. The Nifty just below that 25,000 mark, and the Nifty Bank is, about 100 points lower. Typically, after a big day on the markets, the frontline indices, the next day belongs to the broader markets. And that's exactly what's taking place today as well. We have the broader markets, the mid-cap index up around 0.9%, a percent higher for the Nifty Next 50, and 1.8% higher for the small cap markets as well. So we have 1,800 stocks advancing for about 800 stocks which are declining. And here as well, there is a clear schism. The domestic-facing sectors, they're doing a lot better than the export-facing sectors. If you look at, indices like the Nifty Public Sector Enterprises, the Nifty Realty Index, or the FMCG and the Auto Index, typically getting most of their revenue from Indian shores, are doing a lot better, as against companies that get a lot of their revenue from external shores. So you have the Nifty IT Index and the Nifty Pharma Index, which is actually underperforming in today's trading session. For the Nifty itself, 25,000 remains a bit of a fulcrum for the next couple of trading sessions, and that's why we are seeing a fair amount of writing on both the 25,000 call and the 25,000 put. Together, they have a premium of nearly 300 rupees, bracing for a broader range of 24,700 to 25,300. A lot of long positions added on Titagarh Rail Systems with big volumes, and shorts covering their positions on Angel One and IRFC. The one stock which is seeing some shorting activity is Patanjali Foods, opened higher on account of good numbers, but from highs it has seen a selling because maybe the worst or the best of the oil cycle is behind the company. And that's something which the street is perhaps taking note of, Ekta.
Okay, all right. So Patanjali Foods on your screen, that stock down around 1.7%. Samit Chavan joins in to tell us what he's tracking today. Samit, welcome to the show. Well, it's a Friday, so give us a sense in terms of what your calls would be today and any specific Nifty strategy for the second half.
Good afternoon, Ekta. See, as far as key indices are concerned, we expect Nifty to head towards 25,200, 300 quite soon. We have a typical pattern wherein you would see a sharp surge followed by some consolidation that we witnessed in last 3 days. And again, yesterday, towards the tail end, we witnessed a massive surge in Nifty, and it clocked 25,000 with ease. Again, today we are seeing some consolidation. So it's a part of time-wise consolidation. The overall structure has become strongly bullish. If you look at the weekly chart structure, it suggests that the Nifty has clearly formed a strong base. The immediate base is now shifted higher. 24,000, 23,800 is the immediate base, and there's a strong support for next few days would be around 23,700, 23,600. So any dip would be a good buy. In fact, it's 24,700, 24,600. Any decline is likely to get bonded to, and now going ahead, we expect Nifty to outperform Bank Nifty, which has been outperforming since last couple of months. So overall, as I said, level-wise, 25,300, 25,400, these are the next levels to watch out for as far as Nifty is concerned. As far as individual stocks are concerned, although we are seeing some, consolidation or some, sluggishness in key indices. If you see mid-cap index, it is trading with gains of nearly 0.8%. So individual stocks are buzzing, and we like, a couple of mid-cap counters. First one would be, from the railway space. IRFC certainly looks good. It has already formed a good base, and today we are seeing a breakout from V-shaped pattern along with sizable volume. So any minor decline would be a good buying opportunity. In case of IRFC, 136, 135 would be a good support zone wherein one can look to get into this stock. Stop loss can be placed around 132, and we have a positional target of somewhere around 150 to 155 for IRFC. The other buy call would be on SJVN, similar chart pattern. It has already formed a good base of V-shaped pattern breakout with volumes, and is likely to head higher. 110, 112, these are the next important levels to watch out for, which would be our immediate target. It can be bought with a stop around 19.
All right, Samit, thank you so much for that. That's about his calls on the index as well as individual stocks. Let's take a short break. On the other side, we have management of Thangamal Jewelry joining in to talk about their fourth quarter numbers. Thangamel Jewelry, that's the stock on our radar. SM Lakshmanan, who's the Vice President Finance and Accounts, joins in to discuss their fourth quarter numbers, which were obviously, bolstered by the big rise that we saw in gold prices. The question is where we go from here on itself, because the company believes that if this rise continues to sustain, then maybe at some point it may have an adverse impact on volume offtake for gold. Thanks a lot, Mr. Lakshmanan, for joining in. I was looking at your update post-quarter as well. Akshay Tritiya, not much in terms of value growth happened over the last year. In fact, volumes declined by about 24% as well. So in light of all of this and the kind of growth that you've seen in this year, close to around 28%, what is the aspiration that you have for FY26 when it comes to revenues? And what kind of margin prognosis do you go with?
Good afternoon, Mangala. Thank you for the opportunity. Thangamel Jewelry Limited has achieved a turnover of 4,911 crore rupees for the financial year 24-25, registering a retail revenue growth of 28% year on year. In terms of volume, gold increases by 4% for the financial year 24-25, and the diamond volume increases by 12%. As far as the current financial year 25-26 is concerned, yes, it has started on an encouraging note. Akshay Tritiya 2025 revenue performance has been better than the 2024 Akshay Tritiya performance. Chennai flagship showroom, which was launched in the last week of February, initial response is satisfactory. And the company is hopeful of bettering the retail revenue performance of 24-25 in the financial year 25-26.
So upwards of 25% is what we can see this year.
Absolutely.
Okay. So just wanted to get a sense in terms of the diamond volumes. For Q4, it was up around 7% odd. Are your diamond volumes being impacted, one, because of lab-grown diamonds, along with the fact that there are higher gold prices?
Lab-grown diamond is not a concept in this part of the country. Rather, more particularly for Thangamel Jewelry, whatever we have been selling is natural diamonds. And yes, the diamond sale has been having a very good youth appeal. And it has been doing wonders in my company, Thangamel Jewelry.
All right. What about store expansion? What are you targeting in FY26? You've, opened a couple of stores in Chennai. You have a few more likely to open. You've raised over 500 crores via fundraise as well. All of this to be deployed in store expansion. What is your target here? What geographies are you looking at in and around Tamil Nadu, looking to get out of there as well? What's your prognosis?
Yes, Mangala. The year started with a store count of 60. The 60th showroom had been the Chennai flagship showroom. As you correctly said, 2 showrooms have been opened during this 1.5 month period. So the present store count is 62. And 8 more showrooms the company is looking at to launch during this financial year 25-26, taking the new showrooms tally to 10. And predominantly it's going to be in and around Chennai, and probably 3 could be in other than Chennai, in the state of Tamil Nadu. As of yes, the company is looking at Tamil Nadu state, and a lot more can be done in the state of Tamil Nadu itself.
Okay. While business has grown for you, your margins are still subdued. In fact, they've fallen on a year-on-year basis from, say, 4.9 to 4.1%. What resulted in the additional incremental pressure, and what is your guidance?
Yes, EBITDA margin for the financial year 24-25 stands at 4.76% on the retail sale. There are a few reasons. One is the customs duty reduction hit. Normalizing this customs duty reduction hit, my EBITDA margin would have been 5.08% for the financial year 24-25, meaning upwards of 5%. Yes, the company has consciously incurred brand building, advertisement, publicity promotion expenses in the financial year 24-25 for the expansion that has been going on in and around Chennai, as well as in a few other towns and cities in the state of Tamil Nadu, which will have the enduring revenue benefits in the periods to come. But for this one-time expense which has been incurred in a front-ended manner, and to some extent the staffing expenses also for these expansion outlets, the company is confident or hopeful of retaining or maintaining the EBITDA target at 6% level going forward.
So what margins should one work with next year? Are we looking at closer to double digits?
Gross margin?
EBITDA margins.
EBITDA margin, I'm saying 6%.
Okay, 6%. And you said that if gold prices are high, that may impact volume offtake. So what is your experience been so far with gold at little over 1 lakh rupees per 10 grams? How has customer behavior been? And what are you doing to prop up volumes going forward?
Sales continues to be encouraging for Thangamai jewelry. That is the reason I said the company's gold volume growth has been 4% for the financial year 24-25, and in the last quarter it has even been 5+%. So we are confident that we will be able to maintain this positive gold volume growth in the year 25-26 as well.
Okay. What I wanted to know is, have you had to reduce your making charges when you do sell jewelry to your customers? Have you had to do that, especially in the past couple of months?
There could be a little bit plus and minus in terms of making charges or in terms of, at the gross level, but the company tries to target the gross level to be at a double-digit level, 10% level. Presently, it is 9+%. Definitely, the company is looking at a target or guidance level of gross profit double-digit level, 10%.
Okay, but just specifically on the making charges, I wanted to understand that are the discounts heavier than what you were probably giving 1 year ago?
Yeah, it is cyclical based or season based. For example, in the Q4, yes, Thanksgiving discounts would have been given. It depends on the seasonal factor. But at the end of the day, the company tries to have the combined gross profit level at 9+%, taking it to 10 double-digit level going forward. To answer your question, is the season-based, strategies the company will be taking.
What about hedging? It's increased from what, 70% back in FY 21-22 to close to 96% now. How does that, what kind of bearing does that have on your margin? Because at a time when gold prices are rising, you would have been better off unhedged because you would have gotten a lot of money on the inventory that you would be sitting on. Now that gold prices are at the peak, are you looking at increasing your hedges further or are you looking at reducing some of the hedges?
Yes, Mangalam, as I had mentioned in the last CNBC discussion as well, the company maintains the hedging policy of 90+%, almost fully hedged. The reason is company wants to focus on the operating efficiencies, operating profitabilities. So now that it is fully hedged, yes, the company is looking at the operating profitabilities.
Okay, operating profitability is what you're looking at, over 25% revenue growth in the retail business next year with positive gold volume growth and margins, EBITDA margins of 6%, targeting gross margins of double digits as well, with 10 stores to be opened in this year, 2 of which have already been opened. Thank you so much for joining in, sir, and giving us an outlook for the next year. That's the management of Thangamai Jewelry. Street likes what they're saying specifically on the margin and gold volume and the guidance for next year. The stock at the high point of trade. Take a short break, come back, getting more on the markets and a lot of stock-specific action. Stay with us.
Welcome back. Well, Crompton Consumer is in focus post their Q4 numbers. Upasna is tracking the stock. She's here with the details.
While the company has reported a good set of numbers, revenue was largely in line. PAT and EBITDA margin beat the poll estimates. Now, EBITDA margin beat was mainly led by positive margin surprise in company's lighting segment and a healthy growth trajectory seen in company's butterfly business. Now, coming to the numbers first, now revenue saw a growth of 5%, EBITDA saw a growth of 30%, EBITDA margin saw an uptick of 240 basis points and stood at 12.8% versus the poll of 11.5%. And this EBITDA margin expansion was mainly supported by company's lighting segment, which saw an uptick of as high as 700 basis points at 15.9%. Butterfly stood at 6.7%, which stood positive versus the negative PBIT, and ECD saw a steady margin of 16.7% on a Y-on-Y basis. Now, PAT saw an uptick of 29%, and company's key segment, that is ECD, saw a steady growth of 6% on a Y-on-Y basis, which was in line with the street estimates. This growth in ECD was mainly led by pumps and appliances, which nearly saw a 20% growth on a Y-on-Y basis. Now, company held its Q4 con call, and here are some of the important takeaways indicated by the company. Now, company says that it is actively exploring a greenfield manufacturing project with an investment of 350 crores, and the phase 1 will focus on fans. It is also entering into a high growth solar rooftop segment with a TAM estimated around 20,000 crores is what they have indicated. Now, coming to appliances, it says that the appliances have delivered high-teen growth, whereas pumps continue to perform very well. And despite delayed summers, air cooler continue to see a strong, robust growth of 50% on a year-on-year basis. Now, coming to Butterfly, which was under stress and has gone under various management strategic changes, it says that the Butterfly performance was mainly supported by double-digit growth in mixers and cooker category. And lastly, company has also said that despite consumer demand that continue to remain subdued, company is hoping for an optimistic FY26 growth on a Y-on-Y basis. So all in all, strong set of numbers and upbeat management commentary.
Strong set of numbers, upbeat management commentary. The stock market happy. Crompton up 7%, but not so much for Newland Lab, down after reporting a weak set of numbers. The intraday comes up for you, currently down 6%. A tale of two cities here, Ekta.
Yes, absolutely. Well, Newland Labs, you know, the stock is down around 6% because it was really a darling of a lot of investors, and it's disappointed the street in terms of numbers. So the revenue is down 15% year-on-year, down 18% Q-on-Q. EBITDA is down 52% year-on-year and down 41% Q-on-Q. Margins have come all the way down to 16% versus 28% year-on-year and 22% Q-on-Q. And the profit has fallen 59% and 73% year-on-year and Q-on-Q respectively. Now, in terms of the FY25 performance as well, revenue down 5%, EBITDA down 30%, margins 22%, and a profit decline of around 13%. The company has said, however, that several molecules in the portfolio are currently at an inflection point, and growth is expected to resume in FY26. The CMS revenues this quarter stood at around 637 odd crores. Now, separately, Goldman Sachs has written on Newland. They have a buy and a target price of around 14,775. They say reported Q4 was impacted by significant fall in development revenues, which are generally lumpy in the CMS segment. They expect the top line to accelerate by 30% in FY26, driven by monetization of the expanded Unit 3, commercialization of Cobenfy, and a potential fourth molecule. So they are bullish on certain drugs and molecules, and launch and approval of newer niche molecules in the specialty API segment. So overall, let's see whether that comes through. As of now, the street is disappointed and taking profits off the table for Newland.
Right, that's about Newland Labs. What we'll do is let's talk about PB Fintech as well. That's in the green after reporting its fourth quarter numbers. Vamakshi joins in to tell us more about PB Fintech. Vamakshi, what is it that the street liked?
Well, for PB Fintech, the premium saw growth of almost 37%, and this growth was largely driven by the new initiatives this time around. Revenue saw an uptick of almost 38%, but came in below what the analysts were expecting. The adjusted EBITDA, on the other hand, was much better as compared to analyst expectations at 149 crores. It has almost doubled as compared to the same quarter in the previous year. The adjusted EBITDA margin as well, seeing an uptick of almost 400 basis points to 10%. Now, keeping in mind, the elevated valuations, Morgan Stanley has given an underweight call, target price of 1,130 per share. And in fact, earlier this morning as well, there was a con call that the company held. They sound quite cautious as far as the savings part of the business is concerned. They say that the new insurance core premium came in below expectations. They think savings business is very challenged right now, and they are struggling to grow here. They see slowdown in savings business to persist in Q1 as well as Q2 of FY26 as well. From a long-term perspective, however, they still maintain their 30% CAGR growth, especially in the core business. Apart from XX, that is X of the savings business, the growth can be as high as 35 to 40% is what they've highlighted. That was the key negative this time around. But on the flip side, when we look at the health insurance business, they say that they are growing at almost 4 to 5 times as faster than the industry. This is much higher than their own expectations of 2 to 3 times. They're focused on building new segments like pension, and in fact, they also highlighted that some conversations internally are on to enter the broking business. So lots of factors playing their way through PB Fintech.
Okay, all right, Vamakshi, thanks very much for that. We'll take a short break now. On the other side, Manisha Gupta will join in and take us through what she's tracking in the commodities segment. Stay tuned. Welcome back. Well, you're still tuned into Halftime Report on CNBC-TV18. Well, it's as of now similar for the markets. We have a consolidation taking place for the Nifty with a negative bias, and the Midcap index holding up with a gain of almost 600 odd points. Bank Nifty absolutely flat with a little bit of a tinge of red. Manisha Gupta joins in with more details on the commodity space. Manisha.
Thank you so much for that, Ekta. And I have a guest as well. Mr. Maninder Singh Nair is CEO and founder at CEF Group. Mr. Singh, thank you so much for joining in. When I was looking at numbers, it does tell us that the government is pushing for more organic exports. There was a statement from Minister Piyush Goyal to that effect as well. So from 5,000 to 6,000 crores right now, the target is 20,000 crores for the next 3 years now. How achievable, feasible do you think those numbers are?
So these numbers are quite achievable. In fact, to the country that we are in and kind of agriculture we have, it's a very small number. So basically, this number is small because we are just targeting good quality produce for export market. But one big question is that why are we not targeting good quality produce for our domestic market? So if we target the good quality food for our domestic market and then also think of export market together, this number can really be much more bigger.
Mr. Nair, what would you say is the overall organic farming number for India right now, and what is the kind of growth that we've seen on a year-on-year basis?
So when we say the word organic, there are two things to it. One, that whether it is certified organic, defined through a certificate, or whether the quality is actually organic, which is high on nutrient and less on quantification. So if you talk about India exporting food to the world, the current scenario is that we are just talking of organic as certification. And trust me, if we convert this from certification basis to actual quality basis, then the kind of market that is available globally is almost 50 times than what India is looking at right now. So there is a big push required for natural farming, which can lead to organic produce and amplify this market as a whole.
Mr. Nair, talk to us also about the feasibility part of it. Would you say that there is enough available in sense of efficient, cost-efficient inputs for India to dwell into this?
Yeah, so you see, when in 2014, when Prime Minister Modi came into power, the kind of subsidies we were giving to chemicals that were used in agriculture was to a tune of 40 to 50,000 crores a year. Today, if we talk about the same quantity of chemical fertilizers used and subsidies being given to it is almost 2.5 lakh crore per annum. Now, organic or natural farming, in a way, is a must to be done by the government right now to reduce our financial burden on one side and also to increase the health and quality of our produce and exports thereon on the other side. This is very much possible provided we work more on the consumer side, which wants to pay good amount of money for good quality of food. One big gap that we see in this entire market is that we are focusing on saying that we should use bioagri inputs and we should produce naturally grown food, organic food. But at the other end, we are not really doing anything to bring the consumers in line with this thought process. So a lot of spend from the government also has to go on consumers who can get access to good quality produce parallelly.
Mr. Nair, also, what is your sense on the National Mission for Natural Farming, where we do understand of 1 crore farmers and nearly 7.5 lakh hectares is what the government is looking at? What is the on-ground progress when you see that?
So this is also divided in our country in a way that you will see few states like Uttarakhand, Sikkim, of course, even Jammu Kashmir for now, and a lot of other parts of Madhya Pradesh, Andhra, Tamil Nadu. They have really done significant progress when it comes to organic or natural farming. We need to create and also amplify existing successful models for other states to fall in line and to make sure that this progress happens across the country and not in few states. So a lot of synchronization in the central government pertaining to policy matters being implemented at the ground level needs to be done, which can really up the scale of natural and organic farming in the country.
Just to get a sense of the numbers really, Mr. Nair, what would you say is the overall market right now and then the organic as a small part of it?
So overall market, if you say is 100, organic is currently at less than 3%. And we really need to shift our gears on all sides to bring this to at least 25 to 30% in next 1 decade or so.
All right, so just 3% of organic food is what we are eating, Ekta. So really a small number there. And Mr. Nair, thank you so much for joining us, telling us that a lot perhaps needs to be done in that line.
Yes, absolutely. Thanks, Manisha, for that. On that note, we need to wrap up on Halftime Report. Business Lunch up next.
Stocks trade ranged following a mixed session in the US and rising geopolitical uncertainties. Industrials and realty are the big gainers, even as IT and healthcare drag. Mid-caps are clear outperformers. IndusInd Bank revealed its wrongly recorded interest income of 675 crore rupees over 3 quarters and identified unsubstantiated assets of 595 crore rupees. While the accounts have been corrected in January, the instances spark fears of a deeper malaise. The stock dips. Bharti Airtel, co-promoter and Singapore's telecom operator Singtel sells under 1% of its stake in the company via block deals with a floor price of 1,800 rupees a share. The stock slips. SW Energy gains despite missing income and operating profit estimates on the company's bold aim of tripling capacity to 30 gigawatt by 2030, coinciding with a similar growth in EBITDA. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. A look at the markets today. A subdued trading session is what we're seeing coming in. Like you can see, 24,989. So slightly below the 25,000 mark is what the Nifty is trading at as of now. So surely we'll be watching out for the Nifty. Bank Nifty also a bit of an underperformance coming in today as well. It's not managing to move on to the green side. So that is something that we're watching out for. Mid cap and small cap, that's where the outperformance continues even today as well. Mid cap up 0.9%, small cap up 1.75% as well in today's trading session. So that is something that we're watching out for. Now, other than that, what's trending? We have defense stocks that are in focus today. They continue to be in focus. We have Zentek, HAL, Data Patterns among the top gainers coming in on the defense side. Shipbuilding stocks, those are also buzzing in trade. So Cochin Shipyard, GRSC, Masgao Dock, all these names also are in focus today and buzzing away in trade. Look at the gains, more than 8% for each of them. Railway stocks, that's another trend that is there today as well. Titagarh Rail, RVNL, RITES, Jupiter Wagon, Ircon International, all of them are managing to hold on to gains of around 9 to 10% and above that mark. So surely watching out for that trend as well in today's trading session. So keep an eye out on all these buzzers, mid and small cap, clearly the outperformance like we spoke before. But let's focus in on IndusInd Bank now. More accounting discrepancies come to the fore after the bank has come and actually clarified on this front as well. Yesterday, they've given some updates on this front. Ritu is joining in with us to give us more updates on what is happening with IndusInd Bank. Ritu.
Well, fresh trouble brewing at IndusInd Bank again after that 1960 crore rupee hit from the discrepancies in the derivatives book. 2 more accounting lapses have now come to light. The bank says its internal audit department, in a review of the microfinance portfolio, has found that 674 crores was incorrectly recorded as interest income over 3 quarters of FY25, and that amount has since been fully reversed as of the 10th of January. Now, this follows the bank's earlier disclosure that it had roped in EY to assist with an audit into certain concerns in its MFI book, and now we know the scale of the issue, but even that's not all. Separately, a whistleblower complaint has prompted the audit committee to direct the internal audit team to dig into transactions under other assets and other liabilities, and that probe has uncovered 595 crores in unsubstantiated balances under other assets, which were set off against other liabilities in January. Now, the bank said that its audit team has also reviewed the roles and actions of key employees, and the board will take steps to strengthen internal controls, hold people accountable, and initiate action where needed. We've already seen the CEO and the deputy CEO step down last month, taking moral responsibility for the lapses in the derivatives portfolio. And now these latest disclosures make it 3 major accounting lapses in just 3 months. And that raises some serious questions around financial controls and oversight at the bank. Morgan Stanley has cut the bank's FY26-27 earnings estimates by 15 to 20% and says the FY25 net income could take a 900 crore rupee hit. CLSA, meanwhile, has downgraded the stock to hold, cut its FY25 profit estimate by 22% and lowered the FY26-27 projections by 13 to 17%.
Thanks for that, Ritu. But earlier we spoke to Abhijit Diwan, founder of Neostrat Advisors LLP, and he too weighed in on the accounting discrepancies from IndusInd Bank and gave his view on what the way forward for the bank could be and what it could look like. Listen in.
Now, it's important to note that even suspense accounts, which is accounts where unreconciled or unexplained balances also sit in other assets and other liabilities. So technically, unless one goes to the root cause of what these other assets and other liabilities were, which I'm sure IndusInd has done but not disclosed, at least to the in publicly declared forums, then one would not get an appreciation of exactly what was this. Having set off could have been the right option. But one needs to explain what these entries were, what the root causes of these unreconciled numbers or unsubstantiated numbers were, and how have now they been substantiated by netting off the other assets and other liabilities. Needs to be explained. Now, it's important to note that even suspense accounts, which is accounts where unreconciled or unexplained balances also sit in other assets and other liabilities. So technically, unless one goes to the root cause of what these other assets and other liabilities were, which I'm sure IndusInd has done but not disclosed, at least to the in publicly declared forums, then one would not get an appreciation of exactly what was this. Having set off could have been the right option. But one needs to explain what these entries were, what the root causes of these unreconciled numbers or unsubstantiated numbers were, and how have now they been substantiated by netting off the other assets and other liabilities. Needs to be explained.
Okay, let's move on and talk about two other stocks, Bharti Airtel and JSW Infra. They saw block deals in today's trading session. Vivek, who's joining in with us to give us more details in this one. Afternoon, Vivek.
Well, that's right. So earlier today, pre-market open, we had told you and intimated about how there were likely to be two large block deals in today's trading session. So Bharti Airtel as well as JSW Infra. Now, Bharti Airtel, along expected lines, Singtel sold another 7.1 crore shares worth in the company. The total size of this particular block was a little over $1.5 billion, and this particular deal was done at close to 1,814 rupees a share. Now, what Singtel has said in a press release that they've just issued a couple of hours ago is that they've been working with Bharti Enterprises to go ahead and equalize its effective stake in Airtel in the medium term. So, what was Singtel's pre-block stake? It was at close to 29%. Through Pastel, they held a little over 9.1%. So the effective stake post this particular block deal will be close to 28%. The Mittal Group stake, remember, is close to 23%. So you could see some more stake or some more block deals that could happen going forward as well as far as Singtel is concerned. Now coming to JSW Infra, in order to maintain and in order to adhere to SEBI's MPS, which is minimum public shareholding norms, the company earlier on May 12th had intimated the exchanges that the family or the promoter group intends to sell close to 2% stake along expected lines. Today, the Sajjan Jindal Family Trust that held over 80.7% stake in the company sold close to 2% stake via a block deal. Now, this particular stake would have fetched that particular entity a little over 1,200 crores. Both of these stocks post the block deal are under slight pressure today.
Okay, Vivek, thank you so much for that. Now, moving on, sources say that the Reserve Bank of India could decide on the government dividend on May 23rd, which is next Friday. The RBI board has already reviewed the economic capital framework, which is required before the dividend payout. Now, economists believe that RBI's dividend could be higher due to bond purchases as well as forex operations. They say and they see that the dividend ranging between 2.5 lakh crores and 2.5 lakh crores is something that they're watching out for. And in some trade updates that are coming in, the US president has said that India has offered to trade a deal with the United States with basically no tariffs. President Trump said that US trade with India is very limited due to the high tariff rates that they're seeing. Foreign Minister Jaishankar has said that the trade negotiations are complex and not yet final. He added that any trade deal has to be mutually beneficial and work for both the countries. Listen in.
You couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest, and now they're saying no tariff.
These are very complicated negotiations. They are very intricate. Nothing is decided till everything is. But any trade deal has to be mutually beneficial. any trade deal has to work for both the countries. And I think that would be our expectation from the trade deal. And until that is done, I think any judgment on it would be premature.
And Sanjeev Sanyal, member of the Prime Minister's Economic Advisory Council, also weighed in on trade talks between India and the United States. Listen in to what he had to say.
We are quite confident that we will have some sort of a trade deal with the US in the very near future. So all of these things will not matter very much. As you heard President Trump mention, we are in advanced talks for a free trade agreement, no tariffs on both sides. And so, and we have already concluded one with the UK just a couple of weeks ago. And as you yourself mentioned, that we are now in advanced talks of doing something with the European Union. So really, we are opening up our market in a very big way. But of course, as our Minister of External Affairs mentioned, it has to be done in a mutually advantageous way. Yes, I think as I said, we are in advanced talks. This has been going on for some time. So it's not like I have, we have just come to this point suddenly. And I think both sides are very keen on this. It works in various ways. I think there are some small niggling issues. I'm so sure they'll be sorted out in the next few months.
And let's move on. The Commerce Ministry has said that the External Affairs Minister's response to the United States President is appropriate. The ministry said that the talks are progressing well, with a team slated to travel to the United States for further talks. Abhimanyu is joining in with us to give us more details on this one. Abhimanyu, tell us more about the ministry's comments that are coming in. What more are you picking up?
While the pause on the applicability of tariffs announced by the United States continues, India and the US are looking to sign a first tranche of a bilateral trade agreement before the 9th of July. That is when till the pause is going to remain for now. It remains to be seen how early the discussions are going to happen and are going to be concluded, even as both the sides are engaged in continuous discussions. India's Commerce and Industry Minister Piyush Goyal is slated to travel to the US and his visit is going to be followed by a visit of India's negotiating team, who are going to speak to their American counterparts and are looking to chalk out a deal which will possibly include issues of goods in the first tranche. It remains to be seen whether the issues of rules of origin and technical barriers to trade as well as non-tariff barriers are going to be included in the first tranche. The Commerce Ministry had also indicated that it was good to see de-escalation in trade tensions between the US and China, since both the sides had reached a deal, and India is looking to increase its overall competitiveness to remain attractive for global companies to invest in and also to generate jobs locally. So clearly India is indicating that it's increasing competitiveness, which is an ongoing process across sectors, and is looking to attract more companies as part of its overall trade strategy, even as India is engaged in continuous discussions with the American side and is also engaging in other discussions for FTAs with other geographies like the European Union and even the Gulf Cooperation Council.
Thanks for that, Abhimanyu. But on that note, we're going to slip into a very short break and here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen. Welcome back to Business Lunch on CNBC-TV18. Now let's move on defense stocks. They have been rising in trade of late. One major reason for this is the government's push on defense manufacturing, especially post-Operation Sindoor. Parikshit is joining with us now to tell us the impact of Operation Sindoor on this sector. Parikshit, what are industry sources telling you? What are you picking up on this front?
Well, Operation Sindoor was extremely successful in India's fight against terrorism and also to send out a strong message to Pakistan with attacks on their air bases in retaliation. Now, the industry is now expecting that there will be orders for replenishing weapon and ammunition stocks, and these could be in the tune of, say, 39,000 to 40,000 crores. Now, the exact numbers are yet to come up, but this is the industry estimate for the moment. Having said that, there is also a feeling among experts and the industry that the government will now have to double down on acquisition of drones, on stealth systems, low-cost ammunition, intelligent munitions such as loitering munitions, which are guided by artificial intelligence, which can detect faces of terrorists, of the enemy, and carry out strikes with minimum intervention of ground forces. Operation Sindoor showed the importance of new age warfare, new technology warfare, and India dominated that. But going forward, we will need to acquire more such platforms and place big orders for loitering munitions, drones, and also alternatives to scalp and hammer missiles, which we get from Israel. All of that will have to be developed locally. Foliage penetrating radar, more ballistic cruise missiles that will have to be developed here in India.
Okay, Parikshit, thank you so much for that. That's the update coming in on the defense manufacturing side. But do stay on with us and tell us about the latest tensions that we're seeing in terms of an update between India and Pakistan. What are you picking up here?
As of now, the government has neither confirmed or denied any further DGMO talks. But what has been said by top officials in the Indian Army is that the understanding that was reached on the 10th of May, that continues. There is no change as far as the ground situation is concerned. Both sides are working out measures to reduce troops at the border. But for the moment, nothing has changed. Operation Sindoor continues. Our forces remain at high alert across the border and also on land, air and sea. So we'll have to see how things progress from here onwards. But calling off Operation Sindoor will be a political call. For that moment, for a moment, it has not been taken.
Okay, Parikshit, thank you so much for that. Now let's move on and get you more updates coming in here. Now, especially meanwhile, the products from Turkey have been caught in the crosshairs of India and Pakistan tensions. Among those impacted is Turkish ground handling firm Celebi Airport Services. India has revoked the security clearance to the firm, citing national security. Madhya is joining with us to give us an update on this front. Madhya?
Well, soon after the government's notice, all the concerned airport operators issued statements announcing termination of contract with Celebi. The Civil Aviation Ministry announced that all employees working with Celebi will be transferred to other ground handlers at the 9 airports. We learned from sources that airport entry permits for Celebi staff will continue to be valid until the 19th of May, after which the Bureau of Civil Aviation and Security will issue new permits to these employees under their new employers. But these are around 10,000 employees who handled nearly 160 flights daily across these 9 airports, which is Mumbai, Delhi, Cochin, Kannur, Bangalore, Hyderabad, Goa, Ahmedabad and Chennai. So issuing entry permits on the new employer's name may take more time, and BCAS may have to extend the validity of the existing permits of these 10,000 employees. Now, Celebi provided key services like terminal handling, ramp handling and cargo handling at the 9 airports. It also operated the cargo terminal at the Delhi airport. So now all of Celebi's assets, including the staff, are likely to be taken over by the other ground handling companies. Whether the existing one or new, we don't know as yet. As per India's ground handling policy, there has to be 3 ground handling companies at airports where annual passenger traffic exceeds 10 million. So at Delhi airport, the handlers are Celebi, AI SATS, Air India SATS and Bird Worldwide Flight Services. We learned that Celebi's ground handling at Delhi airport will be transferred to AI SATS and Bird, while GMR will take over the cargo terminal. At Mumbai airport, the 3 ground handlers are government-owned Air India Airport Airport Services Limited, Celebi and Bird Worldwide Flight Services. Now, sources say that Mumbai Airport is onboarding a new company, Indo-Thai, to transfer Celebi's staff and assets. Mopa Airport in Goa had Celebi as the sole player. It is yet to be decided if the operator GMR will take over or some other company will be brought in.
Okay, Madhya, thank you so much for that. We'll surely be keeping an eye out on more updates on this front. But on that note, we're going to slip into a very short break now. And on the other side, we'll get you the updates from our special segment, Trump Watch. So stay tuned in for that. Welcome back. You're tuned into Business Lunch on CNBC-TV18. A quick look at what the market is doing. As of now, yes, we're just at 25,000, about that mark. Slight bit of a recovery that we're seeing coming in from the day's lowest point. The Nifty, as of now, is down 0.2%. Yesterday we saw that run-up coming in the trade in the second half of the trading session. We'll watch out if that's going to be the case today as well. Real estate surely is the one that's trending today. So Nifty Realty is among the top sectoral gainer. We have names like Signature Global, Brigade Enterprises, Shobha Developers, Godrej Properties among the top names coming in from the real estate side. Advance decline ratio clearly in the favor of advances versus declines that we've seen. So yes, that's important to watch out for, and that is why the mid and small cap, that outperformance that we've seen clearly is something that is continuing even in today's trading session. And that's why, most of those mid and small cap names are holding on to very, very strong gains. What is also not doing well today is the pharma and the IT pack. Keep an eye out on that. That's a bit under pressure today to these two sectors. Some bit of a pressure on that front. But on that note, let's move on and shifting focus to the geopolitical developments that we've seen coming in. And as US President Donald Trump ends his tour in West Asia, we have Dia joining you with us to get you some updates on the deals he has signed and what is the latest news from the White House. Dia.
From tense diplomacy to legal battles and economic signals, U.S. policy is in sharp focus this week, shaping developments from Ukraine to Syria, Iran, and even inside President Trump's own tech firm. We begin with Ukraine, where the outlook for a ceasefire is growing dimmer. Secretary of State Marco Rubio played down expectations for the Russia-Ukraine talks set to take place in Istanbul today, saying the likelihood of progress was slow without a meeting between Putin and U.S. President Donald Trump. Let's listen to what he said.
And frankly, at this point, I think it's abundantly clear that the only way we're going to have a breakthrough here is between President Trump and President Putin. It's going to require that level of engagement to have a breakthrough in this matter. I don't think anything productive is actually going to happen from this point forward until they engage in a very frank and direct conversation, which I know President Trump is willing to do.
On Capitol Hill, attention is turning to a new round of sanctions, with lawmakers urging stronger measures to pressure Moscow back to serious negotiations. Meanwhile, the U.S. is signaling a shift in its Syria strategy. The administration plans to request a 180-day waiver on congressional sanctions, potentially opening the door to broader economic engagement. Secretary of State Marco Rubio said President Donald Trump intends to use the waiver authority granted to him by the Caesar Syria Civilian Protection Act, which penalizes anyone who does business with the Syrian government. And as nuclear talks inch forward, Iran is opening the door to American business. Iranian Foreign Minister Abbas Araghchi said that Tehran has no objection to U.S. companies operating in the country, including in the oil and gas sector. His remarks come after President Donald Trump said Washington was getting close to a new nuclear deal with Tehran to replace the one he had abandoned during his first term in 2018. Wrapping up with legal developments, President Trump is invoking presidential immunity in a suit filed by the co-founders of his Truth Social platform. Lawyers for President Donald Trump argued to a Delaware judge that a suit against him by the co-founders of his Truth Social platform should be dismissed or put on hold because he has immunity from such litigation while in office. Though the U.S. Supreme Court last year said presidents have presumptive immunity from criminal prosecution over official acts, it has also previously ruled that sitting presidents are not shielded from civil suits in federal court over acts that predate their time in office. That's all for today. Now back to you.
Thanks for that, Dia. But US President Donald Trump's West Asia tour has ended in another multi-billion-dollar bilateral deal, this time with UAE. Watch this report.
Donald Trump's Gulf tour took him to the United Arab Emirates on Thursday, and the visit was marked by the signing of more deals, valued in all at $200 billion. That followed a pledge by the UAE in March to invest some $1.4 trillion in the US over 10 years. Trump hailed that deal in a meeting with country President Sheikh Mohammed bin Zayed Al Nahyan.
And all I could say is thank you very much. We will work very hard to deserve it.
Among the deals announced Thursday was another order for Boeing. UAE airline Etihad said it would buy 28 big jets from the aerospace giant, including 787s and 777s. That followed news of Boeing's biggest ever order for wide-body jets a day before, when Trump visited Qatar. Also finalised in Abu Dhabi was a plan for the largest AI campus outside the US to be built in the UAE. Reuters sources said the deal would give the country expanded access to AI chips from NVIDIA. Company boss Jensen Huang was seen conversing with Trump at the palace on Thursday. A White House fact sheet said other deals included a partnership between US and UAE oil firms to expand oil and gas production. It valued that agreement at $60 billion. However, US lawmakers, including Bernie Sanders, on Thursday sought to block further arms sales to the country. That's over allegations that UAE forces are involved in Sudan's civil war.
And moving on to some other updates coming in from Israel-Hamas war. An explosion was seen earlier Friday morning on the Gazan side of the Israel-Gaza border, and multiple blasts were seen and heard the night before. Israeli strikes killed at least 114 people in Gaza, according to the local health officials. Meanwhile, a global hunger monitor has warned that 500,000 people face starvation, a quarter of the population in Gaza, where Israel and Hamas have been at war since October 2023. And with that, we're absolutely out of time on this edition of Business Lunch on CNBC-TV18. Thank you so much for tuning in. Up next, your Midcap Radar.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Amakshi Doria and with me is Vivek Iyer. Vivek, we've so far managed to hold on to that 25,000 mark. Nothing much exciting that is happening in the benchmark indices, but on the flip side, when you look at the broader indices, they continue to be vibrant.
Broader indices continue to be vibrant, and this color across the screen is green, especially in the broader end of the markets. Advanced decline ratio almost at 2:1. So it's a very strong session, especially when you're looking at the broader end of the markets. The usual suspects are the ones that are doing quite well. Names like the different stocks, etc., continue to surge. We have quite a lot lined up on the show. We have a couple of managements that we'd like to probe. So let's start off with the top headlines today. Stocks trade ranged following a mixed session in the USA and rising geopolitical uncertainties. Realty and FMCG are the
52-week high amid strong buying in the sector on hopes of boost in domestic manufacturing industry after Operation Sindoor.
Crompton Consumer climbs nearly 7% after posting good Q4 results. Revenue comes in line while profit after tax and EBITDA beat analyst estimates. Management remains optimistic about FY26 growth.
Profit booking in NCC takes the stock lower. Also, FY26 guidance is marginally below what the street was expecting.
Dhanuka Agritech surges after reporting the Q4 numbers. Net profit up nearly 29%, revenue surges 20% compared to last year. The stock is up over 7% intraday.
Well, the Nifty is seeing a downtick of almost 0.2%, but it is still managing to hold on to that 25,000 mark. The broader end of the market is doing exceptionally well. The mid-cap index is up almost 1%. That gets reflected in the advanced decline ratio. The advanced decline ratio is at 2:1. When we look at the sectoral indices, most of them are trading in the green. The Nifty Realty Index is leading the pack with gains coming in on Anantaraj. Nifty Energy as well as media also continue to gain in trade. But like we mentioned before, the action in the mid-cap space is very vibrant. And just to highlight just that, we have a special segment, Mid-Cap Movers. Hormaz is across the wall and is taking us through the mid-caps that are moving around in trade. Good afternoon, Hormaz.
Good afternoon, Vamakshi. You'd be expecting the market to go into snooze mode ahead of the weekend, but of course there are certain pockets that haven't been in snooze mode ever since the last 2 weeks. Defense is that sector, and even today the defense index is at a new high. And take a look at these names. Cochin Shipyard, a note came out today where an analyst was projecting the stock to fall 60% from current levels. The stock is up 12%. Garden Reach is up 11%. Masgao Dock is up 9% at a record high, and Data Patterns too. All of these names have surged anywhere between 30 to 40% this week. And the same goes for the railway PSUs as well. All of these names have surged anywhere between 25 to 30% in the week gone by. Look at Titagarh, of course not a PSU, but still 13% higher today. RITES, RVNL, IRCON, IRFC, all of them seeing gains of anywhere between 5 to 10% in today's session and 25 to 30% for the week. Now, of course, a lot of earnings reactions that have come in. Today, Newland Laboratories is the top loser on the Nifty 500 along with Godfrey Phillips, and the two of them 5 to 6% lower. SKF is off the highs of the day, still holding on to gains of around 6%. Some stocks that are doing well on the volumes front in today's session, that also includes some earnings reactions like Crompton is up 8%. Shipping Corporation of India, another name doing well, 10% higher on very strong volumes. Look at Concor and Devyani International too doing well for themselves. And lastly, a sector that has been in focus has been the capital market names. The revival in the stock market sentiment has definitely given a boost to these names. Look at Angel One, CDSL, anywhere between 5 to 8% in today's session. Back to you guys.
Thank you so much, Hormaz. The shirt you're wearing is red, but color across the screen is definitely green. Well, it's now time for a short break. The management of Balrampur Chini Mills joins us next to discuss their Q4 numbers and more.
Well, good afternoon and welcome to Midcap Radar on CNBC-TV18. Let's go across to Balrampur Chini. The company reported a revenue growth of 5% in the fourth quarter due to higher volume in the distillery segment and increased realizations in both sugar as well as distillery. But sugarcane crushing was down almost 1.4% on a yearly basis. To discuss the numbers and more, we are joined by Pramod Patwari, CFO, Balrampur Chini Mills. Well, good afternoon, Mr. Patwari. I'd like to first ask you on the performance in FY25. Not such a great set this time around, but in the second half of the year, the situation seems to be turning around for you. So what is your outlook going into FY26 for all your segments, sugar, distillery, etc.?
Good afternoon, and thank you for having me on the call. So we are dependent upon few factors, which is very difficult to predict at this point in time. One is the cane availability. So survey will be completed maybe around end of June. So we'll be in a position to give any indication of crushing for the upcoming sugar season post that only. We are also looking to government towards the revision of the ethanol prices for this year. You are aware of the fact that in last 2 years, in spite of increase in the sugarcane prices by 11.5%, we have not seen any increase in the B-heavy juice route ethanol as well as the juice route ethanol. And on top of that, government has increased the FRP for the upcoming sugar season, as a result of which the FRP has gone up by around 16.5% in last 3 years. So the revision on account of that is due. So that's the position at this point in time.
Understood that, sir. So going into FY26, are you hopeful of a better scenario, especially when it comes to the macro environment? And number two, realizations have improved to close to 40.5 rupees per kg. Is this sustainable?
Yeah, it is very much sustainable. In fact, the current realization for Balrampur is around 41 rupees per kg ex-factory. And as of 31st of March, we are holding around 71.5 lakh quintals of sugar. And in April, we produce another 3 lakh. So that is totaling to around 74.5 to 75 lakh quintals of sugar, which is currently valued at around 35.5. This entire inventory will get liquidated within November. So at least for 2-3 quarters, there is a visibility. But as I was mentioning in my earlier remark, thereafter, it will depend upon the correct setting of ethanol prices. So what happened really when we divert extra sugar cane into juice-based ethanol and B-heavy, there is a sacrifice of sugar. So we needs to be adequately compensated on account of that by way of revision in the ethanol prices.
Right.
In the sugar season gone by, country's net sugar production is around 26 million ton, which is expected to go up significantly in the next year. That means it will result into surplus production of sugar. That can be arrested only and only when there is a proper juice-based and B-heavy ethanol prices. Otherwise, the sugar prices remain subdued, and which impacts our paying capacity to the farmers on time.
Sure, and I'd just like to revisit, your comment on the ethanol prices. Now, like you said, FRP has been increased by almost 16.5% in the past 3 years, but the same sort of quantum of increase has not come in on the ethanol prices. So, so I would just like to understand from you, what is the kind of hikes that the industry is expecting for the ethanol this time around? Has any communication been made to the government, and what has their response been?
So as far as the upcoming sugar season is concerned, we have not started our communication with the government. But if you see the price mechanism which was in place till 2022-23, it was a direct linkages with the FRP, and any increase in the FRP was automatically adjusted with the juice-based and B-heavy ethanol prices, with an ultimate mandate of passing that to the retail price of the consumers. So there was a direct pass-through. No absorption was taken at the OMC level, and no subsidy was given by the government also, which was disturbed in the year 2023-24 when the restriction was put. If I go with the price linkage which was in place in 2022-23, then on the basis of current FRP of 355, there seems to be a gap of almost 10 rupees per litre. So I am not suggesting that government will give us a hike of 10 rupees per litre, but that's the gap.
Sure.
Understood that. So 10 rupees per litre is the gap that you're currently facing, and that could lead to margin pressures. Now, going into FY26, keeping all things constant, how do you see guidance that you could give the street in terms of top line, in terms of EBITDA margins, as well as profitability?
I'm afraid we don't give that guidance.
A qualitative number, sir, what could be or a ballpark figure that you could give us?
So it all will depend upon the cane availability, but as far as the sugar prices are concerned, we have given enough indication that 7.5 lakh tons of sugar which we are holding at this point in time will get liquidated within November. The carry cost of which is around 35.5, and currently we are selling sugar at around 41 rupees per kg. On top of it, ethanol inventory what we are having in terms of finished goods as well as in terms of B-heavy molasses, which will get converted into ethanol. Around 8 crores liter of ethanol is expected to come from that segment. In addition to that, we are also targeting around 4 crores liter of ethanol in off-season out of maize root.
Sure, and one news flow did come through this morning. There was a report that suggested that India was examining US request to abolish curbs on ethanol imports. So what is your assessment? What happens if this does go through? Could supply probably outpace the kind of demand, especially in ethanol, and that could put further pressure on the ethanol prices? Is my understanding correct?
So you must have seen the news that government is pushing towards E30 now. So for E20, the requirement is 1,000 odd crores liter. And if the intent is to go beyond E20, that means E30. So I don't see any risk of supply being overshooting the demand as of now.
Sure.
Understood.
And just on the PLA facility, you had said in the past that October 2026 is when you want to commission it. Is it largely on track? And some analysts also, I was just reading a report, and they say that this with the PLA facility coming up, your top line could, your EBITDA rather, could see almost 30% CAGR over the next 3 years. So is that likely?
So as of now, the project is largely on track, and we are targeting October 26 to be the date of commissioning. It is going to be 80,000 tons capacity on an annual basis. Maybe FY28, you will see a full utilization of capacity.
So in FY26, what would be the, in FY27 rather, what would be the kind of revenue contribution that will come through? Because in FY28, when the plant gets commissioned, fully utilized, your revenues could be 2,000 crores is what you've said in the past. So in FY27, what could we expect?
So if we are able to run our facility for say 5 months also, so I really don't know at this point in time, because initially it may take some time to scale up, to stabilize. So it will be difficult for me to give any prediction on this at this point in time. This being a new subject for us.
Right.
So let's target that. Let's hope that FY28 will be the year when we will see the full benefit of this 80,000 tons capacity of PLA.
Thank you so much, Mr. Patwari, for joining us, giving us a sense of how FY25 panned out and the way ahead as far as FY26 is concerned. Also hoping for a price hike is what the management has told us. Well, it's now time for a short break. The management of Kaplan Point Labs joins us next to discuss their Q4 numbers and more. Well, as promised, We are now focusing on Kaplan Point. The company reported nearly 11% growth in revenue from a year ago, margin to see slight expansion on a year-on-year basis. Joining us now to discuss more is Vivek Parthiban, COO, Kaplan Point Labs. Welcome, Vivek. First up, let's start with your performance as far as the USA market is concerned. How did it perform? Number one, when it came to approvals, what is the drug pipeline looking like? And overall, has there been a bit of a slowdown in the anticipation of tariffs that may come about?
Yeah, so we've had a good year when it comes to the US. In fact, we've grown across all parameters. Even while coming to approvals, I think we've had 8 approvals this year. Pipeline remains robust. We have another 13, 14 products under active review with FDA, so that should come through. Most of it at least should come through in the coming few quarters, which should set the stage for another decent year going forward. At this point, the whole tariff situation is a wait and watch. It hasn't affected us or any other generic companies per se, but we're all waiting to understand what could be the implications. But given the recent noise around big pharma, which is basically branded pharma, it looks like generics is likely to be exempted from any tariffs.
Well, thank you for that, Vivek. This is Vamakshi joining in. Now, just sticking to the US market, right? The company has launched the front-end business in the US recently. How much of this, business actually contributes to your revenue currently, and what is the plan for scaling it up?
Yeah, at this point, it's very small. The revenues from the front end, I mean, we are literally a few months old in the front end, right? So it's very small, negligible at this point. We are still very much a B2B company at this stage. Having said that, Kaplan Point as an entity, we've always been in the front end, whether it's Latin America, whether it's many parts of Africa that we used to be present in. So that's one of the reasons why we wanted to be in control of the marketing end of things, number one. Number two, also with generics, what happens is over a period of time, prices begin to erode. There could be competition coming in. The entry barrier might not be as much as it is in terms of big branded pharma, etc. So we front end compared to what it is right now.
So how large would it be?
Right now, it's almost 95.5. So I would say in the next 4 or 5 years, we hope that for it to be flipped over to 70-30 or something like that.
Understood that. Well, give us a sense of the kind of opportunity that you're seeing, the kind of launch pipeline that you have in Latin America. You have presence both in Mexico, Chile, Brazil. Growth plans over there, and can you quantify these growth plans when it comes to FY26?
Yeah, so we already have a fairly dominant position when it comes to Latin America, especially Central America per se. The next wave of growth should come in from the larger markets like Mexico, Brazil, etc., Chile as well. We are a little bit further ahead, I would say, in Chile and Mexico as well compared to Brazil. Brazil does take a little bit longer, but we are there for the long run. I would say over the next 18 to 24 months, there will be a bit of a gestation period where some of these products that we have filed will start to come out, and then we will need to get into, in at least the interim period, some amount of institutional business before we focus on what we are very good at, which is the private market. So I would say 18 months would be the gestation period for us to start firing on all cylinders when it comes to the newer and larger markets in Latin America.
Sure, and you also received an insulin approval in Central America, right? So what is the plan on the diabetes front? How are you participating in the GLP-1 drug wave?
Yeah, so we've already had a presence in the anti-diabetes range in all of Central America. And so this insulin approval that we've partnered up with another company adds to the portfolio. GLP-1 products, I think almost everybody who has a presence in this institutional space and in this wellness space will have some amount of developments that are going on. We are trying to augment our pipeline in as many ways as possible, and anti-diabetes, anti-weight loss is something that is also part of our overall expansion. I would say sometime by middle towards later part of next year is when we will be launching our product in Latin America.
Vivek, at the end of H1, you had indicated that you have a close to 650 crore to 700 crore capex plan. This was to mainly augment existing facilities and also to go ahead and set up facilities as far as oncology is concerned. Where are we on that? How much of that is spent? FY26, what is the capex plan, and how will you go ahead and fund your expansion plans?
Yeah, so I'm happy to report that we've completed our capex for the oncology side. Our oral solid dosages oncology division has been up and running for almost a year now, and the injectable division is going for trials in the next few weeks. So that is completed. The API for general category is also completed. Our oncology API is going on in full steam. Last year, we've invested around 190 crores into capex. And we envision there to be another 350 to 400 crore over the current year and next year, and we should be done with most of our capex after that.
Sure, Vivek. And this year you've closed with a margin of almost 33%. What's the guidance for FY26 then?
We remain hopeful that we're at a good place when it comes to margins. In fact, across peers, I think our margins are probably better than most of the people. I would say, the three levers of growth that we have, number one is the US front end, number two is the oncology piece, and number three is the entry into larger markets of Latin America. Will start to pick up more steam, I would say, in the next 18 months or so. After that, there is a chance for these numbers to potentially move up a little bit. But at this point, I don't see us, having lesser when it comes to EBITDA or PAT or anything like that going forward.
Understood that. Vivek, lastly, when we're talking about Kaplan Steriles, almost 20% of your total revenue now, a 15% growth rate over FY24. You had an important launch in January 2025. What has been the response to that particular launch? And going forward, can you tell us how you see that particular business scaling up? Eventually, what will be the revenue mix going forward?
Yeah, so we've given public statements out that in the next few years, we expect the US business to hit $100 million mark. Hopefully that happens in the next 2 to 3 years. More importantly, I think what we are interested in is to make sure that we're not really chasing top line just for the sake of it. So we are at a good space right now. Even in the US business, if you see our EBITDA is more than 24-25%, and we expect this number to even inch up a little bit more in the coming years. So at this point, the US business is about 20 odd percent. In the next 2 to 3 years, I see this going up to 30% or even more than that.
Sure, and you also have cash on books, 1,180 crores as of Q4, liquid assets of 2,000 crores as of Q3. Plans on M&A?
We're not against it. We're actually, we're always open to something, but it has to be meaningful. We are just about getting done with a bunch of our capex. We want to make sure that we do enough justice to everything that we've taken on organically before we can look at something inorganic. But absolutely, we're not against it. It has to sort of fit in with our line of growth. It has to be a well-managed acquisition as well. So we're not against it, but nothing to report at this point.
Understood. In case you do sign a check, what will be the likely size of the check? And secondly, what is the trend that you're seeing as far as generic price erosion is concerned? Is it high single digit or has it abated a little bit?
Thankfully, in the injectable space, at least, we have not seen too much of a price erosion more than what has already happened. I would say, by and large, it has stabilized. And in a couple of instances, it's actually inched up a little bit as well. When it comes to acquisition, to be honest with you, we are not going to be against something even a little bit larger compared to what we are doing. So the fact that many people have asked us why is it that we sit on a large amount of reserves. Number one, organically, we are able to put away 350, 375 crores almost on a yearly basis just from our regular cash flow. So you can imagine that our Latin American business is very robust. Again, when it comes to M&A, it has to be something that really is meaningful towards Kaplan. It has to be something that fits in with our line of growth. And if the right opportunity comes up, I don't think we'll be shy to write an even larger check than what many people would even predict for us.
Well, thank you so much for that, Vivek. That was the management of Kaplan Point joining in with us. Thank you so much. And we hope to connect with you in the quarters ahead. But, moving on then, let's also focus in on another candidate that is in focus on the back of its numbers. Crompton Consumer is up in trade, and Upasna is here to tell us why. Upasna?
Well, the company has reported a good set of numbers. Revenue is largely in line. EBITDA margin and PAT beats the poll. Now, EBITDA margin beat was mostly led by the positive margin surprise in the company's lighting segment and the healthy growth trajectory seen in company's butterfly business. Now, coming to the numbers now, revenue saw an uptick of 5%, EBITDA saw an uptick of 30%, EBITDA margin saw an uptick of 240 basis points at 12.8% versus our poll of 11.5. Now, this beat was majorly supported by 700 bips expansion in EBIT margin of company's lighting segment, which stood at 15.9%, Butterfly at 6.7%, and ECD saw a stable margin at 16.7% on a YoY basis. Now, PAT saw a growth of 29%, and company's key segment, that is the ECD segment, the growth came in steady at 6% in line with the street estimates. And this growth in ECD was mainly led by pumps and appliances. Now, coming to the company's con call, company has highlighted few important pointers in its con call. Now, here are some of the important takeaways. Now, company says that it is actively exploring greenfield manufacturing project with an investment of 350 crore, and phase 1 of this will focus on fans. It is also entering into high growth solar rooftop segment with a TAM estimated around 20,000 crores by the company. Now, pumps division continues to perform very well is what the company has highlighted, and appliance has also delivered a high teen growth this quarter. Despite delayed summer in air cooler, saw a robust growth of 50% on a YoY basis. And lastly, company says that the consumer demand continue to remain subdued, but company remains optimistic about FY26 growth prospects. So good results plus upbeat management commentary.
Thank you so much, Upasna, for joining us, giving us a sense of how Crompton Consumer's results panned out with strong growth seen across the butterfly garment, product portfolio as well. Well, one stock, if we could pick up, that is the HAL, Hindustan Aeronautics. That particular stock trending near the day's highest points, in line with the entire defense pack that's doing very well. But as we wrap up on this edition of Midcap Radar, here is some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in, as always. Markets where we left it, right at 130, 25,000 around that mark is what the Nifty is managing to hold on to. Sensex at 82,000 is what we're watching out at. 82,300 levels, just about that mark is what the Sensex is trading at. Underperformance also coming in from the Bank Nifty today as well. Not much of a green there. So Bank Nifty as of now is down 0.05%. Keep an eye out on that. Outperformance from the mid and small cap that continues even in today's trading session. Mid cap trading at the day's highest point as of now. Small cap 2 is trading at the day's highest point. Advance decline ratio clearly even in the favor of advances versus decline that we've seen coming in. But this is a show where we solve all your stock related queries, and that's what we're going to be doing. We have our independent expert Shaina Mukaddam joining in with us, as well as Vaishali Parekh, Vice President Technical Research, Prabhudas Leeladhar, to solve all your stock-related queries. Good afternoon, ladies. Thank you so much for joining in with us, as always. Vaishali, before we get to more stocks, let's just take a check in terms of the markets. What are we watching out for? Yesterday, we saw that sharp recovery coming in, right, in the markets in the second half of the trading session. Does it seem like a story that we could watch out for in the last 1.5 hours, or what are we watching out for in terms of levels?
Hi, very good afternoon, Vinny. Yes, so it has been a very good week so far, and we have managed to cross 25,000 levels. So to my understanding, this rally is to continue. And well, now we will elevate our support levels, which was last week, if we spoke, it was 23,800. And now we elevate our support levels to 24,700 and look for the next projected target of 25,500. So I guess the rally will continue, and we will close well too.
Okay, rally will continue is what you're watching out for. 25,000 above that mark is already what the Nifty is trading at as of now. But let's get on to your stock-related queries then. This first query for today is coming in from Umesh, who's writing to us from Pune. He's holding 200 shares of Viatech Wabag, and this is at a price of 1,300 rupees per share, so making a profit on this one. The other one is Suzlon Energy, 2,000 shares, price is 54 rupees per share, and wants to know whether the long-term outlook on the stocks are still intact. What should they be doing with this? Suzlon Energy also, they're making some bit of a profit on this one. Shaina, let me come to you first. What is your long-term view on both Viatech Wabag as well as in terms of Suzlon Energy?
See, Viatech Wabag, I would say that it's a small cap, and it's in a nice niche segment of water treatment, with almost half its turnover coming from international markets, half coming domestically. It's a asset-light model, and they get good funding, like the recent one from the Norwegian markets, where they have got Norwegian fund $100 million. So they have got, fundraising capacity on one hand and execution of the projects on the other hand. So it's a smaller company, but they have got good order book. Order book is 13,000 crores, which is, if you look, almost about 3 times their FY25 turnover. So they have got sufficient scope for growth. Valuations are reasonable. So I would say it's a hold for Viatech Wabag. For Suzlon, there the valuations are expensive. While the management has improved the balance sheet quality by reducing debt, selling unnecessary assets which are non-core. Also, they have got a decent order book position which will drive growth. At the same time, I think if you get any upside from here, or even at current levels, I would say it's a switch, because valuations are expensive in my view. EV by EBITDA is almost 50 times, and which I think is pretty steep.
Okay. And Vaishali, your view coming in on both these on the technical front, Viatech Wabag as well as Suzlon Energy. What should they be watching out for?
So, Viatech Wabag, I think the long-term trend is very much intact, and currently it is at a very good support level. So to those who want to buy, I think this is a very good level to buy, because technically, if you see, it is a long consolidation right from 1,300 levels to 1,500. So there will be furthermore clarity and strength seen above 1,500 levels, and this can go towards 1,800 to 2,000. So I would say it is either you can add more, or you can continue holding or buy as well, as for the targets that I have been mentioning. And coming to Suzlon, Suzlon also actually is showing signs of reversal, but the near-term target resistance comes at around 65 levels. It's getting into a trend. Again, a good range between 50 and 65. So once we see a clarity, if this stock sustains above 65, then it's ready to go towards target of 72. So I think one can hold with a stop loss.
Okay, hold with the stop loss is what you're highlighting for Suzlon Energy. Let's move on to the next query. Actually, this is an investment query that we have coming in. It's from Lal Bahadur Yadav, who's writing to us from Mumbai. He's looking to invest 1.5 lakh rupees. And this is actually for a short-term time period. China, he wants to know for a 6-month time period, any suitable stock or sector that maybe he could look at and in the current scenario that, could help him in terms of investment for the short term.
Well, I think, the obvious sector, like top of mind is defense. And while the stocks have run up, I still think something like a BL, which I personally also hold, is doing well. And even from here on, if you look at the potential, given the fact that there the execution was a problem, order book is not at all a problem. So if they can move from, 1 shift to 2 shift to 3 shift and meet the demands, like, for example, the missiles, some of them, the components are, provided by BL. So to that extent, I would think that is an obvious sector. Of course, the other ones also over there, like HAL, which, all are not cheap. They are pretty expensive. But at the same time, if you are going to factor in good growth, I think you can look at that sector. I would say banking sector also, to some extent, should participate in the growth in the economy. Like, for example, ICICI Bank, even some of the smaller banks, you could look at adding to your portfolio. So you could have a mix of FMC, you could have a mix of banking, you could have a mix of defense, and some, mid-cap stock related to the capital markets. I think to that extent, you could build a portfolio for the medium to longer term.
Okay. Thank you so much for that, China. And on the technicals, Vaishali, anything that you are finding interesting? The time period is short, right? 6 months. So they want to make, I think, quick money, but anything as an option that looks attractive to you?
Yeah, so actually, technically speaking, I think stocks which have yet got a lot of upside scope. I'm looking at two-wheelers. So, for example, Bajaj Auto, Hero Moto. That also is our recommendation. So, I think it's showing automobile sector on the whole is on a renewed growth. So, I would focus on these two stocks, and along with that, there are capital goods like ABB, Siemens, Cummins. These are the stocks which show potential upside. So, according to me, these are good opportunities to get into these stocks.
Okay, look at those options over there as well. ABB also in among the names coming in. But let's move on to the next query for today. We have Nirav Jain writing to us from Jaipur, holding 500 shares of Inox Wind. Price is 160 rupees. They're making some bit of a profit on this one. They want to know the long-term prospect of the stock. Inox Wind, for you, China, is it still a long-term bet? Should they continue to hold the stock?
Yeah, I personally also have been holding it for some time. So I think the business prospects are good. In fact, this year, FY25, the previous year, was extremely good for the company. They actually turned around from losses in FY24 to starting to make profits. The order book position even currently is pretty strong. They have got more than, I would think, a 3 gigawatt order book position on hand to be executed over the next 2 years, 2 to 3 years. So potential from here also is good. At the same time, having the stock having run up, I think it's better to hold it with a stop loss, a deep stop loss 150. That would be a good hold, but I would hold it for much higher levels from here.
Okay, hold it for higher levels from here on as well. And Inox Wind for you on the charts and technicals. Vaishali, would you also suggest the viewer continue to hold this one?
I would say so because the stock long-term trend is very bullish, and it's making an attempt to bounce from its support of, it has been hovering around 140, and from there on it's taken a good move. So I think in all likelihood this can again go towards 220, 240 levels at least. So I guess these lows that are made in these stocks are all buying opportunity, adding more opportunities. So take your call. If you wish to add at 140, 150 zone and hold for the target of 220, 240.
Let's move on to the next query then, and this is on ITC hotels. Sabaseva Rao is writing to us from Andhra Pradesh. She's holding 100 shares of ITC hotels. Price is 200 rupees per share. Wants to know the long-term prospect of the stock. So obviously, most people have also gotten it when they were holding ITC. So the demerger happened, they got ITC hotels. China, ITC hotels for you. Does it merit to hold ITC hotels, or are there other better hotel stocks that they could look for a long-term story?
So I'm one of those investors who got it even as part of the demerger from ITC as well as added on later. We got it at decent levels. So today I think is a day where a lot of my stocks from my portfolio are coming up. So I am positive. At the same time, see, we saw the numbers that came out. They reported decent set of numbers with a 20% inline profit growth. Margins were slightly better. Revenue was about 5% higher. So they have got a good pipeline of projects that are on hand. In fact, they're talking of doubling their number of rooms. They've got about 13 keys, so 13,000 keys. So they're talking of doubling it over the next 5 years. Already have announced a new project in AP along with the results. Valuations is about, if you look at FY27, it's about 20 times EV by EBITDA FY27. So I would not say it is cheap at current levels. Still, I would say it's a add at every dips. You could just add it and keep it in your portfolio for the next 3 to 5 years.
Absolutely, Shaina. So, all the stocks that you are holding also are trading in the green. So, you're going to be treating me and Vaishali, right? Today it's Friday. We are ready to come whenever you call us. We are ready for the treat. But, Vaishali, your view on ITC hotels. I know in terms of charts, there's not enough. But any view that you have for this one?
Sure. So it is in a trend, of course, and whatever data I have, I think the near-term target one can look at is at least 220. From there on, we can have a relook because chartically it is showing a lot of strength from whatever limited data I have. It can go towards 220, 240 would be the next target. So continue holding.
Okay, continue holding the one. 240 is the target also that one could watch out for ITC hotels. Next query for today is coming from Ram Kumar, who's writing to us from Mumbai. Holding 100 shares of PNB, price is 138 rupees is what they bought it at. Currently, the stock is trading at 99. He wants to know if he should continue to hold or maybe book his losses now. PNB, your view, Shaina, coming in, do you think there are better banks that they could look at other than not private, but even in a PSU side that they could look at?
Well, yeah, I mean, see, of course, private sector banks, if you look at the very long term, I would prefer. But at the same time, PNB by itself is a hold at current levels because valuations are not expensive. If you look at price to book, it's just about 0.83 times, which is not expensive. The results were out, last week, and the results were pretty decent. So we saw 15% growth in the credit. And while NIMs were slightly softer, they have got sufficient provision coverage of close to about 90%. So I would say it's a hold at current levels.
Okay, hold at current levels. And Vaishali, your view coming in for PNB on the charts, does it merit holding it still for some bit more of the time?
Definitely, because on charts too, it is showing signs of revival. And of course, it's lagging behind as far as the other PSU banks are concerned. But I think it can go towards 110 to 115 near term. So my view is to hold and look for these targets at least.
Okay. View is to hold from both our experts for PNB. But on that note, we're going to slip into a very short break, viewers. And here's some good news coming in for you all. Our India's business news leader is now a click away. You can, introducing CNBC-TV18's all-new app, get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can scan the QR code on your screens. Welcome back to your stocks on CNBC-TV18. A quick check in terms of Vodafone Idea. Now, what we're seeing and what sources are saying that Vodafone Idea cautioned government without its support, company cannot operate beyond FY26. Vodafone Idea says that without government support, it will have to go to NCLT for insolvency. In case of no support, government stakes value will go to nil. Government will have no recovery on 1.18 lakh crore of spectrum dues without its support. So that's a big update that we're picking up from a Vodafone Idea. So keep an eye out on that one in today's trading session and going forward as well in terms of the updates that we pick up on that front. But let's keep it going with more of your stock-related queries. Let's move on to the next query for today. MG Kapoor is writing to us from Mumbai, holding 100 shares of Bajaj Auto at a price of 1,140 rupees per share. So they're holding it for a long time, as well as they have Tata Technologies, 300 shares at 1,130 rupees per share. Now, they want to know whether to continue to hold at the current levels or look to sell. Shaina, your view coming in for Bajaj Auto, right? They've been holding it since levels of 1,140 to now, today, 8,000 and above that mark. What should they be doing with Bajaj Auto and Tata Tech also? What's your view?
So Bajaj Auto, since the buying price was very good, I think he can continue to hold, keep a stop loss, so that if there is any major dip, he does not lose too much in terms of profits. At the same time, I think they are losing. Bajaj Auto is losing market share, and to an extent, I think the numbers in the next couple of quarters are likely to be subdued. There's a lot of competition coming in, so I would hold it as of now because valuations are not too expensive. 20 times FY27 EPS, I mean P. So to that extent, one can continue to hold with a stop loss. Tata Technologies also, in my view, is pretty expensive. So I would say it's a switch, but it is showing some good bounce. And while it is more expensive in terms of the other large cap IT stocks, they have some other segments that are likely to do well in addition to auto, which is starting to again look up after the tariff settlement. They have got in aerospace, in the aeronautical space, some good projects. So I would say there also you can hold both these stocks, hold them with stop losses.
Okay, hold them with stop losses is what you're saying. Vaishali, your view coming on both these stocks as well, Bajaj Auto as well as Tata Tech. And Bajaj Auto, do you merit that, some bit of a profit booking is fine given that they've made so much money? And Tata Tech, like, Shaina was also highlighting, in the last 1 month specifically, we are seeing that bounce back after it not performing for a very long time. So your view?
Now, indicators in Bajaj Auto, I think it's coming out of its oversold zone, and it's also making an attempt to come above the cluster of moving averages, so which implies that this stock can do 9,500 levels. But for that, I would say always disciplined trading is always required. So 8,000 should be taken as a stop loss. So that would be my view. I think the bounce is quite likely. And the other stock you mentioned is
Tata Technologies.
Yes, so Tata Technology also technically it's showing a good comeback in this bounce, and I think keep a stop loss of 720. This can go, even as a short-term perspective, this can go towards 800, 820. So in my opinion, both are good buying opportunities, favorable risk-reward ratios.
Favorable risk-reward ratio for Tata Tech, you mentioned 820 levels also is what one could watch out for. So keep an eye out on that one. Next query for today is coming from Jacob, who is writing to us from Kerala. He asks if it's a good time to buy Tata Power at the current levels. Tata Power, your view coming in on this one, Shaina?
Yes, in my view, you could look to add Tata Power at current levels. The numbers were pretty good. Valuations also not expensive. EV by EBITDA, it's about 9 times, and price to book is about 3 times. They are doing pretty well in the RE space. Their cell manufacturing capacity is coming up well and will be on stream. It's already on stream, but in terms of addition to turnover and profitability will be more over the next year. And Orissa is doing well for them in discoms. They are likely to expand into that vertical also going forward with, looking at any new discoms that will be available for them to enter into. So I think it's a good stock to be in for the long term.
Okay. Good stock to be in for the long term. That's the view coming in on the fundamentals. On the technicals, Tata Power, does it merit entering the stock right now?
I would say so because it's come out of its consolidation and a tough resistance of 400. So, in my opinion, accumulate the stock between the band of 380 to 410 and look for higher targets of 480 to 500 from here on. So, accumulation would be my idea for getting into this stock.
Okay, that's a view coming in on Tata Power. Let's move on to another Tata Group company. This query is on TCS. We have Anil Kumar, who's writing to us from Trivandrum. He's holding 100 shares of TCS at a price of 3,930 rupees per share, making a loss on this one. Wants to know if he should actually look to average and add some more at these levels or look to sell and get out of the stock. Shaina, what is your view coming in for TCS? Commentary hasn't been that great from these large cap IT companies so far this time. So what should one be watching out for now from these large cap IT companies, and should they look to average or sell?
I would say you just sit on it as of now. I would not suggest averaging immediately. The fourth quarter numbers were pretty disappointing, except for the fact that they had very good deal wins, and these deal wins were much better than what we all expected. So let the U.S. market, in terms of the market, settle down in terms of how it will evolve over the next couple of quarters, and then you could add. But I would still say that TCS is a long-term investment, so you can continue to hold.
Long-term investment, continue to hold. So yes, keeping an eye on that. Vaishali, your view coming in for TCS, as a whole, does it merit holding TCS, or mid-cap IT names is the trend, or what is your view? Averaging, is that an option right now for TCS?
According to me, everything is quite cyclical, and TCS, I mean, it is already given a good bounce from its low. So I would say wait for a furthermore dip. 3,200, 3,300 is a technical level that one can look at re-entering the stock. And I guess this will go when the IT sector shows a confirmed turnaround. We will be seeing a good upward move coming towards 4,200, 4,400. And along with that, of course, the mid cap like the Persistent and Coforge, all these are doing very well, KPIT. So I guess one should not be just focusing on a stock. It's better to have good quality stocks in a particular sector.
Absolutely. Not just one stock. Look at, the basket also of stocks that are there in a sector as well. The next query for today is coming from Sharayana, who's Mohan, who's writing to us from Coimbatore. She's holding 225 shares of Prestige Estate. Price is 1,166 rupees per share. Currently, obviously, she's making some bit of a profit on this one. Wants to know the future prospect of Prestige Estate. Shaina, your view for Prestige Estate. Just recent announcement had also come in that they acquired some land in Ghaziabad and for some township project as well. So projects are continuing. So what are you watching out for in terms of the outlook for Prestige?
The outlook is pretty strong. See, actually, third quarter numbers were very disappointing. So we saw that huge crack in stock price on back of that. Subsequently, one is on basis of these new orders new projects that you also spoke about, plus the existing projects that are likely to contribute in a big way, both in Bangalore, Mumbai, in the starting fourth quarter, and going on into next year. They've got huge projects on hand, and also in terms of fundraise, they have got some. There is, I would say, the IPO for their hospitality segment could result in some, value unlock for Prestige Estates in terms of getting some cash from the IPO, and that would actually go to fund their growth. So I would say it's a hold at current levels, and you could look for good growth going forward in the next couple of quarters.
Okay, could look for good growth. Hold right now is what the view is coming in on the fundamentals. Technicals, Vaishali, what's your view coming in for Prestige Estate? 6 months, 1 year, not anything exciting in terms of an up move or a return that we've seen, right? So now, do you think on the charts, or is it an indication that maybe we could see some up move?
Yes, it is in a trending mode, but actually, I'm not too sure if I would look at these stocks for a long-term perspective. I would really go step by step. So right now, it is in a trending mode, and it is having a resistance at 1550. So that is a level to look out for. Once we see a decisive move above 1550, then it surely confirms an uptrend going towards 1800 levels. So that is how I would deal with this stock. I have a disciplined trading strategy.
Okay. That is a view coming in on Prestige Estate. But that was the last query for today, ladies. Thank you so much for joining in with us as always, Shaina as well as Vaishali. And hope you have a great weekend. And viewers, thank you so much for tuning in as well. Hope you all have a great weekend as well. And remember, you can always write to us and email us your queries and we will address them with our experts. But that's all the time we have. Up next, we have Closing Bell to take you through the last hour of trade. So don't go anywhere.
Beyond market headlines, to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Asian markets are panning off, and it's a pretty cautious looking screen, if you could call it that, across the Asia Pacific.
We were by far the biggest outperformer in Asia, in the Asia Pac yesterday.
That 674 crore rupees was incorrectly recorded as interest income in 3 quarters of FY25.
So it's kind of mixed. I mean, 30 down and 100 down on Nifty and Sensex respectively.
It's only fair for these larger companies to have diversified supply chains.
US people do still talk of a recession, even if hopefully the odds of that have fallen.
There is a bit of a cool-off in the markets. The Nifty is exactly at the 25,000 mark.
More ballistic cruise missiles that will have to be developed here in India.
Nifty is seeing a downtick of almost 0.2%, but it is still managing to hold on to that 25,000 mark.
Well, that is the day so far, and actually it's a day of individual stocks because the Nifty is lackluster. It's been that way since the morning, 50 points here, there, but so many movers. And the big theme continues to be defense, and we'll talk more about that as we go along. We're coming to you from the CNBC-TV18 Motilal Oswal studios. This is Closing Bell. I'm Prashant, with me my colleagues Surabhi and Rima here. Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. Hi, big week though, right? The Nifty is up more than 4%. The mid-caps have rallied more than 7%. And defense, I think we should pull up that the defense index and see the kind of gains we've had this week.
It's been phenomenal, to say the least. I mean, I was actually looking at that just now. The Nifty Defense Index is up well over. Yeah, that's just today's move. Imagine that. That's today's move. So if you talk about the week's tally, it's absolutely dizzying.
Yeah.
I mean, to say the least. Nigel.
Well, this morning I'd made that point, right? Nifty is at 25,000, but portfolios are feeling like 23,000 or 24,000. And that's why I'm expecting the broader markets to do a bit of a catch-up. And today, at least, it's played out. Just take a look at the mid-cap index. Surging away, breadth of the market, 1,900 stocks in comparison to 1,800 stocks that's declining. So it seems the Nifty next 50, the mid-cap, the small caps as well, they have some catching up to do. So let's see whether or not that plays out. But by the way, we have BHEL that I think the numbers are flashing for you on the screen. And it appears, at least on the EBITDA number, I think it's a little bit lower. It's coming at around 830 crores. That compares with more than 1,000 crores or thereabouts. So I think a mild disappointment on the operational performance, though we'll have to go through the fine print on this one. But guys, you all take it away.
Absolutely. And we'll have more on BHEL with our research team in just a bit from now. Yeah, I mean, the theme is defense, and we'll talk more about that. BHEL, by the way, is coming off on an absolute EBITDA basis. There is a miss, as Nigel pointed out. Well, let's talk about Vodafone. Now, sources are telling us that Vodafone Idea has cautioned the government that it can't operate beyond FY26 without more support. I mean, give us money, otherwise, FY26 is the outer limit. Ashmit is here with what he's picking up. Ashmit, over to you.
Well, just yesterday, we were the first to report that Vodafone Idea has moved a fresh application in the court seeking relief on account of the AGR burden. Now what we're picking up, they've sought a waiver of the interest as well as the penalty component. Now what we're picking up is that before moving the court, they had thrown a last throw of the dice with the government. They had written a letter to the government whereby they had clarified that if the government doesn't step up and grant relief, it could result in the company going into insolvency before the NCLT, and that it's going to be difficult for the company to move ahead as far as beyond FY26 is concerned. That's the line in the sand that Vodafone Idea appears to have drawn as far as the government is concerned. Now, bear in mind, the argument that Vodafone Idea has put forth in that letter is that the government is now a partner. Post the equity conversion, it holds nearly 49% of stake as far as this company is concerned, and that entire stake's value will be brought to nil if this company is pushed into insolvency. Also going on to say that the government is looking to recover 1.15 lakh crore rupees in spectrum dues. All of that, again, will not fructify if the company, Vodafone Idea, goes into insolvency, if it cannot continue beyond FY26. And furthermore, Vodafone Idea argues that this will have a cascading impact. There are over 200 million customers that Vodafone Idea has, and that there will be a spillover effect as far as the broader digital aspirations of the country are concerned. And going on to say that they're facing difficulties, that despite pumping in as much as 26,000 crore rupees from a promoter standpoint, despite the government's equity conversion, the banks are not stepping up. The banks are not giving them debt. The banks are not supporting them. And that is leading to a huge crisis in terms of management and in terms of future operations of Vodafone Idea. And it is on that count that they are making a renewed push before the highest court of the country, before the Supreme Court, for a waiver of the interest as well as the penalty component. This, they believe, will help turn the tide, will help turn things around for Vodafone Idea. But all of it, clearly from Vodafone Idea's submissions in the court to their conversations with the government, one aspect is clear, that the ship will not set sail, it will not move forward without government support. That's a clear message coming in from Vodafone Idea.
Thank you very much for that. I guess what will help Vodafone Idea is the bank funding. They've been looking to raise 25,000 crore rupees, and despite the promoters infusing money, the large QIP funding infusion that they did last year, and even the spectrum dues getting converted into the equity and the government owning 49% now, the banks have been reluctant to lend that 20,000 crore to Vodafone Idea. So that is something. So maybe in terms of a government support, the government can nudge, the banks to go ahead and lend that 20,000. And second would be, I think, Supreme Court relief. In the past, the Supreme Court, the Apex Court, had rejected all applications regarding any sort of an AGR relief. But now that we have a new Chief Justice, Mr. Gavai, I think once again, these shock and awe kind of statements might nudge the Supreme Court to grant that much needed relief for Vodafone Idea. If it doesn't come through, as Vodafone Idea says, it might just go under.
So, yeah, it's very, very interesting because basically Vodafone Idea has thrown the ball into the government's court, saying either you help us with additional
the government
support,
can't do anything. They have 49%
Precisely.
Stake, so they can't infuse further money. They don't want to convert more dues into equity and then make it a PSU.
Exactly.
They want it to remain as a private entity.
Exactly. So the question is, who is going to bring in the funding?
It's the banks.
Whether it's additional equity funding or debt funding, and debt funding is not coming. So
debt funding is not coming. So it's either the banks or then some sort of a Supreme Court relief. But Prakash Diwan is now joining in. Prakash, we've spoken so many, for the last so many years now on Vodafone Idea and the fact that it's struggling, it needs more money, it needs more relief. It's always one step forward, two steps back. And now this, shock and awe kind of statements coming in from Vodafone Idea.
Yeah, definitely looks like the last straw. But interestingly, this is happening at a time where they seem to be kind of getting their act together in terms of the operation, at least. I'm not saying that they are out of the woods by any measure, but in terms of expansion on 5G, I mean, as a Vodafone consumer, I've been getting calls about 5G introduction in certain places, and how things are so positive and all of that. And on the ground, if you see, Bharti's been talking about making noises that there should not be the spectrum charges that are due should not get waived and all that, because they also probably smelling the opportunity to get this big player out. And which in the first place the government never wanted. So it always wanted it to be a 3 or 4 player market. And that's what Vodafone probably seems to be counting on in a big way, that the government will want it to continue playing some sort of a third fiddle or whatever. So interesting setup, but this seems like the beginning of the end of this issue. How it gets resolved, I don't know, but it does seem to have come to an end of sorts. There's nothing else left beyond this declaration or this intent being announced.
Okay, the government so far at least has been committed to maintaining a 3+1 market construct. Statements coming in from Vodafone Idea seeking urgent relief. The stock price right now is 7.5%, so it's reacting positively. It's not reacting to the statement. The risk that it might just go under, it might have to reach out to the NCLT and file for insolvency. So that's not what the market is, the stock price is reacting to. The stock price is perhaps reacting to some sort of a relief coming through for Vodafone Idea. Hopeful. Let's pull up Indus Stars as well. That's the other stock indexed to Vodafone Idea's futures, and Indus Stars will also come up.
I'm still a little curious. I'm not sure what sort of support Vodafone is expecting from the government, because, nudging banks to lend has its own huge moral, implication and question mark, and we don't know if the government would want to go down that route. The only thing is it's catch-22. The government's own 49% stake gets written down to 0 if indeed this has to go the NCLT way.
There are no good choices here. All bad choices, but it is what it is, and they'll have to kind of sort of deal with it. Prakash, thank you very much for that, and sort of good getting that quick word in, and we'll get you more opinion as we can sort of go along on this exclusive story that we're putting out right now. How should you position yourself in the last hour? Sachidanand Tegar is with us. Sachidanand, good to have you with us here. A quick word on the markets, at least at the index level, not very much is happening. And before I ask you for your trades, a quick word on what are you picking up in defense stocks? Any trades one way or the other? Go on.
Good afternoon, Prashant. Prashant, I think the entire defense pack is in motion, and at the beginning of this particular week, we discussed the trade setup in a stock called BEL and BHEL. I think both have delivered good returns, but so far, I think there is no sign of any exhaustion when we look at both these counters. Even at this juncture, I think it is better to place yourself in BEL. From a momentum perspective, I think the base at 350 now looks very confident. The stock may consolidate here a bit, but eventually we see this particular rally getting extended towards 405 to 435. So I think it's a good momentum breakout on the weekly scale, and we expect that this particular momentum may extend going forward as well. When we look at the Nifty, it is consolidating well around that 25,000 mark. If you look at the last 4 trading sessions, it has managed to sustain and close above its 5-day exponential moving average support. Now, this particular support is currently placed somewhere close to around 24,820. So until unless we don't see a closing below the same, the expectation of a diverging trend, looks bleak. On the contrary, we are expecting that this particular rally may extend towards 25,180, and eventually in the coming week, we may see levels close to around 25,555. So we are, advising our clients to build, long positions when it comes to Nifty. A pullback towards 24,900 would be healthy. That's why one can keep a stop loss at 24,830 on a closing basis. The first target would be around 25,180. Second target would be 25,555.
Thank you very much for that. Shiju PB, Managing Partner, India Law LLP, is now with us on the show. Shiju, just 24 hours back, we understand that Vodafone Idea filed a fresh petition at the Supreme Court seeking a 30,000 crore waiver on the AGR dues. And now it's written to the government, talking about its survival, that without financial support, the survival of Vodafone Idea is at stake. How do you expect, what can the government do in its capacity? It already has a 49% stake. And two, how do you expect this to play out?
I'm doubtful whether my voice would be clear. Yes, I'm traveling. See, Supreme Court, Vodafone Idea has approached on the ground of for waiver of penalty and interest. But the chances are moderate, I would say, because there's already a clear-cut Supreme Court order, and even government also stated that even though government is holding equity shares in the VI after conversion, but it is already stated that there's a binding precedent from the Supreme Court. So chances of getting a little moderate, but still on the basis of equity or a consideration saying that considering the financial stress and strain and likely closure of the aspect and overall economy and all, Supreme Court has to change the stand. If it is lenient, it may get, but I would say it's a very moderate chance because Supreme Court has already clearly stated. And government stand also has a lot to do with what is the stand government is also taking on this issue.
Okay. All right. Shiju, thank you very much for joining in with that quick take and quick perspective. Let's see, it's a developing story. We will see if the government has any response to offer in the coming days. Thank you for joining in. Well, let's move on to the other big story of the day, of the week, of the year, you can really say, and that's defense. The theme is running red hot and strong. And once again, let's pull up the stocks for your benefit. Right now, it's the shipbuilders. They're actually in lead position. Mazagon Dock, 10%. Cochin Shipyard, 12%. Garden Reach, 10%. But then the smaller companies are not too far behind either. Many of them, like Zentech, etc., have had another pretty good session. Let's check Hindustan as well. Hindustan Aeronautics, 5%. Idea Forge. All of them are still running around. And like we told you, the Nifty Defense Index is up almost 15-16% for the week. We caught up with Nirmal Bang's Jyoti Gupta to understand whether defense stocks still offer an opportunity or whether, the ship has sailed, so to speak. Listen in.
There's a clear urgency to replenish inventories and strengthen capabilities. Also, what we have understood and sensed from the market is that the companies have already stepped up their production levels. And, they've transitioned into an accelerated execution phase where they are working 3 shifts. So this proactive scaling signals that there's a potential. One is early achievement of our targets, which is something like 3 trillion by 2029. Possibly it could be achieved earlier than 2029. All my interviews, I've been saying we are replete with order books. What we need is step up of execution. Now, in the current scenario where we have post the war, we obviously need to replenish our inventories, and strengthen capabilities. So in that case, what we have consumed in the current war, we need to replenish. And of course, we've had deficit in inventories of X days, which has to be done. As far as what was discussed in the ministry, I think no comments. As far as my understanding goes, that there is a huge unfinished order book which needs to be completed in a certain time frame. Everybody must be thinking that the current valuations may appear stretched, and I feel that they're expected to be justified once you get earnings growth visibility. As order execution accelerates and operating leverage, kicks in, investor confidence in current valuation should strengthen, making them reasonable. And that on that basis, I would say HAL is my top pick, followed by, again, BTL and BML, which has been quite a laggard for many years. These are 3 companies. MDL, which has done its peak revenue growth, I think going forward, maybe with a lag, MDL will also start because there's a complete demand, not only from the, there's an overall demand from all the 3 fronts, land, army, and sea. So obviously you have to scale production not only at the air fleet level, but also in sea levels.
All All right, that was Jyoti from Nirmal Bang with her perspective on the defense space. I want to focus on one stock as just an example, a microcosm of what's happened in the defense sector. Pull up Solar Industries. Let's pull up a long-term chart of Solar. Solar at, somewhere around, early 24, late 23 used to be a 6,000, 7,000 rupees stock. Today it's 14,000, so it's already a doubler. And that's the gain in just the last 12 months. Gurmeet Chadha of Complete Circle is with us. Now, Gurmeet, of course, identified Solar a long time back, and it's been one of his favorites. And Gurmeet, that's the real question, right? I also did some reading on who does what, and I realized from BrahMos to Pinaka, I mean, these guys are everywhere, the Solar guys, right? Making all the warheads and the bombs. The question is it all done? Is it all in the price, the opportunity, the possibilities? Or is there more to go? I mean, do people have the risk of getting caught up if they jump on the defense bandwagon now?
So we've been lucky. I mean, we personally invested this in 2015 when it was in 3 digit.
Oh, 2015, Gurmeet.
Yes.
3 digits, Solar Industries.
Yes. So pretty lucky.
I'm surprised you're still working. These are like retirement stocks, right? The multi-baggers.
No, it's done a lot of heavy lifting in our portfolios. And just to tell you, it was 8,000 rupees in February when market had fallen back at 21,800. So, on the near term, yes, it's expensive, 100p stock. But over a long term, let's say, and this is what I keep telling, that, defense is a lumpy business. You cannot expect quarter-on-quarter returns, and orders can. So, for example, when Pinaka Rocket orders got delayed by like 7-8 months, the stock underperformed when most of the market was doing well. So right now, defense is around 25% of the book. The movement has been from, a product maker, from explosives to a platform. So now they make Pinaka multi-rocket barrel system. The day before yesterday, they successfully tested Bhargavastra, which is, the anti-drone kind of a system which can fire micro rockets, for any kind of a drone attack, the Swan drone attack. And that cost, apparently, I've been told, is like 1/5, 1/6 of the other air defense systems we have. So one is the frugal engineering, which a lot of our players like Solar, BEL, Bharat Dynamics Extra are doing. And obviously the support from DRDO and the capex they have done. So if you have a 5-7 year view, the defense book would almost become 50%. And that's a high margin business. But on a near term basis, most defense stocks, even HAL, for example, after the sharp run up, near term, you should be a little careful. But I think on a long term basis, defense should be a good 10, 12, 13% of your portfolio.
Okay. All right. Hi, Gurmeet. Good afternoon and good to see you, Ben. I think from the telecom space, I think Bharti Airtel was something that you all were bullish on. You'll continue staying bullish on that, or would you all give Vodafone Idea a look, and or maybe Reliance Industries, I think, as well as part of your portfolio? So how do you play this telecom theme?
So, Nigel, a couple of ways. One is obviously Bharti is one of our top 3 picks in the portfolio. Very secularity, lot of secularity in earning visibility. Right now, obviously, there's a bit of an overhang. One, the quarterly results were okayish because the ARPU was flat at about 245. And then obviously you have Singtel, offloading, and there could be more because they want to equalize the stake between the Bharti promoters and Singtel. So this could mean maybe another block may come. And that's why the market it's reacting the way it is, but it's 2-3%. But if you see last 3-4 years, the stock has been one of the top performers in Nifty. So if you see the wireless business, I think it can continue to grow at 20%. More importantly, if you see the EBITDA to free cash flow conversion, I think it's likely to improve to 40-50% now. Which means that there are a lot of high cost spectrum debt they will be able to retire, unlike Vodafone, which is struggling. And any waiver in spectrum can't be for one entity. So if at all government chips in, and sometimes I don't understand, the promoter has the money for cable and wire and paints, but on telecom, you don't want to infuse capital. So that, anyways, that's a capital allocation call to be taken. But I think Bharti stands out there in case there is some relief coming there. And the other businesses, which is the business part, the other digital businesses also now catching up. And it is a slightly expensive, considering that if you give it a forward multiple, maybe 14-15 times EV by EBITDA. But as I said, in this market, there's one stock which gives you earning visibility. So we continue to hold, and any meaningful correction, I think we'll add. We will look at more digital infra plays. I think Tejas is corrected. So we are looking at that, but we first want to see whether the orders were lost or it's just a near-term blip.
By the way, did you buy Solar at 8,000? in February?
No, we continuously buy. Personally.
You bought in 3 digits.
I know, but I meant, did you top up at 8,000?
Yeah, so वो कहते हैं नजर लग जाती है कई बार, if you talk about stocks too much. But on a lighter note, we did add, and it's almost around 7-8% of the portfolio we have.
Is there any other solar in the making? Do you see another solar anywhere, Gurmeet?
So we don't know that, right? But I think one stock which we got right and got very early was Zen Technology. We bought it almost at 600 levels, and that's something which has almost 23 patents, but again very expensive, right? You saw 2600 also on Zen Tech. You also saw 1100, in a matter of 6 months. So that's what I said. You need a slightly better stomach, for kind of volatility you see in these kind of businesses. So build a core portfolio. And be focused on how much you want to buy. Sometimes we get carried away by near-term momentum. I think at this point of time, incremental addition in near-term may not be the wise idea to do. But if you get any meaningful corrections in between, I think so. We have HAL, we have Bharat Electronics, we have Solar, and we have Zen. These are our four defense stocks in our portfolio.
Got that. What about railway stocks? That's the other theme which often...
Sorry, 1 minute. I just finished. Otherwise, I'll have to come back to defense like you did. Gurmeet, on Zen, so you for Solar, you said they have what is the name of the system? You said mini anti-drone.
So it's called Bhargavastra, which is Lord Parshuram's weapon. It's called that. Pinaka also is, I think, the bow. Which Lord Shiva used. So they keep the names basis our, the mythology. And Bhargavastra actually fires micro rockets. So apparently they say it's 1/5 or 1/8 the cost in terms of dispelling any swarm drone attack. And they coordinate it with, the satellite. So there's a lot of coordination which is happening between ISRO, DRDO, So I think that, the indigenous tech we have developed, Prashant, the kind of order inquiries we are getting right now, I can't speak about specific quantum and names because it's a very confidential information, is humongous, but we don't have the capacity. So when the street is getting excited that there are a lot of inquiries, the execution will take time. And that is where probably you may get more opportunities.
So Solar is actual physical missiles, anti-drone. And the other stock which you mentioned, Zen, which you also bought, is basically radio frequencies. For
Zen basically, Prashant, is simulators. So you use simulators. You can't send everybody to the war front. You need to train your soldiers, right?
I think it's 50-50 simulators plus anti-drone.
And anti-drone and surveillance. So we have big borders and unfortunately not so good neighbors. So, per kilometer cost of surveillance, modern surveillance is quite high. So let's say, for example, the Myanmar border would probably be 800 kilometers plus. Similarly, so it's a huge opportunity in terms of covering that. Right. So as I said, there are multiple vectors. And one thing good about Zen is the IPs. I think it's one of the top 3 companies in India in terms of number of patents.
I discovered that they also, by the way, own a majority stake in one of the very few drone component makers.
Yes.
Which is, again, interesting. But the stock, as you said, this is all, and this is, of course, for viewers, and I think you made it very clear, don't chase it. But on dips, this becomes...
Absolutely.
If you're convinced and if you do your work, then, when opportunities come, then you're ready.
There's one more opportunity here, which is specialized carbon fiber, which currently we need to import from Japan and US. And that's, so you only can use it for commercial purpose. So if you see the wings of Tejas, a lot of fighter planes, etc., carbon fiber is extensively used. They're very specialized. And that is one place where India is trying to work around and do some, that could be a part of the bilateral deals which we have with few nations. That could be the next big opportunity. So that's
which is the
ancillary
company, Gurmeet?
Does anyone make it? Any listed company?
Nothing listed right now. Sulbi, there are a couple of unlisted players here, but it all depends on getting the delicensing done and approval done. Use that for defense manufacturing.
Very interesting, Gurmeet, very interesting. I think this is a moment, and this is a moment we'll look back on and remember. Sectors at times go through an inflection point, and yes, there are excesses that get built up, but then sometimes the stories are very, very real, and then it becomes a turning point. And maybe for Indian defense manufacturers, private sector and public sector, this is that very real inflection point. Great conversation. Thank you so much for joining in and shining a light on the opportunities over here. Thanks for joining in. Have a great weekend, and we look forward to the next chat soon. All right, quick break on that note. Come back on the other side, and we'll have Vikas Khemani join in with some market perspective.
Okay, welcome back. 50 points lower on the Nifty, but it is broader markets and, of course, defense, which is the big sort of theme as we just discussed with Gurmeet. Vikas Khemani is with us, founder of Carnelian and Asset Management and Advisors. Vikas, good to have you back on the program. Thank you for your time. Defense, let's just start with that. Why not, right? I think let's get your views, Vikas. It's of course, I mean, it's the theme is great. It's multi-year. Orders are lumpy, and I think we covered quite a bit with Gurmeet earlier. But where are stocks at now? If you've given this a look, your team and you, just your perspective on the space and stocks.
From a long-term perspective, it is definitely an interesting space to look for. And my own approach towards something like this is whenever there's a euphoria, kind of try to stay away, because I think in these times everything goes up, good, bad, ugly, and one tends to forget the real risk reward of investing, be it any sector. So I think just because we recently had a conflict does not mean that suddenly all the companies will start growing at 30-40%. Right. Of course, it can marginally improve the environment, and that defense has been a good opportunity, directionally speaking, even last couple of years. And we saw how, when markets corrected, they corrected far more than rest of the space. So I feel given very limited set of opportunities, companies in that, a lot of excesses have got built from a risk reward perspective, and one has to be careful. And I'm not passing this comment across the board for all the companies, but there are, by and large, this is a sentiment of the sector. So definitely looks good, but there are companies one has to see from a risk reward point of view, and one has to be cautious and careful, and then approach that.
So don't buy defense at these levels, but is defense a part of your portfolio?
We own some companies, but we are not buying anything fresh. We've been holding for some time, but we aren't buying anything fresh.
What are you buying fresh then, Vikas?
I think nothing has changed for us, to be honest. We've been through this whole crisis. We've been kind of believer in India's story. India's story has not changed. We've been believer that this whole year markets are saying corporate earnings will be subdued, but my view is that 25-26 corporate earnings will be very, very, very good. And if you remember from our last conversation, and I said that the last year liquidity was squeezed in the system. This time around, we are in an environment of reasonably good liquidity, and that is likely to be so. And that has a huge impact on the entire corporate profits earning cycle. I think demand environment is reasonably decent. Interest rates are looking down. So usual, we are quite overweight on banking and financials. Through the fall we kept on buying them. We are quite bullish on the entire manufacturing space. We don't think anything is changing in that, despite all the noise around tariffs and non-tariffs. We don't think sort of anything is sort of changing. Even IT, we've been quite reasonably. In fact, through the fall we added some stocks. So I think through the fall also. So lots at times it swings on one side, and noise kind of clutters the sort of segment, and that's where the opportunity comes. So I think we have not made any major hypothesis change around India's story. I think everything remains same, except the fact that in this year, early part of this year, we were adding a lot more banking, which is significantly overweight for us.
Okay, all right. Hi, Vikas. Good afternoon, and good to see you. When in the past, you've spoken about how bullish you're on the CDMO segment, from the pharma vertical. But I'm just looking at the past quarters, shareholding, and a couple of stocks you've added from the diagnostic space. SE Suraksha, you'll have gone ahead and added on to whatever you'll had. Amrutajan Healthcare as well is another one that you'll have gone ahead and built a position. Tell us a couple of stocks, if you can, where you're quite bullish and you believe that it's at that inflection point.
It will be very hard for me to comment on a stock specific, as per the compliance. But in general, we've been bullish. I mean, both the names you mentioned are not part of CDMO, but CDMO is in a big opportunity. And, we've been quite overweight for some time now. We have not added anything recently, but we've been owning it for the last 1.5 years, very large position, and they've kind of done well.
Right, Vikas, as we speak, we have actually Hyundai Motors numbers that have come up on the screen. And that's looking like a pretty much okay set of numbers. A mild growth is what we're seeing on the revenue front. Margins more or less stable at around 14.3% or thereabouts. How are you approaching the auto space, Vikas? Plenty is happening, right? You have Trump's tariffs out there. You have reports of slowdown in parts of India as well. But some of these stocks have seen a big run. What do you like from it? The two-wheelers, four-wheelers, or would you play the auto ancillary stocks?
We've been playing, I think we own automobiles, so I think as is public in our portfolio, we own Mahindra and Mahindra. We used to own Tata Motor, which we sold last year. But right now, I think, and then we are playing through some of the auto hangs. Other than that, I think we don't own, we own a little bit of Bajaj Auto as well. But I think auto story is quite interesting story. There's no doubt on that. Tariffs don't make much impact on as far as India Auto is concerned. I think as far as the cars are concerned, we have to see a little bit more on the competitive intensity coming about with a lot of new launches. So we have to, this all individual company specific, how many models come, what kind of growth can come. But in general speaking, I think auto, both four-wheeler and two-wheeler, generally directionally look good. Demand has been reasonably all right. But yeah, these are the large cap names, so you have to kind of take a little bit of, intermittent views as well. So we keep kind of increasing and decreasing position, but directionally speaking, we are positive in the sector.
Vikas, hi, good to have you on. So I want to talk about manufacturing because that's been one of your favorite themes for many, many years, right? Now, defense is obviously one part of it, and that's where manufacturing is working out beautifully. But what else should one be looking at in this environment? Because that whole China plus one story, it's still there, but I guess it's just very confusing because of what's happening with trade. And one day Mr. Trump says, don't make in India with respect to those iPhones. And you don't know what's happening to the chemical supply line. So therefore, what are the clear manufacturing plays that you see ahead, at least for the next 2-3 years?
One thing I must again say that I think one thing is very clear, Surbhi, from the recent past, that a lot of noise comes that goes away, right? These noises are not changing anything. None of these are going to change the long-term story of India, both in general and manufacturing in particular. Because I think if you just see all our growth drivers are in place, and each sector and sub-segment has its own growth drivers. And when we say directionally they are in place, does not mean that, they will have stupendous growth every quarter after quarter, year after year, right? There will be intermittent cycles. Like you mentioned, chemicals has been going through intermittent cycle, in the recent past. But again, there are two parts in the chemicals, also specialty chemical and, commodity chemical. Now, specialty chemical is where I think the real opportunity is from growth perspective. And there are companies which have been, I think, looking very, very interesting in that space, provided you can overlook the noise which is around. So again, you have to go back and look at the individual company and opportunity and assess them. I mean, we own a couple of them and we think that they are interesting, great stories. I mean, if you see SRF, when nobody wanted to buy one of our reasonably large holding, we bought it on 2,300 levels. And when, despite all this noise and all, stock has done reasonably all right. So again, it's not, you can't really broad brush. Directionally speaking, I'm again telling you, manufacturing across auto component, chemical, specialty chemical, garments, that's been doing very well, capital goods, defense, electronics manufacturing, across, there are lots of, opportunities. But of course, it boils down to the understanding the sub-segment and the company individual, because that determines the outcome.
For you, among all the different, various facets of manufacturing that you described, for you, what looks the most convincing at this point in time? And within chemicals, I know we're not going to talk too many stock names, but just to get the theme right, would it be fluorochemicals? Would it be, SRF is obviously very big in refrigerants. And likewise, if you talk textiles, so give us, a few more nuggets in terms of what in manufacturing are you most optimistic on?
I think whatever sits between import, substitution, export oriented, right? And then the companies have more. So let's say in textile, more than anything, the garmenting is a very interesting opportunities. And with the BTS in place, I think you can see a little bit more growth coming through. But structurally, that's a very positive story. Similarly, in chemicals, I think right now, agrochemicals looks pretty interesting because I think all inventories have got cleared out. The demand is picking up. Agri prices have been reasonably robust across the board. So I think that segment, again, within that, few companies are looking very interesting. So again, the structurally all are positive, but there will be intermittent cycle, interesting opportunities coming about.
Okay. All right, Vikas, a great conversation as always. Thank you very much for joining in.
Thank you very much.
Okay, thank you very much for that. We will slip into a break on that note. On the other side, we'll get you a few BTST calls from our experts. Stay tuned.
Welcome back. Well, the markets are still down close to around 40 points, but guess what? Your portfolio must be still feeling very, very good because the mid-cap index is up close to 1%. And as we speak, the Nifty Bank as well has sneaked its way into the green. Nagaraj Sethi joins us on the show. Hi, Nagaraj. Good afternoon. What would your call be on the Nifty? I think there's a lot of bullish sentiment that's currently prevailing. But when does this bullish thesis get nullified? 24,500, 24,800, if you could give us a crucial support level and also fill us in with a couple of stocks.
Hi, good afternoon, Nigel. No doubt Nifty has been in a strong uptrend for the last few sessions. We have seen some sharp upside momentum from the lowest after small corrections. Currently showing consolidation. I don't think that's going to have any bigger negative impact on the trend itself. And 1 or 2 days of consolidation, and Nifty could move up again towards the next hurdles of around 24,500 levels, which is the next target. At the meantime, at 25,250 is going to be a small resistance. After that, Nifty could eventually move towards the 25,500 levels as the next target. At the lower levels, 24,900, 24,850 is going to offer a strong support for the Nifty, and any consolidation or dips is going to be a buying opportunity at the lows. I have 2 stocks. First one is from a real estate front. You know that, Nigel, real estate was not performing that much during this upside bounces in the market, and recently it has started to perform from the lower levels. This stock is moving in a consolidation after the downward correction down to the 1,500 levels, had bounced back smartly and showing some kind of accumulation pattern building at the lower levels. The overall chart pattern is looking positive. Currently trading around 1675. One can look to buy at this price, and the upside target would be around 1770, 1780 levels. One can place a stop loss at 1610. And second one is GE Shipping. You know that GE Shipping counters have buzzed very well in this today's session. GE Shipping was moving in a larger consolidation band. It has witnessed a decisive upside breakout of the crucial resistance in today's session, looking attractive at the higher levels. Currently trading around 970. One can look to buy at this point of time. Immediate target would be around 1,050, 1,060 levels. One can place the stop loss at 930.
Thank you very much for that. Let's talk about Apollo Tyres and Tube Investments. Both these stocks are higher in trade. Sudarshan now joins in. Sudarshan, just yesterday you were telling us that how Apollo Tyres Q4 numbers were subdued. There was nothing to write home about. But in the conference call, the management is sounding upbeat. They're targeting double-digit growth.
That's correct. So both these stocks, Apollo Tyres and Tube Investments, are reacting to the positive commentary that these companies have given in the analyst call held after Q4 earnings. So first talking about Apollo Tyres, Q4 earnings were a miss. Company has underperformed its peer, and 2 segments, OEM and exports, had seen a decline. But for Q1 and FY26, company believes that growth will start coming back in Q1 itself, and not only growth, it will see a double-digit growth, and both OEM and exports that had seen a decline in Q4 and Q3 of FY25 will see a growth in Q1 of FY26. For Tube Investments, results were almost in line with estimates, but commentary is looking very positive. So first, for the first time, company has announced that it has bagged new railway order of rupees 8,000 crore. It was not in public domain. For the first time in the analyst call, company has mentioned about this order. And this order of rupees 8,000 crore will be executed over next 7 years. And about railway business, company also says that it will return to the previous growth peak by the end of this fiscal. And 2 businesses, one is truck and 3-wheeler, company believes that it will break even by the end of this fiscal, and it's working on $1 billion revenue by 2029. So overall, commentary was positive for both these stocks, and that's the reason you are seeing a positive move.
In between 3-4%. So thank you very much for that. So Apollo and Tube Investments in focus. Let's also talk about the blocks today. Bharati and JSW saw blocks. Vivek is here with details. Vivek.
Well, that's right. So 2 large block deals happened in today's trading session. We had intimated and alerted you, prior to market open about both of these possible block deals that happened. So first, Bharti Airtel, Singtel, that, pre-block deal that held almost 29% stake, has sold almost 7.1 crore shares in the company, worth $1.5 billion in today's trading session. The block deal happened at a rate of close to 1,814 rupees a share. There is now a lockup of 60 days on further sale of shares from Singtel. So remember, Singtel's pre-block ownership was around 29%. 9.17% was what Pastel, the entity that sold today, actually held in Bharti Airtel. The effective stake post-block deal will now be close to 28%. Mittal Group stake, remember, is at 23%. Why are we stating that? Because Singtel today released a statement saying that, number one, that they had sold the block within Bharti Airtel today. Along with that, they are saying that they are working closely with Bharti Enterprises to equalize its effective stakes in Airtel in the medium term, indicating that there could be further blocks in the process or further blocks on the way as far as Bharti Airtel is concerned. Now, talking about JSW Infra, remember the promoters and the company had earlier intimated the exchanges that the promoter entity would need to go ahead and trim their stake to meet SEBI's MPS, which is minimum public shareholding norms. In line with that, Sajjan Jindal Family Trust today likely sold close to 2% stake in the company. Offer size of this particular block over 1,200 crore. Remember, they held 80.7% stake, which now drops to 78.7% stake. So need to watch out, because even in JSW Infra, they will go ahead and require to trim their stakes further to bring it below 75%, which is SEBI's MPS.
Okay, all right, Vivek, thanks a lot. On top of the ball as always. Well, let's hop across to Ekta. She's here to tell us about Newland Labs. Remember, the stock has corrected from around 18,000 rupees to around 12,000. But today it's lost another 6% post its numbers. Ekta, tell us more.
Well, definitely a disappointing set of numbers for what was a darling stock amongst investors. So revenue down around 15% year on year, 18% Q on Q. Margins have also shrunk to around 16% versus 28% year on year and 22% Q on Q, and a profit decline of around 59% year on year. FY25, they ended the year with a revenue decline of 5%, margins 22%, profit down 13%. The company has said that several molecules in the portfolio, according to them, are at an inflection point and growth is expected to resume in FY26. Goldman Sachs has a buy with a target price of 14,775. They say that the reported Q4 was impacted by a significant fall in the development revenues, which are generally lumpy in the CMS segment. They expect the top line to accelerate by 30% in FY26 based on monetization of the expanded Unit 3, commercialization of the molecule Cobenfy and a potential fourth molecule, and launch approvals of newer niche molecules in their specialty API segment.
Thank you very much for that. There are quite a few other mid-caps which are reacting adversely to their earnings. So Datamatics is one where the profits have declined. Stock is down nearly 7%. Precall is another one. MediAssist is under pressure, and that on volumes is down by nearly 5%. PN Guardgill, Garvare Tech, Tega, Allied Blenders. These are all stocks which are currently in the red. Even as the mid-cap index is holding up in the green, some of these stocks are reacting to their earnings. Hemang Jani is now joining us on the show. Hemang, thank you very much for joining in. You know, outside of defense, which we'll come to, the big winners this week were some of these two-wheelers. So Hero MotoCorp rallied close to about 12-13%. Compared to the rest of the peers, its valuations are more attractive. Bajaj Auto has gained about 10.5%. TVS Motors is up 7% this week. So they've gotten re-rated this week.
Yeah, good afternoon, Rima. I think, after a brief underperformance and a sideways movement, we have seen a good amount of traction come through in Hero Motors and to some extent in Bajaj and TVS also. I think the key trigger for that was, the con call of Hero Motors, where they sounded extremely positive on the growth, over the next, let's say, few quarters and year. And they're looking at a very significant, recovery, particularly driven by the rural markets. So we think that that has, driven the entire, two-wheeler space. And within the pack, we think that, both Hero Motors and Bajaj are very well placed because Hero, I think the volume growth could be about 7 to 8%. Bajaj could be also somewhere similar, And overall, we think that, second half would give you a much better growth traction compared to the previous quarter. So I think from a, next couple of quarters perspective, this space is looking quite positive.
Okay, we discussed quite a bit of defense. Hemang, hi, good afternoon. Let's just bring in our colleague Ria, who's of course been updating, and as she's had to update these numbers furiously every day because stocks have done so well. I mean, a stock like Garden Reach, Friday to Friday is up 40%. Let's go across to Ria, but not just about prices, but valuations as well. Ria, take it away.
Well, yes, defense and shipbuilding stocks have continued their rally in trade today. In fact, some stocks are up as much as 20% in today's session. The biggest gainers include Paras Defense, Premier Explosives, Cochin Shipyard, Garden Reach Shipbuilders, Mazagon Dock, and Data Patterns as well. In fact, since the 7th of May, we've seen market cap additions of up to rupees 1.6 lakh crores across the entire defense pack. Now, the key triggers that are aiding to this rally include the recent escalations that we saw between India and Pakistan after the Pahalgam terror attack. In fact, going ahead, defense equipment makers can also be expected to ramp up production in a lot of areas, which can include more focus on manufacturing low-cost ammunition indigenously. We can also see a greater push for AI-guided loitering munitions and for unmanned systems on land, air and sea as well. In fact, going ahead, the need for foliage-penetrating radars and robotics can also see an increase, and we can see a need for large-scale acquisition of stealth technology and weapons also in the future. Now, industry sources have told us that the defense industry expects replenishment orders worth anywhere between rupees 30,000 to rupees 40,000 crores going ahead, and India's defense budget, which stood at rupees 6.8 lakh crores in FY25, is also set to see an increase next year. Today, analysts also told us that defense companies are now working in up to 3 shifts in order to ramp up production as directed by the government of India in light of these escalations between India and Pakistan and the increasing tensions geopolitically as well. Now, major defense companies like HAL, Garden Reach Shipbuilders and Cochin Shipyard have also reported a healthy set of numbers in this quarter, which is also aiding to this overall increased optimism in defense stocks, and they also have strong order and earnings visibility going ahead. Some stocks that are trading near or at their 52-week highs include Bharat Dynamics, Astra Micro Products, BEL, Solar Industries, Mazagon Dock and Paras Defense as well. Other stocks, although, are still down anywhere between 10 to 33% off their respective 52-week highs, which include Idea Forge, Zen Technology, Cochin Shipyard and Emtatech. Lastly, in terms of valuations, 14 of the 16 defense stocks that we've looked at are now trading above their 3-year average PEs.
Okay, that's very comprehensive, Ria. Thank you very much for that. Hemang, you want to quickly weigh in anything you like from the space?
Prashant, because of this entire news around the increased defense spend and the kind of upgradation requirement that we may have, we are seeing a re-rating for many of the stocks, given that we had this, entire war playing out between India and Pakistan. So I think some of the companies, particularly which have a specialized segment into either drones or the air defense mechanisms, I think that is where there is a hope that you will see significant traction in terms of order inflow. So I think Bharat Dynamics, Idea Forge are the names that we think are extremely well placed. Apart from that, Solar Industries, which has a certain component of defense and also the explosives, I think that also appears to be extremely well placed. We have to remember, Prashant, that some of these stocks have run up quite a lot, and in terms of valuations, they may look a bit stretched. But given the sentiment and the kind of news flow that you will see, probably some people may want to have some more allocation towards these stocks.
Yeah, I mean, we made that point. Don't get carried away. This is when you get carried away because everything is going up. Even as the long-term story is good. Well, we'll take a quick commercial break here. 10 minutes to go for market closing. Now, the US government has introduced a bill that could levy a 5% tax on money transfers sent by non-citizens, non-US citizens. India, the world's top recipient of remittances, sees around $83 billion a year in transfers. If the bill passes by Memorial Day, May 26th of this year, it would mean a 5,000 rupee tax on every 1 lakh sent home, with funds used for extended tax breaks. A lot of chatter, a lot of discussion on this online, a lot of opposition to this online as well in terms of what is being proposed. And remember, it's being proposed right now, and this would need to pass the US Congress for this to become reality. We'll take a break. More on the other side. Stay tuned.
Welcome back. 5 minutes to go and things are very, very quiet. The index, I think, has moved in about a 30-point band over the last 2 to 3 hours. 25,000 to 25,030, just chopping around between those levels. IndusInd Bank has staged a recovery. Remember, there was this fresh accounting issue. There was about 670 crore new irregularities amounting to 764 crore rupees. But the stock is now back in the green with a gain of close to about 0.5%. Hemang, IndusInd Bank, when after the issue came out, after a point, valuations had turned attractive. There was buying in the stock. How are you approaching this entire issue now surrounding IndusInd Bank?
So, Rima, what is happening with IndusInd Bank is that... hello? Am I audible now?
Yes, go ahead.
Yeah. So, Rima, when it comes to IndusInd Bank, the issue is that every time you get a sense that the worst of the news flow is behind us, and every maybe second or third month, you keep hearing that some more this kind of issues are still there, and one doesn't really know when exactly it will end. So while the stock has underperformed and it has corrected quite a lot after the last episode where the top management also left, the comfort is still missing, So I think that, if you really want to play this entire banking or financial services, then go for some other private sector banks like maybe Axis, some of the NBFCs like LIC Housing, etc., rather than having a small allocation to IndusInd Bank and getting into that uncertainty phase.
Yeah, I mean, it's interesting, right? The stock's actually higher after the news yesterday, and that kind of is, of course, talking about the fact that the market is looking ahead. Now, rightly, wrongly, that's a different point. But who'll lead IndusInd Bank? Will it be a credible player? What kind of names? Of course, it'll all have to be approved by the RBI. And typically, the bank will have to send a few names. I think at least 3 names, and the RBI will then pick depending on what they feel most sort of comfortable with. So that's essentially the road ahead. But it may be now, it may be soon, it may take some time. But that is the story as far as IndusInd is concerned. Otherwise, I mean, I think as Rima pointed out, it's largely kind of quiet this week. But it's a good week. I mean, I think 9% on the small cap index Friday to Friday. Mid cap index Friday to Friday up 7%. The Nifty itself up 4%. And I think the Nifty Bank up about 3% or so. So it's a very, very good session coming through this particular week. I mean, I can spot a few other names here which did well. There was Apar Industries, which was up some 35%. Eclairs was up 35%. Wrights was up some 34%. Kirloskar Engines about 33%. Titagarh 33%. Birla Corp, Ircon. So at least, 5, 6, 30% plus kind of movers if you sort this through from an NSE 500 broader market kind of perspective. And on the downside, not very much. All in the single digits, really, which is what we saw today. So broad up move, I think, is what we've seen, especially for the broader markets playing a little bit of catch up to the large cap indices. Hemang, you want to leave us with an idea or two as we wrap up this week?
I think, Prashant, some of the power stocks, we do feel that there is some more juice left. I think JSW Energy, the numbers were not good, but we were quite impressed with the management commentary about the growth plans. And we do think that that theme could do pretty well. Even Tata Power, we expect very strong set of numbers, over the next couple of days. And the renewable and the traditional, power as a space should actually do pretty well. And also commodity stocks, which have seen a decent bounce back, something like a SAIL, NMDC, Hindalco. I do think that there is some more, upside case for some of these names which have underperformed big time, given the stability in the global markets and the fact that the quarterly numbers that some of the companies have reported are looking quite good in terms of, volume growth, pricing, and the growth outlook. So I think these are the two, areas that we are quite positive.
Hemang, thank you very much for joining in. Just counting down to the close of today's trading session. Quiet close. The Nifty and the Sensex witnessing a modest pullback after yesterday's mega gains. The Nifty ending at that 25,000 mark with a cut of 50 points. Sensex lower by 240 points. But for the week, the Nifty and the Sensex higher by more than 4%. The mid-caps rallying. The mid-cap index up 7%. Small-cap index up nearly about 9%. So largely in the red. As a sector, there's only one which stands out really, and that's the entire defense and railway pack. The Nifty Defense Index gained 15% for the week. BEL up 4%. Outside of that, you had Cochin Shipyard, you had Mazgaon Dock Shipyard, HAL, BDL. Across the board, big moves, double-digit up moves coming through. Railways had a very strong session. Lots of interest in RITES, IRCON, RVNL, as these stocks have gained close to about 25 to 30% over the last couple of trading sessions, Friday to Friday. Quite close, but it's been a very strong week for our markets. We'll take your leave on closing bell. Thank you for watching. Don't go anywhere. On the other side is our special Editors Roundtable.
Dalal Street clocks huge gains this week with the broader market seeing a big buying. The Nifty and the Sensex are up 4% this week. The Midcap index has recorded its biggest weekly gain in the last 2 months. Hello and welcome to the Editors Roundtable. Today on the show, we take you through all the market action of the week, take stock of all the big block deals that have started taking place again in the last 2 odd weeks. And we will also put the spotlight on mutual funds and whether they have enough firepower to keep buying in this market. I'm Surbhi Upadhyay. With me on the show, of course, Nimesh and Nigel. And also joining us today in the studios right here with us is Gautam Charchoria, Head of Global Markets, UBS Securities. Gentlemen, great to have all of you in. And Gautam, thank you so much for being here in person. I can tell you personally, for me, this doesn't feel like a 5-day week. It feels like, 2 weeks have ended, given the volume of information and news flow, guys.
Yeah, news flow, I mean, markets have also been so surprising, like how we get surprised every day with the Trump tweet, right? I mean, every day is a shocking tweet from him. And I think markets have also shocked a lot of investors. They're sitting on cash, a lot of HNIs are out of the market, and boom, the indexes are 4%, mid-cap indexes rallied pretty hard. All the stocks, the defense stocks are up 15, 20, 25% in just 4-5 days. Yeah. That's the kind of market we've seen in the last 1 week. So it's been crazy, as you rightly pointed out, doesn't feel like it's a 5-day week. I mean, it's been like...
It feels like we've been working for 2 weeks.
Absolutely.
Because the news flow is so intense. It's actually quite astounding, right? Who would have thought that you have the whole trade war issue, this Liberation Day disruption. Then from a trade war, you've moved to a real geopolitical war.
Yeah.
And in that scenario, in those 4-5 weeks, this market will rocket 15%.
Well, that's right. And Trump, Nimesh, one tweet a day is okay. Sometimes it's different in the morning, different in the evening. Depends on which side he's waking up as well. And the other point is, as you said, this rally has been so swift. A lot of money sitting at the sidelines, just waiting for that dip, which eventually hasn't yet come. So they'll have to rush in maybe at some point.
It looks like, I think you're going to put out a piece on the amount of mutual fund cash people are sitting on. But even generally, I talk to so many large investors, and everybody seems to have left out. I mean, there is a lot of left out feeling now. Gautam, you must be talking to a lot of clients as well. Generally, is that the sense that, everybody got just caught by surprise and there is a lot of left out feeling now?
If any sharp move, no one can participate, especially when you have moves early in the morning also. It's very difficult, right, for them. And this left out is both global and local.
And the thing is that, and that's the hardest thing, right, in the market, that to buy when the news flow is still negative. Because everybody thought there will be another dip and there'll be another leg down and then we can buy, we'll get better prices. But it just... Throughout all the negative news, the market just kept rallying. So what's happening?
And you all know, right? Nigel, we used to talk to a lot of experts on the channel as well. At 22,000, everybody had come out and said, next is 19,500 and maybe 19,000 on the Nifty.
We did say market is bottoming out.
But I remember, Gautam, at that time also you were a little bullish. Even from the sidelines of the conference and all, you said, we feel it's good level to enter at 22,000. Still hold on to that view that 22,000 is a kind of near-term bottom for the Indian equities?
After the long week, everything is falling in place. Narrative is good, flows are good, sentiment is positive. Even Trump, the tweet world is positive for now. But the risk reward at these levels is obviously not attractive as at 22,000.
Correct.
So our Nifty target is 26,000.
Sure.
So there is still some momentum left. I think it should retest the earlier lows, earlier highs.
Sure.
But risk reward is no longer feeling as attractive. So do we recommend investors jump in at this level in a big way? No.
Well, Gautam, don't say recent lows. We went to 21,900, then everyone said we missed that, and then we visited 21,700. So hopefully that's the near-term base in place. But I wanted to ask you, we're at Nifty's at 25,000. Everyone's thumping the table. This is the highest since October 15th. But a lot of small cap stocks, the small cap index itself is still 12-13% away from the same day, that's October 15th. If you look at even the Nifty next 50, that as well is more than 10% down. Do you think from here on, the headline index could take a bit of a backseat and maybe the broader markets outperform, or would you stick to the large cap names?
We are still sticking to the large cap names at a very broad market level. For the small cap world or even the mid cap is okay. Small cap world specifically, what we saw in last year, I think that the requisite conditions are still not there. Right? There's not enough euphoria. There's optimism, but not enough euphoria for it to be driven high. And again, the other thing to keep in mind, this is only last year. A lot of retail investors, even the small cap funds, etc., the memory is fresh that the drawdowns or losses can be sharp. So for that to go back very quickly at an euphoric level, I think will take some time. So large caps will still be fine.
Let's talk about the block action.
Well, Now we'll focus more on numbers. So I'll talk about some large blocks which have happened and which have taken place, and we'll ask you about your views as well. So last 10 days or maybe 12 days, there has been block deals worth 17,000 crores. So nearly $2 billion is what we've already seen. The promoters are PE encashing in this pullback. So to start with, today itself we saw a large block in Bharti Airtel. Singtel sold a little over 1% stake for 13,000 crores. So that was a large block which happened today itself on Friday. Even JSW, there was a large block where the promoter entered it through the trust. They sold 2% stake and there is close to 1,200 crores. The other big notable deal was Paytm, where Ant Financial sold 4% stake. They own 10%, they've sold 4%. So still some left, but that again was a very large block deal. The other large interesting deal was K Fintech. They came out with solid set of numbers, but then General Atlantic came and sold 10% stake in one single day, and they've rose close to 1,700 crores there as well. So quite a bit of large deals which have already happened. But when I talk to some large funds or for that matter the investment bankers, it seems like the pipeline is quite strong for the next 2-3 weeks. As in when the earnings season gets over and there is an opening window, there's going to be large blocks. I'll just run through a few names which I have heard of where there could be large potential deals. To start with, Asian Paints, the strategic investor is likely to sell a large stake. Then it's going to be a large block as well. Some of the names where private equity will keep selling stake. Zomato is one, Swiggy is the other name. Keynes Technologies yesterday reported very strong set of numbers, but again, there the expectation is that it could be a decent sized block. Aptus Wealth, again, a private equity sitting there. They're going to sell one-fifth of their stake. Ami Organics, OneSource, and Apollo Tyres also could be an interesting name there. Again, came out with decent set of numbers. The commentary was strong, but again, there is a private equity who owns 10%, and there is a strong buzz that they'll sell half of their stake as well. So again, that's going to be quite a sizable number that's going to come out. Apart from the block deals, Surbhi, the other interesting kind of observation has been the kind of MNCs which are looking to exit or sell out their stakes. This week, like Thursday, Friday, we had a large OFS. In terms of size, it's a large one. Vent is looking to sell its entire 37.5% stake in the Indian company. So that's while in size it was only 500 crores, but they're selling their entire 37.5% stake. So that's one big exit. Next week, by 20th, there is Whirlpool's board meet for results. And we all know that the parent has gone on record saying that they're looking to sell 30% of their stake in India. So the MNC is selling out, P is selling out, promoters looking to exit in some form. So looks like, now that we are fag into the earnings season, this is only going to pick up and there's going to be more momentum in terms of large blocks and large supply. So Gautam, how do you read? Traditionally we've seen a supply of paper means it's negative for the stock, but that's all out of the window in the last 2 years, right? We've always seen stocks actually going up after large blocks. So what's your take?
So I don't think the first line I would agree with, that traditionally supply means necessarily markets come down. It's in the context of markets.
No, I'm saying generally,
the stock would fall. On the day of a block trade, the stock would fall, but now it gets, it reverses.
See, what I meant was that when the insiders sell, a PE selling or a promoter selling, generally it's been perceived as negative and they would know better than anybody else, right? So from that perspective, in the last 2 years, that's not been the trend. So
that reflects the level of cash sitting around.
Correct.
Very simply. There's enough.
Too much of liquidity chasing limited.
And then cash levels, like locally with the funds, even appetite in general, beyond the institutional funds, also the appetite with the retail, high HNIs, the cash levels are just too high. So that's the reason, very simple reason. And also the backdrop of sentiment, right? The market sentiment today versus a month back is very, very different. So I think this was pent-up supply. We had almost a quarter where we didn't do much, unlike last couple of years. So this is going to, I think, if market remains where they are, this will continue.
But Gautam, isn't it going to be a bit of an overhang? Because I know the argument is that our markets have deepened and now we can absorb all this block supply. But the scenario versus, there's one difference that I want to talk about, and Nigel will speak more about this. In October, around November, December, mutual funds were getting in 40,000 crores, 42,000 crores of just equity inflows every month. Now that number is halved. Now they're getting 25,000 crores on a net basis. Yes, the SIP book is strong, but that net number has halved. So in the previous block cycle, when the markets peaked out, domestic institutions and mutual funds were big buyers. Do you think that will hold true right now? Or is this the fact that insiders are selling, whether it's promoters or PEs, it's also an indication, right? Market's back at 25,000. So isn't it indicating that this is a near-term top?
So I think for the foreseeable future, not necessarily. I think markets can absorb, also given the very high cash levels, not just the inflows happening.
Sure.
So I think there is enough room for it to absorb. And even if you put these numbers, whether you look at IPOs or blocks or QIPs, in dollar billions or rupees crore, they seem very, very high. But it's not necessarily off the charts if you go back to, say, pre-GFC as a percentage of market cap, etc.
Yeah.
So there is precedent for these numbers to actually even go higher. And there's enough cash levels today. So I won't worry about that for now. Okay. We were worried about it a bit towards the end of last year when it was reaching that level. We are far from that.
Okay, all right. Gautam, I wanted to ask you, if the markets are in a better place, then how do you play these financialization stock market plays? BSE people said that it was expensive at 5,000. It went to 7,000. Angel Run saw a sharp correction. I think in the recent low, 2,000 has become 2,800 rupees, just to state a few examples. How would you play this? Would you play the wealth management listed companies? Would you play the brokers? Would you play the stock exchanges? Both MCX and BSE have done very, very well. Your take.
So by the way, before he speaks, they've already played, in India by buying 5% in 361. So UBS actually is now 5% holder in 361.
Yeah, so I name the others. Yeah, go ahead.
I can't comment on that.
Obviously. That's a separate.
But like, our research team is broadly positive on the financialization as a thematic. And one of the things we pick up from investors globally, not just investors here, is India is one of the unique capital markets and much more similar to US, for example, this financialization theme. Like investing, saving, capital markets, it's much more similar to that market. So in that context, what we are seeing at a sector level is not surprising. And there's still a long runway left for them to keep on growing.
Sure. Okay, I think we have to take a quick break. We have to discuss a lot of other sectors and your whole strategy for this market now. Take a break and come right back.
Welcome back. You're tuned in to Editor's Roundtable. Well, let's focus on the big focal point then. The equity mutual funds are sitting on solid ammunition, and the cash levels that they're sitting on is actually the highest we've ever seen. So the cash market levels in percentage terms, as a percentage of the total equity AUM, is at around 7%. Just take a look at the way it's moved up. From around 5.5%, it's gradually moving up. Now at around 7%, if you look at it in absolute terms, it's around 2.15 lakh crore. Remember, we're talking about the core equity AUM out here. The cash levels are around 2.15 lakh. So it makes sense to pull up some of those, mutual funds that are sitting on a good amount of cash. SBI, well, they are sitting on close to around 36,000 crores. PPFAS on a base of less than a lakh, they're at around, 24,000 crores or thereabouts. Around a lakh is what their AUM is. ICICI Prudential at around 28,000 crores, and HDFC Mutual Fund, they are as well at around 25,500 crores. But it makes sense to look at the cash levels that they're sitting on, and if you compare it with the total equity AUM, and that number comes up for you in the screen. So just take a look at PPFAS. They're sitting on cash, plenty of cash, a lot of firepower is available with them. Similar is the case with Motilal Oswal Mutual Fund, Quant Mutual Fund, as well as SBI and Axis Mutual Fund. So all of them sitting on a good amount of money. Now the question is, why are these equity mutual funds sitting on a lot of cash? Three possible reasons. One is that in case of times of uncertainty, you want to have some kind of liquidity, some kind of ammunition in your hand. So that could be one point. Now the question is, will they be forced to rush in? Because now the macros are improving. You look at the Indian rupee, you look at the crude oil prices that have come out as well. FI flows have been gradually coming in there, and the RBI, they have managed things very, very well, both on the liquidity front as well as the rate cuts that the market is anticipating. The problem is that there could be a bit of a negative, and that's why they're sounding a little bit cautious and they're sitting on this cash. Because of what we were discussing, right? The supply overhang. OFS, there are lock-ins that could get come off as well, and you could see some kind of supply that's coming in there. So are they signaling something, or are they going to be forced to rush in? Equity mutual funds sitting on cash of close to around 2.15 lakh crore. Well, Gautam, I wanted to ask you, we briefly discussed this as well in terms of the cash levels, but tell us how you're reading earnings, because ultimately earnings are what drives this market, right? And Q4 wasn't expected to be good, but the street was looking forward to commentary for the coming quarters. Are you satisfied?
So I think it's a question of expectations more than absolutes. So the expectations are still not optimistic in general. People are expecting second half recovery. Yeah, exactly. That's what happened in the 4Q till now. The expectations were running very, very low.
In that context, the numbers are better?
Marginally. Marginally. Again, a mixed bag as always. But
at a house level, are you expecting some upgrades after the Q4 earnings?
So our strategist believes that double-digit earnings growth, which is being talked about in the market for the full year fiscal 26, is reasonably likely. Having said that, I think given the way the policy easing cycle has happened or is happening, that's still not played out completely. Will there be room for that? Every year we talk about 15% growth and then numbers
the negative
down.
surprises. Will we have positive earnings surprises?
At least it's much more going to be closer to expectation, if not beating the cycle. Because I think the market is still not completely, including strategists and analysts, in my view, building in completely the effect of easing cycle. And we are seeing meaningful easing cycle, both RBI and central government. Again, one last thing to remember there, over this year and next year, fiscal 26 and 27, we'll see 2% of GDP consumer stimulus. 2% of GDP from the social welfare schemes, the pay commission, and the tax break, which is meaningful. It's meaningful. So at a bigger picture level, one of the simple calls the strategists are making, which we believe in, is this is the next year or two, consumption as an overall theme should do much, much better than they have in the last couple of years.
So let's narrow down a little bit more, right? What do you like from the consumption basket?
So we like everything, from staples to discretionary to leisure to hotels, everything. But obviously within that, the aviation / leisure / hotels, they are better placed. For sure.
And they bounce back big time as well in this week. But
and they can do.
One sector, my home sector, so to call it, like have you have a home ground? Cement is a sector that I've been trying.
Home or
Friday evening.
Metal,
I'm surprised
and the other stuff.
Okay, let's give you an option then. Both my favorite sectors. One is the cement one, which I track very closely, and the other one is where I contribute.
Contribute very closely
as a consumer.
Cement had a very, very rough last year, but now things are looking up. Pricing are moving up, demand is better, and input costs are down. And the other one where there is an immense consumption boost and immense scope out there is alcohol beverages. Which one do you like?
Alcohol beverages, you have to also look at the FTA impact. We'll see how that plays out. It's still early in the day. So I think the answer is very clearly towards cement. Cement, both from the input cost, demand surprise possibility, and also I think the housing cycle is still, in our view, underappreciated. So that has much more, not just the real estate is one part of it, but the broader housing, government spending on housing, for example, that has more legs than is being built in our view.
Sure.
Okay,
but just one more question on the cement pack. Would you go with these larger names? I'll tell you why. Because when times are a little bit dull, then people like to hide in the larger names. But when the cycle is going to turn, for example, a couple of these south-based cement companies came out with below expected numbers or weak numbers as well. But the stocks are up because the street is saying going ahead is going to improve, and then that buzz about M&A and all that. So what would you like?
So typically, that's what happens. The smaller ones do well. We don't have coverage of the small cement names, but that's where the operating leverage is more. But even on the large cap, I think it's not been a case where a large part of the large caps are trading at very rich valuations. There are pockets there which are very well placed, very attractive, even from a valuation perspective. So our preference is risk reward wise still the large caps, but obviously if you have the risk appetite, then go down.
So we spoke a lot about the domestic triggers and the earnings and everything. What about the global setup? Are we just forgetting that what's happening in the US, what's going to happen with the tariffs, is something still a serious concern which one should watch out for?
It is an overhang for sure, which we have, I think, pushed it out a bit, waiting for the next tweets or whatever. But again, look, the one good respite in general, where I think the global economy and investor class is getting some comfort, is ultimately we did see a pullback on the tariffs on China, and a sharp one. It's not going from 145 to 60 or 80. It's a sharp pullback, which in a way tells us, okay, the tariff is a new reality. US will have tariffs. Possibly, even you look at the US-UK FTA, you have 10% in general. So 10% will be a tariff. So the weighted average tariff from US on the economy globally will still be higher than it used to be last year in any scenario, and which will be therefore a drag on growth, at least in the near term. But at least it may not be as extreme as 2 months back. So there is some respite. But uncertainty and overhang, absolutely. We still don't even know.
What's the UBS US House view in terms of recession, in terms of growth? What's your big call?
So there is a reasonable chance of recession, but again, short-lived, not a long-lived one for a quarter or two. Reasonable probability, that's not necessarily the base case. The base case is maybe for a quarter, but not sustained recession.
But will that be disruptive for emerging markets like India?
So question is, recession is a one data print, right? Yeah, but that data print happening in the context of the overall tariff and direction of that, then market might just look through that.
Ignore it. Okay.
Yeah. But if it's a broad-based tariff disruption, again, I think the bigger issue now, given what's happened in the last 3 months, is uncertainty rather than the level of tariffs. The level of the tariffs, people are less shocked today, about 20-30% than they were 3 months back.
I think that's how you play it, right? When you say 145, 30 looks absolutely fine. You know,
30 is also not small, right?
30 is very small.
Uncertainty is a thing.
Yeah, so it's like our earnings. You know, we were so much low in terms of expectations.
So you know, 6-7%, count volume growth of 5% on an FMCG company. It's like wow.
If you look at the global thing, US, China, at least we have some sense of next 2-3 months something will happen.
Yeah.
UK is already done. Europe is the missing piece, but again, UK, China template will get done. India, anyway, we are hoping that will get done soon. So I think large part of the economy will have uncertainty behind us in the next couple of months.
In the near term,
Surbi, just to wait, it's like used to coming home at 2-3 a.m. in the morning after a good party night. You come at midnight, it's a lottery.
It's like early.
Mom will be surprised.
Yeah, parents can't believe it.
Mom will be surprised what happened.
But you're like that. It's all about expectations, right? And the reset therein. Gautam, since we're talking global, I'm just curious, what are the conversations that you hear or pick up on when it comes to foreign money and foreign clients? Because as this thaw continues between US and China, I was always watching out for the days the Chinese market was rallying, because we know that in the valuation context, China's much cheaper, right? And you also have the, a lot of the tech plays, which are very high-tech sort of plays, which you don't have here in India, bigger size businesses. And the world has largely ignored all that. The Chinese market has been in the doldrums. So is the China revival, a tactical revival maybe, in equities, could that be a risk for India in the near term?
You mean more from a flow perspective?
From a flow perspective, yeah.
Yes and no. Like, I think in general, if China revives, it's actually great for EM as an asset class.
Yeah, correct.
So India
because the EM basket does well.
Everybody will get the money.
And the second part, unlike last year, India's positioning for global and EM investors is not that heavy. Sure. It's still neutral, underweight, depending on how you look at it. It's not that investors have gone overweight India in a material way, unlike, say, a couple of years back or a year and a half back. So the positioning is also not, I won't worry about that aspect. I think it will be good because China recovery means EM asset class. China recovery also means good global growth.
Yeah. So overall, it will be good. Got that point. So I'm going back to now what you like. Just to recap, you spoke about cement, which is something that you like. Capital market plays, we spoke about that. What else? I mean, house view, what is the biggest bullish?
So consumption is the biggest one as a simple thematic, especially given how investors are positioned, priced in, what they have done in the last couple of years. So that's the obvious big bet for us. Financials remain a big bet, and then real estate.
I want to ask you on defense. We've seen a big recovery in the defense stocks. Then some of the defense, schemes, mutual fund schemes, the NAVs have moved up sharply from 15, a low of 15 to now 23. Do you think it's a decadal opportunity, the way we've shown up our strength and the Indianization which is happening? Do you think defense could be a big play from here as a thematic play?
Yeah, so the policy environment suggests that policy environment, despite the fiscal constraints India has, just the localization should be a big driver. Like this thing always difficult. It's easy to say 10-year themes, but always difficult. But again, you've seen what happened to defense in Europe also.
True.
But the difference here and Europe is looking at increasing spending structurally.
Yeah.
That's not the case in India necessarily, given the fiscal constraints. But within that, a much more higher localization. Again, early signs suggest it could continue for long. Sure. That's what the markets are already possibly pricing in.
Yeah.
Our analyst remains bullish.
Okay. You'll have a bullish house view on the
defense.
Okay, so market, let's say 6 months from now, by the year end?
Unlikely to be down.
Okay. That's a good way to put it.
Unlikely to be down.
Okay.
But do you make higher than risk-free returns? That's a tricky one to answer right now.
Okay. Well said, well put, Gautam. Thank you very much. Great conversation. Thanks so much for dropping by. And we look forward to more of these in perhaps the coming Fridays as well. Thank you.
Thank you.
Well, with that, guys, it's gotten time to say goodbye. I guess it's a wrap on this edition of Editors Roundtable then. Thank you very much for watching. News and updates continue right here on CNBC-TV18.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Despite clocking modest losses on Friday, the Nifty and the Sensex closed the week over 4% higher. Midcaps record their biggest weekly gain in 2 months with a 7% jump. India and Pakistan to extend the stoppage of military action. Defence Minister Rajnath Singh interacts with armed forces at the Bhuj Air Force Station, says India will keep Pakistan on probation until its behaviour improves. Says the IMF must reconsider its financial assistance of $1 billion that it extended to Islamabad last week. The Indian defence juggernaut keeps rolling. Top defence stocks add over 1.5 lakh crore rupees to their market cap since the start of Operation Sindoor on the 7th of May. Sources tell us the government may hike its defence budget next year. Industry expects replenishment orders worth up to 40,000 crore rupees. Turkey and Azerbaijan continue to face backlash in India for supporting Pakistan. Traders body CATE decides to completely boycott all trade and business relations with the two nations. In Turkey, shares of baggage handler Chalabi crashed 10% after India revokes its security clearance. Sources say Chalabi's employees will be absorbed by other ground handling companies after the 19th of May. Vodafone Idea urges the government to support its funding attempts, says banks have not been forthcoming despite a 26,000 crore rupee equity infusion and the government becoming a 49% shareholder. Warns it may have to file for insolvency, adds this will result in heavy losses for the government. RBI board is likely to meet on the 23rd of May to consider a dividend payout to the government. Economists tell CNBC-TV18 that this year's surplus transfer may top 2.5 lakh crore rupees due to forex operations and bond purchases. More financial irregularities come to light at IndusInd Bank. An internal audit report flagged 674 crore rupees being incorrectly recorded as interest income in the bank's MFI book. Also identifies unsubstantiated balances of 595 crores under the header Other Assets, which the bank offset against other liabilities in January. President Trump wraps up his three-day West Asia visit by signing a flurry of deals worth over $200 billion with the UAE. The three-nation trip has yielded deals worth over $2 trillion for projects in areas that include defense, aviation, and artificial intelligence. Israel steps up its military operations in Gaza and the West Bank after U.S. President Trump refloats his idea of changing Gaza into a freedom zone. Reports say over 120 Palestinians have died in the attacks in the last 48 hours. Delegations from Russia and Ukraine get ready for the first face-to-face peace talks between the two countries in 3 years, but hopes of progress are low. Ukraine's President Zelensky refuses to attend after Russia's Putin spurns his offer for an in-person meeting. Well, let's go straight to the top story this evening. India and Pakistan have decided to extend the stoppage of military action, but Operation Sindoor is not over yet. That's the Indian point of view. The Indian Army has said that confidence-building measures to reduce alertness will continue. Defence Minister Rajnath Singh visited the Bhuj Air Force Station to review operations. Bhuj is one of the military sites that Pakistan attempted to attack last week. The Defence Minister warned that India has kept Pakistan on probation until its behaviour improves. He's also called upon the IMF to reconsider providing financial assistance to Pakistan as it has again started to rebuild its terror infrastructure.
निश्चित रूप से इंटरनेशनल मॉनेटरी फंड से आने वाले $1 बिलियन के बड़े हिस्से को टेरर इंफ्रास्ट्रक्चर को फंड करने में इस्तेमाल होगा, ऐसा मेरा मानना है। इसलिए मैं मानता हूं कि आज के समय में पाकिस्तान को किसी भी तरह की आर्थिक सहायता टेरर फंडिंग से कम नहीं है। भारत यही चाहेगा कि IMF पाकिस्तान को अपनी $1 बिलियन की असिस्टेंस पर वह पुनर्विचार करे।
Minister there asking the IMF to reconsider its $1 billion loan to Pakistan. Now, Network 18 learns that the centre is reportedly planning to send a delegation of MPs across parties to major world capitals to make India's case against cross-border terrorism from Pakistan and articulate our stance on terrorism. The Congress party has expressed its support for the move. Let's listen in to Jairam Ramesh.
सरकार की ओर से अगर कोई इनविटेशन आता है, कोई मांग आती है कि एक बहुदलीय प्रतिनिधिमंडल में कांग्रेस पार्टी भी शामिल हो, हम ज़रूर शामिल होंगे और जो कुछ हमें करना है हम करेंगे। राष्ट्रीय हित सर्वोपरि है।
That's the Congress party's Jairam Ramesh. Now, a CNBC-TV18 exclusive. India's defence budget is expected to be hiked next fiscal to bolster the country's arsenal. But here's what we learned. The defence industry is expecting replenishment orders worth 30 to 40,000 crore rupees. Parikshit Luthra joins us now with more details. Parikshit, many thanks for joining us. You know, we cannot preempt what the defence budget is likely to allocate towards spending. But what are we picking up in terms of estimates on account of Operation Sindoor? What has been used and what needs to be replenished?
You know, let's start with where things stand as of now. As far as the FY26 union budget was concerned, the defence outlay was 6.8 lakh crore, 9.5% up from FY25. The capital acquisition outlay there was around 1.8 lakh crore, up 4.5% compared to FY25. Now, both these figures are likely to go up significantly. We will also see diversification. Currently, India's imports from Russia, which has been the traditional mainstay supplier of India, are about 36%. We have been diversifying. Today, US and France account for 45% of our defense imports. Having said that, in the next few months, as a result of Operation Sindoor, we expect, and this is coming from different sources in the industry, that there could be orders to replenish our ammunition stocks, weapon stocks, and this could be in the tune of anywhere between 30 to 40,000 crores. The defense budget also likely to go up, especially for indigenous acquisition. What sources and experts tell us, it is very important for the government to focus on low-cost ammunition, alternatives to scalp and hammer missiles, which are expensive, and India should have a local supply chain. At the same time, we should be buying more drones, more AI-powered drones, which reduce the role of ground forces, and more stealth technology as well. So more drones, more high-tech technology, also more low-cost intelligence ammunition, foilish penetrating radar. This is the kind of wish list that is coming from experts and the industry, and this is going to be the likely push area for the government as well in the coming months.
Parikshit, many thanks for joining us. And let's stay with the defense theme. Now, what we are seeing is in terms of defense stocks, after Operation Sindoor, we've seen the might of the Indian military and Made in India arsenal being showcased. Top companies, including PSUs and private players, have added over 1.5 lakh crore rupees to their market cap since the 7th of May, with their stocks gaining anywhere between 15 and 40%. Surbhi joins us now to take us through the self-reliance story of India's defense sector and whether this is a coming-of-age story for India's defense industry. Surbhi.
Operation Sindoor has literally announced the coming of age of the Indian defense manufacturing ecosystem. And it's an ecosystem that has a lot of private sector players and, of course, the big PSU giants. Let me start by telling you about some of the weapon systems that were deployed in Operation Sindoor. We're talking about, of course, the missiles, the medium-range surface-to-air missiles, MRSAMs as they're called. Bharat Dynamics is a very key player here, not only when it comes to manufacturing these missiles, but it's a full systems integrator, and it played a huge part. The Akash weapon system, which we all know, which was critical in Operation Sindoor. This is a weapon system that has suppliers, across a long supply chain. So when it comes to the outer shell, it was manufactured by a company called Paras Defense. When we're talking about the warheads and the initiating systems, then Solar Industries was the name that was in play. And once again, Bharat Dynamics was the key systems integrator over here. The Nagastra loitering munitions, this was a war that was fought in the sky with drones, and the anti-drone systems came into play as well. And here, Nagastra 1 and 2, which is what Solar has been manufacturing, that was, in key play. I want to talk about some numbers as well, the size of the opportunity in the industry. The projected estimated output by the Indian defense sector for FY25 is 1.75 lakh crore rupees. That number is expected to swell, or was expected to swell, to 3 lakh crore rupees by FY29. But a lot of analysts that we've been speaking to say that these targets will be hit much earlier now because the production is being ramped up, because companies are running on double and in some cases triple shifts. So all of this is getting accelerated. 193 contracts signed by the Ministry of Defense in FY25, and a whopping 92% of those actually went to domestic suppliers. By value, this is number of contracts. By value, 80% of the contracts by value actually went to local manufacturers. So that's really saying something about the extent of our Atmanirbharta. I just want to quickly talk about some of the names here. Many of them you already know. Bharat Dynamics, like I said, when it comes to missile systems, and it's right up there. It's also a key systems integrator. BEL, when it comes to defense communication and electronics. It's a big player in of course, in the Akash new age weapon system, land-based radars, naval systems, tanked armored vehicles, and all the electronic systems that go there. BEL plays a part. HAL needs no introduction, whether it's the Su-30s or the other aircraft. It recently won a massive order, HAL, 62,700 crore rupee order for the light combat aircraft that it will deliver both to the Indian Air Force as well as to the Army. And then, of course, Mazgaon Dock, Garden Reach Shipbuilders, Cochin Shipyard, the frigates, the destroyers, the corvettes, all of them being manufactured locally right here in India. But it's not just the PSUs. The private sector players are really, notching up the game as well. Of course, there are giants like Tata Advanced Systems, which are, into a range of weapon systems, whether it's launchers, artillery gun systems for the Akash surface-to-air missile systems. There's also the, advanced towed artillery gun systems, the ATAGS as it's called. And of course, a range of other optronics, radars, etc. Solar Industries, like I mentioned, when it comes to warheads and bombs, then this is a key emerging player. In fact, whether you talk about missile systems like, BrahMos or many of the others, the Pinaka multi-barrel rocket launchers, Solar is a big player in a lot of these projects, and it's a big supplier. Astra Microwave, big name when it comes to radars and electronic, warfare systems. And then there is Paras Defense as well. Again, the rocket and missile programs, warfare, surveillance, naval systems, tanks, and armored vehicles. This is not a fully exhaustive list, by the way. There are many other companies, many other SMEs as well. But the entire ecosystem, when it comes to defense, self-reliant manufacturing, indeed thriving now in India.
All right, Surabhi, many thanks. That's India's defense story. But the other big story that we're continuing to track here on CNBC-TV18, shares of Chelbi plunged 10% on the Istanbul Stock Exchange. This a day after the Indian government revoked security clearance of Chelbi's Indian subsidiary. Now, what will this mean for the company's employees in India? Madiha joins us with the latest details. Madiha, what does this mean for airports who are in business with Chelbi? Airports like Mumbai, Delhi and others have decided to cancel their contracts with Chelbi and move ground handling to other service providers. Take us through what's happening on the ground today.
Well, soon after the government's notice, all the concerned airport operators issued statements announcing termination of contract with Chelbi. The Civil Aviation Ministry announced that all employees working with Chelbi will be transferred to other ground handlers at the 9 airports. We learned from sources that airport entry permits for Chelbi staff will continue to be valid until the 19th of May, after which the Bureau of Civil Aviation and Security will issue new permits to these employees under their new employer. But these are around 10,000 employees who handled nearly 160 flights daily across these 9 airports, which is Mumbai, Delhi, Cochin, Kannur, Bangalore, Hyderabad, Goa, Ahmedabad and Chennai. So issuing entry permits on the new employer's name may take more time, and BCAS may have to extend the validity of the existing permits of these 10,000 employees. Now, Chelbi provided key services like terminal handling, ramp handling and cargo handling at the 9 airports. It also operated the cargo terminal at the Delhi airport. So now all of Chelbi's assets, including the staff, are likely to be taken over by the other ground handling companies. Whether the existing one or new, we don't know as yet. As per India's ground handling policy, there has to be 3 ground handling companies at airports where annual passenger traffic exceeds 10 million. So at Delhi airport, the handlers are Chelbi, AI SATS, Air India SATS and Bird Worldwide Flight Services. We learned that Chelbi's ground handling at Delhi airport will be transferred to AI SATS and Bird, while GMR will take over the cargo terminal. At Mumbai airport, the 3 ground handlers are government-owned Air India Airport Services Limited, Chelbi and Bird Worldwide Flight Services. Now, sources say that Mumbai Airport is onboarding a new company, Indo-Thai, to transfer Chelbi staff and assets. Mopa Airport in Goa had Chelbi as the sole player. It is yet to be decided if the operator GMR will take over or some other company will be brought in.
Madiha, many thanks for joining us. That is the latest on the government's decision to revoke the security clearance for ground handling services provided by Chelbi, and now what happens from here on. Indian businesses have also started boycotting Turkey and Azerbaijan after their opposition to India's Operation Sindoor and their support for Pakistan. Traders from 24 states held a conference in Delhi and have decided to halt all trade and commercial engagement with both countries, including travel and tourism. The Confederation of All India Traders has urged the film industry to avoid shooting in these countries. The resolution by the traders also warned corporate houses from shooting promotional ads there. Earlier, the All India Cine Workers Association announced a complete ban on Turkey for film shoots and cultural collaborations. Let's talk about the markets, witnessing huge gains this week with the Nifty and the Sensex up 4%. Each broader markets continue to see large intraday buying. The Midcap index recording its biggest weekly gain that we've seen in the last 2 months, up by about 7% today, 7% this week. The Sensex up almost 4% and the Nifty up 4% as well. Prashant joins us now to wrap up the market action. What a week it's turned out to be, Prashant, for India and for the Indian markets.
It's been a good week, no doubt about it. Broader markets, of course, much better. And remember what we started off with. You know, last weekend, as we go into this weekend, just to remember last weekend, Saturday and Sunday, there was those US-China talks. Monday morning, Asia time, we got news that there perhaps is some sort of a deal, a handshake deal, which is being worked out. Tariffs are being lowered. The tariffs were being lowered to much better levels and the most optimistic expectations. And generally, that kind of has triggered a bit of a risk-on, tactical risk-on kind of environment across the board. And that continued broadly through the course of this week. So I'm not going to go into what happened on Friday specifically, but the week, I think, gives you the real picture. The Nifty is up 4% Friday to Friday. The Nifty Bank is up 3%. The mid-cap index is up 7% this week, and the small-cap index is up 9%. So these are large moves. Now, on the Nifty, you had gains coming through with names like Adani Enterprises, Hero MotoCorp, about 14% on both these. Jio Financial Services and Shriram Finance, which were also strongly higher. The one sector of the week without a doubt is defense. Bharat Electronics, 15%, but that's, smaller than the rest. Garden Reach, 38%. Cochin Shipyard, 37%. Midhani, 31%. Zentech, 27%. Data Patterns, 24%. And Paras Defense was up about 23% as well. In the broader market, a few names. Apar Industries, big gains this week, 35%. E-Clerks, 35%. Rights, 34%. Kirloskar Engines, 30+. Titagarh, Birla Corp, and Ircon were some of the other names which did very, very well. On the downside, not very much actually. KPR Mills was down about 9.5%. Chambal Fertilizer, Naveen Fluorine, United Breweries, Muthoot Finance. But, these are single-digit losses as compared to the massive gains that I pointed out earlier. The big headlines, I think, are still coming out of what the US President Donald Trump wants to do. And, there are so many things up in the air, which I think remains the focus point. I think from an India perspective, will some of the recent discomfort with regards to, the comments made by Trump and potentially the trade deal taking a bit of a backseat, will that be put on once again? I think that is what markets will be closely watching. Back to you.
Yes, we will be watching that closely. And of course, the next round of negotiations between India and the US on the trade front expected to kick off next week. We will head to a break. But up next, Vodafone Idea urges the government to support its funding attempts, warns it may have to file for insolvency. That and more when we return. Cash Up Vodafone Idea has urged the government to support its funding attempts. Sources have told CNBC-TV18 the company says that if it fails to receive support from banks and the government, it will have to file an insolvency plea in the NCLT, impacting more than 200 million subscribers. Ashmit joins us now with more. Ashmit, this continues to be Vodafone's SOS to the government. We've already seen the government become the largest shareholder with a 49% stake in the company. Now, what exactly is Vodafone seeking and why?
Well, just yesterday, we were the first to report that Vodafone Idea has reached out to the highest court of the country, fresh application seeking AGR relief on account of the interest and the penalty burden. Now what we understand is that before reaching out to the Supreme Court, they had also knocked on the doors of the government as a last throw of the dice. In that letter, Vodafone Idea has painted a gloomy picture. Vodafone Idea says that without government support, the company could very well head into insolvency and will not survive beyond FY26. Now, speaking of that letter, in that letter, what Vodafone Idea argues is that without government support, the banks are not stepping up. Promoters have pumped in 26,000 crore rupees. Banks are not stepping up. That's affecting capex. That will affect the operations. The company will not survive beyond FY26, could head into insolvency. And speaking of insolvency, the letter then goes on to say that this insolvency will adversely affect all stakeholders. And by stakeholders, Vodafone Idea also making a reference to the government, saying that it holds 49% now. It is a partner as far as this company is concerned. That as far as the government stake is concerned, the value will be brought to naught in case Vodafone Idea goes into insolvency. That the spectrum dues that the government is hoping to recover, 1.15 lakh crore rupees, that will also be brought to naught. It will adversely affect over 200 million customers, will affect the Digital India mission. So clearly painting a gloomy picture, saying that the government now needs to step in or else the company could go into insolvency. The government, importantly, however, on its part, believes that its hands are tied on account of the Supreme Court's AGR judgment.
Well, that's essentially Ashmit reporting that Vodafone Idea says it will move the Insolvency and Bankruptcy Court if the government doesn't step in and provide further relief in terms of waiving those AGR dues. It's also moved the Supreme Court. Another CNBC-TV18 exclusive, the RBI board is likely to meet on the 23rd of May to consider its dividend payout to the government. Economists tell CNBC-TV18 this year's surplus transfer may top 2.5 lakh crore rupees. In fact, it could even be significantly higher. Sapna standing by with more details. Sapna, take us to the range that economists are working with in terms of what could be another bumper dividend payout by the RBI to the government this year.
Absolutely, and the numbers are really big. They range anywhere from 2.5 lakh odd crores as the baseline number that may be given out by Reserve Bank of India, as high as 3.5 lakh crores. So that's the range that we are talking about. But having said that, let's look at the numbers also. So 2.56 lakh crore odd, that's the overall head that the GOI has kept in terms of dividends from Reserve Bank of India, and also includes dividends from banks and FIs. So if you deduct that, around 220 can be roughly estimated as actually the target that they expect from RBI in terms of a dividend payout. Now, against that, the range that we're talking about is around 2.5 lakh odd crores to 3.5 lakh odd crores. So that is pretty significant. Now, having said that, the reasons that are being still given out in terms of why the number could be again huge for this financial year. Two things. A, the forex operations by the RBI, which have seen a huge jump. And second, their bond purchases also in terms of liquidity infusions that have been happening since the last couple of months. Now, what we are hearing from economists is the fact that, say, for example, in the last financial year, around $150 billion worth of dollar sales had happened, or rather RBI had done. Against that, RBI had booked around 83,000 crores worth of gains. Now, what they are saying is that there has been a 2.5-time jump in the dollar sales done by RBI in the financial year gone by. So keeping that in mind, it's likely that the exchange gains from the dollar sales are going to be massive. So that's one reason, one trigger why the dividend could be again a bumper one. And second, of course, the bond purchases that have been happening in terms of making sure that there is enough liquidity in the market. Now, economists are also saying that this dividend number will have other implications. Basically, it will also easen out the wrinkles in terms of the liquidity situation in the market. They're also expecting that if that happens, then down the line, open market operations can also come down. So let's wait and watch what happens on that 23rd May board meeting of Reserve Bank of India.
Yes, we have a few days to go. Sapna, appreciate you joining us. It is going to be another bumper dividend from the Reserve Bank for the government. That is Sapna's story there. The National Company Law Tribunal has agreed to hear IRDA's insolvency plea against Gensol. The court issued a notice to Gensol to respond to the insolvency plea. Remember, IRDA moved the NCLT citing a default of 510 crore rupees. More financial irregularities have come to light at IndusInd Bank. An internal audit report flagged that 674 crores was incorrectly recorded as interest income in the bank's MFI book. This error was rectified by the 10th of January this year. The department also identified unsubstantiated balances of 595 crores under the header Other Assets. This amount was offset against other liabilities in January. President Trump has concluded his first official tour to West Asia, bagging investments claimed of more than $2 trillion. Hailed the Gulf nations for their deepening ties with the US, Trump has made his last stop in Abu Dhabi, where he participated in bilateral meetings at the presidential palace. He announced deals more than $200 billion during his visit today.
Donald Trump's Gulf tour took him to the United Arab Emirates on Thursday, and the visit was marked by the signing of more deals, valued in all at $200 billion. That followed a pledge by the UAE in March to invest some $1.4 trillion in the US over 10 years. Trump hailed that deal in a meeting with country President Sheikh Mohammed bin Zayed Al Nahyan.
And all I could say is thank you very much. We will work very hard to deserve it.
Among the deals announced Thursday was another order for Boeing. UAE airline Etihad said it would buy 28 big jets from the aerospace giant, including 787s and 777s. That followed news of Boeing's biggest ever order for wide-body jets a day before, when Trump visited Qatar. Also finalised in Abu Dhabi was a plan for the largest AI campus outside the US to be built in the UAE. Reuters sources said the deal would give the country expanded access to AI chips from Nvidia. Company boss Jensen Huang was seen conversing with Trump at the palace on Thursday. A White House fact sheet said other deals included a partnership between US and UAE oil firms to expand oil and gas production. It valued that agreement at $60 billion. However, US lawmakers, including Bernie Sanders, on Thursday sought to block further arms sales to the country. That's over allegations that UAE forces are involved in Sudan's civil war.
Well, that is President Trump's visit to the Middle East. U.S. House Republicans have proposed a law which would impose a tax of 5% on all remittances sent outside the country by immigrants. The House aims to pass the Immigrant Remittances Bill by the 26th of May. India is the world's top recipient of remittances, with $83 billion sent from individuals in other countries annually. If the law is passed, for every transfer of 1 lakh rupees, 5,000 rupees will go to the United States federal government. And that could be a hit there as far as the Indian diaspora is concerned. That is expected to be taken up around the 26th of May in the US. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned.
Risk markets have clearly come a full circle. So is the worst of the reciprocal tariff scare behind us? That's the question we're asking in today's Indianomics. Now watch this, the table that will come up for you. Pre-April 2nd, that is the pre-reciprocal tariffs, the US indexes, S&P for instance, was at 5670, NASDAQ 17,150 thereabouts. Post-reciprocal tariffs, they fell about 15%, as you can see. And now, after the US-China deal over the weekend, they are back above their April 2nd levels. Likewise, you can look at the Nifty, or you can look at the dollar index. The Nifty as well, 23,350, falls about 15% after the reciprocal tariffs, and now back above the April 2nd, or back above the reciprocal tariff levels. Likewise, for the dollar index, it's not quite climbed back to the pre-reciprocal index levels, but the rupee definitely has. It fell to a low of 86.50. Gold is the other way around. Gold being a haven when risk aversion is high. It was high during the time. It was low during the pre-reciprocal tariff. After the tariff, because risk aversion was at its height, gold went to a high of 3,500 and now is back to the pre-reciprocal times level. So the question we are asking is the worst of the tariff threat over? And if yes, which assets will smart money chase? First, I'm joined by Neeraj Seth, founder and CEO of 3R Investments and formerly head of fixed income, at BlackRock. Neeraj, thank you very much indeed for your time. That really is the first I'll ask you the big question and then come to the nitty-gritties. Do you think the markets have priced the worst of risk aversion?
I think the markets certainly have priced out all of the risk from the tariff and more. Obviously, there's an element of positioning that plays a role here, but I do think looking at the 120-degree turn, not 180, from President Trump, I do think the worst of the tariff scare is behind us. It's not done, it's not over. And the fascinating thing is that the investors are actually celebrating a 10% across the board tariff and still the remaining uncertainties in front of us. But it's not as bad as what we saw on April 2nd.
Yes, I agree that it is 120-degree turn and not a 180-degree turn because the president has said this is a 90-day truce. But is the market seriously pricing in something worse than 30% tariffs on China or a return to very high tariffs?
So I do think the markets, in fact, are moving more towards pricing even below whatever the last number around 30 that was in the news, for a simple reason that in any negotiation, if you start from 0 or whatever the last number was, or 10 that cross the board tariff versus 30 as the discussion point, the markets would expect the meeting point to be somewhere in the middle. So the pricing that I see at this point actually is reflecting a better outcome than even that 10 and 30 that obviously President Trump has been talking about.
Okay, let me ask you some unfair questions first. You are a fixed income expert, but I'm going to ask you if the best of gold is over for the moment. If risk aversion of the worst kind is already priced in, then gold doesn't go back to $3,500 for now?
If I have to predict, gold will go back to 3,500, but it'll take time. Part of the reason, exactly what you said, the near-term risk averseness and the uncertainty has come down, which is bringing gold back down. But if I take a step back and think about the world that we live in and the global reserves that sit in US dollars, the exposure the world has in US dollars, I do think the systematic reallocation is still going to happen over the coming years, and gold will be one of the beneficiaries, whether it's in the central bank portfolios or individual portfolios. So it's going to be a structural bull run, but a cyclical correction that we are going through. And I do think right now, near term, you probably have more to correct on the gold, given the uncertainties coming down and market is pricing the other side. But longer term, I still think gold will go higher.
Okay, so that is something like a buy on dip strategy that you're giving us. Okay, let me come to now the Asian, okay, where smart money will go. Do you think now smart money chases risk assets like equities?
I think there is some reallocation happening. There's also, as I said, the technical backdrop of positioning. The CDAs were short given post the moves in the market post April 2nd. I think that readjustment is happening. I do think the smart money will still look at more diversification, first of all. Very high concentration that you see at this point in the US equities and US tech for a number of investors. So I think diversification is going to be one element. And if I take that lens and think about the markets that will benefit, in my view, Europe will get a little bit of that reallocation benefit. Japan and India, in case of Asia Pac, will get that benefit. So you will see some of that money flowing back in these markets.
Okay, now let me come to credit. India, even at the worst of times, continued to receive money in the bond funds. I think there was practically a couple of weeks when we didn't get, otherwise money was coming. How will bond funds look at Asian credit and particularly Indian credit?
So broadly, the Asian credit, I would say, is at this point fairly priced. I do think the spreads have a risk of widening, and because credit is not an asset class that loves uncertainty, and that's something which hasn't gone away from the market. So credit, I think, still has a little more risk of widening if you take a 6 to 12 month view. India is slightly different, and part of what we have talked about in the past, that when you look at the Indian markets, one, you have a fairly big high quality market, including the government bonds, PSU, and small corporates in the capital market perspective. And then you have the growth of private credit markets. And the global exposure, the foreign exposure in the India onshore story, despite all the news flow, is still not very high. So I do think India will continue to see those flows. on a structural basis, at least for the foreseeable future.
Oh, yes. We also got a lower than expected inflation number for the 4th month running. So there are other reasons why Indian bonds are looking very attractive, even for domestic investors. But coming to the one, asset class which has defied all the risk move up and down, US bonds. I mean, 4.53 after you've seen what one must say is, some end of uncertainty. What explains the rise of US yields?
Well, part of it is obviously the markets are going through the respite, and hence you are seeing the sell-off in the bonds, which had a little bit of a tailwind or a support because of uncertainty and the risk of recessions that the markets are pricing in.
Okay.
And equally importantly, if we look at the fiscal financing and the monetary policy path, I still think there's a challenge there. On the fiscal financing, US still has a fairly heavy fiscal financing with close to $2 trillion of deficit that needs to be funded this year, and it's not coming down anytime soon. And on the monetary policy path, which is even more complex, I do think the Fed is sitting in the middle of very dense fog of uncertainty, both on the inflation as well as the employment front. So it's going to be hard for the Fed to move. Their best case scenario is to sit and wait. So between the financing, which is pushing the term premium higher, and the Fed uncertainty or the lack of Fed moves, which is keeping the front end also pricing out a little bit of the rate cuts. I think looking at the curve, the way it's behaving, I'm not at all surprised. If anything, I do believe the long end can actually keep backing up more.
Oh, going towards 5, you think?
I think 30-year crossing 5 is, well, we're not very far to begin with, but I don't think that should be a surprise. You still, when you think of fiscal financing, end of the day, the clearing price is a function of supply, demand, and where obviously you could get the investor interest. And the foreign demand is, although hasn't gone away, but it's not as strong for the US treasuries at this point.
Okay. Time permitting, I wanted to ask you a little more about US treasuries, but let me come to the dollar index. We have seen the dollar index recover somewhat from the sub-100 levels, but give us your view on whether dollar strengthens from here on, and therefore the dollar rupee in particular, not other Asian currencies.
So medium horizon, I'm still in the camp of dollar weaker, and that's mainly to do with more of the flow picture that you see on the back of the tariffs, the global exposure to the US assets, which is north of $30 trillion in the liquid markets. And hence, as some of that reallocation happens, I do think the dollar still has potential to weaken further. On the dollar INR is interesting because you have, in addition to what happens to the dollar, you have RBI sitting on the other side. I think that stays more sideways with potentials, like, if anything, over time, some strengthening driven by the flows.
Okay. Well, some strengthening because of the flows, yes. Neeraj, now a big question. We may not have time to flesh it out completely. Do you think the next big problem for all financial markets will not be the end of this 90-day period, but potential tax cuts by the US government, which perhaps is just a few weeks down the line?
So interestingly, that's an important point, because the market can normally focus on only one thing at a time. And that focus will go towards tax cuts as we cross middle of the year. So you're right. I think that focus shift will happen. That also, to some extent, keeps the tailwind for the markets in the near term, because obviously the regulatory aspect and the tax cuts still have a bit more of room for the tailwind to be there. So I think that will move. Now, the interesting thing will be, I would say the bigger point the markets will focus on as we get into July will be the earnings from the second quarter, because the uncertainty that got created was April 2nd onwards, which is not captured at all in the first quarter earnings. So the second quarter earnings, you start to see a little bit of initial impact of these changes. And I think that will be more important in my view.
Okay, then a quick last question. Because of that, will US exceptionalism fade or will it rise?
I think on
tax cuts.
I think on the margin, the US exceptionalism little bit fades, partly to do with obviously the policy uncertainty that has been created. But when I look more from a corporate perspective in terms of innovation, growth, the technology aspect, the overall focus on shareholder value creation, the depth of the capital markets, I think US still remains an important market. It's more a question of how much exposure a non-US investor should have in that market. But it doesn't change the focus on the return on equity and the shareholder value creation that we have seen over the last 40 years.
Okay, a rupee appreciation. That's not the majority view in the market. But thank you very much, Neeraj, for clarifying how the US-China deal is impacting Asian credit markets and currencies. We have to take a break, and thereafter we have two more experts joining us. Louis Quees, the economist from S&P for Asia Pac, and Mitul Kutecha, the head of Forex at Barclays Bank, to discuss whether the US-China deal is going to bring more strength to Asian currencies. Welcome back to Ideanomics. Well, we have been discussing whether the US-China deal has completely erased the worst possibilities of tariff wars, and whether it can actually lead to some growth upgrades, at least for Asia, for China in particular. Also, what happens to yields and currencies in Asia now that the overhang is gone? Joining me are Louis Quees, the Asia economist of S&P, and Mitul Kutecha, head foreign exchange FX at Barclays Bank for EM Macro Strategy. Gentlemen, thank you very much indeed for your time. Well, Louis, let me start with you on the first growth picture. Any changes to S&P's growth forecasts for the global economy or for China because of the US-China deal?
Well, that's definitely the lowering and suspension of tariffs between these two large economies is a plus for the global economy and for these economies themselves. It matters a lot for China. We will be looking at that again. These things take time, changing one's forecast, so we don't do that overnight. But definitely, this is a positive for the economy. It will also, of course, probably mean a bit less stimulus necessary in China, but that's all a good thing. So this by itself is a piece of good news, even though, of course, there remain quite a few areas of uncertainty, both with regard to the US-China dimension and also more generally. There's still a lot of, uncertainty hanging over that global trade arrangement.
Oh, yes, let's not forget that this is a 90-day truce. But Mitul, what is the sense about, first, the Chinese yuan? We saw that rapid appreciation, almost 7.18, even 1.7 on a day, on an hour. Do you expect that there will be an appreciation of the yuan that we should be prepared for? What are the ranges you're looking at?
I think at the moment, you're right. We had an initial positive reaction in the yuan on the back of the trade truce. But the reality is, I think it would be hurting China's economy if we do see continued appreciation of the currency. Now, obviously, the dollar has been very restrained. But our view at the moment is that the pressure on the dollar, the headwinds to the dollar have been fading, and we don't see much more downside from here. And so in that sense, currently, if you look at the fixings that we see on a daily basis, the PBOC sets these fixings, and they've been generally around this 720 mark. So there's no real sense here that China's looking for an aggressive appreciation of the currency. in this environment. If anything, with a weaker dollar or a weak dollar backdrop, China's benefiting from some trade-weighted improvement of the yuan, actually much like the rupee has done in recent months. So in that sense, they don't necessarily have to see a stronger currency versus a dollar. But our view is still that we will see some depreciation of the yuan in the months ahead. We think that the currency is still one of the release valves of economic pressure, along with more fiscal stimulus and more monetary stimulus. Now, admittedly, the pressure on the economy is less than it would have been given the tariffs truce, but there is still economic pressure, and growth is still coming under that downward momentum without further stimulus, whether it's monetary, fiscal, or via the exchange rate.
Okay. Actually, things are pretty clear when it comes to equities because everyone's reading growth after the US-China deal, but it's very confusing on the currency and yields front. Lewis, what are your thoughts on Asian currencies? Not just the Taiwan dollar, which I'll discuss separately, but the rupee itself has zigzagged a lot. What is the longer-term view on Asian currencies?
Yeah, I think we've seen a quite remarkable, very interesting, but also unexpected shift in currency markets in the last 6 months or so. Because, 6 months ago, everybody, all the experts were saying that if the US is going to engage in, trade wars with everybody else, that will strengthen the dollar and will weaken other currencies. In fact, the opposite happened. And the opposite happened in large part, I think, because financial markets started to reprice US assets compared to the assets of other economies. We've seen there have been capital flows, into Europe, into Asia. I'm not sure that this is completely over, but I'm also not sure that we can extrapolate from this. I would still expect there to be some at least, risk and uncertainty hanging over those Asian currency markets as that situation on tariffs and what will the US eventually roll out. I think that will still weigh over those currency markets. Having said that, our forecast has for a long time been that if you look at, say, a 3-year period, we expect most Asian currencies to strengthen against the US dollar from a position. In the current situation, most Asian currencies are still quite weak vis-a-vis the dollar on fundamentals. So there is some room still for further strengthening of Asian currencies.
Strengthening of Asian currencies. Actually, a previous speaker also said that, Neeraj Seth. Bitul, what are your thoughts? Is the rupee going to get stronger? First, Asian currencies, but more specifically the rupee.
Sure. Look, I think I have some sympathy with the view because we wrote a piece recently highlighting the massive net international investment positions that Asia has, countries like Korea and China and obviously economies such as Hong Kong, Taiwan. And we've seen the upward pressure more recently on these currencies. You mentioned Taiwan dollar, very, very rapid move in that currency. So I think if you could see a big repatriation of this money coming back into Asia, yes, there could be some severe strength, significant strength in Asian currencies. But again, it's not our base case. We still see the dollar picking up some ground in the next several months. Even though structurally there is some shift out of US assets and shift of repatriation, which is a longer term path, we will see cyclical and large moves cyclically in that environment. And we still think the bias will still be for dollar Asian currencies to move, or dollar versus Asian currencies to move higher. And I would say similarly for the rupee. I think we're finding a sort of base around this sort of 85 level for dollar rupee. We have seen some improvement in competitiveness more in the last few months. But again, I think the RBI would probably want to avoid any real richening of the currency from these sort of levels. At the same time, I think there will be continued focus on what the CNY is doing. And I think India will focus on that. And I would doubt that we will see a move out of that sort of range that we've been in. Potentially, you could see CNH INR cross also moving, back towards sort of the 12 level where it was some time back. So look, I think that I think the downside risk on the rupee will pick up in the next several months. Not a massive depreciation, but perhaps a gradual depreciation of the rupee.
Okay. Well, actually, the market is quite deeply divided. You just heard Lewis saying that, he expects a rupee appreciation, or rather Asian currency appreciation. A lot of this confusion is coming because of the dollar. Why are you expecting a dollar appreciation at all? Trump himself wants a dollar depreciation. Is the appreciation likely because he may announce tax cuts as you get into the middle of the year?
I think, again, any appreciation is probably a lot milder than had previously been expected, for sure. I mean, I agree with the comments that, everyone had expected a dollar to strengthen on tariffs, and it just didn't happen. And now we're probably seeing better news on the US and less tariffs and less economic impact, less policy gyrations. And that actually, perversely, could bode well for the dollar. So, our view is that sentiment and positioning is really stretched negatively on the dollar, that we might start to see some better news coming through from a point of view of less extreme negativity. And that could help the dollar to pick up some momentum as we go through the next several months after being in this very oversold territory that we're in presently.
Okay. Well, let me just finish the India growth story with Lewis. Lewis, what are your growth forecasts for India? And interest rate as well. The Reserve Bank's policy is up next month.
No, I think when we look at our forecast for the different economies in Asia, the Indian one, the forecast for India has been among the more stable. We still we nudged down our forecast for the fiscal year, for current fiscal year, to 6.3%, but we expect growth to recover to about 6.5%, and then move up to close to 7%, in 2-3 years' time again. So we've factored in our Indian forecast the impact of that, of really all that trade turmoil. But our medium-term view on India remains pretty positive, with growth of around 6.5-7%. On the RBI, we do think that the RBI will consider there to be room for them to lower rates later in the year. We actually expect 75 basis points of cuts this fiscal year.
Okay, 75. Actually, the market is moving to the view that the end repo rate could be 5/4. But Mitul, the other big question I wanted to ask you is this Taiwan dollar appreciation and the latent fear that the US may impose non-tariff barriers, like asking people to buy 100-year US treasuries, or in some way forcing a depreciation, an appreciation of Asian currencies. Does that threat still remain?
Well, that threat definitely remains. And for example, just yesterday, or last couple of days, we had these comments out of Korea, where there had been some statement and reports that the currency, the Korean won, had been discussed on May the 5th between discussions between US and Korean officials, and we saw quite a sharp rally in the Korean won. Similarly, Taiwan dollar, there is, and I would argue the yen as well, there is some focus on whether currencies will play a part in these trade discussions. And as you highlighted earlier, some in the US administration do want to see a weaker dollar. They do believe that Asian currencies are vastly undervalued, and that they should be strengthening somewhat more going forward. And that is a big risk. And I think that is one of the reasons why currencies in Asia have been doing so well lately, and catching up with the moves in the broader dollar sell-off that we saw against major currencies.
A quick last one, Mitul. Why is it that the US bond yields are not coming down at all? They're remaining at around the 4.5 mark, even after yesterday's fall. And if they remain at that point, what is the impact for Asia?
Well, it's a good point. And I think the the risk premium, the term premium has been something that's been increasingly priced into the US bond market. The worries that the fiscal expansion in the US is going to get out of hand from a deficit that's already around 6.5-7% of GDP. There's still lingering worries about inflation risks. And the Fed perhaps not moving as quickly to counter that. So, and also one other factor remains foreign selling. We go back to the same theme, concerns about foreign selling of US treasuries. Now, we think some of these concerns are overdone. Our US rate strategists have just put out a piece highlighting that they still remain quite constructive on treasuries going out further. So, we don't think this pressure is going to be sustained. But of course, if US rates continue to remain high, that won't bode quite badly for Asia rates markets and Asia overall, because of the fact that we'll see continued funding sucked towards the US. We'll continue to see perhaps some latent pressure on Asia markets because of that.
Oh, yeah, that uncertainty of US yields remains. But otherwise, it looks like the worst of the tariff, at least, is behind us. Lewis and Mithil, thank you very much for joining me indeed. That's it on this edition of Indonomics. Thanks for watching.
Hello and welcome to our special broadcast. I'm Parikshit Luthra. The top story we're tracking this evening. India's defence budget is expected to be increased next fiscal to bolster the country's arsenal. Sources tell CNBC-TV18 the defence industry is expecting replenishment orders worth 30,000 to 40,000 crore rupees. The industry also expects the government to double down on manufacturing low-cost ammunition in India. AI-guided loitering munitions, which are crucial in Operation Sindoor, are also likely to be a priority area. The centre is also expected to push for more unmanned defence systems and foliage-penetrating radar and robotics. Industry sources have said that the development of more ballistic, cruise and hypersonic missiles is also likely to be on the government's priority list. So what else should be on the government's radar when it comes to the defence sector? What were the learnings for defence manufacturing when it comes to Operation Sindoor? To discuss that and more, I'm joined by former Defence Secretary Mohan Kumar and Arun Ramchandani, Executive Vice President, L&T Defence. Gentlemen, thank you very much for joining us on the show today. Mr. Kumar, let me begin by asking you, India has been ramping up its air defences, inducting new fighters, inducting cutting-edge weapons over the last 10 to 15 years. Looking at the lessons from Operation Sindoor and what happened between the 6th of May till about the 10th or 11th of May, what would be some of the key lessons in terms of what should our defence push be in future?
Well, good evening and thank you for having me on the program. I think this Operation Sindoor was a very professionally executed operation. I think it was one of the best operations that we have done in our history. You see, one of the outstanding features of this the operation was the power and the strength and the accuracy with which we could target Pakistan's terror camps, and the surprise it gave them, in spite of the fact that they were expecting India to, they were anticipating an action from India. There was still an element of surprise, and it was very beautifully executed. So the outstanding features are that the accuracy, the precision of the weapons is something which is a new development now, because more than ever before we have perfected the use of precision weapons. And of course, this is just a small operation. It was not a long sustained operation. It was just 3 days. But the way it was operated with great precision is really commendable. And one of the other interesting features was, the net-centric warfare that we got into. Net-centric in the sense that the integrated air command control systems. I think they were used in an actual operation probably for the first time. And this was developed by us. It was developed indigenously, and I think the credit should go to Bharat Electronics. And the way various systems were networked with us, and how effectively we could counter and have almost good dominance, total dominance in the air. I mean, that's something which is remarkable. And this has happened only because of these new technologies which have been introduced into the system. And networks, right. For instance, apart from the other drones and other facilities that we used, we also had the support of the S-400. That was also networked with this, and it proved to be lethal. And it was it was one of the most potent weapons available in the world today, and we could use it very effectively. Apart from the,
you're right.
Of course, the thing is that the game in this particular operation, we found all modern systems of warfare coming into play.
Absolutely. So I'm going to come back to you. Right. I'm going to come back to you, sir. Clearly, this was new tech warfare that we sought. Mr. Ramchandani, if I were to get you in at this stage, when it comes to defense manufacturers in India, how does Operation Sindoor give you guidance in terms of how to change or modify your defense manufacturing path for the future?
So, Parikshit, the defense manufacturing part has become more and more domestic driven, both in terms of the manufacturing capability and the design and development capabilities. What is becoming obvious today is that in current conflicts, the focus on low asset equipment, the focus on net centricity, electronic warfare, on surveillance reconnaissance equipment, on strong air defense systems, all of these are emerging. And, it does give us a direction that when, let's say, we are developing our radars of the future, they have to look at low cross-section targets, such as drones, etc. And, the application of these technologies into the defense manufacturing is clearly becoming visible and will be a thrust area for industries like us.
Kumar, to get you in, do you feel that the government will have to double down on drone manufacturing and also acquiring some of these armed drones from Indian manufacturers? Because we saw the use of swarm drones in big numbers. Do you feel we have a strong domestic supply chain right now, or are we majorly reliant on imports? Mr. Kumar, if you can hear me, I wanted to ask you, yes. Do we have a domestic supply chain for armed drones right now, AI-guided loitering munitions, or are we largely dependent on imports?
Well, I think that's the real question, because, we have found, we have now come to know how critical these things are for modern warfare. And technology becomes absolutely a critical factor here. Because in India, of course, we have been manufacturing drones, we have been manufacturing various other systems, and the manufacturing in India has gone up. There is a lot of orders being given to the private sector. But one important factor is that, we take it as a Make in India program. Like it's a Make in India program. And then we talk about Atmanirbhar, that is self-reliance. But the thing is, I don't know, just the fact that, by merely, giving orders to the private sector in the private sector or public sector or domestic companies, I mean, you really do not solve a riddle, because the real crux of the issue is technology. And even I understand that even in the drones that we used, there was a lot of import content from different leading countries. So, it's always possible to put together a drone. Otherwise, you you get some material from China, so China will give you different types of drone. They can always put together, and then you can prepare a drone even for civil use or even military use. But the thing is that no, the critical issue is how much we can actually develop, how much of technology we can actually develop indigenously, and that's the most important factor. Because if you have any program which any company which manufactures a critical weapon with a high import content, or even a marginal import company is sufficient to derail the process, because we do not know these days. The world is in a flux. We do not know what kind of relationship we are going to have with other countries. Today will be friends. Tomorrow they will be enemies, or they won't like you, and so the supply chain can be disrupted, and this will actually create a big problem for our strategic independence. So strategic independence is one of the cornerstones of our policy. So that part has
to have local technology.
We have to have local.
We need our own technology.
Absolutely, there is absolutely.
Mr. Ramchandani, Mr. Ramchandani, to get you in at this stage, we used our ammunition drones that we had in our arsenal during Operation Sindoor for those 3 to 4 days. Are you expecting replenishment orders? What are the kind of orders you're expecting the government to give out in the coming months now?
So the government is looking at accelerating many of the acquisition programs, and we can feel that energy in the Ministry of Defense. There is also a number of emergency procurement cases which have been initiated. So quite clearly, the thrust for scaling up manufacturing, scaling up production, and at the same time looking at building, like Mr. Mohan Kumar said, our own technology-driven products, where the reliance on in-house technology and advanced tech getting integrated into our products, I feel the thrust would be in that direction.
Right. Let me also get in Mr. Kumar once again. Mr. Kumar, now speaking about having your own supply chain of low-cost ammunition, is it now very important to develop low-cost alternatives or Indian alternatives to scalp and hammer missiles? Now, these are ones that we acquire from Israel, but how much of a supply chain can we have here in India, for that matter?
Well, these drones are all imported ones. They come from different countries. But I have a feeling that if we try hard, we will be able to attain self-reliance in missile manufacturing. In fact, some of the missiles we have done, we have started with Akash. Akash, 10 years ago, when I was in the ministry at that time, Akash was in the preliminary stage. It didn't have proper guidance systems or all those things, but it was radar. The radar was being used, and these days, there is some improvement in that missile. So much of control systems have improved, and it can be we can use it to our advantage. But then we have to go much ahead, because we need medium range missiles, we need long range missiles. Like S-400 is a range of say 400 of over 400 kilometers. Now we need to build a missile which is a long range missile, and which can be very accurate, because precision targeting also should be facilitated with such a missile. So this will call for lots of research and development. And we are yet to come out with a proper format for the long-range missile. So that's also very important. We have, of course, developed MRSAM and other things, but of course with not with our own technology. But this needs to be promoted, and lots of development has to take place. Research and development have to take place, so that these long-range missiles can also be manufactured in India. So that is one of the areas where we can altogether stop importing. If we are diligent in our work, and we are able to produce the right type of product through our own indigenous research.
That's an important point. Let me go back to Mr. Ramchandani at this point. Sir, when it comes to drone manufacturing in India right now, how much of a supply chain do we have in the country? We saw the success of AI-guided loitering munitions. This was seen in the Russia-Ukraine war as well. How dependent are we on foreign sources right now? What is the supply chain that we have in the country? How much can we localize over the next few months?
So as far as drones are concerned, the capabilities in airframe manufacturing, the capabilities in some of the surveillance equipment, the capabilities in the flight control systems, I think they exist, and the manufacturing infrastructure exists. There could be challenges on engines for the drones. The propulsion packages, there could be some challenges there. Some of the sensor packages and miniaturized sensors could be a challenge. And I guess we will have to plug these as we move along, both in terms with government support and in growing the industrial base. But I would say today, for a major part of it, the infrastructure exists and can be scaled up quite easily.
Right. What I would also like to ask you, at L&T Defence, are there certain segments which you're likely to focus more on in the coming few months or years?
So, for example, air defense is something that we are looking at quite strongly. We have been associated with the Akash program, and many of the ground equipment for the Akash we are involved with. We are looking at close-in weapon systems, given the thrust on drone warfare. So we have our own close-in weapon systems, which we are now contracted with the Air Force for. And that's one area that we would like to scale up and speed up. We are looking at some of the anti-drone systems, both in terms of radars, jammers, and laser directed energy laser systems, which would make the counter-drone systems more effective. So these are some of the areas that we are focusing on, and I think the learnings from these past events do give us the impetus to push these developments faster and scale up production on these aspects.
Right. Mr. Mohan Kumar, if I were to ask you about the defense budget went up by 9.5% to 6.8 lakh crore, out of which the capital acquisition budget was 1.8 lakh crore rupees. How much do you think our defense budget, especially the capital acquisition budget, needs to go up?
See, this is a perennial question. So, I like people talk in terms of what percentage of the GDP should be our budget. Somebody will be asking for, say, 3% of the GDP or something, as other countries are doing. So, I will not push for that kind of an approach, maybe. But what we need to do is we have to have a proper plan, long-term perspective plan, which, of course, armed forces are having. But we need to have that plan and have a specific timelines for delivery of each of the components of that plan, and accordingly the money will have to be budgeted. Because whatever happens is, whenever there is a capital budget, that capital budget is always meant for the committed systems, whatever is in the procurement line. So you have to pay the money off, and so you have to pay advances or pay the second or third installments. So that kind of payment is being made with that money. But what is more important is a long-term plan, a plan which integrates research and development, our requirement for this. For instance, we have to visualize what's going to happen within the next 15 years. And accordingly, plan has, because by the time, you do something now with the current scenario, by the time it is developed, it will become obsolete. So we need to have a vision of 15 years and then do what is possible. We have to visualize what is going to happen at that particular point of time in future. And accordingly, your research and development efforts have been made, and we have to integrate both public sector and private sector with that. And private sector will have to be given tremendous importance in that. So otherwise, innovation is of key importance here. And so money alone is not going to transform things. It's our thinking also which matters.
Thinking, and you need to have more innovation and more R&D in order to ensure that you have a greater supply chain here in India for all that stealth and AI-guided equipment. Thank you very much, Mr. Ramchandani and Mr. Mohan Kumar, for joining us. We're taking a break, but up next, a closer look at how the success of Operation Sindoor may boost India's indigenous defense arsenal. Sky is the limit for Indian defence stocks after Operation Sindoor showcased the might of Made in India arsenal. Top companies including PSUs and private players have added over 1.5 lakh crore rupees to their market capitalization since the 7th of May, with their stock gaining anywhere between 15 and 40%. My colleague Surbhi Upadhyay joins us now. Surbhi, is self-reliance the new war cry now?
Operation Sindoor has literally announced the coming of age of the Indian defense manufacturing ecosystem. And it's an ecosystem that has a lot of private sector players and, of course, the big PSU giants. Let me start by telling you about some of the weapon systems that were deployed in Operation Sindoor. We're talking about, of course, the missiles, the medium-range surface-to-air missiles, MRSAMs as they're called. Bharat Dynamics is a very key player here, not only when it comes to manufacturing these missiles, but it's a full systems integrator, and it played a huge part. The Akash weapon system, which we all know, which was critical in Operation Sindoor. This is a weapon system that has suppliers, across a long supply chain. So when it comes to the outer shell, it was manufactured by a company called Paras Defense. When we're talking about the warheads and the initiating systems, then Solar Industries was the name that was in play. And once again, Bharat Dynamics was the key systems integrator over here. The Nagastra loitering munitions, this was a war that was fought in the sky with drones, and the anti-drone systems came into play as well. And here, Nagastra 1 and 2, which is what Solar has been manufacturing, that was, in key play. I want to talk about some numbers as well, the size of the opportunity in the industry. The projected estimated output by the Indian defense sector for FY25 is 1.75 lakh crore rupees. That number is expected to swell, or was expected to swell, to 3 lakh crore rupees by FY29. But a lot of analysts that we've been speaking to say that these targets will be hit much earlier now because the production is being ramped up, because companies are running on double and in some cases triple shifts. So all of this is getting accelerated. 193 contracts signed by the Ministry of Defense in FY25, and a whopping 92% of those actually went to domestic suppliers. By value, this is number of contracts. By value, 80% of the contracts by value actually went to local manufacturers. So that's really saying something about the extent of our Atmanirbharta. I just want to quickly talk about some of the names here. Many of them you already know. Bharat Dynamics, like I said, when it comes to missile systems, and it's right up there. It's also a key systems integrator. BEL, when it comes to defense communication and electronics. It's a big player in the, of course, in the Akash new age weapon system, land-based radars, naval systems, tanked armored vehicles, and all the electronic systems that go there. BEL plays a part. HAL needs no introduction, whether it's the Su-30s or the other aircraft. It recently won a massive order, HAL, 62,700 crore rupee order for the light combat aircraft that it will deliver both to the Indian Air Force as well as to the Army. And then, of course, Mazgaon Dock, Garden Reach Shipbuilders, Cochin Shipyard, the frigates, the destroyers, the corvettes, all of them being manufactured locally right here in India. But it's not just the PSUs. The private sector players are really, notching up the game as well. Of course, there are giants like Tata Advanced Systems, which are, into a range of weapon systems, whether it's launchers, artillery gun systems for the Akash surface-to-air missile systems. There's also the, advanced towed artillery gun systems, the ATAGS as it's called. And of course, a range of other optronics, radars, etc. Solar industries, like I mentioned, when it comes to warheads and bombs, then this is a key emerging player. In fact, whether you talk about missile systems like, BrahMos or many of the others, the Pinaka multi-barrel rocket launchers, Solar is a big player in a lot of these projects, and it's a big supplier. Astra Microwave, big name when it comes to radars and electronic, warfare systems. And then there is Paras Defense as well. Again, the rocket and missile programs, warfare, surveillance, naval systems, tanks, and armored vehicles. This is not a fully exhaustive list, by the way. There are many other companies, many other SMEs as well. But the entire ecosystem, when it comes to defense, self-reliant manufacturing, indeed thriving now in India.
All right, thanks, Surbhi, for joining us. And shares of Shelby plunged 10% in Istanbul Stock Exchange a day after the Indian government revoked security clearance of its Indian subsidiary. What will this mean for the company's employees in India? Madiha Mujawar joins us now with the details. Madiha, what does this also mean for airports who are in business with this Turkish ground handling company?
Well, soon after the government's notice, all the concerned airport operators issued statements announcing termination of contract with Celebi. The Civil Aviation Ministry announced that all employees working with Celebi will be transferred to other ground handlers at the 9 airports. We learned from sources that airport entry permits for Celebi staff will continue to be valid until the 19th of May, after which the Bureau of Civil Aviation and Security will issue new permits to these employees under their new employer. But these are around 10,000 employees who handled nearly 160 flights daily across these 9 airports, which is Mumbai, Delhi, Cochin, Kannur, Bangalore, Hyderabad, Goa, Ahmedabad and Chennai. So issuing entry permits on the new employer's name may take more time, and BCAS may have to extend the validity of the existing permits of these 10,000 employees. Now, Celebi provided key services like terminal handling, ramp handling and cargo handling at the 9 airports. It also operated the cargo terminal at the Delhi airport. So now all of Celebi's assets, including the staff, are likely to be taken over by the other ground handling companies. Whether the existing one or new, we don't know as yet. As per India's ground handling policy, there has to be 3 ground handling companies at airports where annual passenger traffic exceeds 10 million. So at Delhi airport, the handlers are Celebi, AI SATS, Air India SATS and Bird Worldwide Flight Services. We learned that Celebi's ground handling at Delhi airport will be transferred to AI SATS and Bird, while GMR will take over the cargo terminal. At Mumbai airport, the 3 ground handlers are government-owned Air India Airport Services Limited, Celebi and Bird Worldwide Flight Services. Now, sources say that Mumbai Airport is onboarding a new company, Indo-Thai, to transfer Celebi staff and assets. Mopa Airport in Goa had Celebi as the sole player. It is yet to be decided if the operator GMR will take over or some other company will be brought in.
Network 18 learns that the centre is reportedly planning to send a delegation of MPs across parties to major world capitals to make its case against cross-border terrorism and articulate India's stance on terror. The Congress party has expressed its support for the move.
सरकार की ओर से अगर कोई इनविटेशन आता है, कोई मांग आती है कि एक बहुदलीय प्रतिनिधिमंडल में कांग्रेस पार्टी भी शामिल हो, हम ज़रूर शामिल होंगे और जो कुछ हमें करना है हम करेंगे। राष्ट्रीय हित सर्वोपरि है।
Russian Foreign Affairs Minister Sergei Lavrov has claimed that the Western nations are plotting to fracture the relationship between India, Russia and China. Speaking at an event, Lavrov said that policies of the West clearly are anti-Chinese and are pitting our neighbors against each other.
What is happening right now in the Asia-Pacific region, the West has begun to call it the Indo-Pacific region in order to give its policy a clear anti-Chinese direction, hoping to thereby additionally gain the opportunity to pit our great friends and neighbors, India and China, against each other. Recently, President Putin recalled that it's simply a divide and rule policy.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Hello and welcome to this special broadcast. I'm Shireen Bhan. Operation Sindoor is the new normal for India's stance against terror, said Prime Minister Modi as he reset the terror doctrine. His address to the nation on Monday was his first since India's military strikes against Pakistan in retaliation to the Pahalgam terror attack. Prime Minister Modi added that India would not fall for nuclear blackmail and that terrorists and their enablers would be seen as one. He also called Operation Sindoor the Make in India moment for India's defence sector.
न्यू एज वॉरफेयर में भी अपनी श्रेष्ठता सिद्ध की। इस ऑपरेशन के दौरान हमारे मेड इन इंडिया हथियारों की प्रामाणिकता सिद्ध हुई। आज दुनिया देख रही है 21वीं सदी के वॉरफेयर में मेड इन इंडिया डिफेंस इक्विपमेंट्स इसका समय आ चुका है।
Joining us now on the program to talk about where India stands today post Operation Sindoor, the big defence equipment moment. Is this a coming of age of India's defence industry as well as the geopolitical reset that we are currently in the midst of? Sanjeev Puri, President at CII, Baba Kalyani, Chairman and Managing Director at Bharat Forge. Also with us on the show, R. Mukundan, Vice President at CII. Gentlemen, appreciate you joining us here on the program. Mr. Puri, if I could start by asking you, we heard from the Prime Minister in his address to the nation and subsequently when he addressed air warriors at the Adampur Air Base, making it clear that Operation Sindoor is the new normal. It's the new red line for India's response to any future terror activities, whether terror actors directly or enablers of terrors as well. Now, from industry's perspective, how do you respond to what we've seen from the Prime Minister, what we've heard from the Prime Minister, and where India finds itself positioned?
Thank you, Shireen, for having us on the channel. So, first of all, let me start by congratulating the Honorable Prime Minister for his very swift, decisive, impactful and yet very responsible actions. It started with the targeting of terrorist camps, and then India also responded very effectively against the provocations, caused a significant amount of impact and damage to various strategic sites in Pakistan. So I'd like to congratulate him for the swift action and for demonstrating to the world that India will not tolerate terrorism. It's a zero tolerance. And the new normal, I think, is extremely important because, sustainable growth, quality of life, for them, what is very important is a safe operating environment. And this gives immense confidence to investors and businesses. So the Indian industry really would like to congratulate the Prime Minister, would like to salute the armed forces for their bravery, the professionalism. And I think what is interesting that it has demonstrated the prowess that the Indian defense industry has built over the years. I think it all started again with the visionary leadership of the Honorable Prime Minister, the Make in India program, which has started several years back. And we know from a minuscule amount of exports, we're talking about last year about 3 billion or approximately kind of exports. And the efficacy of all of these equipments were amply demonstrated by the effectiveness of the targeting, the precision targeting, and the extensive and effectiveness of the damage caused. And and this is not merely speculation. This is based on images that have been verified, not only what we've seen in India, but also by overseas media channels where they have access to various satellite images and have very clearly demonstrated the extensive damage that has been caused. So I think it's absolutely Indian industry is in complete solidarity with the Indian government on the actions that have been taken. We welcome it. And I'm sure that this also gives a lot more impetus and energy to the building of the strategic defense sector in India.
Yes, let me take that point forward with Mr. Baba Kalyani, somebody who has, of course, been involved with India's defense sector for very long now. Mr. Kalyani, as I started, is this really in a way a coming-of-age story as far as India's defense sector is concerned? Sanjeev Puri alluded to the export number, and we've seen that export number up 34-fold increase in the last 10 years to over 23,622 crores. But, Operation Sindoor and what it's meant in terms of testing India's military prowess, testing India's defense capabilities, coming out successful on all parameters. We are given to understand at this point in time that we could be talking about replenishment orders worth about 30 to 40,000 crores. And all of this now builds on the indigenization efforts over the past decade. Mr. Kalyani, your first thoughts on what Operation Sindoor has meant as far as India's defense capabilities are concerned, as well as the road ahead.
Well, thank you, Shireen. And first of all, let me share what Sanjeev said and congratulate the Honorable Prime Minister, the political leadership in India, and our armed forces, the National Security Advisor, and everybody else who took part in planning and making this successful. I think what we need to understand, what is very different in this conflict is this has been a technology-enabled and technology-intensive battle, not the normal kinetic war that we were used to with our adversaries across the border in Pakistan. And I think this is what is very heartening for India, heartening for the nation, and what our industry has been able to contribute, both the public sector and the private sector. And more importantly, let's not forget our DRDO, who has been at the backbone designing products and making technology happen. And I think this is a big change that has happened. We all see it in our own businesses where we are making defense equipments. And I think you will see India moving ahead very fast in the technology-enabled battle scene that we had in this conflict. Having said that, I just want to caution that this was a short conflict. I think from our side, it lasted 25 minutes, if I have heard the media correctly. And we should be prepared that something bigger happens. We are not caught napping, and we are ready with all our muscle power, all our technological capability, and all our hardware. And I think Indian industry is pretty much up to the mark. We are, more than just the business side. I think as Indians, we are extremely elated and very proud of how this has been handled, how our leadership has taken decisions and have made things happen in a very proper fitting manner.
Well, Mr. Kalyani, since you talked about the length of the operation, just to be absolutely precise, it was 23 minutes to be exact, sir. That is how long Operation Sindoor, the first installment of Operation Sindoor, lasted, 23 minutes exactly. But let me bring in Mr. Mukundan into the conversation as well. Mr. Mukundan, just to take forward what we heard there from Mr. Kalyani, in terms of future readiness, future preparedness, he talked about the contribution of organizations like the DRDO, etc., but perhaps a need for even deeper, more robust private-public sector participation, partnership as well, especially on the defense side as we move forward, because at this point in time, in the geopolitical reset that we're seeing, perhaps self-reliance will be of critical importance.
Thank you, Shri. Let me also join my two senior colleagues in congratulating and complimenting our government, our Prime Minister, and our armed forces on a wonderful, resounding message they sent across. And this was a very important message, fundamentally, because ours is a fight for peace. Ours is a fight for calm. And I think this was very important to do the way it was delivered, precise and short, as Baba Kalyani explained. And I think very clearly, in the long run, the point about Atmanirbharta, which the government has been saying, is actually most acutely we need to drive home in the area of defense. Because one of the things I did learn through this whole process is that when countries do export their wares, they actually reduce some of the capabilities of the equipments they sell to others. So I think in that context, if you had to be fully capable and measuring up to any form of threat issues which we will face in future, I think we need to design and develop and ensure that we have equipments and the technology which is right up there, matching with the best in the world. What we have seen is the human ingenuity, the human talent which has come to the fore, but we need to back it up with material goods and technological goods. And we are right there, but we must continue the momentum. One of the things which I would certainly say is that what private sector does bring to the table is its ability to put together a time-bound and also very cost-effective solutions to be delivered in a way that I think it not only caters to Indian needs, but also the needs of India as it begins to project itself beyond the shores of India. So really, the government has taken many, many steps in the area of defense, especially in terms of public-private partnership, procurement from Indian companies, encouraging joint ventures with the overseas partner. I think that momentum should continue. And I'm sure that more avenues will open up for us. And this defense spending and defense development, as I call it, should be seen as expenditure and an investment in peace. Many of us mistake that, whether it can go into other sectors like education. Certainly those we need to do. But I think this is one of the critical things. If development doesn't happen without peace all around, and in ensuring not just peace at home, but also peace overseas, I think we need to progress it, and the private sector and public sector should work hand in hand, and government has taken wonderful steps in this regard.
Mr. Kalyani, if I could come back to you, sir, and talk about the road ahead as far as acquisition is concerned. And, I would imagine that we are likely to see another improvement over the previous year's budget. We did see a significant improvement this time around as well on the defense budget, including the acquisition budget. But, the focus and priority, you talked about this having been a tech-enabled conflict. The focus on drones, for instance, the focus on AI-guided loitering munition, for instance. What would you now like to see being prioritized, both from a development perspective as well as an acquisition perspective, sir?
Well, if you closely look at India's response in this conflict, it was a response which was, all the three services put together along with ISRO and other agencies working together as an integrated response. That's where technology comes into play. So if you look at UAVs are going to be a major part of any battle scenario anywhere in the world. If you look at the Russia-Ukraine conflict, Ukraine is making something like 1 million UAVs per year. There are hundreds of companies in Ukraine making UAVs. India has more than 500 companies who make UAVs. So I think we have come of age in this area. What is very important is we are able to do precision strikes. And for precision strikes, you need, the satellite surveillance, you need multiple agencies working together, making these things happen. And I think that was very ably demonstrated in those 23 minutes, as you said, what happened. So I think we have the capabilities. We just need to keep enlarging it, because you can imagine conflicts like the Ukraine-Russia conflict. This is going on for 3 years. Now, we had a conflict that went on for less than half an hour. So if we have a longer conflict, then we need to be far better prepared. But I think we are all there with the policies that the Honorable Prime Minister put into place for the last, let's say, 10 years in the area of defense, and all enabled by our Honorable Defense Minister and the whole user industry collaborative effort that is going on between industry, DRDO, and the users, that is the services. We are all moving forward at a very rapid pace. There are a lot of things that you don't see that are happening in industry. But I can tell you and assure you that we are moving forward at extremely rapid pace. And this is not only good for our defense, but is also good for our overall economic and industrial development.
Why don't you give us a sense of what is happening behind the scenes within the private sector in the defense space, Mr. Kalyani? What exactly is moving forward?
I'll give you, for example, I can't give you specifics, but I'll give you an example. In the artillery sector where we are involved, we have weapons which are far more advanced than anywhere in the world today. That's one. Second, if you look at in armored vehicles, whether tracked, wheeled, India is moving ahead with new equipment designed by DRDO, but produced by Indian industry, and with much higher technical capabilities than what we have today. And all this is with integration with AI, digital, and everything else that's there anywhere in the world. So I think we are pretty much moving ahead. In terms of electronic warfare, I think whether it's anti-drone warfare, whether it's jammers, whether it's, those kind of things, we are moving ahead pretty fast. There are many companies working in this area. In terms of software-defined radios, again, that's an area where we are moving very rapidly in terms of technology. So every area you are moving in technology up ahead. And the good thing is all this is converging in every equipment that you make. So it's not that in like the old days, you have an artillery gun sitting and firing at the Kargil hill. Now it's all integrated. It is autonomous. It can be controlled without any man being there, and controlled by using data from satellites and everything else. So I think things have gone in the last 5-7 years way ahead, and they're going to go even faster.
Absolutely. We are seeing that already in play. But Sanjeev Puri, if I may bring you and Mr. Mukundan into what we are seeing outside of course, what's happening on the battlefront. In the midst of this, we are seeing this global reset, where if I could loosely say trust is being replaced by trade. I mean, here you have a situation where President Trump is now even talking about a possible deal with Iran while he's touring the Middle East. So Sanjeev Puri, as we look at the world today, you know, how India is best placed to navigate on the trade front in a world which is in a geopolitical flux.
So this is a very important facet that you have brought in, Shireen. That I think that first of all, India is very well placed because of the strengths, inherent strengths that India has got. India has got the capacity to produce at scale economically of world-class quality. India has the talent, and India is also a services powerhouse, a powerhouse of some of these frontier digital technologies also. So India, from its own competitiveness perspective, is well placed. Now, we have seen several policy reforms over a period of time. Several of them have happened that make India a competitive destination. There are several successful examples. I think the world is also looking for supply chain resilience, which becomes even more important in a world where there is, when there are these trade fragmentations and also, the certain geopolitical shifts happening. This becomes very important, and scale can only come from India in many of these areas. So that's, having said that, I think the way to go is what is being done is we need to stitch our own bilateral trade deals in alignment with national interests. And as we do economic integration, I think we have to be cognizant of countries that are also working against our interest. And we have to, certainly CII would encourage its members to move away from them, to reassess. There are countries that supported Pakistan in this conflict. And of course, with one of them, we do have a material amount of trade. And I think it's not in India's interest to, not in national interest for us to pursue that. We should be reassessing what are alternatives that we have got.
Are you suggesting, Sanjeev Puri, that India break trade relationships with Turkey, with Azerbaijan? Azerbaijan, of course, is too small. Even Turkey, in the larger scheme of things, is about $10 billion. But are you suggesting that we break, trade ties with Turkey?
Look, before the conflict happened, we had a trade of about 40 million with Pakistan, or something of that order, right? It was small. So all I would say right now is that we must reassess, and we must definitely look at alternatives. We should certainly reduce, or if possible, eliminate economic integration with such countries. Why should I? I mean, it goes without saying, why should you be creating economic activity for places that are working against national interest? The national interest must come first and foremost. And I'm very happy to see, a lot of Indian consumers in this true spirit of nation first are kind of cancelling their the tourism or the holidays, vacation they wanted to take in some of these countries. That's, I think, absolutely the right thing to do. Why should we be creating economic activity for countries that will work against our interests? That's the principle. India's self-interest is the first. And therefore, very strong reassessment and as much as possible, realignment, I think, is something that I would encourage everybody to think about. And
yes.
Coming back to what the question that you raised, I think fundamentally in this whole, the very hyper-dynamic evolving trade scenarios, I think the way to go is to, one, focus on domestic drivers of growth, which the government is very well doing and has done over several years. And the advantage is India is a very consumption-driven economy. The second pillar we need to strengthen is our integration with global value chains. Exports is just 12% of GDP. How do we take that number up? And towards that, I think the bilateral trade agreements that India is pursuing, that's the right way to go. I think that's the way to have one-to-one arrangements with countries where there are synergies and where there are mutual benefits. That's the way we should be pursuing those. And I think some of the ones that are in the pipeline now are the ones that will create immense value for the economy.
We spoke the day that the UK agreement was done, the India-UK agreement was done. Mr. Mukundan, talking about bilateral agreements, let's talk about the US. We just had Donald Trump once again reiterate that, in fact, telling Tim Cook that he doesn't want Apple to build more in India. Also suggesting that, look, if you're building in India for India, that's fine, but anything beyond that may not pass muster. Now, that's his point of view. Whether Apple agrees or not is a different story altogether. But what do you take away from that messaging? Also, do you believe that a zero-for-zero tariff policy is the right approach? Again, Trump suggesting that India has offered zero tariffs. He said quite literally, they've said that there will be no tariffs. The Indian government so far maintaining that it's too premature to comment on any deal contours. Do you believe that a zero tariff policy is appropriate?
Firstly, Shireen, I think this is a world of trade partnership, as you mentioned. And I think we've already signed up with UK and FTA, and I think we are looking to sign FTA with the European Union, and I think also some kind of a deal with the US. So I think when we talk about free trade, I think there is going to be some give and take. And if that leads to zero tariff on some tariff lines, I think that is the way the world is going to shape. But that is the opportunity for India. India's opportunity is to be not just the service center of the world, but also the factory of the world, but also the manufacturing center of the world. And all the decks are stacked in India's favor. We have the talent. We don't have an aging population. We have workforce which is actually very productive. And we now have improving infrastructure. You look at it from all perspectives. I think everything is going for us. And really, the basic message which we must be pushing forward in the world stage is India is open for business. And effectively, we are looking for partnerships with like-minded countries. And really, what we want is a progress through peace and progress through partnership. That is really what we want. Even this skirmish which we had with our neighbor was a fight against terrorism. It was not a fight with the neighbor. And I think as long as there are principles on which we stand, I think we should then work with countries, like-minded countries. And I think we would certainly welcome a move from government to enhance our trade competitiveness through networks and supply chain, which we want to build. And it's all going to augur well for us.
The message there from industry is very clear. The answer, the antidote to uncertainty is a strong, resilient domestic economy. And that needs to continue to be the focus of the government and, of course, of the private sector. Once again, a sharp focus on what is happening with our defense industry. The fact that the military prowess of the country has been tested and we have delivered successfully. That needs to be built on, and a more robust private-public sector partnership in each of these areas. Sanjeev Puri, Baba Kalyani, R. Mukundan, always a pleasure. Many thanks for joining us here on CNBC-TV18 to take stock of where we find ourselves post-Operation Sindoor and what it means for our economy and, more importantly, what it means in terms of the coming of age of India's defense industry. We'll take a break. A lot more coming up. Don't go anywhere. We're back in a moment. Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Despite clocking modest losses on Friday, the Nifty and the Sensex closed the week over 4% higher. Midcaps record their biggest weekly gain in 2 months with a 7% jump. India and Pakistan to extend the stoppage of military action. Defence Minister Rajnath Singh interacts with armed forces at the Bhuj Air Force Station, says India will keep Pakistan on probation until its behaviour improves. Says the IMF must reconsider its financial assistance of $1 billion that it extended to Islamabad last week. The Indian defence juggernaut keeps rolling. Top defence stocks add over 1.5 lakh crore rupees to their market cap since the start of Operation Sindoor on the 7th of May. Sources tell us the government may hike its defence budget next year. Industry expects replenishment orders worth up to 40,000 crore rupees. Turkey and Azerbaijan continue to face backlash in India for supporting Pakistan. Traders body CATE decides to completely boycott all trade and business relations with the two nations. In Turkey, shares of baggage handler Chalabi crashed 10% after India revokes its security clearance. Sources say Chalabi's employees will be absorbed by other ground handling companies after the 19th of May. Vodafone Idea urges the government to support its funding attempts, says banks have not been forthcoming despite a 26,000 crore rupee equity infusion and the government becoming a 49% shareholder. Warns it may have to file for insolvency, adds this will result in heavy losses for the government. RBI board is likely to meet on the 23rd of May to consider a dividend payout to the government. Economists tell CNBC-TV18 that this year's surplus transfer may top 2.5 lakh crore rupees due to forex operations and bond purchases. More financial irregularities come to light at IndusInd Bank. An internal audit report flags 674 crore rupees being incorrectly recorded as interest income in the bank's MFI book. Also identifies unsubstantiated balances of 595 crores under the header Other Assets, which the bank have offset against other liabilities in January. President Trump wraps up his 3-day West Asia visit by signing a flurry of deals worth over $200 billion with the UAE. The three-nation trip has yielded deals worth over $2 trillion for projects in areas that include defense, aviation, and artificial intelligence. Israel steps up its military operations in Gaza and the West Bank after U.S. President Trump refloats his idea of changing Gaza into a freedom zone. Reports say over 120 Palestinians have died in the attacks in the last 48 hours. Delegations from Russia and Ukraine get ready for the first face-to-face peace talks between the two countries in 3 years, but hopes of progress are low. Ukraine's President Zelensky refuses to attend after Russia's Putin spurns his offer for an in-person meeting. Let's go straight to the top story this evening. India and Pakistan have decided to extend the stoppage of military action, but Operation Sindoor is not over yet. That's the Indian point of view. The Indian Army has said that confidence-building measures to reduce alertness will continue. Defence Minister Rajnath Singh visited the Bhuj Air Force Station to review operations. Bhuj is one of the military sites that Pakistan attempted to attack last week. The Defence Minister warned that India has kept Pakistan on probation until its behaviour improves. He's also called upon the IMF to reconsider providing financial assistance to Pakistan as it has again started to rebuild its terror infrastructure.
निश्चित रूप से इंटरनेशनल मॉनेटरी फंड से आने वाले $1 बिलियन के बड़े हिस्से को टेरर इंफ्रास्ट्रक्चर को फंड करने में इस्तेमाल होगा, ऐसा मेरा मानना है। इसलिए मैं मानता हूं कि आज के समय में पाकिस्तान को किसी भी तरह की आर्थिक सहायता टेरर फंडिंग से कम नहीं है। भारत यही चाहेगा कि IMF पाकिस्तान को अपनी $1 बिलियन की असिस्टेंस पर वह पुनर्विचार करे।
Minister there asking the IMF to reconsider its $1 billion loan to Pakistan. Now, Network 18 learns that the centre is reportedly planning to send a delegation of MPs across parties to major world capitals to make India's case against cross-border terrorism from Pakistan and articulate our stance on terrorism. The Congress Party has expressed its support for the move. Let's listen in to Jairam Ramesh.
सरकार की ओर से अगर कोई इनविटेशन आता है, कोई मांग आती है कि एक बहुदलीय प्रतिनिधिमंडल में कांग्रेस पार्टी भी शामिल हो, हम ज़रूर शामिल होंगे और जो कुछ हमें करना है हम करेंगे। राष्ट्रीय हित सर्वोपरि है।
That's the Congress Party's Jairam Ramesh. Now, A CNBC-TV18 exclusive. India's defence budget is expected to be hiked next fiscal to bolster the country's arsenal. But here's what we learned. The defence industry is expecting replenishment orders worth 30 to 40,000 crore rupees. Parikshit Luthra joins us now with more details. Parikshit, many thanks for joining us. You know, we cannot preempt what the defence budget is likely to allocate towards spending. But what are we picking up in terms of estimates on account of Operation Sindoor? What has been used and what needs to be replenished?
You know, let's start with where things stand as of now. As far as the FY26 union budget was concerned, the defence outlay was 6.8 lakh crore, 9.5% up from FY25. The capital acquisition outlay there was around 1.8 lakh crore, up 4.5% compared to FY25. Now, both these figures are likely to go up significantly. We will also see diversification. Currently, India's imports from Russia, which has been the traditional mainstay supplier of India, are about 36%. We have been diversifying. Today, US and France account for 45% of our defense imports. Having said that, in the next few months, as a result of Operation Sindoor, we expect, and this is coming from different sources in the industry, that there could be orders to replenish our ammunition stocks, weapon stocks, and this could be in the tune of anywhere between 30 to 40,000 crores. The defense budget also likely to go up, especially for indigenous acquisition. What sources and experts tell us, it is very important for the government to focus on low-cost ammunition, alternatives to scalp and hammer missiles, which are expensive, and India should have a local supply chain. At the same time, we should be buying more drones, more AI-powered drones, which reduce the role of ground forces, and more stealth technology as well. So more drones, more high-tech technology, also more low-cost intelligence ammunition, foilish penetrating radar. This is the kind of wish list that is coming from experts and the industry, and this is going to be the likely push area for the government as well in the coming months.
Parikshit, many thanks for joining us. And let's stay with the defence theme. Now, what we are seeing is in terms of defence stocks. After Operation Sindoor, we've seen the might of the Indian military and Made in India arsenal being showcased. Top companies, including PSUs and private players, have added over 1.5 lakh crore rupees to their market cap since the 7th of May, with their stocks gaining anywhere between 15 and 40%. Surbhi joins us now to take us through the self-reliance story of India's defence sector and whether this is a coming-of-age story for India's defence industry. Surbhi.
Operation Sindoor has literally announced the coming of age of the Indian defense manufacturing ecosystem. And it's an ecosystem that has a lot of private sector players and, of course, the big PSU giants. Let me start by telling you about some of the weapon systems that were deployed in Operation Sindoor. We're talking about, of course, the missiles, the medium-range surface-to-air missiles, MRSAMs as they're called. Bharat Dynamics is a very key player here, not only when it comes to manufacturing these missiles, but it's a full systems integrator, and it played a huge part. The Akash weapon system, which we all know, which was critical in Operation Sindoor. This is a weapon system that has suppliers, across a long supply chain. So when it comes to the outer shell, it was manufactured by a company called Paras Defense. When we're talking about the warheads and the initiating systems, then Solar Industries was the name that was in play. And once again, Bharat Dynamics was the key systems integrator over here. The Nagastra loitering munitions, this was a war that was fought in the sky with drones, and the anti-drone systems came into play as well. And here, Nagastra 1 and 2, which is what Solar has been manufacturing, that was, in key play. I want to talk about some numbers as well, the size of the opportunity in the industry. The projected estimated output by the Indian defense sector for FY25 is 1.75 lakh crore rupees. That number is expected to swell, or was expected to swell, to 3 lakh crore rupees by FY29. But a lot of analysts that we've been speaking to say that these targets will be hit much earlier now because the production is being ramped up, because companies are running on double and in some cases triple shifts. So all of this is getting accelerated. 193 contracts signed by the Ministry of Defense in FY25, and a whopping 92% of those actually went to domestic suppliers. By value, this is number of contracts. By value, 80% of the contracts by value actually went to local manufacturers. So that's really saying something about the extent of our Atmanirbharta. I just want to quickly talk about some of the names here. Many of them you already know. Bharat Dynamics, like I said, when it comes to missile systems, and it's right up there. It's also a key systems integrator. BEL when it comes to defense communication and electronics. It's a big player in the, of course, in the Akash New Age weapon system, land-based radars, naval systems, tanked armored vehicles, and all the electronic systems that go there. BEL plays a part. HAL needs no introduction, whether it's the Su-30s or the other aircraft. It recently won a massive order, HAL, 62,700 crore rupee order for the light combat aircraft that it will deliver both to the Indian Air Force as well as to the Army. And then, of course, Mazgaon Dock, Garden Reach Shipbuilders, Cochin Shipyard, the frigates, the destroyers, the corvettes, all of them being manufactured locally right here in India. But it's not just the PSUs. The private sector players are really, notching up the game as well. Of course, there are giants like Tata Advanced Systems, which are, into a range of weapon systems, whether it's launchers, artillery gun systems for the Akash surface-to-air missile systems. There's also the, advanced towed artillery gun systems, the ATAGS as it's called, and of course, a range of other optronics, radars, etc. Solar industries, like I mentioned, when it comes to warheads and bombs, then this is a key emerging player. In fact, whether you talk about missile systems like, BrahMos or many of the others, the Pinaka multi-barrel rocket launchers, Solar is a big player in a lot of these projects, and it's a big supplier. Astra Microwave, big name when it comes to radars and electronic warfare systems. And then there is Paras Defense as well. Again, the rocket and missile programs, warfare, surveillance, naval systems, tanks, and armored vehicles. This is not a fully exhaustive list, by the way. There are many other companies, many other SMEs as well. But the entire ecosystem when it comes to defense, self-reliant manufacturing, indeed thriving now in India.
All right, Surabhi, many thanks. That's India's defense story. But the other big story that we're continuing to track here on CNBC-TV18, shares of Chelbi plunged 10% on the Istanbul Stock Exchange. This a day after the Indian government revoked security clearance of Chelbi's Indian subsidiary. Now, what will this mean for the company's employees in India? Madiha joins us with the latest details. Madiha, what does this mean for airports who are in business with Chelbi? Airports like Mumbai, Delhi and others have decided to cancel their contracts with Chelbi and move ground handling to other service providers. Take us through what's happening on the ground today.
Well, soon after the government's notice, all the concerned airport operators issued statements announcing termination of contract with Chelbi. The Civil Aviation Ministry announced that all employees working with Chelbi will be transferred to other ground handlers at the 9 airports. We learned from sources that airport entry permits for Chelbi staff will continue to be valid until the 19th of May, after which the Bureau of Civil Aviation and Security will issue new permits to these employees under their new employer. But these are around 10,000 employees who handled nearly 160 flights daily across these 9 airports, which is Mumbai, Delhi, Cochin, Kannur, Bangalore, Hyderabad, Goa, Ahmedabad and Chennai. So issuing entry permits on the new employer's name may take more time, and BCAS may have to extend the validity of the existing permits of these 10,000 employees. Now, Chelbi provided key services like terminal handling, ramp handling and cargo handling at the 9 airports. It also operated the cargo terminal at the Delhi airport. So now all of Chelbi's assets, including the staff, are likely to be taken over by the other ground handling companies. Whether the existing one or new, we don't know as yet. As per India's ground handling policy, there has to be 3 ground handling companies at airports where annual passenger traffic exceeds 10 million. So at Delhi airport, the handlers are Chelbi, AI SATS, Air India SATS and Bird Worldwide Flight Services. We learned that Chelbi's ground handling at Delhi airport will be transferred to AI SATS and Bird, while GMR will take over the cargo terminal. At Mumbai airport, the 3 ground handlers are government-owned Air India Airport Services Limited, Chelbi and Bird Worldwide Flight Services. Now, sources say that Mumbai Airport is onboarding a new company, Indo-Thai, to transfer Chelbi staff and assets. Mopa Airport in Goa had Chelbi as the sole player. It is yet to be decided if the operator GMR will take over or some other company will be brought in.
Madiha, many thanks for joining us. That is the latest on the government's decision to revoke the security clearance for ground handling services provided by Chelbi, and now what happens from here on. Indian businesses have also started boycotting Turkey and Azerbaijan after their opposition to India's Operation Sindoor and their support for Pakistan. Traders from 24 states held a conference in Delhi and have decided to halt all trade and commercial engagement with both countries, including travel and tourism. The Confederation of All India Traders has urged the film industry to avoid shooting in these countries. The resolution by the traders also warned corporate houses from shooting promotional ads there. Earlier, the All India Cine Workers Association announced a complete ban on Turkey for film shoots and cultural collaborations. Let's talk about the markets, witnessing huge gains this week with the Nifty and the Sensex up 4%. Each broader markets continue to see large intraday buying. The Midcap index recording its biggest weekly gain that we've seen in the last 2 months, up by about 7% today, 7% this week. The Sensex up almost 4% and the Nifty up 4% as well. Prashant joins us now to wrap up the market action. What a week it's turned out to be, Prashant, for India and for the Indian markets.
It's been a good week, no doubt about it. Broader markets, of course, much better. And remember what we started off with. You know, last weekend, as we go into this weekend, just to remember last weekend, Saturday and Sunday, there was those US-China talks. Monday morning, Asia time, we got news that there perhaps is some sort of a deal, a handshake deal, which is being worked out. Tariffs are being lowered. The tariffs were being lowered to much better levels and the most optimistic expectations. And generally, that kind of has triggered a bit of a risk-on, tactical risk-on kind of environment across the board. And that continued broadly through the course of this week. So I'm not going to go into what happened on Friday specifically, but the week, I think, gives you the real picture. The Nifty is up 4% Friday to Friday. The Nifty Bank is up 3%. The mid-cap index is up 7% this week, and the small-cap index is up 9%. So these are large moves. Now, on the Nifty, you had gains coming through with names like Adani Enterprises, Hero MotoCorp, about 14% on both these, Jio Financial Services and Shriram Finance, which were also strongly higher. The one sector of the week, without a doubt, is defense. Bharat Electronics, 15%, but that's, I mean, smaller than the rest. Garden Reach, 38%, Cochin Shipyard, 37%, Midhani, 31%, Zentech, 27%, Data Patterns 24%, and Paras Defense was up about 23% as well. In the broader market, you know, a few names: Apar Industries, big gains this week, 35%, eClerks 35%, Wrights 34%, Kirloskar Engines 30+, Titagarh, Birla Corp, and Ircon were some of the other names which did very, very well. On the downside, not very much actually. KPR Mills was down about 9.5%, Chambal Fertilizer, Naveen Fluorine, United Breweries, Muthoot Finance, but you know, these are single-digit losses as compared to the massive gains that I pointed out earlier. The big headlines, I mean, I think are still coming out of what the US President Donald Trump wants to do, and I mean, there are so many things up in the air, which I think remains the focus point. I think from an India perspective, will some of the recent discomfort with regards to, you know, the comments made by Trump and potentially the trade deal taking a bit of a backseat, will that be put on once again? I think that is what markets will be closely watching. Back to you.
Yes, we will be watching that closely. And of course, the next round of negotiations between India and the US on the trade front expected to kick off next week. We will head to a break. But up next, Vodafone Idea urges the government to support its funding attempts, warns it may have to file for insolvency. That and more when we return. Cash-strapped Vodafone Idea has urged the government to support its funding attempts. Sources have told CNBC-TV18 the company says that if it fails to receive support from banks and the government, it will have to file an insolvency plea in the NCLT, impacting more than 200 million subscribers. Ashmit joins us now with more. Ashmit, this continues to be Vodafone's SOS to the government. We've already seen the government become the largest shareholder with a 49% stake in the company. Now, what exactly is Vodafone seeking and why?
Well, just yesterday, we were the first to report that Vodafone Idea has reached out to the highest court of the country, fresh application seeking AGR relief on account of the interest and the penalty burden. Now what we understand is that before reaching out to the Supreme Court, they had also knocked on the doors of the government as a last throw of the dice. In that letter, Vodafone Idea has painted a gloomy picture. Vodafone Idea says that without government support, the company could very well head into insolvency and will not survive beyond FY26. Now, speaking of that letter, in that letter, what Vodafone Idea argues is that without the government support, the banks are not stepping up. Promoters have pumped in 26,000 crore rupees. Banks are not stepping up. That's affecting capex. That will affect the operations. The company will not survive beyond FY26, could head into insolvency. And speaking of insolvency, the letter then goes on to say that this insolvency will adversely affect all stakeholders. And by stakeholders, Vodafone Idea also making a reference to the government, saying that it holds 49% now. It is a partner as far as this company is concerned. That as far as the government stake is concerned, the value will be brought to naught in case Vodafone Idea goes into insolvency. That the spectrum dues that the government is hoping to recover, 1.15 lakh crore rupees, that will also be brought to naught. It will adversely affect over 200 million customers, will affect the Digital India mission. So clearly painting a gloomy picture, saying that the government now needs to step in or else the company could go into insolvency. The government, importantly, however, on its part, believes that its hands are tied on account of the Supreme Court's AGR judgment.
Well, that's essentially Ashmit's reporting that Vodafone Idea says it will move the Insolvency and Bankruptcy Court if the government doesn't step in and provide further relief in terms of waiving those AGR dues. It's also moved the Supreme Court. Another CNBC-TV18 exclusive, the RBI board is likely to meet on the 23rd of May to consider its dividend payout to the government. Economists tell CNBC-TV18 this year's surplus transfer may top 2.5 lakh crore rupees. In fact, it could even be significantly higher. Sapna standing by with more details. Sapna, take us to the range that economists are working with in terms of what could be another bumper dividend payout by the RBI to the government this year.
Absolutely, and the numbers are really big. They range anywhere from 2.5 lakh odd crores as the baseline number that may be given out by Reserve Bank of India, as high as 3.5 lakh crores. So that's the range that we are talking about. But having said that, let's look at the numbers also. So 2.56 lakh crore odd, that's the overall head that the GOI has kept in terms of dividends from Reserve Bank of India, and also includes dividends from banks and FIs. So if you deduct that, around 220 can be roughly estimated as actually the target that they expect from RBI in terms of a dividend payout. Now, against that, the range that we're talking about is around 2.5 lakh odd crores to 3.5 lakh odd crores. So that is pretty significant. Now, having said that, the reasons that are being still given out in terms of why the number could be again huge for this financial year. Two things. A, the forex operations by the RBI, which have seen a huge jump. And second, their bond purchases also in terms of liquidity infusions that have been happening since the last couple of months. Now, what we are hearing from economists is the fact that, say, for example, in the last financial year, around $150 billion worth of dollar sales had happened, or rather RBI had done. Against that, RBI had booked around 83,000 crores worth of gains. Now, what they are saying is that there has been a 2.5 time jump in the dollar sales done by RBI in the financial year gone by. So keeping that in mind, it's likely that the exchange gains from the dollar sales are going to be massive. So that's one reason, one trigger why the dividend could be again a bumper one. And second, of course, the bond purchases that have been happening in terms of, making sure that there is enough liquidity in the market. Now, economists are also saying that this dividend number will have other implications. basically, it will also ease out the wrinkles in terms of the liquidity situation in the market. They're also expecting that if that happens, then down the line, open market operations can also come down. So let's wait and watch what happens on that 23rd May board meeting of Reserve Bank of India.
Yes, we have a few days to go. Sapna, appreciate you joining us. It is going to be another bumper dividend from the Reserve Bank for the government. That is Sapna's story there. The National Company Law Tribunal has agreed to hear IRDA's insolvency plea against Gensol. The court issued a notice to Gensol to respond to the insolvency plea. Remember, IRDA moved the NCLT citing a default of 510 crore rupees. More financial irregularities have come to light at IndusInd Bank. An internal audit report flagged that 674 crores was incorrectly recorded as interest income in the bank's MFI book. This error was rectified by the 10th of January this year. The department also identified unsubstantiated balances of 595 crores under the header Other Assets. This amount was offset against other liabilities in January. President Trump has concluded his first official tour to West Asia, bagging investments claimed of more than $2 trillion. Hailed the Gulf nations for their deepening ties with the US, Trump has made his last stop in Abu Dhabi, where he participated in bilateral meetings at the presidential palace. He announced deals more than $200 billion during his visit today.
Donald Trump's Gulf tour took him to the United Arab Emirates on Thursday, and the visit was marked by the signing of more deals, valued in all at $200 billion. That followed a pledge by the UAE in March to invest some $1.4 trillion in the US over 10 years. Trump hailed that deal in a meeting with country President Sheikh Mohammed bin Zayed Al Nahyan.
And all I could say is thank you very much. We will work very hard to deserve it.
Among the deals announced Thursday was another order for Boeing. UAE airline Etihad said it would buy 28 big jets from the aerospace giant, including 787s and 777s. That followed news of Boeing's biggest ever order for wide-body jets a day before, when Trump visited Qatar. Also finalised in Abu Dhabi was a plan for the largest AI campus outside the US to be built in the UAE. Reuters sources said the deal would give the country expanded access to AI chips from NVIDIA. Company boss Jensen Huang was seen conversing with Trump at the palace on Thursday. A White House fact sheet said other deals included a partnership between US and UAE oil firms to expand oil and gas production. It valued that agreement at $60 billion. However, US lawmakers, including Bernie Sanders, on Thursday sought to block further arms sales to the country. That's over allegations that UAE forces are involved in Sudan's civil war.
Well, that is President Trump's visit to the Middle East. US House Republicans have proposed a law which would impose a tax of 5% on all remittances sent outside the country by immigrants. The House aims to pass the immigrant remittances bill by the 26th of May. India is the world's top recipient of remittances, with $83 billion sent from individuals in other countries annually. If the law is passed, for every transfer of 1 lakh rupees, 5,000 rupees will go to the United States federal government. And that could be a hit there as far as the Indian diaspora is concerned. That is expected to be taken up around the 26th of May in the US. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. Porter generates returns of over 1,200 crore rupees for Peak 15, which recently exited its investment in the firm. Reports suggest that the exit marks a 11 times return on the 116 crore rupee investment made across multiple rounds by Peak 15.
Disposable hygiene firm Nobel Hygiene bags $20 million from Neo Asset Management. Proceeds will be used to increase the firm's penetration in adult diaper market and expand its distribution network.
Shiprocket launches India's first MCP server for e-commerce shipping. AI agents can now create, track and manage shipments with just one command. Enables businesses to automate logistics with natural language commands.
Fortnite goes offline on iOS globally after Apple blocks a relaunch attempt. Epic Games says the game will remain unavailable on iPhones until Apple lifts the block. Move comes after Epic tried to reinstate Fortnite on the US App Store following a court ruling on in-app purchase commissions.
Plagued with lawsuits and allegations of harming users' mental health, TikTok to launch an in-app guided meditation exercises and other well-being features aimed at young users.
Those were the headlines that we're tracking for you this evening. But on What's Brewing today, 91 Trucks, a full-stack platform for used commercial vehicles, has just raised $5 million in a Series A round led by Arkam Ventures. The startup is betting big on India's booming logistics sector, aiming to transform how small fleet operators buy, finance and manage used trucks. With plans to expand its physical footprint and double down on technology, 91 Trucks is positioning itself as a key player in a $50 billion market. Joining me now to discuss this further is Siddharth Sharma, the co-founder and CEO of 91 Trucks. Siddharth, thank you so much for taking time out and being here with us on Startup Street. You know, you've described this as a full stack platform for used trucks, right? If you could sort of break that down for us and what it means for a used truck buyer in practical terms, and sort of explain to us what you have on offer.
So let me give you an overall perspective of what 91 Trucks is all about. We started 3 years back. The larger aim was to have a platform where people can not only research about new commercial vehicles, but also get a very trusted platform where they can actually go and research and buy and see different types of used commercial vehicles as well. Today, this segment is pretty much broken. We don't have a used, if I may say so, structured dealer who sell a trusted vehicle to the retail buyer whom we are actually targeting at, right? So we have two set of buyers. We have a fleet operator who typically runs a fleet of 5 to 8 vehicles and he wants to expand his business. And we are also targeting a DCO, a driver cum operator, which is a very big segment now because as we all know, this industry has seen a significant growth of load aggregators and last mile mobility, where there is a lot of business being generated. And these drivers today have an aspiration of becoming a micro entrepreneur. And this is what 91 Trucks is all about. As a platform, yeah, go ahead.
Yeah, and if, we'll get into further details about what the company exactly does. But if you could, sort of tell us, you've just raised this $5 million in a Series A funding. What are the top priorities that this capital will be deployed towards?
So there are two things on which this capital will be used for. One is we would be doubling down on our retail outlet footprints. We started only being available in Delhi NCR when we started this business 3 years back. But now you would see us expanding across different parts of India, including west as well as east part of the country as well. The idea is to have, as I said, the pan-India presence. And also we would getting into a new set of businesses as well. For example, we would be getting into the financial segment of the business as well, because commercial vehicle used finance is a very important enabler for anyone who wants to become a micro entrepreneur and own a used commercial vehicle.
Right. And, you're also targeting 10,000 annual commercial vehicle sales over the next 3 years, right? So what's the roadmap to get there, especially in tier 2 and 3 cities?
Look, the way we are envisaging this whole business is today, if I talk on numbers, close to 1 lakh commercial vehicle gets sold every month. And we believe 1.5 to 2x of used commercial vehicles are being transacted every month. Today, this entire transaction is pretty much unorganized. So as we build up in the next 3 years, one priority would be to build 91 Trucks as a brand where we would want anyone who wants to get into building his own business, or any DCO or fleet operator who wants to buy a used commercial vehicle, which would be a trusted mark by us, finance, RTO, end-to-end full stack model. We would like to be in that space in this market.
Right. And, you also pointed out that expansion, especially to other parts of India, is also on top of your agenda. But also, you're looking at offline expansion as well, right? Yeah. You're looking to add about 20 new stores. How will this play a role in strengthening your customer trust and driving sales? And how soon will we see these stores open?
Look, used commercial vehicle is a touch and feel product. This is not a luxury product which you buy. You basically buy a commercial vehicle because it, in a way, supports your livelihood. So a lot of transaction for us happens offline. As we open new stores, as you rightly said, today we are 7 stores strong, but in the next 2 quarters, we would be in a range of opening another 15 to 20 more stores. So by the end of this financial year, in the first H1, we would be probably in a range of 20 to 25 plus stores.
Right. And access to affordable financing is a key pain point for small fleet operators. So how is 91 Trucks 91 Trucks' financing platform sort of addressing this gap? And what makes your offering more accessible or flexible versus the traditional lending norms?
Look, we are if I may put it, we are a marketplace. So what we have done is we have tied up with across banks and NBFCs. So we have we would have a range of banks and NBFCs being partnered with us in terms of understanding the profile of the user, basis which we are being able to provide loans to every aspect and every profile user who comes to our store and who has an aspiration of buying a used commercial vehicle. The other pain point in this segment has been the documentation. And that is why when we started this business, we were very clear, we want to have a full stack model. Not only we do loan for the user, but we also give him the assurance of the entire paper transfer, which is very important when one wants to run his own business or run a commercial vehicle on the road. And the biggest enabler, we believe, would be our warranty scheme, because once you take a vehicle from us, our relationship doesn't end there. We also give you a warranty product wherein if tomorrow, once you are on the road building your own business, if you face any kind of problem, we are there to support you and help you.
You've also said that, you all have seen 8 times revenue growth over the last 2 years. What has been driving this momentum? Can it be sustained post the funding? If you could tell us what your targets are for this year and where you hope to end this year?
I mean, just to give you a broader perspective of where we are and what number we would like to end, this financial year, we would be in a range of 100 odd crores with an exit ARR of approx 180 to 220 crores. As you rightly said, our revenue has grown by 8x, and a lot of it is being fueled by a lot of references which we are now getting from the market. Because as I said, every user who buys from us is our reference point. He is actually promoting 91 Trucks to his colleagues, to his friends, to his industry. And this is where we want to double down as a brand, which would have a lot on trust as we build this business.
Right, absolutely. And if you could quickly tell us, how do you plan to differentiate, as competition in logistics, tech and used vehicle platforms intensify? If you could quickly tell us that.
Look, today, commercial vehicle as a segment hasn't seen the level of growth which we all have seen in used car as a segment. We believe this is a complete white space where people are looking to have new technology in terms of researching as well. So we are building a lot on the AI technology, where anyone who wants to buy a new commercial vehicle can come on our website, and we would give them the exact information based on the kind of work he wants to do with that commercial vehicle. Apart from that, access of loan online. I think as the evolution in this segment would happen, a quick loan will be a reality in this segment as well in the used space. And this is where we would like to work with banks and NBFCs and create a product where anyone who wants to own a used commercial vehicle can get a loan in maybe 10 minutes.
Oh, all right, Siddharth, we're completely out of time, but thank you so much for joining us on Startup Street today, and we wish you all the best on your journey going forward.
Thank you so much. Pleasure being there.
All right, moving on. On the hot seat today, we have a startup that is giving the humble samosa a bold new identity. From science labs to snack counters, Samosa Singh is redefining Indian street food one crispy bite at a time. With a growing footprint across India and fresh launches in Delhi NCR, this snacking brand is on a mission to become India's snack king. And to tell us how, joining me now is its co-founder, Shikhar Veer Singh. Shikhar, welcome to Startup Street. Now, you already have a presence in Hyderabad, and now you have launched new outlets across Delhi, NCR. What's your broader vision for this market over the next year, and how many more stores are in the pipeline?
See, India is a big country, and to just give you a number, that we sell about 6 crore samosas every single day in India. So people do that. So there is a huge appetite for samosas across India. So currently we are present in 4 states, Delhi, NCR, Hyderabad, Bangalore, and Chennai. And this year we'll be focusing majorly in these areas. We want to go deep down in these and saturate the market, and then go to the other cities. And we'll be opening roughly around 50 to 60 more stores this year. So doubling down from the current count of 50. So we'll be reaching about 100.
All right, so 50 to 60 more stores by end of this year. Shikhar, you described Samosa Singh as a brand offering guilt-free indulgence. Tell us, how are you reimagining the traditional Indian snacks for today's health-conscious consumer?
See, I always believed, traditional Indian snack has always been a healthier option if done in a right way, because I still have my memories from where grandmother used to prepare and we used to enjoy. And see, this snack has been in the little, bad limelight just because it is unorganized right now in India, and it is being prepared by the street food vendor, where they don't put major effort in, maintaining the health perspective or taking on the good quality checkpoints in the, sourcing of the material. But at Samosa Singh, we have taken a very well, on these quality checkpoints. So we, like, just for example, using, employing a no palm policy. So we use only sunflower oil in all our products, and sourcing the material from the right places, from the right vendors, that procuring vegetable from the farmers. So all these steps help us maintain the consistency, hygiene, quality in the product. Plus also we have a ISO certified facility in Bangalore where we do.
Okay. All right. So, Shikhar, samosas are deeply nostalgic, and, like you mentioned, you've successfully modernized them along with a diverse menu of chaats, kachoris, and more. How do you strike a balance between innovation and tradition, and what does your product development process look like?
So we always, we started Samosa Singh with the aim of being innovative only, because this snack is something which everyone knows. So if there is no innovation, there is no twist in the, the product. So we have a big NPD team in our, in Bangalore. So currently we focus majorly on the, on how to be innovative. So especially in the samosas, like we are the first one to automate the samosas, and our crust being the differentiating factor, where it's more crispier, it absorbs less oil in comparison to the other which you get on the roadside. And very soon we'll be, launching a version 2.0, where we have different fusion of varieties, Western and traditional combination of things, where we calling it as a launch platform as 2.0.
Okay. You also often call Samosa Singh India's emerging snack king. How close are you to that crown? Give us a sense of your current growth trajectory, profitability, and the scale of operations. Like you mentioned at your Bangalore manufacturing unit, what kind of daily volumes are you managing?
So in terms of, scale of operation, we have about 1 acre facility in Bangalore, which we have recently opened. And we do roughly around 5 tons of material every day output on daily basis. And in terms of growth trajectory, we have been growing so far well. So we are doubling down every year in terms of the, top line. And the major focus this year is going to be on the profitability, as we are inching toward that. So last year also we were EBITDA positive. So this year we are aiming to be a PAT positive company.
Sure. Your QSRs cater to both dine-in and delivery customers. How are you ensuring a consistent brand experience across physical outlets and platforms like Swiggy or Zomato? And what is the current revenue mix between online and offline channels?
See, currently we are about 50-50 revenue mix, but we intend to go more to offline channels to about a 70-80%. And in physical outlet, it's relatively easy to maintain the things, because you are in front of the customer, people take care of all the aspect. But when it comes to the online deliveries, it becomes a little challenging, because your food has to travel 5 kilometers from the stage of preparation. So we have done certain checkpoints there as well, like right kind of packaging and how it has to be assembled. and also at the front store level, we have done certain things where, you know, we portion the product. Basically, whenever somebody has to prepare, they don't need to put their brains in that. It's a simple assembly process and the product is ready.
All right. You know, Shikhar, one final question before I let you go. You've built a strong brand recall and customer base. What's next on the horizon? Are there plans to expand internationally or expand into new food categories? Also, will you be actively looking out for funds to fuel your next phase of growth?
See, until now, our major focus was on, you know, establishing the brand in terms of operational finesse. And now going forward, we have two major focuses. First, obviously, we are going to test out in the franchisee mode to scale the brand very rapidly across the geographies. And international expansion, we have already started this year with 2 countries in UAE being already served. And so we see, you know, samosa is, you know, it's called as an international snack. It's a king of snacks. So we believe like this has no boundaries. It can go to, you know, any places in the world and being savored equally well like people do in India.
All right. On that note, we'll have to wrap up our conversation. But Shikhar, many thanks for joining us on Startup Street today and wish you the very best for all your growth plans.
Thanks a lot.
On that note, it is time for us to head into a short break. But coming up next, India's private equity and VC market rebounded to $43 billion in 2024 following 2 years of decline, according to a Bain & Company report and the Indian Private Equity and Venture Capital Association. We'll break down all the key highlights in our next segment, Investor Eye. Stay tuned.
Well, after 2 years of contraction, private equity and venture capital investments in India recovered in 2024, rebounding 9% year-on-year to reach about $43 billion. Now, this resurgence was primarily driven by VC and growth investments, while private equity deal-making held steady, according to a Bain and IVCA report. Now, VC and growth investments surged 40% to nearly $14 billion, and that was fueled by a sharp rise in deal volumes. India also strengthened its position as the Asia-Pacific region's second largest PE VC destination with a 20% share of the total investments. For more such insights from the report, joining me now are Padmanabh Sinha, former chairperson IVCA and managing partner and co-founder at Launchpay Capital, as well as Aditya Shukla, partner Bain & Company. Gentlemen, thank you very much for your time here on CNBC-TV18. Aditya, to start with you, venture capital growth investments surging 40% last year. What were the key triggers, and will this trend sustain in 2025, you think?
Thanks, Ritu, for having me here. So look, I think it's been a very strong secular trend that we've seen on the VC and the growth equity investment side. Last year was 40%, but even in the years prior to that, we've seen strong growth. I think our view is that broadly, if you look at the startup and the growth equity ecosystem, the macro still continues to hold true. There are a bunch of policy reforms which have also helped the market. And there are some, fantastic companies and entrepreneurs, both in the VC and the growth equity space across different sectors, whether it's consumer, whether it's manufacturing, whether it's healthcare. So they've managed to attract, capital from different funds. So in our perspective, I think that is a trend that is here to stay and that should continue.
All right, you expect that trend to stay, but Padmanabh, India achieved record domestic fundraising as well, despite what's going on globally in terms of private equity headwinds. What made the India market resilient, and also what happens now? How will global sentiment shift towards India in light of the conflict that we're seeing?
Thank you, Ritu. As you said, the local investor base in India is now emerging as a high growth segment, albeit from a very low base. So historically, unlike countries like China, India didn't have much of a local investor base. What we are seeing is new institutions emerging. They are the ones like NIF and SIDBI. They are sort of life insurance companies, some fund of funds, and family offices, which are increasingly taking greater interest in alternatives on its asset class, which is good because they were highly underrepresented amongst Indian investors. And I think you'll continue to see that grow from a low base, particularly the more sophisticated institutional investor base grow as they seek to diversify their assets beyond traditional fixed income, public markets, etc. On the international front, I don't think hopefully the current issues are temporary. They don't matter. Private equity tends to be a very long-term asset class.
Okay. So private equity will take a long-term view and not be impacted by the current conflict. But Aditya, buyouts accounting for over half of the PE deal value, does that to you signal a long-term shift in the fund's strategy towards control deals? Or, how do you think this might impact asset pricing and competition?
No, I think it's, I think buyouts will continue to be an important part of the market. I think part of this is that you do have growing investor confidence in the Indian market, right? And as that continues to evolve, you do have quality assets that are available from a buyout perspective. One is, I think, buyout funds have also raised larger funds either for India or, as Padmanabh mentioned, a large part of their APAC capital raising has been also deployed in India. So the dry powder exists.
Sure. Padmanabh, quickly, with public market exits also rising to 59% of exit value as per your report, and IPOs, of course, gaining traction, how does one ensure this momentum remains a reliable exit path for investors from a stakeholder and a regulatory point of view?
A good point, good question, Ritu. I think capital markets by their nature tend to be cyclical, and I don't think one should assume the resilient strategy would be to have a good mix of exit options between capital markets, trade sales, which is sales really to financial investors and other private equity investors, and strategic sales. And historically, actually, India has been fairly balanced between the three modes of exit. Of course, some of the larger deals have been exited off capital markets, either through IPOs or post. But there's bound to be some changes on that front. In fact, in this financial year itself, one of my former portfolio companies, Ather, has just broken the IPO jinx by being the first IPO of this financial year. So I don't think you'll see the same level of activity that you had on the IPO markets last year.
Yeah, well, that is always the case. But Aditya, quickly, the report highlighting aging assets, slower exit cycles for large buyouts. How are funds coping with internal return pressures, and what strategies could we see in response?
So, look, I think great question, Ritu. I think, and this is why you are seeing a surge in the exit volumes, right? I think there is, if you look at priorities for a lot of the funds, especially of the older vintages, I think there is a priority to exit, right? I think the good thing is that the Indian market now in the last 3 or 4 years has shown that we do have a very robust ecosystem, and which is the reason why you are seeing exit surge across, right? Public markets obviously last year was 60%, but even if I look at strategic sales or sponsor to sponsor sales, I think that's also been a significant part of the market. So for a lot of the funds, I think as you rightly said, they are focused on individual companies. A lot of them are actually starting that entire kind of exit or the pre-IPO process a little earlier. So definitely remains a priority, and I think it is good for the ecosystem. As you see more exits, there will be more investor confidence, and as newer funds come up and raise more capital for India, one of the big things that they really see is, has this market provided exits for the other investors? And that answer is
Well, yes. Finally, since we're running out of time, Padmana, very briefly, when you look at 2025, we're one quarter in. What do you expect to be the big themes, the big sectors? What will you watch out for in terms of private equity and venture capital trends in India?
Sure. Ritu, as I mentioned earlier, we in private equity are used to seeing long-term, beyond a quarter and a year. So I can tell you what I read of like 3-year trends based on current knowledge. So the first point I would say is India is definitely becoming a much more sophisticated and diverse market. So if you see from the Bain report itself, you have more than $40 billion of investments, more than $30 billion of sales or exits. So what's happening is across the various categories, venture, growth, buyouts, you're seeing greater size and scale in India. And that allows sophisticated players which are segmented, which focus on either venture, growth, or buyouts to emerge, which is great news. One last point on your previous question on exits. There's a new sort of form of exits, which is in the form of secondary funds, which is also emerging, in addition to the exits that are already there. So they are funds which are focused on providing exit or liquidity to existing private equity investors as well, and that's an additional form of exits that's emerging in India.
All right, it is Friday and it's time to take stock of all the startup deals that happened over this week. The week saw 16 deals worth $151 million. Let's take a note of some of the notable ones. B2B e-commerce platform JSW One bagged $40 million from Principal Asset Management and others, while dry fruit seller Farmly raised $40 million from L Capital Asia and DSG Consumer Partners.
And that's not all. Cancer care startup Complement One filled in their pockets with $16 million from Owl Ventures, Bloom Ventures and others. Mixed reality publishing platform Flam got $14 million from RTP Global and others. Last but not the least, ice cream brand Hoko scooped in $10 million from Sauce VC and others. According to Venture Intelligence, this year saw a total of 339 deals worth $2.9 billion till date.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. This week, we are going to put the spotlight on investing in global equity markets via global funds, or you can call them international funds. Now, mind you, these are funds that are being run by Indian asset managers. So why do you need to look at these funds in the first place for your portfolio? What is their taxation structure? And what funds could perhaps be suitable for investors given the risk appetite and the risk-taking ability? Well, this is what we talk about, and to help us demystify this world of international investing, we have with us Nasir Salim of Flexi Capital and Niranjan Avasthi of Edelweiss Mutual Fund. Gentlemen, great to have both of you on the show. Thank you so much for joining in. And I thought perhaps it's an apt time, right? Because I don't think we've seen so much of volatility in the Indian market, in the international market. The headlines are changing by the minute. And you realize that perhaps for an involved investor, it might make sense to have some exposure to shores that go beyond India as well. So let's get your opening thoughts. Niranjan, you folks at Edelweiss have so many of these global funds, from China to US tech to I think even Europe, right?
Yeah.
Why should one go global?
Yeah. First of all, thanks, Surabhi, for having me. Broadly, over the last 2-3 years, we have seen huge traction for investing globally. And, especially in last 1 or 2 years, when we have seen global markets, Indian markets going through volatile times, it is very, very important to study this category and take exposure. 2-3 reasons, One, if you see last 10 years, India has been amongst the top 3 performing markets maybe 3 to 4 times. US has been there 6 times and China has been 2 times. Now, if you want these winning markets to be in your portfolio, you need to invest beyond India. And if you have them, it's basically easier to navigate, cycles in the market. The second is, if you see India as a market cap, contributes maybe 3 to 4% in the MSCI World Index. It's broadly 3-4%. US, on the other hand, is roughly around 65 to 70%. China is around 14-18%. Now, if you look at a portfolio, you can't ignore a large cap in your portfolio, right? From a market perspective, these are large cap names, or these are large cap nations out there which you need to have in your portfolio. Second, if you see the top 100 market cap companies in the world, 50 plus are from US. Only 2 are from India, and maybe 16 are from China. Now, again, you can't ignore these, heavyweights, big global companies. And for all these, you need to invest globally. Last, but very important, you need to build some dollar assets. If you see our INR against dollar over the last 30 years, it has depreciated every year by 3 to 4%. In last 10 years, US S&P 500, if you see, has given somewhere around 12.75% returns, whereas in INR terms, it has given 16%. So 3.25% return just adding up just because of INR depreciation. So these 3 are very, very important reason why you should have some exposure to global.
Oh, I can't argue against any of those 3 points. They seem perfectly logical, actually. Let me ask Nasir as well. Nasir, your thoughts. And, the thing is that now that everybody has access to information, typically it ends up being a bit of fad investing. When the NASDAQ is going up, you see people want to invest in NASDAQ and they want to invest in NVIDIA. When suddenly there is a boom in China or some stimulus in China, everybody starts talking about China. But there has to be better reason and scientific logic behind looking at global funds, right? What would you say?
Good morning. Thank you once again for having me back on your show, Surabhi. Always a pleasure. So, great question again there. I think, there are multiple reasons why global funds need to be part of your portfolio. And I think it stems from the very fact that, the decision starting from the basics of core and satellite, I think that is something which, is one of the main constructs and the reasons for one holding global funds. But I think broadly 4 broad reasons, So the number one is geographical diversification. I think, lowers dependency on India-specific macro cycles, politics and weather-linked risks. So that's one major reason. The other one is access to sectors absent in India. For example, very thin that are only available in India. World-class tech platforms, you've seen FANGs of the world, semiconductor majors, global healthcare, innovators, luxury brands would be, some of these are not available in India to Indian investors. Third, I think, one of the very important factors, while, index and indices keep changing, I think currency hedge is a very, very important factor which needs to be kind of factored in. The INR has depreciated over 3 to 4% per annum versus the USD over the last decade or so. Foreign assets priced in USD act as a natural hedge for long-term rupee obligations, such as overseas education for children, for example. Then there is the entire valuation and cycle, which you just mentioned. US-China bear phases often coincide with rich valuations at home. And owning both of those markets kind of smooth the ride. And Our view is that, for example, I mean, the 2025 market note recommends that one should, in current times, when we spoke about, at least 10 to 15% allocation should be to international funds for precisely these main reasons.
Oh, okay. So 10 to 15% allocation. That's fairly sizable that Nasir is talking about. But Niranjan, let me ask you the same question. I mean, we want to do this scientifically for long-term wealth creation, right? I mean, in and out timing the market, knowing that, okay, China is bouncing in the next 3 months, China will do better than India, and then buying a fund, getting out of it. That I think requires some next level rocket science, market predicting ability.
Yeah.
Now, we don't want to talk about that because not everybody might have that.
True.
Then how can you benefit? And over longer periods, what is the kind of wealth generation that these international funds have given investors?
Right. So broadly, it should be satellite portion of your portfolio, but this satellite portion also needs to be invested in a strategic way, right? Now, Nasir mentioned that 5 to 10% or maybe 10 to 20%, depending on which way you are looking at your portfolio.
Yeah.
For most beginners, maybe 5 to 10% is a good starter to get into these funds.
Okay.
Strategically, if you want to invest structurally, what you need to see is 3 things. One is go for countries which complements India, which are large. Like US definitely is one country where you cannot ignore to have in your portfolio. It's growing. Most innovative companies are coming from US. The market size is huge. That is one. Second is also look for a region, if at all, which again has maybe lower correlation with India.
Okay.
Again, US comes up first because it has probably 0.3, 0.25 correlation with Indian markets, which means when Indian markets aren't doing well, probably US markets along with currency depreciation will add to your portfolios and improve your risk adjusted returns. So strategically select these kind of countries, go for plain vanilla index funds or diversified funds in these countries, and go for maybe SIP and long-term allocation. There are people who want to do it tactically, as you mentioned, forget about US or China. Even in India, it's very difficult to tactically get in and get out.
Yeah.
But if you still want to do it, maybe spot a market which is trading at lower valuation, take that contrarian bet. Maybe China, for instance, last year we gave that call. China was trading at less than 10 forward P.
Yep.
From there, it's up almost 30-40%.
Yeah.
Even today, amongst the top countries or top markets, China is still very cheap. It's below their long-term average in terms of forward P. So China kind of market can be a contrarian market. But again, it's very, very difficult. As you mentioned, you need to time it well. So for most investors, go for a strategic allocation, select a country like US or even maybe China for long-term allocation. These are 2 superpowers we already have. Go for SIP, simple 5 to 10% allocation. I think so you should be done.
Since we're on the subject, Nasir, I have to ask you as well. Let's talk about China and US, these 2 big markets, right? If someone has to make fresh exposure to international funds, would you look at international funds that are investing onwards into China right now and the US?
Absolutely. So, with specific question to US and China, see, as far as US is concerned, US indices have rallied since the tariff war has gradually eased off, right, which we're currently in the middle of it. NASDAQ 6.13, S&P 500 4.9% are close to all-time high levels. Negative 6.13 and negative 4.9%. Staggered approach to a US equity is currently a more prudent strategy. I completely agree. An SIP or an STP does warrant at this kind of point of time. A strong positive is the US-China trade war de-escalating. So it's a very, very strong positive for both US. And as far as China is concerned, we have some very interesting themes which you usually don't get to capture otherwise. So there is energy transition, there's frontier China, but active alpha still exists. And this entire lithium space, I think, opportunities there if you have enough active fund of funds or some index, where we can index funds or passive routes which are available currently, those both can be explored between US and China. Our view, of course, is that currently, until things don't get more clear in terms of, the tariff war, which is kind of starting to de-escalate, until then, we should still feel that there's a lot of opportunity in market-neutral options available, which we can talk about as we go along.
Okay, fair enough. So let's now talk about, the other aspect of this. In the Indian market, when you have decided that you want to invest in international funds, you have to then make the next choice. An active fund, one that's actively managed, where a human being is deciding what stocks will go in that fund, or a passive fund, which will only track an index. It could be any underlying index, like the S&P 500, like the NASDAQ, or many others. Nasir, I know you've done a lot of homework on sort of looking at the buckets and what is available in the market. So tell us, how many funds are there? How many are active? How many are passive? Where are the AUMs greater?
Okay, so before we get into that, so I think currently in the active space, between active and all the international funds that are available right now, we have 66. That's the last count that I have, Surbhi. And out of those, again, we need to check which ones are open currently for subscription for investors. I believe the Edelweiss are all open and available at the moment. But broadly, to answer your question on active versus passive, see, a passive fund basically tracks the index, or it's an FOF into an ETF. FOF is a fund of fund which is investing underlying into ETFs, and those basically track the S&P 500, for example, the Nasdaq 100 or the MSCI China, or other such indices. And 38 of the 66 of these international schemes are currently, which is about 57%, are passive, right? Those are US and China focused, and typically a broad market for holding low cost, no manager risk in a typical passive fund. Now, if you come down to the active fund of funds, we have roughly 28 schemes, about 43% of these, where usually Indian fund by units often oversees the active fund. For example, JPM Global Equity, Schroders is another example, the Global Innovation Fund, which tracks that particular fund. And most of these, again, they capture niche themes, which are not available in India to investors. And that's where we feel there are a lot of active alpha can still be generated on portfolios. So that's broadly it. Amongst the ones which are, by and large open, we have a fairly large list between passive and active. In passive, we have the Mirai Asset, FANG, which is available. It's an ETF plus FOF. We have something on the passive side again, Motilal Oswal S&P 500, which is available. We have the ICICI Prudential Nasdaq 100 Index. In the active space, we have Investco, India Investco Global Consumer Trends, which is doing very, it's actively and it's open at the moment. As I said to you, Edelweiss Europe Dynamic Equity Offshore Fund is there. Edelweiss US Tech Equity Fund of Fund is there. And then on the fixed income side, because that's again something which one can't ignore completely, we have DSP US Treasury, which is a fund of fund, and something which comes in from the Aditya Birla Sun Life Group as well, which is the US Treasury 3 to 10 year bond ETF fund of fund. So again, some of these between active equity, passive equity, and then fixed income.
Okay, so lots of choices out there. But on the active-passive bit, Niranjan, I think this could be confounding for investors, right? You have, like Nasir said, you have 66 funds. Many are active, many are passive. So what should the approach be? I mean, because you're ultimately trusting maybe a foreign, not even an Indian fund manager, right. A foreign fund manager, probably don't know if, what is the underlying portfolio. So is it safer to just, dovetail on an index? Or should you look at some active management as well?
So I think so. Like in India, we also say midway is a better approach. Over here also, specifically if you are investing in US, probably a mix of active and passive makes sense. Go for a FOF active fund, underlying active fund, which has a long track record. Like we have a tie-up with JP Morgan. These funds have been in India for almost 10 years or even more than that, 15 years. Look for an active fund, FOF. Passive, you can definitely go for passive, but specifically if you're going for an ETF and buying it in India, it is very, very important to see whether the ETF is trading at a discount or at a premium. What has happened over the last couple of months, or in fact a year, that because the inflows have been stopped, many of these ETFs are trading at a huge premium. In some cases, the premium is as high as 20%. Now, mind you, even if market gives you zero returns and this premium comes down to zero, your return can be negative 20%. So if you're investing in passive, and unfortunately we don't have any index funds, most of these passives are via ETFs, and ETFs trade on Indian markets, Indian exchanges. They trade at a premium because the underlying is closed.
So you have to just buy in, sell the units of that
only
ETF.
On the exchange.
So you're already paying a premium.
Already paying
to
a premium.
the underlying NAV.
The moment the underlying fund flows open up, this premium can come down. And we have seen premium hovering from 10% to 30%. Sure. So be very mindful if you're picking for a passive. My bet today would be go for a simple active FOF, which doesn't have this issue for retail investor. Go via SIPs and all, and don't worry about all this.
Okay. Fair enough. We do have to take a very quick break on that note, but we'll come back on the other side to discuss the other important aspect, which is taxation. A lot of the international funds now enjoy better, favorable taxation compared to where we were historically. But still, how does that eat into your returns? What should be your return expectation? We'll discuss that on the other side.
Let's talk money. Let's talk money.
Welcome back. This week we are discussing how you can take advantage of global equities, international equities, via the Indian mutual fund route. And as we've discussed, lots of options. There are actively managed funds, there are passive funds, but we need to understand the technicalities of that investment now. One thing that we must keep in mind is the best part is that we have to invest in Indian rupees. We don't have to take the pain of the whole exchange rate, whether it's China, US, or any other market that you're investing in. But then there is tax, Niranjan, and we need to understand how taxation is arrived at, because there's capital gains, there could be dividends that companies are giving, or any other formats of taxes. There's TCS otherwise when you're remitting money overseas.
Right.
So I don't know, just explain all the tax layers to us.
Right. So broadly, you have two routes to invest outside India today. One is LRS route, one is mutual fund route. Let's talk about mutual fund route. It's very simple. You invest in an FOF or an ETF. Any capital gains after 2 years is taxed at 12.5%. Anything before that is short-term capital gain as per your tax slab. Dividends, whichever you get from these funds, are taxed as per your tax slab, like any other mutual fund. That's very, very simple. Now, these funds investing in maybe US funds and all, they may attract some withholding tax depending on which jurisdiction they invest, but you don't need to worry about, because everything is built in the NAV.
Okay.
On the other hand, if you're investing via LRS, there are two taxation that you need to be aware. Three, in fact. One is while you are investing, there is a TCS, which is tax collected at source. There is a 20% TCS if you are investing about 10 lakh, in any, whether it is US or China.
That is through the direct. If you're directly going to buy stock, send your money overseas through LRS, then you need to pay this TCS.
This tax. When you invest, and if these companies pay you dividend, there is a withholding tax. If you're investing in US, the withholding tax as per the DTA is 25%. So you need to pay 25%. If you're investing in Chinese stocks, that tax rate is around 10%. So that is second layer of tax. Third layer of tax is capital gain, which is equally, which is similar to what you pay in MF. After 2 years, 12.5%. Before 2 years, short-term capital gain as per your slab rate.
Okay, this
so that's how it is.
It's a little complicated. Let me try and recap. So let's start first with capital gains. Capital gains is what's become favorable for international funds now. So if you're holding on your investment for 2 years, then you have to pay long-term capital gains at 12.5%. And short-term would be less than 2 years at your slab rate, right?
Yes.
TCS, we don't have to bother. If you're going through the mutual fund route, then tax collected as source is not a worry.
No.
What happens to the dividends if $100 is coming as dividends from a US company? Then what is
fund?
In the fund, I'm just bothered about the dividend that I'm getting, along with my return.
So basically, if the fund is investing in a stock or maybe a fund which is paying dividend, then at the fund level, right, there is a withholding tax which the fund pays, or it's deducted at source, and you don't need to worry as an investor.
Okay.
Now, dividend, if the fund which you are investing in, if that pays a dividend, it is equally like, an equity fund in India paying you dividend, it is taxed at slab rate.
Okay.
So you don't need to worry about the underlying paying dividend, you need to pay tax on it. It's not like that.
Okay.
So in fund of fund or a mutual fund route, it is very, very simple.
Okay.
Better to go for a growth option, and in a fund of fund structure, the only thing you need to worry is stay invested for more than 2 years and pay that 12.5, nothing else.
Now, if I'm invested for at least 3 to 5 years in a global fund, what should be the return expectation? For Indian equities, everybody says that 12 to 15% steady state returns, good returns. What about these international funds?
So for US, if you see, I think so, because the way market has been structured in US, it's completely different. It is no more linked to the nominal growth like we calculate in India, because US tech stocks are, just buzzing. They are giving extraordinary returns, which may continue because even today, the earnings growth expectation over the next 10 years or so is above 15-20%.
Okay.
Looking at that, I think so anything between 10 to 15% is a reasonable return to expect. Over and above, you should add maybe 2-3% return from currency depreciation.
Oh, yes, yes.
So whatever return US market gives you, we saw an example 12.75, but last 10 years in INR it's 16%. So I think so same expectation you can take over the next 5 to 10 years. But be mindful because tech stocks specifically are highly valued. There can be bouts of volatility. The drawdowns could be higher.
Yeah.
Better way is to, as Nasir mentioned, go in a staggered way, start an SIP. Even if you're investing lump sum, invest now, start an additional SIP so that even when markets fall, you buy in more.
Okay, got that point. Nasir, coming down to final thoughts then, you've already given us some ideas on the kind of funds that you like, but recap it all for us, the do's and the don'ts and the mistakes to avoid when you're taking this 10 to 15% exposure to global funds in the portfolio.
The question between active and passive, that is something that remains, as one of the main reasons for construction of the overseas portfolio. But clearly, I think, first and foremost, please do not chase returns because of momentum. There are enough changes happening dynamically as we speak. US-China was never thought of that they will come in with a trade agreement so soon, but we see it happening. It's obviously going to ease tension between both US and China. A few weeks ago, we were market neutral. We continue to be market neutral, but US started to look interesting. So don't chase themes basis news flow. You have to be more pragmatic. Look at medium to long term generation of wealth. Number one. Number two, I think very, very important is the end objective, your expectation on returns. I think on international returns, the global fund returns, an investment opportunity vis-a-vis expectation has to be staggered. It can't be lump sum. Please do not look at any money which is lump sum going into any of these funds, because a lot of it is changing dynamically, and we feel that a lump sum approach, staggered approach, and again, currency hedge. I think please make sure cognizant of the fact that your underlying investments are going into an international, into a different currency. Are you adequately hedged or not from an overall portfolio perspective? I think some of these are very, very important. Last but not the least, I think we need to look at whether the funds that you're investing in are those currently open or not, because there are enough regulations in place today which have been brought in by RBI, and in terms of freezing some of those investments, there's partial relief, and what may or may not be open today. So those are again something which need to be very, very clearly looked into when you're looking at the international funds broadly. And I think the last but not the least is, please don't expect superior risk-adjusted returns very quickly. I remember this old saying that it is not the time, but the timing. It's not the timing, but the time spent in these markets. And the same holds true also of international funds and international markets. So I think broadly we focus on some of these, and of course not to forget your taxation impact, which we discussed right now. I think those are again something which need to be factored in when you're looking at international funds between active and passive.
All right, good points there. Thanks for that, Niranjan. Any final tip, word of advice, word of caution to investors as they're getting set on this global journey?
Be measured in your approach. Look for long term, because end of the day, these are also equity funds that you are taking exposure. Don't try to be over smart with the market, because it will, hit back.
If it doesn't work in India, chances are it won't work internationally.
Absolutely. The risks are same. There is no easy way to make money. Be very methodical, and your approach should be staggered way.
Okay. All right, gentlemen, thank you so much. Niranjan as well as Nasir, thank you for joining in and giving us a nice sort of bird's eye view on the whole, piece of international funds. Plenty of choices. And now, as you know, a lot of the funds are opened up in India. At least partially they're open. So you have some choices. You can go out, do your homework, and then decide if you want to invest or not. Thank you very much for joining in. It's a wrap on this edition of Let's Talk Money. We'll see you again with another theme next week.
Let's talk money.
Hello and welcome to this special broadcast. I'm Shireen Bhan. Operation Sindoor is the new normal for India's stance against terror, said Prime Minister Modi as he reset the terror doctrine. His address to the nation on Monday was his first since India's military strikes against Pakistan in retaliation to the Pahalgam terror attack. Prime Minister Modi added that India would not fall for nuclear blackmail and that terrorists and their enablers would be seen as one. He also called Operation Sindoor the Make in India moment for India's defence sector.
न्यू एज वॉरफेयर में भी अपनी श्रेष्ठता सिद्ध की। इस ऑपरेशन के दौरान हमारे मेड इन इंडिया हथियारों की प्रामाणिकता सिद्ध हुई। आज दुनिया देख रही है 21वीं सदी के वॉरफेयर में मेड इन इंडिया डिफेंस इक्विपमेंट्स इसका समय आ चुका है।
Joining us now on the program to talk about where India stands today post Operation Sindoor, the big defence equipment moment. Is this a coming of age of India's defence industry as well as the geopolitical reset that we are currently in the midst of? Sanjeev Puri, President at CII, Baba Kalyani, Chairman and Managing Director at Bharat Forge. Also with us on the show, R. Mukundan, Vice President at CII. Gentlemen, appreciate you joining us here on the program. Mr. Puri, if I could start by asking you, we heard from the Prime Minister in his address to the nation and subsequently when he addressed air warriors at the Adampur Air Base, making it clear that Operation Sindoor is the new normal. It's the new red line for India's response to any future terror activities, whether terror actors directly or enablers of terrors as well. Now, from industry's perspective, how do you respond to what we've seen from the Prime Minister, what we've heard from the Prime Minister, and where India finds itself positioned?
Thank you, Shireen, for having us on the channel. So, first of all, let me start by congratulating the Honorable Prime Minister for his very swift, decisive, impactful, and yet very responsible actions. You know, it started with the targeting of terrorist camps, and then India also responded very effectively against the provocations, caused a significant amount of impact and damage to various strategic sites in Pakistan. So I'd like to congratulate him for the swift action and for demonstrating to the world that India will not tolerate terrorism. It's a zero tolerance. And the new normal, I think, is extremely important because, sustainable growth, quality of life, for them, what is very important is a safe operating environment. And this gives immense confidence to investors and businesses. So the Indian industry really would like to congratulate the Prime Minister, would like to salute the armed forces for their bravery, the professionalism. And I think what is interesting that it has demonstrated the prowess that the Indian defense industry has built over the years. I think it all started again with the
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we are tracking this evening. India-Turkey relations have come under severe strain lately after Turkish drones were used by Pakistan against India post-Operation Sindoor. Now, there are calls for reducing business and diplomatic ties. But what is the current state of relations? Total trade between India and Turkey was roughly $10 billion in FY24, with India exporting $6.65 billion worth of goods and India importing $3.78 billion worth of goods from Turkey. Now, Turkey accounts for just 1.5% of India's total exports. The FDI inflows from Turkey were $227 million in the last 25 years. Indian companies have invested $151 million in Turkey in the last 25 years or so. There are 150 Indian companies registered in Turkey, including Polyplex, GMR, Tata Motors, M&M, Reliance, Aditya Birla Group, Wipro, Dabur. Among the major Turkey companies in India are Limac Construction, Furnas, Sarar, Soktas, Hydromas. Celebi had rights to provide ground services in Mumbai for 10 years and has now been denied security access. In light of Indo-Pakistan tensions, Indian exports to Turkey include cotton, organic dyes, chemicals, denim, steel, antibiotics, mobile handsets, clothing. Indian imports include auto components, marble, textile machinery, handlooms, denim, carpets, cumin seeds, minerals, and steel products as well. India also imported 160,000 tons of apples from Turkey in 2024. There are 3,000 Indians in Turkey. At least 1,850 of them are working across commercial organizations, banks, IT firms, universities. There are also 400 Indian students in Turkey. India has also extended a helping hand to Turkey in times of crisis, most recently during the 2023 earthquake when India launched Operation Dost to help people there. India had set up a field hospital, airlifted 250 personnel to Turkey, and we used 6 C-17 military aircraft to transport relief and rescue equipment. This is also not the first time when Turkey has openly supported Pakistan. In February this year, President Erdogan had said that the Kashmir issue should be resolved through dialogue between India and Pakistan, and also according to UN resolutions, keeping in mind the aspirations of the people of Kashmir. This had led to a lot of angry reactions from India, and the Ministry of External Affairs had said that Turkey's stand on Kashmir was incorrect, biased, and unwarranted. To discuss the latest tensions due to Operation Sindoor, use of Turkish drones by Pakistan against India, we're now joined by Sanjay Bhattacharya, former MEA Secretary, also our ambassador to Turkey as well. Ambassador Bhattacharya, thank you very much for joining us. Let me begin by asking you, we do have very old diplomatic and business relations with Turkey. Having said that, do you feel the kind of reactions that we have seen today about boycotting Turkish goods due to national security, cutting down of tourism, stopping bookings, is this warranted considering that Turkey's stand on Pakistan and Kashmir is something we've always known and objected to in the past as well?
Well, thank you for having me on the show, Parikshit. I think, the fact that Turkey has had a position which favors Pakistan rather than India is something that is not very well known in the public domain. And people have always thought that Turkey was perhaps a relatively friendly country. But I think this has changed very much in recent times. While in the past, when Turkey had secular governments, Turkey did follow a somewhat balanced approach towards India and Pakistan. And although Pakistan was the preferred partner, India was always the more dominant partner, particularly in terms of economic engagement. While the economic dominance of our partnership remains, and we do trade and investments are of a much higher scale than that Turkey has with Pakistan, the political understanding between Turkey and Pakistan has taken quantum leaps in the current regime of Erdogan. And his Islamist ideology has been adopted by Pakistan, which makes Pakistan a very important ally of Turkey. And therefore, we see Erdogan actually echoing the Pakistan line, sometimes even more fervently than Pakistan themselves. So if you look at the kind of comments that came from President Erdogan to Prime Minister Sharif immediately after the Pahalgam terrorist attack, in which he talked of the brotherly support for Pakistan, it was somewhat ill-timed. And then you see the Foreign Office statements, which talked of the Indian retaliatory strike of Operation Sindoor being condemnable. And so condemning that retaliatory strike was, I think, somewhat a little excessive. It was even more than what China did. And of course, it brought up the Kashmir issue. So the kind of angst that we have amongst our people, the public outrage is not unexpected, particularly when we see drones coming from there as well.
Okay. So, Ambassador Bhattacharya, what would be your view in terms of what could this lead to in terms of disruption of diplomatic relations between the two nations? A lot is being considered. A lot is on the table. The trade is minuscule compared to some of India's biggest trading partners. What is at stake?
Well, our economic relations are not as small. Trade above $10 billion. I think the previous year it was about $13 billion. Investments are actually, the two-way investments are about $480 million. There's a huge technology component in this particular collaboration, and we are in a sense linked to supply chains. And so and Turkey is very deeply invested in several of our key infrastructure projects, metros, tunneling, other construction activities. So Turkish companies do play a very important role in India's development path. I think for India at this point of time, and there are, of course, two parts of it. One is the public outrage, which I can understand, and I think they must do what they must do. But I think the other is the official response. And I think there is an official response that is necessary, and I think it should be based on very clear evaluation. We must keep in mind that we have a certain development priority. We are on our way to becoming a major global economy. And part of that is a technology collaboration in which Turkey is a partner. Remember, Turkey probably has a per capita income which is equivalent to that of a middle-income country. And so, it does have certain technologies that we could both benefit from. So I don't think, and besides, the other point that I wanted to make was Turkey is also a reasonable weight in its diplomatic imprint. So what we do should be based on careful evaluation. It should not be knee-jerk. We should not look through the lens of Pakistan. I think Turkey's problem has been, or Erdogan's problem has been, that he's been looking at India through the lens of Pakistan. We should not look at Turkey through the lens of Pakistan, but an independent position based on our national interest, our priorities, and I think we can craft out a certain response approach.
Ambassador Bhattacharya, you're right when you speak about the quantum of trade. We've got about 150. I was just giving an explainer to our viewers. 150 Indian companies, big listed firms such as Mahindra & Mahindra, Wipro, TAFE, all have presence. Tata Group, all of them have a presence in Turkey. If the situation between India and Turkey were to worsen, what could we lose, and how could Turkey react, retaliate, not just economically, but politically and diplomatically?
I think our economic relations are something that we should factor in very closely. If our economic relations are those that do have a connect with the kind of attack or connections that we have seen in the recent past, then I think we should consider whether we continue with that or not. But if it is an element in our national development exercise, our path towards economic growth, we should consider that more favorably. I think we have to take a very nuanced approach. The approach is not so much in terms of economics, because even if we were to stop all tourist traffic to Turkey, the impact that it would have on the Turkish economy would be very minimal. It would probably have a larger sentimental value about telling the Turks about how deeply we feel about it. But if you just look at it in pure terms of economics, that would be very minimal. I think what we need to do is twofold. First, I think we need to step up our diplomatic activity so that we make sure that the kind of statements that Turkey makes repeatedly about its problems with India and our position on Kashmir are blunted so that they don't have much effect. And I think a lot of that has already been achieved. There are very few buyers for the Turkish version of India's policy towards Kashmir or, India-Pakistan relations. I think the rest of the world really looks at it very differently. Along with that,
Ambassador Bhattacharya? Yeah, Ambassador Bhattacharya, one more question. I'd like to understand from you, if you were to explain an Indian viewer, where is the Turkish president actually coming from? Where is his support for Pakistan and Kashmir emerging from?
Right. I think the president of Turkey has a certain Islamist agenda, which he has advanced within the country. In his first half of his rule of over 20 years, in the first half, he actually focused on economic development. And Turkey became one of the rising stars in terms of economic growth and development. It probably has a per capita income which is over $15,000 today. And after that particular satisfaction level was achieved, he turned to another idea, which was of having greater influence of Islam in all aspects of life. And the AK Party has been an agency through which it has continued that. And of course, the religious institutions. Realizing that the friendship of the Arab states around him was not to be taken for granted. They were skeptical about Erdogan's visions of an Islamist agenda. He turned towards Southeast Asia, South Asia, Central Asia and Africa. And in this particular effort, Pakistan, which also has a very similar agenda, became a useful ally. And not just an ally, it became the springboard for Turkey's exercise of this projection. And so that drew a very deep connection. The second deep connection was the Turkish economy, as you know, in recent years had not been doing too well, but there was a shining star, which was the military-industrial complex. And in that military-industrial complex, which is very closely linked to the AK Party, the ruling party, they found new buyers in Pakistan. And so that set up a new relationship with the new elites on the two sides. And the third was a very strong personal chemistry that Erdogan enjoyed initially with Nawaz Sharif and of course, later with Imran. And that has been also a very strong factor. But I think essentially what happened was he found it more convenient to speak Pakistan's line and Pakistan's words in its approach towards India, something that wasn't the Turkish position in the past, which was more balanced and more independent in its assessment of India and Pakistan.
Right, and it also probably plays in with the view that the Turkish president wants to play a bigger regional role, and taking this strong Islamic line, supporting countries like Pakistan, somehow helps that agenda as well. Ambassador Bhattacharya, always a pleasure to have you here on Global Eye. Thank you very much for joining us at a time when India-Turkey relations are at an all-time low. We're taking a short break, but coming up on the other side, President Trump wraps up his West Asia visit by signaling proximity and signing deals worth over $2 trillion for projects in areas that include defense, aviation, artificial intelligence. A special discussion with Talmiz Ahmed, former Indian ambassador to Saudi Arabia, when we're back. Welcome back. You are watching Global Eye. US President Donald Trump has concluded his first official tour to West Asia, bagging investments worth more than $2 trillion. Trump hailed the Gulf nations for their deepening ties with the United States. His trip began in Saudi Arabia, where he signed a defense deal worth $142 billion. With Saudi's Crown Prince Mohammed bin Salman, the kingdom has pledged an overall investment commitment of $600 billion in the United States. Speaking at a summit in Riyadh, President Trump also announced plans to lift sanctions on Syria following the fall of the Assad regime. Trump's second stop on this tour was in Doha, where he was greeted by the Emir of Qatar and other top officials before boarding his motorcade. He held bilateral talks with the Qatari Emir and signed agreements that would generate an economic exchange of at least $1.2 trillion. The biggest highlight of Trump's trip to Qatar was the deal between Boeing and Qatar Airways. The airline has signed an agreement to purchase up to 210 Boeing jets. This includes an option of an additional 50 aircraft. The deal will be the largest wide-body aircraft order in Boeing's history. This is also Qatar Airways' largest order. Trump made his last stop in Abu Dhabi, where he participated in bilateral meetings at the presidential palace. The US president said the UAE will invest $1.4 trillion in America's AI sector over the next decade. He also said that the Etihad Airways would be purchasing 28 wide-body aircraft from Boeing worth $14.5 billion. So big deals on the table and big wins for Donald Trump as well. Let me go across to Talmiz Ahmed, former Indian ambassador to Saudi Arabia and someone who's an authority on the Middle East as well. Ambassador Ahmed, always a pleasure to speak to you. Your thoughts on the big takeaways. Let's start with Saudi Arabia. What has Donald Trump achieved by visiting Saudi Arabia this time around?
We have to take into account what the president's agenda was. His agenda is overwhelmingly domestic. He wants to project himself as a deal maker, as someone who works extremely hard for his constituency, and who is bringing in huge sums of money to boost the American economy. At a time when people have criticized his economic policies, he has shown that he has got all these corporate honchos on his side, and they have all come back extremely pleased with themselves. As far as the Gulf is concerned, we are looking at very huge numbers that have really no relation with reality. These are numbers just thrown up in the air. Very often you hear now, earlier you heard $1 billion, now you are hearing $1 trillion. There is no time frame, there are no specific projects. The kind of agreements that have actually been done are at best memoranda of understanding. What the Gulf was interested in was to flatter this president's ego, make him feel good about himself, serve his constituency so that he remains on their good side in coming months and years. There was no geopolitics in the visit whatsoever. And that is a very serious omission. It is pretending as if everything is normal in the region and that commerce is the only thing that matters when you have an entire region that is looking at very serious crises.
Absolutely, sir. And his visit to Qatar, what has really stood out is the Qatari offer of giving him a brand new plane. And the Qataris have said that this is a very simple government-to-government deal, but this is raising very serious questions by former White House officials and former US government officials as well. What kind of a precedent is this going to set? And what is Qatar actually getting from such an arrangement?
I think this offer is in extremely bad taste. It serves no useful purpose. It is embarrassing to both sides. The president has, of course, shown extraordinary enthusiasm, but he has not applied his mind. And these are serious matters. Does American law allow such extraordinary gifts? There are security issues that have been raised about this aircraft. Has the United States reached the stage where it needs such gifts for its presidential requirements? I think this is seriously embarrassing, and luckily this was not mentioned during the visit itself. We will see where it goes, but I must say that my own view is that nothing will come out of it, and hopefully it will just die a miserable death.
Right. The largest significance of his visit to UAE and Qatar, what have these nations actually achieved vis-a-vis their relations with the United States? What's the victory for them over here, sir?
These three Gulf nations have rulers who are extremely experienced and very wise. They have understood the persona and priorities of their guest. They have recognized that Donald Trump in his second incarnation is not the same as he was earlier. Earlier, he was propelled by, he was insecure, he was at that time inexperienced, he was very much under the influence of certain elements within his inner circle. Much of that has now gone behind that. His focus today is on his legacy. He wants to show people what a great guy I am. And people, of course, have been saying tongue-in-cheek that he really desperately wants the Nobel Prize. The Gulf leaders understood this. They recognize that this man goes in for numbers. And then they threw the maximum possible numbers that you can imagine onto him. They don't have to be linked with anything real. It is just the numbers that count in the coming months. And that is what he will be dining out on for a very long time to come. What have they gained? They have gained his goodwill. They have gained, now the president is on their side. They have gained his goodwill. They will ensure that their needs will be met by the Americans. But frankly speaking, in the absence of geopolitics, there is no strategic content to the visit that I could see.
Right. I'm also going to speak about Iran, sir, because he said that, and he confirmed questions about offering Iran a nuclear deal. And he said that we're close to a deal with the Iranians. What is the signal that he has sent to his allies from the Middle East when he says that, yes, a deal is on the table with Iran and we may have one very soon?
Donald Trump seems to be picking up where he left off. In 2018, he had unilaterally withdrawn from the JCPOA and had promised the international community that he would provide a much better deal. At that time, largely under the influence of the Israelis and Netanyahu personally, he was not able to pursue that at all. The region was left in a shambles. There was no nuclear agreement. Iran was showing that it is moving forward rapidly towards weaponization. Israel was threatening war, and the region was extremely insecure. The folly that Trump committed at that time, under pressure from Netanyahu, is now sought to be corrected. There is dialogue going on. There are already, I think, 4 rounds have taken place. Some more rounds are likely to occur. The president unilaterally announced that they are very close to a deal. I don't think so. Whatever I have read so far, there's some very serious issues still divide the two sides. There is an issue relating to how far the Iranians can go with regard to their nuclear, with regard to their enrichment program. That's a crucial issue. There are issues relating to missile capability. We have some way to go. But he just spoke off turn, saying that, oh, we are very close to an agreement. I don't think they are close to an agreement. However, what has changed since 2018 now, the rest of the region is now desperate for a nuclear agreement. The Saudis and the Iranians have very good relations, as does the UAE. And I think that they have conveyed to the president that from his side, he must do his best. However, his administration is deeply divided. There are hawks in the administration who don't want any deal with the Iranians, who follow the Israeli agenda of no enrichment, no weaponization, no concession as far as Iran is concerned. As far as Trump is concerned, his own position possibly is much more pragmatic, perhaps going as close as possible to the JCPOA as he could go at this stage. But we have some way to go. This issue has not been discussed in the detail it deserved. It certainly did not come up seriously during the visit. So we will have to bide our time and see how things pan out.
All right. My final question, Master Ahmed, would be how should India look at Donald Trump's relations with the Middle East? His visit to Saudi Arabia, UAE and Qatar, also at a time when there is a certain sense of disappointment with the kind of stand that Donald Trump has taken. In fact, his press secretary going to the extent of saying Pakistan thanked the US, but India has not.
I don't think we should get too agitated. We should not. We should show the confidence and maturity that a great nation like India deserves. As far as we are concerned, we have the closest possible relations with every country of the Gulf, and indeed possibly every country of West Asia, except for Turkey, with which we have difficulties as we have now, as was discussed a short while ago. We have good relations, and those are very substantial relations, and they are mutually beneficial. I don't think Trump's impact on this relationship is likely to be significant. Indeed, I think that these are all separate files. The kind of relationship that the countries of the Gulf have with the United States, they deal with defense, and they deal with security, and they deal with technology and investment. They do not impinge on our interests. I think we can go forward in the areas where we can work with each other as through I2U2 or IMEC. Whenever opportunity comes up, we will work together. Otherwise, we have very substantial bilateral relations with all the countries of the region, and we have nothing to worry about in that regard.
All right, so India has nothing to worry about. We stand on our own feet when it comes to relations with nations in West Asia. Very important points there, Ambassador Talmiz Ahmed. Thank you so much for joining us on the program to really break down Donald Trump's Middle East visit and what he really achieved from there. That's all we have time for here on Global Eye. Thank you for watching. Goodbye.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Operation Sindoor sets the Indian defense manufacturing juggernaut rolling. Sources say the government may hike its defense budget next year. Industry expects replenishment orders worth up to 40,000 crores. Defense stocks add over 1.5 lakh crore rupees to their market capitalization since the start of Operation Sindoor. India and Pakistan to decide to extend the stoppage of military action. Defense Minister says India will keep Pakistan on probation until its behavior improves. Prime Minister Modi meets top ministers at his official residence, even as the Indian government considers sending a multi-party delegation to various countries to present India's stance. Turkish ground handling service provider Çelebi moves the Delhi High Court against a revocation of its security clearance by the government of India, says the move will hurt over 3,000 jobs. But sources say Indian airports have begun roping in other service providers to replace Çelebi. The company's shares plunged 10% in the Turkish markets. CNBC-TV18 exclusive. Vodafone Idea urges the government to support its funding attempts as banks have not been forthcoming despite a 26,000 crore rupee equity infusion and the government becoming a 49% stakeholder. Warns it may have to file for insolvency if this continues. The RBI board is likely to meet on the 23rd of May to consider a dividend payout to the government. Economists tell CNBC-TV18 this year's surplus transfer may top 2.5 lakh crore rupees on account of forex operations and bond purchases. Commerce Minister Piyush Goyal is set to visit the US to steer negotiations on the bilateral trade deal. Sources say he will assess the progress made at the delegation level over the last 2 months. He will meet with his counterpart Howard Lupnick and US Trade Representative Jameson Greer. President Trump wraps up his 3-day West Asia visit by signing a flurry of deals worth over $200 billion with the UAE. The three-nation trip has yielded deals worth over $2 trillion, claims the White House. Israel steps up military operations in Gaza and the West Bank a day after US President Trump refloats his idea of changing Gaza into a freedom zone. Reports say over 120 Palestinians have died in the attacks in the last 48 hours. No significant breakthrough in peace talks between Russia and Ukraine in Turkey. The first direct peace talks between the two warring nations in over 3 years lasted close to 2 hours. A source of the Ukrainian side tells Reuters that Moscow's demands were detached from reality. Well, let's start with the market action. The Indian market saw huge gains this week, and what a surprise that's turned out to be given the week that we've seen. The Sensex and the Nifty up 4% each. That's the story that's played out for the Nifty over the week. 4% higher, almost a 7% gain there as far as the Midcap index is concerned. The Sensex up by almost 4% as well. So we've seen a strong close, not just for the day, but for the week as far as our markets go. But the big story that we continue to track, India and Pakistan have decided to continue to extend the military stoppage, but Operation Sindoor is not over yet. That is the India point of view. The Indian Army has said that confidence-building measures to reduce alertness levels will continue. Meanwhile, Defence Minister Rajnath Singh visited the Bhuj Air Force Station to review operations. Bhuj, in fact, was one of the military sites that Pakistan attempted to attack last week. The Defence Minister warned that India has kept Pakistan on probation until its behaviour improves. He's also called upon the IMF to reconsider providing financial assistance to Pakistan. As he says, Pakistan has once again started to rebuild its terror infrastructure. Prime Minister Modi met with top ministers at his residence at a time when the government is considering sending a delegation of lawmakers across parties to represent India's position on Pakistan to countries like the UK, US and others. This, of course, is something that the government is working on in partnership with other political parties. Here's Jairam Ramesh.
निश्चित रूप से इंटरनेशनल मॉनेटरी फंड से आने वाले $1 बिलियन के बड़े हिस्से को टेरर इंफ्रास्ट्रक्चर को फंड करने में इस्तेमाल होगा, ऐसा मेरा मानना है। इसलिए मैं मानता हूं कि आज के समय में पाकिस्तान को किसी भी तरह की आर्थिक सहायता टेरर फंडिंग से कम नहीं है। भारत यही चाहेगा कि IMF पाकिस्तान को अपनी $1 बिलियन की असिस्टेंस पर वह पुनर्विचार करे।
सरकार की ओर से अगर कोई इनविटेशन आता है, कोई मांग आती है कि एक बहुदलीय प्रतिनिधिमंडल में कांग्रेस पार्टी भी शामिल हो, हम जरूर शामिल होंगे और जो कुछ हमें करना है हम करेंगे। राष्ट्रीय हित सर्वोपरि है।
किरण रिजिजू जी ने फोन किया था, बोला आपको 22 या 23 तारीख को जाना पड़ेगा 10 दिन के लिए। इतना था कि मेरे पास जानकारी है, इसका आगे कुछ नहीं है। जैसे सरकार जो काम हमारा ऊपर सौंपेगी वो काम हम निभाने का कोशिश करेंगे। आई एम रेडी टू सर्व द नेशन एज एंड व्हेन आई विल बी डायरेक्टेड। भारत किसी भी कीमत से इस सीमा पर आतंकवाद को उखाड़कर फेंक देना चाहते हैं।
And continuing with Operation Sindoor, India's defence budget is expected to be increased next fiscal to bolster the country's arsenal. Sources tell CNBC-TV18 the defence industry is expecting replenishment orders worth 30 to 40,000 crore rupees. Parikshit joins us now to tell us what he is picking up. Parikshit, thanks very much for joining us. all of the ammunition, the arms that we have used through the course of Operation Sindoor, these will now need to be replenished. What are you hearing from industry? What's the expectation, the estimates that they're factoring in, both in terms of replenishment as well as any emergency procurement?
India's defense budget, Shireen, has been on the rise. We've seen how in FY26 budget, the defense outlay was 6.8 lakh crore. That is 9.5% over FY25 higher. If you look at the acquisition budget, the capital outlay, it was 1.8 lakh crore, up 4.5% over FY25. The modernization budget, in terms of what you're acquiring from domestic industries, that was as high as 1.2 lakh crore. What we are spending on infrastructure assets and R&D is around 31,000 crore rupees. Now, all of that is set to increase because of what we've seen in Operation Sindoor. Just a word on the exports as well. It's an important story. 24,000 crore worth of exports in FY25, and this could go up all the way to 50,000 crore by 2029. Having said that, yes, there is a lot of chatter within the Defence Ministry for emergency procurements and also replenishing the ammunition stocks which have been depleted. In fact, industry estimates suggest that we could be looking at orders worth 39 to 40,000 crores in the coming few weeks. The focus of the government, what we learn from sources, will be a lot on loitering munitions, AI-guided munitions, having stealth equipment, more drones, having a supply chain for low-cost, smart ammunitions, alternatives for the Scalp missile, Hammer missile, which we acquire from Israel and other nations for a very high cost. You need to have a domestic supply chain where you can get all of this very quickly. Strengthen your radar systems. Companies like L&T, Bharat Forge, Zen Technologies, drone makers, they will be in focus. And finally, having a strong base, development and manufacturing of hypersonic missiles, cruise missiles and ballistic missiles. This seems to be focus for the next few months and years.
Parikshit, many thanks for joining us. As Parikshit was taking us through what industry expects, let's listen in to some of the big voices from industry on their estimates.
With the policies that the Honorable Prime Minister put into place for the last, let's say, 10 years in the area of defense, and all enabled by our Honorable Defense Minister and the whole user industry collaborative effort that is going on between industry, DRDO, and the users, that is the services, we are all moving forward at a very rapid pace. I mean, there are a lot of things that you don't see that are happening in industry, but I can tell you and assure you that we are moving forward at extremely rapid pace. And this is not only good for our defense, but is also good for our overall economic and industrial development.
Air defense is something that we are looking at quite strongly. We have been associated with the Akash program, and many of the ground equipment for the Akash we are involved with. We are looking at close-in weapon systems, given the thrust on drone warfare. So we have our own close-in weapon systems, which we are now contracted with the Air Force for. And that's one area that we would like to scale up and speed up.
And more on the defense team. Defense stocks after Operation Sindoor have been on a tear. Top companies, including PSUs and private players, have added over 1.5 lakh crore rupees to their market capitalization since the 7th of May, with their stocks gaining anywhere between 15 and 40%. My colleague Surbhi Upadhyay is joining us now. Surbhi, self-reliance clearly is the new war cry, but also in many ways a coming-of-age story for India's defense industry.
Operation Sindoor has literally announced the coming of age of the Indian defense manufacturing ecosystem. And it's an ecosystem that has a lot of private sector players and, of course, the big PSU giants. Let me start by telling you about some of the weapon systems that were deployed in Operation Sindoor. We're talking about, of course, the missiles, the medium-range surface-to-air missiles, MRSAMs as they're called. Bharat Dynamics is a very key player here, not only when it comes to manufacturing these missiles, but it's a full systems integrator, and it played a huge part. The Akash weapon system, which we all know, which was critical in Operation Sindoor. This is a weapon system that has suppliers, across a long supply chain. So when it comes to the outer shell, it was manufactured by a company called Paras Defense. When we're talking about the warheads and the initiating systems, then Solar Industries was the name that was in play. And once again, Bharat Dynamics was the key systems integrator over here. The Nagastra loitering munitions, you know, this was a war that was fought in the sky with drones, and the anti-drone systems came into play as well. And here, Nagastra 1 and 2, which is what Solar has been manufacturing, that was, in key play. I want to talk about some numbers as well, the size of the opportunity in the industry. The projected estimated output by the Indian defense sector for FY25 is 1.75 lakh crore rupees. That number is expected to swell, or was expected to swell, to 3 lakh crore rupees by FY29. But a lot of analysts that we've been speaking to say that these targets will be hit much earlier now because the production is being ramped up, because companies are running on double and in some cases triple shifts. So all of this is getting accelerated. 193 contracts signed by the Ministry of Defense in FY25, and a whopping 92% of those actually went to domestic suppliers. By value, this is number of contracts. By value, 80% of the contracts by value actually went to local manufacturers. So that's really saying something about the extent of our Atmanirbharta. I just want to quickly talk about some of the names here. Many of them you already know. Bharat Dynamics, like I said, when it comes to missile systems, and it's right up there. It's also a key systems integrator. BEL, when it comes to defense communication and electronics. It's a big player in of course, in the Akash new age weapon system, land-based radars, naval systems, tanked armored vehicles, and all the electronic systems that go there. BEL plays a part. HAL needs no introduction, whether it's the Su-30s or the other aircraft. It recently won a massive order, HAL, 62,700 crore rupee order for the light combat aircraft that it will deliver both to the Indian Air Force as well as to the Army. And then, of course, Mazgaon Dock, Garden Reach Shipbuilders, Cochin Shipyard, the frigates, the destroyers, the corvettes, all of them being manufactured locally right here in India. But it's not just the PSUs. The private sector players are really, notching up the game as well. Of course, there are giants like Tata Advanced Systems, which are, into a range of weapon systems, whether it's launchers, artillery gun systems for the Akash surface-to-air missile systems. There's also the, advanced towed artillery gun systems, the ATAGS as it's called. And of course, a range of other optronics, radars, etc. Solar Industries, like I mentioned, when it comes to warheads and bombs, then this is a key emerging player. In fact, whether you talk about missile systems like, BrahMos or many of the others, the Pinaka multi-barrel rocket launchers, Solar is a big player in a lot of these projects, and it's a big supplier. Astra Microwave, big name when it comes to radars and electronic, warfare systems. And then there is Paras Defense as well. Again, the rocket and missile programs, warfare, surveillance, naval systems, tanks, and armored vehicles. This is not a fully exhaustive list, by the way. There are many other companies, many other SMEs as well. But the entire ecosystem, when it comes to defense, self-reliant manufacturing, indeed thriving now in India.
Surabhi, many thanks. That's a quick snapshot of where things currently stand as far as India's defense industry is concerned. Now, shares of Chelbi plunged 10% in Istanbul after the Indian government revoked the security clearance of its Indian subsidiary. What will this mean for the company's employees in India? Our colleague Madiha is standing by now to explain. Madiha, what does this also mean for airports who are in business with Chelbi? Many have decided to move forward with other players. Mumbai in specific has appointed somebody else, and also we're given to understand that Chelbi has decided to exercise legal recourse in India.
Exactly. Now, sources have confirmed to CNBC-TV18 that Mumbai International Airport has signed an agreement with ground handling company Indo-Thai to take over the employees and assets of Chelbi Aviation. The development comes after the Bureau of Civil Aviation and Security revoked the security clearance of the company, citing national security concerns after Turkey expressed its support to Pakistan. Sources said that Indo-Thai has received BCAS approval to operate ground handling services at the Mumbai airport. So nearly 3,000 Chelbi employees will be moved to Indo-Thai, and new airport entry permits will be issued under the new employer's name. To make the transition smooth, the BCAS extended the validity of the AEPs, which is the airport entry permits, till the 19th of May to have enough time for remaking the new permits. Now, Indo-Thai provides ground handling services at multiple airports in India, including Pune, Kolkata, Amritsar, Varanasi, Calicut, Bhubaneswar, Guwahati and Jaipur. Among the 9 airports that Celebi was operating at, Mumbai Airport, like you mentioned, is the only one to get a new company to replace Celebi. Other airports, including Delhi International Airport, have assigned the existing handlers, that is ASL, AI SATs and Bird Worldwide Flight Services, to absorb Celebi's staff and take over the assets. We had reported earlier that government policy mandates an airport having passenger volumes of over 10 million, they should have 3 ground handling companies. So Celebi was present at the 9 airports along with 2 more players, either AIASL, AI SATs or Bird Worldwide Flight Services. So for the first, for the time being, 2 companies will handle Celebi's operation, including airports like Delhi Airport, until a new ground handler is appointed. But at Mumbai Airport, the third operator, because Mumbai Airport has AIASL and Bird, so the third operator, which is Indothai, is already being appointed.
All right, Madhya, many thanks for joining us. Now, Chelbi Airport Services, as per Reuters, has moved the Delhi High Court against the government's decision to revoke its security clearance. Reuters says that Chelbi has highlighted that the clearance was revoked without any warning and without elaborating how the company was a threat to India's national security. Chelbi has warned that close to 4,000 jobs will be impacted and investor confidence will also be hit. The court did not set aside if the court did not set aside the Indian government's decision, the matter is yet to be taken up. CNBC-TV18 exclusive tonight. Cash-strapped Vodafone Idea has urged the government to support its funding attempts yet again. Sources have told CNBC-TV18 that if the company fails to receive support from banks and the government, it will have no choice but to file an insolvency plea in the NCLT, impacting more than 200 million subscribers. Ashmit joins us now. Ashmit, what does this now mean for Vodafone Idea? And more importantly, where does this leave the government? Does it even have a choice in the matter as a 49% shareholder?
Well, just yesterday, we were the first to report that Vodafone Idea has filed a fresh application in the Supreme Court seeking a waiver of the interest and penalty dues. Now we learn is that before filing this fresh application, there was a last knock on the door of the government by Vodafone Idea, a letter being going from Vodafone Idea to the DOT, where a bleak picture, a gloomy picture has been given to the government. Vodafone Idea saying that without government help, the company could very well be heading into insolvency, will not be able to sustain operations beyond FY26. Now, in this letter, Vodafone Idea essentially says that without the government coming on board, despite the promoters having pumped in 26,000 crores, the banks are not willing to come on board. There is no capex. The operations becomes difficult, and therefore FY26 doesn't look feasible. Beyond that, the letter also then goes on to say that the insolvency, if it happens, as far as Vodafone Idea is concerned, that will be bad for all stakeholders, saying that even for the government, which is a 49% shareholder, the value of that shareholding will come to naught. The recovery of 1.18 lakh crore rupees of spectrum dues, that will come to naught, of course, hurting the government. 200 million customers will get impacted. Digital India mission will get impacted. And on the back of this, saying that this is the line in the sand that we're drawing, the government needs to come up. Without that, we're looking at the private players shrinking from 3 to 2, that Vodafone Idea will head into insolvency, no operations beyond FY26. The government, however, on its part believes that because of the Supreme Court's AGR judgment, its hands are tied.
Ashmit, many thanks for joining us. This is going to be a tough one for the government. Now, the RBI board is likely to meet on the 23rd of May to consider its dividend payout to the government. Economists tell CNBC-TV18 that this year's surplus transfer may top 2.5 lakh crore rupees. Sapna is standing by with more in this exclusive story. Sapna, economists expecting another bumper dividend payout this year. It's a broad range that they're working at, from 2.5 lakh crores all the way to 3.5 lakh crores.
The economists are extremely positive that the RBI dividend that will come to the government sometime next week is going to be materially higher. And there are 2 key drivers that they're talking about. First, of course, are the forex operations of RBI, and plus also their bond purchases in terms of liquidity infusion that have been happening since the last couple of months. But having said that, well, I'll come to that just in a minute. In terms of the numbers, well, basically 2.5 lakh odd crore to 3.5 lakh odd crore is what the street is expecting in terms of the surplus transfer from RBI to the government of India. Now, in terms of the reasons, coming back to that, so in terms of the forex operations of RBI, everybody knows that the volume has been much higher in the last financial year as compared to what it was in FY24. But if you look at FY24, it was around $150 billion odd dollars, 150 billion worth of dollar sales by RBI, on which they got around exchange gains of somewhere around 84,000 crores. Versus that, what economists are saying is that the dollar sales in the financial year gone by have really jumped by 2.5 times. So somewhere around $375 billion odd worth of sales have actually happened by have been done by RBI. So against that, the exchange gains are going to be humongous. That's what the street expectation is. That's one aspect. Second, also in terms of the bond purchases that have happened basically to smoothen out liquidity, over 1 lakh crore easily. So there is some interest income that has come from banks to the RBI. So these two could be the key drivers. We have to also, of course, look at the investment portfolio in terms of how the yields have behaved in terms of the exposure to US T-bills. Having said all of this, there are other implications also of this RBI dividend number. Basically, with so much of liquidity that is expected to come in, it may just be possible that from the second quarter onwards, the open market operations may actually come down. This is the third expectation of economists across the board. So we'll have to wait and watch and see what really happens on that May 23rd RBI board meeting in Bombay. And last word in terms of the economic capital framework, also there's a lot of talk that review has already happened. We'll have to wait and watch and see whether additional risk buffer will be required and what kind of impact that has on the final payout to the Government of India.
Well, has been a substantial cushion for the government and is expected to be the case this time around as well. May 23rd is likely when we will know what that number is in terms of the RBI's dividend. Many thanks, Sapna, for joining us. Up next on India Business Hour, Commerce Minister Piyush Goyal to visit the US to steer negotiations on the bilateral trade deal. He will assess the progress made by the delegation-level talks. Catch all of CNBC-TV18's news and updates on YouTube, Facebook, Instagram, X and Geo Hotstar. Ozempic maker Novo Nordisk has said that its CEO Lars Jorgensen will step down. The weight loss drug company cited the decline in the company's share price as a reason for the exit. The firm's stock has fallen more than 50% since the middle of 2024. But this after rallying significantly. Also, this after prescription for the competitor's Eli Lilly obesity drugs surpassed that of Novo Nordisk. Jorgensen will remain in his post until a new CEO is chosen. The pharma giant said that search for a replacement is currently underway. Commerce Minister Piyush Goyal will travel to the US to steer negotiations on the proposed India-US bilateral trade deal. Sources say that the Commerce Minister will assess the progress made by the delegation-level talks that have taken place over the last 2 months. Abhimanyu standing by with more. Abhimanyu, take us through what we can now expect over the next week as far as the Commerce Minister's Washington visit goes.
India's Commerce and Industry Minister Piyush Goyal is in the United States, where he's going to meet the US Commerce Secretary and the US Trade Representative. Government sources have indicated that the political level meetings are going to assess the developments between both the countries with respect to the talks which have taken place since the past 2 months for a potential bilateral trade agreement which both the countries intend to sign. Also, the ministerial meetings intend to provide some political steer to the discussions which are going to be held after the ministerial level meetings, since India's negotiating team led by Chief Negotiator Rajesh Agrawal is also headed to the US, and from the 19th to the 22nd of May they are going to hold talks with their American counterparts. It remains to be seen what all is going to be on the table. Of course, issues pertaining to goods are going to be discussed for the first tranche of a bilateral trade agreement. It remains to be seen whether issues like technical barriers to trade or even non-tariff barriers are going to figure in the discussions, even as both the countries intend to utilize the window of opportunity between the 90-day pause which has been effected on the announcement of tariffs by the United States till the 9th of July.
Abhimanyu, many thanks. The US House Republicans have proposed a law which would impose a tax of 5% on all remittances sent outside the country by immigrants. The House aims to pass the Immigrant Remittances Bill by the 26th of May. India is the world's top recipient of remittances, with $83 billion sent from individuals in other countries annually. Now, if the law is passed in the US, for every transfer of 1 lakh rupees, about 5,000 rupees will go to the United States federal government. But this is not law yet. It is something that has been proposed. And President Donald Trump has concluded his first official tour to West Asia, bagging investments worth more than $2 trillion. Trump hailed the Gulf nations for their deepening ties with the U.S. He also made his last stop in Abu Dhabi, where he participated in bilateral meetings at the presidential palace. He's also announced deals worth more than $200 billion during his visit today. Israel has stepped up its military operations in Gaza and West Bank. This comes a day after U.S. President Trump floated his idea of making Gaza a freedom zone. Israeli forces have reportedly killed at least 143 Palestinians in Gaza in the last 24 hours. And the talks between Russia and Ukraine in Istanbul concluding in less than 2 hours without any significant breakthrough. This was the first time that Russia and Ukraine held direct peace talks in more than 3 years. Amidst pressure from the U.S., a Reuters report suggests that Moscow's demands were detached from reality. Earlier, U.S. Secretary of State Marco Rubio had warned that without Russian President Putin and U.S. President Trump, there may not be a breakthrough at all. And Russian Foreign Minister Sergei Lavrov has claimed that Western nations are plotting to fracture the relationship between India, Russia and China. Speaking at an event, Lavrov said that policies of the West clearly are anti-Chinese and are pitting our neighbors against each other.
What is happening right now in the Asia-Pacific region, the West has begun to call it the Indo-Pacific region in order to give its policy a clear anti-Chinese direction, hoping to thereby additionally gain the opportunity to pit our great friends and neighbors, India and China, against each other. Recently, President Putin recalled that it's simply a divide-and-rule policy.
Well, that's Russia's foreign minister there. And with that, it is time for us to wrap up this edition of India Business Hour. From all of us here, thanks very much for watching. But do stay tuned. The news will continue on CNBC-TV18. We're going to be back with a lot more.
The Lal Street clocks huge gains this week, with the broader market seeing a big buying. The Nifty and the Sensex are up 4% this week. The Midcap index has recorded its biggest weekly gain in the last 2 months. Hello and welcome to the Editors Roundtable. Today on the show, we take you through all the market action of the week, take stock of all the big block deals that have started taking place again in the last 2 odd weeks. And we will also put the spotlight on mutual funds and whether they have enough firepower to keep buying in this market. I'm Surbhi Upadhyay. With me on the show, of course, Nimesh and Nigel. And also joining us today in the studios right here with us is Gautam Charchoria, Head of Global Markets, UBS Securities. Gentlemen, great to have all of you in. And Gautam, thank you so much for being here in person. I can tell you personally, for me, this doesn't feel like a 5-day week. It feels like, 2 weeks have ended, given the volume of information and news flow, guys.
Yeah, news flow, I mean, markets have also been so surprising, like how we get surprised every day with the Trump tweet, right? I mean, every day is a shocking tweet from him. And I think markets have also shocked a lot of investors. They're sitting on cash, a lot of HNIs are out of the market, and boom, the indexes are 4%, mid-cap indexes rallied pretty hard. All the stocks, the defense stocks are up 15, 20, 25% in just 4-5 days.
Yeah.
That's the kind of market we've seen in the last 1 week. So it's been crazy, as you rightly pointed out, doesn't feel like it's a 5-day week. I mean, it's been like
It feels like we've been working for 2 weeks.
Absolutely.
Because the news flow is so intense. It's actually quite astounding, right? Who would have thought that you have the whole trade war issue, this Liberation Day disruption. Then from a trade war, you've moved to a real geopolitical war.
Yeah.
And in that scenario, in those 4-5 weeks, this market will rocket 15%.
Well, that's right. And Trump, Nimish, one tweet a day is okay. Sometimes it's different in the morning, different in the evening. Depends on which side he is waking up as well. And the other point is, as you said, this rally has been so swift. A lot of money sitting at the sidelines, just waiting for that dip, which eventually hasn't yet come. So they'll have to rush in maybe at some point.
It looks like, I think you're going to put out a piece on the amount of mutual fund cash people are sitting on. But even generally, I talk to so many large investors, and everybody seems to have left out. I mean, there is a lot of left out feeling now. Gautam, you must be talking to a lot of clients as well. Generally, is that the sense that, everybody got just caught by surprise and there is a lot of left out feeling now?
If any sharp move, no one can participate, especially when you have moves early in the morning also. It's very difficult, right, for them. And this left out is both global and local.
And the thing is that, and that's the hardest thing, right, in the market, that to buy when the news flow is still negative. Because everybody thought there will be another dip and there'll be another leg down and then we can buy, we'll get better prices. But it just... Throughout all the negative news, the market just kept rallying. So what's happening?
And you all know, right? Nigel, we used to talk to a lot of experts on the channel as well. At 22,000, everybody had come out and said, Kyo, next is 19,500 and maybe 19,000 on the Nifty.
We did say market is bottoming out.
But I remember, Gautam, at that time also you were a little bullish. Even from the sidelines of the conference and all, you said, we feel it's good level to enter at 22,000. Still hold on to that view that 22,000 is a kind of near-term bottom for the Indian equities?
After the long week, everything is falling in place. Narrative is good, flows are good, sentiment is positive. Even Trump, the tweet world is positive for now. But the risk reward at these levels is obviously not attractive as at 22,000.
Correct.
So our Nifty target is 26,000.
Sure.
So there is still some momentum left. I think it should retest the earlier lows, earlier highs.
Sure.
But risk reward is no longer feeling as attractive. So do we recommend investors jump in at this level in a big way? No.
Well, Gautam, don't say recent lows. We went to 21,900, then everyone said we missed that, and then we visited 21,700. So hopefully that's the near-term base in place. But I wanted to ask you, we're at Nifty's at 25,000. Everyone's thumping the table. This is the highest since October 15th. But a lot of small cap stocks, the small cap index itself is still 12-13% away from the same day, that's October 15th. If you look at even the Nifty next 50, that as well is more than 10% down. Do you think from here on, the headline index could take a bit of a backseat and maybe the broader markets outperform, or would you stick to the large cap names?
We are still sticking to the large cap names at a very broad market level. For the small cap world or even the mid cap is okay. Small cap world specifically, what we saw in last year, I think that the requisite conditions are still not there. Right? There's not enough euphoria. There's optimism, but not enough euphoria for it to be driven high. And again, the other thing to keep in mind, this is only last year. A lot of retail investors, even the small cap funds, etc., the memory is fresh that the drawdowns or losses can be sharp. So for that to go back very quickly at an euphoric level, I think will take some time. So large caps will still be fine.
Let's talk about the block action.
Well, now we'll focus more on numbers. So I'll talk about some large blocks which have happened and which have taken place, and we'll ask you about your views as well. So last 10 days or maybe 12 days, there has been block deals worth 17,000 crores. So nearly $2 billion is what we've already seen. The promoters are PE encashing in this pullback. So to start with, today itself we saw a large block in Bharti Airtel. Singtel sold a little over 1% stake for 13,000 crores. So that was a large block which happened today itself on Friday. Even JSW, there was a large block where the promoter entered it through the trust. They sold 2% stake and they raised close to 1,200 crores. The other big notable deal was Paytm, where Ant Financial sold 4% stake. They own 10%, they've sold 4%. So still some left, but that again was a very large block deal. The other large interesting deal was K Fintech. They came out with a solid set of numbers, but then General Atlantic came and sold 10% stake in one single day, and they've rose close to 1,700 crores there as well. So quite a bit of large deals which have already happened. But when I talk to some large funds or for that matter the investment bankers, it seems like the pipeline is quite strong for the next 2-3 weeks. As in when the earnings season gets over and there is an opening window, there's going to be large blocks. I'll just run through a few names which I have heard of where there could be large potential deals. To start with, Asian Paints, the strategic investor is likely to sell a large stake. Then it's going to be a large block as well. Some of the names where private equity will keep selling stake. Zomato is one, Swiggy is the other name. Keynes Technologies yesterday reported very strong set of numbers, but again, there the expectation is that it could be a decent sized block. Aptus Wealth, again, a private equity sitting there. They're going to sell one-fifth of their stake. Ami Organics, OneSource, and Apollo Tyres also could be an interesting name there. You know, again, came out with decent set of numbers. The commentary was strong, but again, there is a private equity who owns 10%, and there is a strong buzz that they'll sell half of their stake as well. So again, that's going to be quite a sizable number that's going to come out. Apart from the block deals, Surbhi, the other interesting kind of observation has been the kind of MNCs which are looking to exit or sell out their stakes. You know, this week, like Thursday, Friday, we had a large OFS. In terms of size, it's a large one. Wendt is looking to sell its entire 37.5% stake in the Indian company. So that's while in size it was only 500 crores, but they're selling their entire 37.5% stake. So that's one big exit. Next week, by 20th, there is Whirlpool's board meet for results. And we all know that the parent has gone on record saying that they're looking to sell 30% of their stake in India. So the MNC is selling out, P is selling out, promoters looking to exit in some form. So looks like, now that we are fag into the earnings season, this is only going to pick up, and there's going to be more momentum in terms of large blocks and large supply. So Gautam, how do you read? Traditionally we've seen a supply of paper means it's negative for the stock, but that's all out of the window in the last 2 years, right? We've always seen stocks actually going up after large blocks. So what's your take?
So I don't think the first line I would agree with, that traditionally supply means necessarily markets come down. It's in the context of markets.
No, I'm saying generally,
the stock would fall. On the day of a block trade, the stock would fall, but now it gets, it reverses.
See, what I meant was that when the insiders sell, a PE selling or a promoter selling, generally it's been perceived as negative, and they would know better than anybody else, right? So from that perspective, in the last 2 years, that's not been the trend. So
that reflects the level of cash sitting around.
Correct.
Very simply. There's enough.
Too much of liquidity chasing limited.
And then cash levels, like locally with the funds, even appetite in general, beyond the institutional funds, also the appetite with the retail, high HNIs, the cash levels are just too high. So that's the reason, very simple reason. And also the backdrop of sentiment, right? The market sentiment today versus a month back is very, very different. So I think this was pent-up supply. We had almost a quarter where we didn't do much, unlike last couple of years. So this is going to, I think, if market remains where they are, this will continue.
But Gautam, isn't it going to be a bit of an overhang? Because I know the argument is that our markets have deepened and now we can absorb all this block supply. But the scenario versus, there's one difference that I want to talk about, and Nigel will speak more about this. In October, around November, December, mutual funds were getting in 40,000 crores, 42,000 crores of just equity inflows every month. Now that number is halved. Now they're getting 25,000 crores on a net basis. Yes, the SIP book is strong, but that net number has halved. So in the previous block cycle, when the markets peaked out, domestic institutions and mutual funds were big buyers. Do you think that will hold true right now? Or is this the fact that insiders are selling, whether it's promoters or PEs, it's also an indication, right? Market's back at 25,000. So isn't it indicating that this is a near-term top?
So I think for the foreseeable future, not necessarily. I think markets can absorb, also given the very high cash levels, not just the inflows happening. So I think there is enough room for it to absorb. And even if you put these numbers, whether you look at IPOs or blocks or QIPs, in dollar billions or rupees crore, they seem very, very high. But it's not necessarily off the charts if you go back to, say, pre-GFC, as a percentage of market cap, etc. So there is precedent for these numbers to actually even go higher. And there's enough cash levels today. So I won't worry about that for now. We were worried about it a bit towards the end of last year when it was reaching that level. We are far from that.
Okay, all right. Gautam, I wanted to ask you, if the markets are in a better place, then how do you play these financialization stock market plays? BSE people said that it was expensive at 5,000. It went to 7,000. Angel Run saw a sharp correction. I think in the recent low, 2,000 has become 2,800 rupees, just to state a few examples. How would you play this? Would you play the wealth management listed companies? Would you play the brokers? Would you play the stock exchanges? Both MCX and BSE have done very, very well. Your take.
So by the way, before he speaks, they've already played, in India, by buying 5% in 361. So UBS actually is now 5% holder in 361.
Yeah, so I name the others. Yeah, go ahead.
I can't comment on that. Obviously.
That's a separate.
But like, our research team is broadly positive on the financialization as a thematic. And one of the things we pick up from investors globally, not just investors here, is India is one of the unique capital markets and much more similar to US, for example, this financialization theme. Like investing, saving, capital markets, it's much more similar to that market. So in that context, what we are seeing at a sector level is not surprising. And there's still a long runway left for them to keep on growing.
Sure. Okay, I think we have to take a quick break. We have to discuss a lot of other sectors and your whole strategy for this market now. Take a break and come right back.
Welcome back. You're tuned in to Editor's Roundtable. Well, let's focus on the big focal point then. The equity mutual funds are sitting on solid ammunition, and the cash levels that they're sitting on is actually the highest we've ever seen. So the cash market levels in percentage terms, as a percentage of the total equity AUM, is at around 7%. You know, just take a look at the way it's moved up. From around 5.5%, it's gradually moving up. Now at around 7%, if you look at it in absolute terms, it's around 2.15 lakh crore. Remember, we're talking about the core equity AUM out here. The cash levels are around 2.15 lakh. So it makes sense to pull up some of those, mutual funds that are sitting on a good amount of cash. SBI, well, they are sitting on close to around 36,000 crores. PPFAS on a base of less than a lakh, they're at around, 24,000 crores or thereabouts. Around a lakh is what their AUM is. ICICI Prudential at around 28,000 crores, and HDFC Mutual Fund, they are as well at around 25,500 crores. But it makes sense to look at the cash levels that they're sitting on, and if you compare it with the total equity AUM, and that number comes up for you in the screen. So just take a look at PPFAS. They're sitting on cash, plenty of cash, a lot of firepower available with them. Similar is the case with Motilal Oswal Mutual Fund, Quant Mutual Fund, as well as SBI and Axis Mutual Fund. So all of them sitting on a good amount of money. Now the question is, why are these equity mutual funds sitting on a lot of cash? Three possible reasons. One is that in case of times of uncertainty, you want to have some kind of liquidity, some kind of ammunition in your hand. So that could be one point. Now, the question is, will they be forced to rush in? Because now the macros are improving. You look at the Indian rupee, you look at the crude oil prices that have come out as well. FI flows have been gradually coming in there. And the RBI, they have managed things very, very well, both on the liquidity front as well as the rate cuts that the market is anticipating. The problem is that there could be a bit of a negative, and that's why they're sounding a little bit cautious and they're sitting on this cash. Because of what we were discussing, right? The supply overhang. OFS, there are lock-ins that could come off as well, and you could see some kind of supply that's coming in there. So are they signaling something, or are they going to be forced to rush in? Equity mutual funds sitting on cash of close to around 2.15 lakh crore. Well, Gautam, I wanted to ask you, we briefly discussed this as well in terms of the cash levels, but tell us how you're reading earnings, because ultimately earnings are what drive this market, right? And Q4 wasn't expected to be good, but the street was looking forward to commentary for the coming quarters. Are you satisfied?
So I think it's a question of expectations more than absolutes. So the expectations are still not optimistic in general. People are expecting second half recovery. Yeah, exactly. That's what happened in the 4Q till now. The expectations were running very, very low.
In that context, the numbers are better?
Marginally. Marginally. Again, a mixed bag as always. But
at the house level, are you expecting some upgrades after the Q4 earnings?
So our strategist believes that double-digit earnings growth, which is being talked about in the market for the full year fiscal 26, is reasonably likely. Having said that, I think given the way the policy easing cycle has happened or is happening, that's still not played out completely. Will there be room for that? Every year we talk about 15% growth and the numbers
the negative surprises. Will we have positive earning surprises?
At least it's much more going to be closer to expectation, if not beating the cycle. Because I think the market is still not completely, including strategists and analysts, in my view, building in completely the effect of easing cycle. And we are seeing meaningful easing cycle, both RBI and central government. Again, one last thing to remember there, over this year and next year, fiscal 26 and 27, we'll see 2% of GDP consumer stimulus. 2% of GDP from the social welfare schemes, the pay commission, and the tax break, which is meaningful. It's meaningful. So at a bigger picture level, one of the simple calls the strategists are making, which we believe in, is this is the next year or two, consumption as an overall theme should do much, much better than they have in the last couple of years.
So let's narrow down a little bit more, right? What do you like from the consumption basket?
So we like everything, from staples to discretionary to leisure to hotels, everything. But obviously within that, the aviation / leisure / hotels, they are better placed. For sure.
And they bounce back big time as well in this week.
But they can do.
One sector, my home sector, so to call it, like I have a home ground. Cement is a sector that I've been trying.
Home or
Friday evening.
Metal,
I'm surprised
and the other stuff.
Okay, let's give you an option then. Both my favorite sectors. One is the cement one, which I track very closely, and the other one is where I contribute.
Contribute very closely as a consumer.
Cement had a very, very rough last year, but now things are looking up. Pricing are moving up, demand is better, and input costs are down. And the other one where there is an immense consumption boost and immense scope out there is alcohol beverages. Which one do you like?
Alcohol beverages, you have to also look at the FTA impact. We'll see how that plays out. It's still early in the day. So I think the answer is very clearly towards cement. Cement, both from the input cost, demand surprise possibility, and also I think the housing cycle is still, in our view, underappreciated. So that has much more, not just the real estate is one part of it, but the broader housing, government spending on housing, for example, that has more legs than is being built in our view.
Sure. Okay,
but just one more question on the cement pack. Would you go with these larger names? I'll tell you why. Because when times are a little bit dull, then people like to hide in the larger names. But when the cycle is going to turn, for example, a couple of these south-based cement companies came out with below expected numbers or weak numbers as well. But the stocks are up because the street is saying going ahead is going to improve, and then that buzz about M&A and all that. So what would you like?
So typically, that's what happens. The smaller ones do well. We don't have coverage of the small cement names, but yeah, that's where the operating leverage is more. But even on the large cap, I think it's not been a case where a large part of the large caps are trading at very rich valuations. There are pockets there which are very well placed, very attractive, even from a valuation perspective. So our preference is risk reward wise still the large caps, but obviously if you have the risk appetite, then go down.
So we spoke a lot about the domestic triggers and the earnings and everything. What about the global setup? Are we just forgetting that what's happening in the US, what's going to happen with the tariffs? is something still a serious concern which one should watch out for?
It is an overhang for sure, which we have, I think, pushed it out a bit, waiting for the next tweets or whatever. But again, look, the one good respite in general, where I think the global economy and investor class is getting some comfort, is ultimately we did see a pullback on the tariffs on China, and a sharp one. It's not going from 145 to 60 or 80. It's a sharp pullback, which in a way tells us, okay, the tariff is a new reality. US will have tariffs. Possibly, even you look at the US-UK FTA, you have 10% in general. So 10% will be a tariff. So the weighted average tariff from US on the economy globally will still be higher than it used to be last year in any scenario, and which will be therefore a drag on growth, at least in the near term. But at least it may not be as extreme as 2 months back. So there is some respite, but uncertainty and overhang, absolutely. We still don't even know.
What's the UBS US House view in terms of recession, in terms of growth? What's your big call?
So there is a reasonable chance of recession, but again, short-lived, not a long-lived one, for a quarter or two. Reasonable probability, that's not necessarily the base case. The base case is maybe for a quarter, but not sustained recession.
But will that be disruptive for emerging markets like India?
So question is, recession is a one data print, right? Yeah, but that data print happening in the context of the overall tariff and direction of that, then market might just look through that.
Ignore it. Okay.
Yeah. But if it's a broad-based tariff disruption, again, I think the bigger issue now, given what's happened in the last 3 months, is uncertainty rather than the level of tariffs. The level of the tariffs, people are less shocked today, about 20-30% than they were 3 months back.
I think that's how you play it, right? When you say 145, 30 looks absolutely fine. You know,
That is also not small, right?
That is very small.
Uncertainty is a thing.
Yeah, so it's like our earnings. You know, we were so much low in terms of expectations.
So you know, 6-7%, volume growth of 5% on an FMCG company. It's like wow.
If you look at the global thing, US, China, at least we have some sense of next 2-3 months something will happen.
Yeah.
UK is already done. Europe is the missing piece, but again, UK, China template will get done. India, anyway, we are hoping that will get done soon. So I think large part of the economy will have uncertainty behind us in next couple of months.
In the near term,
Surbi, just to wait, it's like you used to coming home at 2-3 a.m. in the morning after a good party night. You come at midnight, it's a lottery.
It's like early.
Mom will be surprised.
Yeah, parents can't believe it.
Why will be surprised what happened?
But you're making like that. It's all about expectations, right? And the reset therein. Gautam, since we're talking global, I'm just curious, what are the conversations that you hear or pick up on when it comes to foreign money and foreign clients? Because as this thaw continues between US and China, I was always watching out for the days the Chinese market was rallying, because we know that in the valuation context, China's much cheaper, right? And you also have the, a lot of the tech plays, which are very high-tech sort of plays, which you don't have here in India, bigger size businesses. And the world has largely ignored all that. The Chinese market has been in the doldrums. So is the China revival, a tactical revival maybe, in equities, could that be a risk for India in the near term?
You mean more from a flow perspective?
From a flow perspective, yeah.
Yes and no. Like, I think in general, if China revives, it's actually great for EM as an asset class.
Yeah, correct.
So India
because the EM basket does well.
Everybody will get the money.
And the second part, unlike last year, India's positioning for global and EM investors is not that heavy. It's still neutral, underweight, depending on how you look at it. It's not that investors have gone overweight India in a material way, unlike, say, a couple of years back or a year and a half back. So the positioning is also not, I won't worry about that aspect. I think it will be good, because China recovery means EM asset class. China recovery also means good global growth.
Yeah. So overall, it will be good. Got that point. So I'm going back to now what you like. Just to recap, you spoke about cement, which is something that you like. Capital market plays, we spoke about that. What else? I mean, house view, what is the biggest bullish?
Consumption is the biggest one, as a simple thematic, specifically given how investors are positioned, priced in, what they have done in the last couple of years. So that's the obvious big bet for us. Financials remain a big bet, and then real estate.
I want to ask you on defense. We've seen a big recovery in the defense stocks. Then some of the defense, schemes, mutual fund schemes, the NAVs have moved up sharply from 15, a low of 15 to now 23. Do you think it's a decadal opportunity, the way we've shown up our strength and the Indianization which is happening? Do you think defense could be a big play from here as a thematic play?
Yeah, so the policy environment suggests that. That policy environment, despite the fiscal constraints India has, just the localization should be a big driver. This thing always difficult. It's easy to say 10-year themes, but always difficult. But again, you've seen what happened to defense in Europe also.
True.
But the difference here in Europe is looking at increasing spending structurally.
Yeah.
That's not the case in India necessarily, given the fiscal constraints. But within that, a much more higher localization. Again, early signs suggest it could continue for long. Sure. That's what the markets are already possibly pricing in.
Yeah.
Our analyst remains bullish.
Okay. You'll have a bullish house view on the defense.
Okay, so market, let's say 6 months from now, by the year end?
Unlikely to be down.
Okay. That's a good way to put it.
Unlikely to be down. Okay. But do you make higher than risk-free returns? That's a tricky one to answer right now.
Okay. Well said, well put, Gautam. Thank you very much. Great conversation. Thanks so much for dropping by. And we look forward to more of these in perhaps the coming Fridays as well. Thank you.
Thank you.
Well, with that, guys, it's time to say goodbye. I guess it's a wrap on this edition of Editors Roundtable then. Thank you very much for watching. News and updates continue right here on CNBC-TV18.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Operation Sindoor sets the Indian defense manufacturing juggernaut rolling. Sources say the government may hike its defense budget next year. Industry expects replenishment orders worth up to 40,000 crores. Defense stocks add over 1.5 lakh crore rupees to their market capitalization since the start of Operation Sindoor. India and Pakistan to decide to extend the stoppage of military action. Defense Minister says India will keep Pakistan on probation until its behavior improves. Prime Minister Modi meets top ministers at his official residence, even as the Indian government considers sending a multi-party delegation to various countries to present India's stance. Turkish ground handling service provider Çelebi moves the Delhi High Court against a revocation of its security clearance by the government of India, says the move will hurt over 3,000 jobs. But sources say Indian airports have begun roping in other service providers to replace Çelebi. The company's shares plunged 10% in the Turkish markets. CNBC-TV18 exclusive. Vodafone Idea urges the government to support its funding attempts as banks have not been forthcoming despite a 26,000 crore rupee equity infusion and the government becoming a 49% stakeholder. Warns it may have to file for insolvency if this continues. The RBI board is likely to meet on the 23rd of May to consider a dividend payout to the government. Economists tell CNBC-TV18 this year's surplus transfer may top 2.5 lakh crore rupees on account of forex operations and bond purchases. Commerce Minister Piyush Goyal is set to visit the US to steer negotiations on the bilateral trade deal. Sources say he will assess the progress made at the delegation level over the last 2 months. He will meet with his counterpart Howard Lutnick and US Trade Representative Jameson Greer. President Trump wraps up his 3-day West Asia visit by signing a flurry of deals worth over $200 billion with the UAE. The three-nation trip has yielded deals worth over $2 trillion, claims the White House. Israel steps up military operations in Gaza and the West Bank a day after US President Trump refloats his idea of changing Gaza into a freedom zone. Reports say over 120 Palestinians have died in the attacks in the last 48 hours. No significant breakthrough in peace talks between Russia and Ukraine in Turkey. The first direct peace talks between the two warring nations in over 3 years lasted close to 2 hours. A source of the Ukrainian side tells Reuters that Moscow's demands were detached from reality. Well, let's start with the market action. The Indian market saw huge gains this week, and what a surprise that's turned out to be given the week that we've seen. The Sensex and the Nifty up 4% each. That's the story that's played out for the Nifty over the week. 4% higher, almost a 7% gain there as far as the Midcap index is concerned. The Sensex up by almost 4% as well. So we've seen a strong close, not just for the day, but for the week as far as our markets go. But the big story that we continue to track, India and Pakistan have decided to continue to extend the military stoppage, but Operation Sindoor is not over yet. That is the India point of view. The Indian Army has said that confidence-building measures to reduce alertness levels will continue. Meanwhile, Defence Minister Rajnath Singh visited the Bhuj Air Force Station to review operations. Bhuj, in fact, was one of the military sites that Pakistan attempted to attack last week. The Defence Minister warned that India has kept Pakistan on probation until its behaviour improves. He's also called upon the IMF to reconsider providing financial assistance to Pakistan. As he says, Pakistan has once again started to rebuild its terror infrastructure. Prime Minister Modi met with top ministers at his residence at a time when the government is considering sending a delegation of lawmakers across parties to represent India's position on Pakistan to countries like the UK, US and others. This, of course, is something that the government is working on in partnership with other political parties. Here's Jairam Ramesh.
निश्चित रूप से इंटरनेशनल मॉनेटरी फंड से आने वाले $1 बिलियन के बड़े हिस्से को टेरर इंफ्रास्ट्रक्चर को फंड करने में इस्तेमाल होगा, ऐसा मेरा मानना है। इसलिए मैं मानता हूं कि आज के समय में पाकिस्तान को किसी भी तरह की आर्थिक सहायता टेरर फंडिंग से कम नहीं है। भारत यही चाहेगा कि IMF पाकिस्तान को अपनी $1 बिलियन की असिस्टेंस पर वह पुनर्विचार करे।
सरकार की ओर से अगर कोई इनविटेशन आता है, कोई मांग आती है कि एक बहुदलीय प्रतिनिधिमंडल में कांग्रेस पार्टी भी शामिल हो, हम ज़रूर शामिल होंगे और जो कुछ हमें करना है हम करेंगे। राष्ट्रीय हित सर्वोपरि है।
किरण रिजिजू जी ने फोन किया था, बोला आपको 22 या 23 तारीख को जाना पड़ेगा 10 दिन के लिए। इतना था कि मेरा पास जानकारी है, इसका आगे कुछ नहीं है। जैसे सरकार जो काम हमारा ऊपर सौंपेगी वो काम हम निभाने का कोशिश करेंगे। आई एम रेडी टू सर्व द नेशन एज एंड व्हेन आई विल बी डायरेक्टेड। भारत किसी भी कीमत से इस सीमा पर आतंकवाद को उखाड़कर फेंक देना चाहते हैं।
And continuing with Operation Sindoor, India's defence budget is expected to be increased next fiscal to bolster the country's arsenal. Sources tell CNBC-TV18 the defence industry is expecting replenishment orders worth 30 to 40,000 crore rupees. Parikshit joins us now to tell us what he is picking up. Parikshit, thanks very much for joining us. all of the ammunition, the arms that we have used through the course of Operation Sindoor, these will now need to be replenished. What are you hearing from industry? What's the expectation, the estimates that they're factoring in, both in terms of replenishment as well as any emergency procurement?
India's defense budget, Shireen, has been on the rise. We've seen how in FY26 budget, the defense outlay was 6.8 lakh crore. That is 9.5% over FY25 higher. If you look at the acquisition budget, the capital outlay, it was 1.8 lakh crore, up 4.5% over FY25. The modernization budget, in terms of what you're acquiring from domestic industries, that was as high as 1.2 lakh crore. What we are spending on infrastructure assets and R&D is around 31,000 crore rupees. Now, all of that is set to increase because of what we've seen in Operation Sindoor. Just a word on the exports as well. It's an important story. 24,000 crore worth of exports in FY25, and this could go up all the way to 50,000 crore by 2029. Having said that, yes, there is a lot of chatter within the Defence Ministry for emergency procurements and also replenishing the ammunition stocks which have been depleted. In fact, industry estimates suggest that we could be looking at orders worth 39 to 40,000 crores in the coming few weeks. The focus of the government, what we learn from sources, will be a lot on loitering munitions, AI-guided munitions, having stealth equipment, more drones, having a supply chain for low-cost, smart ammunitions, alternatives for the Scalp missile, Hammer missile, which we acquire from Israel and other nations for a very high cost. You need to have a domestic supply chain where you can get all of this very quickly. Strengthen your radar systems. Companies like L&T, Bharat Forge, Zen Technologies, drone makers, they will be in focus. And finally, having a strong base, development and manufacturing of hypersonic missiles, cruise missiles and ballistic missiles. This seems to be focus for the next few months and years.
Parikshit, many thanks for joining us. As Parikshit was taking us through what industry expects, let's listen in to some of the big voices from industry on their estimates.
With the policies that the Honorable Prime Minister put into place for the last, let's say, 10 years in the area of defense, and all enabled by our Honorable Defense Minister and the whole user industry collaborative effort that is going on between industry, DRDO, and the users, that is the services, we are all moving forward at a very rapid pace. I mean, there are a lot of things that you don't see that are happening in industry, but I can tell you and assure you that we are moving forward at extremely rapid pace. And this is not only good for our defense, but is also good for our overall economic and industrial development.
Air defense is something that we are looking at quite strongly. We have been associated with the Akash program, and many of the ground equipment for the Akash we are involved with. We are looking at close-in weapon systems, given the thrust on drone warfare. So we have our own close-in weapon systems, which we are now contracted with the Air Force for. And that's one area that we would like to scale up and speed up.
And more on the defense team. Defense stocks after Operation Sindoor have been on a tear. Top companies, including PSUs and private players, have added over 1.5 lakh crore rupees to their market capitalization.